uncertainty. I'd say over the short term, it's likely a positive when we think about the equity markets because you're going to see that big boost to growth coming into next year. But thereafter, we're left with the hangover of the deficit and that ever-expanding deficit. If you think about the estimates that have been thrown out over the course of this bill, it's 1 trillion, 2 trillion, 3 trillion, 4 trillion. It's like these numbers don't even mean anything. So it's going to be a meaningful impact and probably create somewhat of a floor on yields over the course of time.
So that's all the global market action that we have for you all this morning. How is all this going to be impacting our Indian markets? We have a team of research joining in with us as always to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. First up, we have Hormaz joining in with us to get us the market cues that we should be keeping an eye out on. Obviously, a lot that are going to be happening in the world of IPO and new listings coming up. But market cues, what's the indication there, Hormaz?
Morning, Winnie. It's been a couple of days of consolidation, right, for the markets after the last week of a rally that we saw on the indices. The only difference being that the range is getting narrower. We traded in a 190-point range on Monday. That range came down to just 90 points in yesterday's trading session. We just managed to end in the green after recovering from the lows, and part of that is of course attributed to the Nifty Bank because that emerged as the outperformer, recovering almost 300 points from the lows of the day, and that recovery in the Nifty Bank happened courtesy of the outperformance that continues in the PSU Bank index, which was up for the 6th straight day yesterday, has almost added almost close to 80,000 crore rupees in market cap over this 6-day up move in the PSU Bank index. Now, even the broader markets saw a bit of a recovery in the second half of the trading session. We saw some profit booking initially, but the mid-cap index recovered almost 300 points from the lows. The small-cap index recovered from the lows as well, so that turns out to be a positive. Now, although they've made a lower high on the charts, the bulls will be happy for the fact that they still managed to hold on to 25,500 on the Nifty. Of course, as you mentioned, the big day today for HDB Financial, the biggest IPO of the year so far, will be listing today. It was a healthy response to the IPO led mainly by institutional investors, so we'll keep an eye out on that, and as a result of which we keep an eye out on its NBFC peers as well as to how they react to this valuation differential. Of course, Monday's high remains the key, 25,662. That's the first barrier to cross for the Nifty and for the Nifty Bank as well. The Monday's high, which is a record high level of 57,614, will be the key level to watch out for. Business updates continue. All eyes will now be on these big banks and the big FMCG companies as to what they report in their provisional updates for the quarter. For now, the GIFT Nifty is indicating a slightly subdued start. We see how the day unfolds.
Absolutely. We'll keep an eye out on how the day unfolds. As of now, it's up 22 points. But let's move on and go across to Upasana, who's here to tell us which are the important stocks to watch out for in today's trading session. Good morning, Upasana.
Good morning, Winnie. First up, a lot of stocks in focus on the back of the monthly sales for the month of June in terms of auto sales. First up, let me start with Hero MotoCorp. The company has seen an uptick of 10% in terms of its auto sales at 5.54 lakh units on a Y-on-Y basis. Hyundai also in focus as company's total monthly sales stood at 60,924 units and company's SUV's contribution stood at 67.6% of the total domestic sales in June 2025. Maruti Suzuki also reported its numbers for the month of June and the total sales was down nearly about 6.3%, largely in line with the CNBC poll on a Y-on-Y basis. Now let us look at the Q1 updates. Key stocks in focus. First up is the V-Mart Retail. The company's total revenue from operations saw an uptick of 12.6% on a Y-on-Y basis and same store sales growth stood at just about 1%. South Indian Bank also reported its provisional numbers. It is a weak start for the year for the bank in terms of loans, and deposits saw an uptick of 9% on a Y-on-Y basis and sequentially saw growth of about 5%. MOIL is the next one on our radar. The price of all chemical grades have been increased by the company by nearly about 2% with effect from July 1. Lupin also in focus as US FDA has approved companies ANDA of loteprenol etabonate ophthalmic gel. Hence, this stock also will be in focus. RITES also will be in focus as the JV company has received LOA from Southwestern Railway for nearly about 37.8 crores. So, all in all these stocks will be on our radar today.
Okay, Upasana, thank you so much for that. But finally, Mangalam is here to tell us what's going to be happening in the world of F&O. Mangalam, like Hormaz was also mentioning, last couple of days of a bit of consolidation. So what should we watch out for now in the world of F&O?
Well, the market's biding time right now, ahead of any major triggers. So that's exactly what's taking place yesterday as well and the previous trading session. The good part yesterday was there was recovery from lows that we saw towards the latter half of trade. The Nifty Bank was the one that led that recovery, and the mid-cap index absolutely flattish, and that was reflected in the advanced decline as well. Almost an equal number of stocks advanced and declined, so that ratio was split right down the middle. Those lines intersected towards the end. 2,000 crore worth selling by FIs in the cash market, nothing really to worry about. The DIs went ahead and bought close to 771 crores. Importantly, the FIIs also did not do much in index futures. A mild sell of close to around 116 crores, of which there was almost an equal amount of long and short additions. So their exposure, which was at 38% yesterday, stands at 37% today on the long side. And because it is consolidation that the street is playing for, and tomorrow is the weekly options expiry, the options that are active are also suggesting some sort of range-bound move. 25,500 put. That added close to around 35 lakh shares in premium. 60 rupees telling you around 25,450 is an important support. And on the way up, we have 25,650, 25,700, which is very close to the last couple of days' highs, where there is some supply, which is likely because that's where the 25,600 calls are extremely active. On the way down, we'll watch out for yesterday's low on the Nifty Bank as well as the Nifty. That suggests that there was some support from, even in consolidation levels, we saw some recovery from there. And in terms of stocks, IDFC First was fairly well bid yesterday, a lot of long positions added. And I'm watching out for a couple of these consumer durable names too. We saw a lot of long positions being added on names like Amber as well as Blue Star. So do watch out for that.
Okay, absolutely, Mangalam. We'll keep an eye out on these names as well. Thank you so much for that. But on that note, we're going to slip into a very short break. Don't go anywhere. We'll come back with more news and updates after the break. Welcome back to Power Breakfast on CNBC-TV18. Now let's move on. The Union Cabinet has cleared an employment-linked incentive scheme with an outlay of over 1 lakh crore rupees. The Cabinet has also greenlit a new research and development fund worth around 1 lakh crore rupees. Both these are budget announcements made by the Finance Minister earlier this year. Abhimanyu Sharma is joining in with us to give us more details on this front. Abhimanyu.
Two schemes aimed at employment and research respectively have been approved by the Union Cabinet. The first is the employment-linked incentive scheme with an outlay of nearly rupees 1 lakh crores, which has been approved by the Cabinet, which is going to provide nearly a month's wage to first-timers in 2 installments. The provision allows for payment up to 1 month's wage and it's going to apply to all sectors. The incentives will be proportional to wages for 2 years up to rupees 3,000 per month per employee, and this will only apply to first-timers. Also, the payments will take place in 2 installments after 6 months and 12 months respectively, and the incentives will particularly continue for the 3rd and the 4th year for the manufacturing sector to provide a spur to India's manufacturing sector. The second scheme, which has been approved, also has an outlay of nearly rupees 1 lakh crores, and it is named the Research, Development and Innovation Scheme, which is going to provide risk capital to sunrise and strategic sectors and is going to encourage private sector to scale up their overall investment in sunrise domains. Also, the government is going to provide funds at 50-year interest-free loans to ANRF special purpose funds, from where it is going to get deployed towards several SPVs and AIFs. It remains to be seen how early the implementation of these schemes is going to begin and what are the opportunities as well as challenges which are going to arise from the same.
Thank you so much for that, Abhimanyu. But moving on, and it's been 8 years since goods and service tax took effect, unifying 17 taxes and 13 cesses. Tax collections have doubled in the last 5 years from just over 11 lakh crore rupees in FY21. Total mop-up now stands at more than 22 lakh crore rupees for FY25. The collections in June stand at 1.84 lakh crore rupees. The overall tax base has nearly tripled. In 2017, there were 16 lakh establishments and individuals registered as taxpayers, and as of 2025, we have more than 1.5 crore registered taxpayers. Experts call for simplification of 5 slab structures and widening the tax gambit.
The challenges, I'm sure the states are struggling with it. One of the challenges that most of the states would be saying is they want revenue neutrality. So, which is not difficult for the officers to work out a revenue neutrality. But the challenge happens is that whether you want to have the rates as 5 and 18, so the gap between the two rates would be too huge, and there'll be a lot of pressure on the government and the political executive to bring items to 5.
Yes, I would think that is going to be a major priority. And I also believe that is going to be the biggest challenge. Simply because while everybody agrees that some sort of collapsing of rates is essential and necessary, it is going to be very difficult. However, what are we going to do? We are going to merge 5 and 12, or would you like to merge 12 and 18? What this would mean in either case is that some commodities rates will go up, some commodities rates will come down. Please remember the rates, like you're fully aware, was a combination of equity and concerns for revenue.
Okay, those were some of the bites coming in on GST and how it's moved. But on that note, we're going to slip into a very short break. After the break, we'll get you the cues in the world of commodities, so stay tuned in. Welcome back to Power Breakfast on CNBC-TV18. Now getting you the latest on Trump-related developments, we have Dia joining with us in our special segment, Trump Watch. Dia, over to you.
US President Donald Trump and Elon Musk reignite their bitter feud. Speaking to reporters on Tuesday, President Trump threatened to deport Musk and strip his businesses of funding following Musk's public criticism of the president's flagship spending bill. When asked directly if he would consider deporting Elon Musk, who has held US citizenship since 2002, Trump said, and I quote, "We'll have to take a look." Later that night, he also posted on Truth Social that the Department of Government Efficiency may need to take a good hard look at his companies. Let's listen in.
I think what's going to happen is Doge is going to look at Musk. And if Doge looks at Musk, we're going to save a fortune. Thank you very much, everybody. I don't think you should be playing that game with me.
President Trump's $3.3 trillion tax and spending cut bill passed the Senate Tuesday following a dramatic 51-50 vote. 3 Republican senators, Susan Collins, Thom Tillis and Rand Paul, broke ranks and voted against it. In the end, Vice President J.D. Vance cast the tie-breaking vote. The bill includes $4.5 trillion in tax cuts and $1.2 trillion in spending reductions, and it now moves to the House. Now, on the tariff front, President Donald Trump says the U.S. could reach a potential deal with India, casting a doubt on a possible deal with Japan as well.
I think we're going to have a deal with India, possibly. And that's going to be a different kind of a deal. It's going to be a deal where we're able to go in and compete. Right now, India doesn't accept anybody in. I think India is going to do that. And if they do that, we're going to have a deal for much less tariffs. We have a great relationship, great reliance, and really a great sort of a partnership in a way. But on trade, they've been very unfair. And those days are gone. So what I'm going to do is I'll write them a letter and say we thank you very much. And we know you can't do the kind of things that we need. And therefore, you'll pay a 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know. And it's very unfair to the American people.
And amid growing political pressure, Fed Reserve Chair Jerome Powell issued a public reminder on Tuesday saying the U.S. Central Bank must remain completely non-political. His comments follow a series of attacks by Trump, who has repeatedly criticized Powell for not cutting interest rates sooner. Here's what he said.
You get attacked by the president a lot on a personal basis. Does it make your job harder?
I'm very focused on just doing my job. I mean, there are things that, the things that matter are using our tools to achieve the goals that Congress has given us: maximum employment, price stability, financial stability. And that's what we focus on, 100%.
And finally, ahead of PM Netanyahu's visit to the White House on July 7, President Trump says Israel agrees on terms for a 60-day ceasefire deal in Gaza and wants Hamas to accept it before conditions worsen.
Okay, thank you so much for that, Dia. But with that, let's move on to Manisha Gupta, who's joining you with us to tell us what's going to be happening in the world of commodities. Good morning, Manisha.
Morning, and thank you for that, Vinny. Well, I'll start with the crude oil prices because we're looking at strong investor demand, and that seems to be keeping the prices supportive at around $67, $68 a barrel for the Brent prices there. Also, remember, it's going to be the OPEC Plus meeting on 6th of July with an expectation that you could be looking at production going higher by 411,000 barrels per day, yet again for a fifth straight month. Having said that, the geopolitical tensions have eased as Iran, Israel are holding ceasefire. But there is absolutely, as you guys were discussing, uncertainty over July 9 deadline for tariff, and that continues to weigh onto the markets there. But I also want to talk about the metals as a sector because we are seeing some support continue here. The gold prices gained almost 1.5% overnight. The US dollar trading at around 4-year lows has been a supportive factor. Not just gold, silver is holding well above $36 an ounce. Copper prices holding around the 3-month highs as well. While there is some profit taking that we've seen happen in case of zinc and aluminum in the overnight market, it's a mixed bag for metals, but more on the higher side as we trade right now.
Okay, Manisha, thank you so much for that. Charlie will be keeping an eye out on copper as well in today's trade and how that is going to be moving going forward as well. But with that, we are absolutely out of time on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We're coming to you live as always from the CNBC-TV18 Motilal Oswal studios. Bang in the middle of the week, the market's taking its own time, at least here in India, to make up its mind about moving to those fresh all-time highs or not. We have a full day ahead. I'm Surabhi Upadhyaya. With me is Nigel D'Souza. And Rima is here with us as well this morning. Hi guys, morning.
Hi, good morning. Well, I was there yesterday and day before. Welcome back.
Welcome back to Rima. So, the mutual welcome backs have happened and it's, nearly a full house now.
Well, that's right, Sir. We hope you had a good time in Goa, but as you enjoyed your time off, nothing really moved out here. The markets are more or less flattish. We had one up, one down day. Let's see, what's the road ahead.
Absolutely. So, if you talk about the headlines, they, of course, keep coming in. And once again, we've got one from the US president. So even before we talk about what's happened with the US market, what the dollar's done, etc., the big headline is coming from Trump, and he is talking about tariffs, and he doesn't seem to be too pleased with Japan, for starters. Take a look at what the US president is saying, the latest on tariffs and that July 9 deadline.
I think we're going to have a deal with India, possibly. And that's going to be a different kind of a deal. It's going to be a deal where we're able to go in and compete. Right now, India doesn't accept anybody in. I think India is going to do that. And if they do that, we're going to have a deal for much less tariffs. We have a great relationship, great reliance, and really a great sort of a partnership in a way. But on trade, they've been very unfair. And those days are gone. So what I'm going to do is I'll write them a letter, say we thank you very much. And we know you can't do the kind of things that we need. And therefore, you'll pay a 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know. And it's very unfair to the American people.
Yeah, so not very happy with Japan, but suggesting that a deal with India could happen. It could be a different kind of deal. We know that the US obviously is pushing for market access for agriculture and dairy. That's been the single most important sticky point. But it seems that, something might finally materialize before the 9th of July. Markets in Asia are reacting to this, and we'll talk about that in just a bit, including how the Japanese market is reacting, which is down. But let's actually start with the mothership and look at what happened overnight on Wall Street. Mixed session and a rotation away from tech into other parts of the market like healthcare. That's what we really saw, which is why you're seeing the Dow up about 1%. But the NASDAQ was down about 1%. Speaking of tech, actually, the headline came in from Jeff Bezos. He's continuing to sell down Amazon stock. He's still the single largest shareholder, but he's selling now stock worth over $700 million. It's not a shock to the market. It's part of a declared sort of a plan. But that's something to keep on the radar as well. By the way, yesterday, the S&P 500 formed what is technically known as the golden cross. That's when the shorter-term moving average crosses the longer-term one. So in this case, the 50 crossed the 200 DMA. Technical experts see this as a sign of strength, but a caveat or a warning here. There have been instances in the past, including in 2019, where the indices, US indices, went on to make a golden cross, and then they fell 10% after that. So never say never. But anyway, that's an important technical pattern to take on board as well. Finally, that big, beautiful bill, at least it's cleared the first hurdle. And markets were reacting to that. It's finally moved through the US Senate, and now it has to go through the US House of Representatives, where it's likely to face some more opposition as well. Promises to add over $3 billion to US deficit, and we'll see how that plays out. Yields actually edged slightly higher because this bill is supposed to be more inflationary. Deficit is a concern. So we had a 2-3 basis points kind of a leg up on the US 10-year yield. Let's see if we can bring the yield back up. It was about 4.24 last I checked. That's pretty much where it kind of ended down. The dollar has been very, very ranged. The dollar index, in fact, intraday fell. There we go. We've got the yield and the dollar. So 4.25 on the yield now. The dollar index intraday fell even below the 96.50 handle, and then there was a bit of a recovery. It's going to be all eyes on the jobs market now, because today you have the private sector ADP report that will come out, and the non-farm payrolls report comes out one day earlier, because Friday, remember, is 4th of July. It's a US holiday. So Thursday is when we get the non-farm payrolls report, and that will pretty much, determine the trajectory from here on. I just want to also quickly point out what Jerome Powell said. He was speaking at an ECB event in Portugal, and he went on to acknowledge that if it hadn't been for the Liberation Day tariffs, then yes, the Fed would have cut rates. And again, the currency market and the bond market were taking note of this. So that war of words between the US President and Powell continues. But he's acknowledging if it wasn't for the tariffs, I would have cut by now. Let's see if they move later in the year. Coming back to our market, the Nifty is continuing to consolidate around the 25,500 level. It'll need a bit of a push, whether it comes from banks or Reliance or IT, we'll have to see. But yeah, that's pretty much been the story. I'll just leave out with the paint sector. No stopping the headlines in the paint sector. The Competition Commission probe on Asian Paints is now a reality. They have initiated an antitrust probe on alleged abuse of dominant market position. It will go on for about 90 days, but paint sector, never going out of the headlines. So plenty of news to digest this morning, guys.
Indeed. I think one number which caught my attention was the GST collections for the month of June. And here we're just putting forth a question. Are some of the recent high-frequency indicators flashing any sort of early warnings on the economy, perhaps suggesting a slowdown? So let's get the numbers up. The GST collections for the month of June came in at 1.84 lakh crore. This is a growth of 6.2% on a year-on-year basis, but it's the slowest pace of growth in more than 4 years. Also, to put it in perspective, 1.85 lakh crore compares with about 2.36 lakh crore in the prior month. So that's one. Secondly, even the passenger vehicle sales have been subdued. We've been talking about it since yesterday, but you can see the pain on the street. So post-market hours, you got Maruti Suzuki's domestic passenger vehicle sales, and they're down close to about 13%. And in fact, barring an M&M, across the board, you can see pressure coming in on the passenger vehicle sales for the month of June. And finally, the third one, and this came out a while back, that's the Q1 advanced tax collection. Again, a barometer of corporate profitability. In Q1, FY26 had gone up by just 3.6%. Again, perhaps pointing to slower earnings growth across some of the key sectors. So that's just one watch point. Other than that, let's get to the flows then. The FIs yesterday net sold about 1,970 crore, while the DIIs pumped in close to about 771 crore rupees. Now, HDB Financial will be listing today. The question is the listing, the debut, going to be as blockbuster as the kind of subscription it's seen? It raised about 12,500 crore, but very strong subscription seen at nearly 17 times. Of course, we'll talk more about auto sales because not just the passenger vehicles, even MotoCorp, for instance, came out with the numbers. And finally, as Surbhi was saying, India-US trade deal, progress on that will be center point. But Nigel, what are you watching?
Well, that's right. We look at the Troika and they are well behaved overnight. If you look at the dollar index, Brent crude prices, as well as the 10-year yield, Mr. Trump's behavior is debatable, but otherwise, these indicators are pretty much well behaved. Trump's taking on Powell, taking on Musk, so we'll have to wait to see what comes out with regard to a trade deal and how do we see the Fed action going ahead. But for the time being, that's in our favor. Let's move on to the next cue then. Yesterday, you had some kind of a long build-up on the Nifty Bank. And I think that's going to be in a trajectory of its own. So this is the one where I'll talk about a little bit more detail in just a bit. What do the FIs do? Well, they added longs as well as shorts yesterday. Mildly so, though. They added close to 2,000 contracts apiece, both on the long as well as the short side, though they continue to remain net short with more than 60% of their positioning on the short side. We look at it in absolute terms as well. Clients, mildly net long, FIs, mildly net short. And that's been the case for the last few trading sessions, though you would like to see some more shorts in the system, because in case we get a favorable deal or something on that front, then you'll have a bigger short covering bounce. For the time being, this is pretty much, okay, very okay-ish positioning that we're seeing from the FIs. 30,000-40,000 contracts is par for the course. 1 lakh contracts is something that the bulls really latch onto and they hope for some kind of positive news flow. Moving to the PCR, well, we had mentioned a couple of sessions ago, it was at around 1.25. That's cooled off to around 0.9 or thereabouts, so that's closer to the lower end of the range. While the options data should come up for you in this screen. Now, a couple of strikes. The 25,600 call, well, it's added close to 20 lakh shares. But on the downside, this 25,500 put as well added close to 37 lakh shares. So just punching in the premiums and matching them with what we saw on Monday with regard to a high as well as with regard to a low. That's the crucial level that I'm looking at. 25,670, very, very close to the highs that we saw on Monday. And going by the options data as well, that's the number you're looking at on the upside. While on the downside, this 25,440, which is closer to the low that we saw a couple of sessions ago. So that's going to be important. That's the broad range you're looking at. But the Nifty Bank, I think that's going to be the one that leads the Nifty higher, and coupled with Reliance Industries. And the last two sessions, that 57,100 mark has become the level that you want to go in there and buy. Remember, now there are reports that are indicating even for smaller banks, there's a good amount of demand. There's a divestment of IDBI Bank as well, dues, and it appears that the Nifty Bank is getting its act together. So with the reference point at around 57,100, that's going to be the driver from here on. Finally, the stock that I'm going to be looking at is Vedanta. It's been holding and protecting that 20 DMA for the last many trading sessions. Today, there's a big cue that's coming in there because their demerger scheme is going to be heard in the NCLT. And if in fact it gets a green signal, then it's going to be very, very good news. If it doesn't find favor, then that's going to be a bit of a negative. But that's going to be the stock to watch for today's trading session. Let's see what the NCLT has to say, because we know there's a big value unlocking exercise that's currently underway.
Thank you very much for that. So let's get some global perspective and find out how investors are positioned on India. Prashant Baroda, Portfolio Manager, Emerging Markets at Allspring Global Investments, is now joining us on the show. Prashant, thank you very much for joining in. This is Reema here. You know, the last time we spoke to you, you were encouraged by the incremental good news coming out of China. Plus, there was a valuation difference between India and China. We discussed at length about India versus China. Where do things stand currently as we enter the second half of the year? How do you feel about India, and how might the Indian equity markets perform?
I think the Indian equity markets should continue to do well. I think the picture moves to just the earnings cycle now, and we'll wait to hear from commentary from the banks, the cement companies, and some of the sectors that have lagged this year, which is healthcare and IT companies as well. So I think the picture will get better as we move across the earnings cycle. But what's really good is at least the monetary cycle easing, inflation being under control. And now if we get some trade deal happening with the US and India, that will provide more impetus to the market going into the summer.
Prashant, hi, morning. So, given that equity markets are at elevated levels, almost at all-time highs in the US and India, how would you look at India amidst this context? Because the market, while it's done very well throughout April and most of May, now is the tricky part. Can the market rally on well beyond the previous all-time highs? What's your sense?
I think it will continue to chug along, and as earnings visibility will become clearer, even though some companies might disappoint in this quarter, the key will be the commentary they'll give going into next quarter as well. I think both US and India market continues to chug along, barring any tariff mishaps or, if there is no trade deal, which implies a 26% reciprocal rate on India. But if you think from a long-term perspective, both India and US have a lot to give and take. So US can supply India with energy, defense, and India itself with electronic products and auto components as well. So I think it makes sense for these two large economies to kind of work in tandem rather than have tariffs against each other.
Hi, Prashant. Good to see you in. So if you're allocating fresh money, then what would the allocation strategy be? First, between emerging markets and developed markets. And from the emerging market basket, how much does India get?
Sure. So I think if you look at what's happened from a US perspective, clearly the US has come back and still captures 60-70% of total global flows. But besides the AI story or the Mag 7 story, I think earnings on the US, banks and others will be subdued going into later half of the year. So apart from the AI capex story, it's very hard to get excited about US markets. I think Europe will continue to do well. Within emerging markets, I think Korea and India continue to do well. China, I think a lot will depend on how real estate plays out in the second half of the year. If there is, I think the Chinese government has been resisting on doing big stimulus there and has been more restrained. So that will have an impact on overall Chinese story. But overall, I think we are very positive on emerging markets. Outside of US, I think both India, Korea will continue to do well.
All right, interesting. What about President Trump? Do you think we have seen peak Trump, or do you think that's yet to come? First 6 months of the year have been a roller coaster ride, even the last 24 hours. I mean, he goes after Powell, talks about tariffs. Do you think we've seen the peak? Because the last time around he went too aggressive. He had to actually pull back a little bit and cool his heels. Your take?
I think, the market has become more attuned to, the Trump administration functioning style. And one thing about this administration is that if they do kind of press hard, they do also pivot back as well. So they're not, as fixed to their viewpoints, and the market has attuned to that as well. So I think longer term, you have to be, with regards to Powell and Trump, you have to be sympathetic to both point of views. I think Powell himself said today that if it wasn't for the tariffs, he would have reduced rates, which I guess Trump is and the administration is pushing him to do. But I think longer term, the Chairman Powell is looking to see how these tariffs will impact inflation. And if, for example, the CPI continues to be range bound where it is now, we will see a rate cut cycle in the second half of the year.
How many rate cuts? And is it already in the price, or can it act as a positive trigger?
Well, I think the market is penciling in at least 2 rate cuts, but it might, I think the Chairman Powell might be more restrained, but he's also data dependent. So if we don't see a big inflation spike in sort of the next few months, I think we will get rate cuts from the Fed.
All right, Prashant, very quickly before we let you go, Powell's term ends in May 2026, and we'll be looking forward to the replacement. If the replacement is announced sooner than expected, do you think that will send a negative, another negative blow to the dollar index? Because a couple of experts overnight, I was hearing them, they were indicating that in case that replacement is actually announced ahead of time, we could see a further downtick on the dollar index. Your take?
Yeah, I mean, there might be a near-term impact, but I think longer term, you realize, the position of the chair of Fed, and we've seen RBI changes as well. Once you kind of take that chair and you have a dual mandate with this inflation and unemployment, you kind of focus on that pretty seriously and kind of try to make data-dependent decisions. So initially, maybe the market will be perturbed, but I think, again, it depends on who comes in and, how they kind of react with the market at that point of time.
Prashant, so just to recap, your order of choice between markets would be US first, then India. I mean, just recap the preference order for us.
Yeah. I think US, Korea, and India. I think Korea, what's happened is we have a new government that's kind of focused on improving corporate governance reforms there. Valuations are a lot lower, and they might even think about doing some sort of fiscal stimulus spend. But India as well, I think, is one of our kind of top 3 markets when you look from allocation standpoint.
Okay. All right. Got that. Thank you very much, Prashant. Good perspective. Nice speaking with you this morning. Thank you for joining in. Well, that's a view coming in. Thanks very much. That's a view coming in from Allspring Global Investments. Let's quickly move on and tell you what else we have lined up for you on the show. Well, at around 8:35, we'll be speaking with the management of MapMy India as it wins a 233 crore contract from an international corporate client for map data licensing in India. At 9 a.m., we'll have Rishi Vora of Kotak Institutional Equities joining in to talk about the auto sales numbers and what does the month of June really tell us in terms of the picture. Rahul Arora of Nirmal Bang Institutional Equities is our market master of the day. He joins in at 9:20. At 9:30, we speak with the management of Apollo Hospitals to talk about the big restructuring, complete corporate restructuring. Will it generate more shareholder value? What are the business growth aspirations looking like right now? We are in conversation with Ms. Reddy at around 9:30. After that, Suyog Kotecha of Aarti Industries speaks to us about the company's FY26 business outlook. That's Aarti Industries in focus. At 9:50, we touch base with the management of Mahindra & Mahindra, talk about their auto sales numbers for the month of June. And today, In our special segment, It's the Economy, Lata will be in conversation with Ajay Srivastava of Global Trade Research Initiative and S. Ganpati of Gokuldas Exports on the likely options for exporters from the 9th of July.
Time to slip into a short break. A lot of stock-specific action to track for you. Get to that in just a bit. For the time being, I give you a sneak peek into the list. Hero MotoCorp, Hyundai, Lloyds Metal, MOIL, JSW Energy will be reacting to positive news flow. We have 5 apiece, pretty much even Stevens today. Maruti, Asian Paints, V-Mart Retail, NMDC and Dreamfolks will be reacting to negative news flow. Get into that break. Come back. We'll get into further detail on all of these names.
Welcome back. Well, let's now talk about a lot of the individual stocks. And before we do that, let's take stock of the Asian market update as well. Like we've been saying, it's a pretty mixed picture. The market that's reacting negatively to obvious comments from the US president is Japan. It's down about 1%. Hang Seng's still okay. So mixed across Asia. Let's get the implied open up to get a sense of where we could be. We've been stalling around this 25,500 mark for the last 2-3 sessions. Will today be any different? We'll find out. 40 points up as far as the implied open is concerned. Well, lots of stocks to track as well. So let's straight away get to our team with a CNBC-TV18 list of top stocks to watch. First up, more auto sales numbers trickled in after market hours. There was Maruti, there was Hyundai, and I think Hero as well. Yeah. How do they look, Rima?
So let's start with Hero MotoCorp, better than what the street was anticipating on account of rural growth, the pickup. So overall sales in the month of June up 10%, higher than expectations of 6%. So Hero MotoCorp was a beat. But on the flip side, Maruti Suzuki was a miss. Again, it's the same issue. The domestic sales are weak because of challenges at the entry-level segment. Exports are doing fine. But on the whole, entry-level segment sales are down 18%. UV sales are down 9%, and as a result of that, the domestic sales are down 12%, while exports are chugging along well, 22% up. Hyundai was largely in line with expectation. The total sales was down about 6%. Expectations were for an 8% fall. Exports are doing well, but again here, the domestic sales have been weak, so 12% lower for the domestic sale. Exports have done well. So to just recap, Hero MotoCorp positive, Maruti was a miss, Hyundai was weak but in line with expectations.
All right, thanks a lot for that, Rima. Well, let's hop across to Mangalam. Mangalam, tell us more. Yesterday I heard a nice tune that you went with Mr. Jindal. And paints are in focus yet again. Asian Paints today, not too great news. V-Mart retailer as well, a little bit of a miss.
Well, you know, Mr. Jindal actually sang the Dulux tune, but more on that later. No, no. So now we talk about Asian Paints. What actually has happened is, remember that, you know, Birlas had approached the Competition Commission alleging, you know, use or abuse of dominant position by Asian Paints in the market. To that, the Competition Commission has released its first report, and they've ordered an investigation against Asian Paints for the abuse of its dominant position, and this probe will complete in 90 days. So post 90 days, we will have an order that will come by from the Competition Commission, where you know, Aditya Birla Group had written to the CCI in November 2024 saying that Asian Paints is disturbing the dealers which are dealing with Grasim products. So we'll keep an eye out on that. Until there is, you know, clarity on this one, expect some subdued movement on Asian Paints on the back of that. V-Mart Retail, on the other hand, it is, you know, their first quarter update that has come in. The sales, not a problem, nearly 13% higher at 885 crores. The problem was the same store sales growth, which is coming at just 1%. On its part, the company has said that, you know, because Eid was in the previous quarter this year and the base quarter had Eid last year, if you adjust for that, the actual same-store sales growth is up 5%. But be that as it may, you know, the street will not like just 1% sort of same-store sales growth, because a large part of the festive season growth was also accounted for in the previous quarter already. They opened 15 stores pretty much in line. So see mild red for both V-Mart and Asian Paints.
All right, Mangalam, thanks a lot for that. Well, let me run you through all the metal stocks that I'm looking at. NMDC, yesterday there was negative news flow because the price cut that came about effective July 1st was larger than expected, of around 500 to 600 rupees. The street would have liked a number of from 200 to 300 rupees per ton. Now, going with a little bit of red out here, though yesterday the stock ended virtually at the low point of the day because production has gone up, but sales have come down. Now, this makes the next few quarters quite challenging as well. So we'll have to see how that goes. So, you know, that's going to be one that we're going to be looking at, because for June, the sales have come down by close to 4%. Could have been impacted by you know, the onset of the monsoon sooner than expected. So going with red out there. Lloyd's Metal, the iron ore production actually is flat at around 4 million tons, while DRI production is up close to around 3%. More or less in line, no big surprise out here, but going with green out there, because since they've done 4 million tons of production just in the first quarter, and now they've got the EC clearance, which they can do close to 25 million tons in the year. For the next few quarters, you know, you could have a bit of a softish monsoon quarter as well, but post that, they'll be ramping up, you know, 6 million tons on a quarterly run rate. So that's why going with green on Lloyd's Metal, though it could be a flattish reaction. And MOIL, you know it by the international trends with regard to manganese ore prices, and they've affected a marginal price increases on a couple of grades out there by around 2%. So that's why going with a tinge of green on MOIL as well. But going to Vinny, she is here because she's tracking JSW Energy and Dream Folks. Morning, Vinny.
Good morning, Nigel. So JSW Energy, positive news flow after the company has signed a battery energy storage purchase agreement in Rajasthan with RVUNL, and now this agreement is to establish 250 megawatt of standalone battery energy storage systems. So positive coming in here, and green is what we're expecting. Now Dream Folks on the flip side, red is what we could see coming in for the stock, a sharper fall, given that the company has now said that certain programs or certain agreements with Axis Bank and ICICI Bank have been closed with effect from 1st of July 2025. They said that the overall contracts are still on with these two banks, but there are certain important programs which have been shut down, and this could have some bit of a material impact. The exact impact is what they are still calculating in terms of on the financials, but some impact is what is expected. Do not forget, on June 20th, the management actually spoke to CNBC-TV18, and they said that all their contracts were in place as of June 20th, and renewal and negotiations were a part of it, and they were sticking to their growth guidance as well. So now it will be important to see how their guidance will change and what is the impact of this. But red is what we could see coming in, given that these two are big clients for the company.
Okay, all right. So we're going to watch for Dream Folks for sure. Thank you for that, Vinny. Let's quickly recap our list of stocks to look at today. The ones that have positive news flow around them are Hero Moto, Hyundai Motor, Lloyd Metals, MOIL and JSW Energy. Stocks with negative news flow would be Maruti, Asian Paints, V-Mart Retail, NMDC and Dream Folks. All right. With that, let's take stock of what's happening in the commodity markets as well. We have Manisha Gupta joining in as always with the latest. Manisha, good morning.
Morning, and thank you for that, Surbi. I'll start with the crude oil prices, which have markets are holding their gains ahead of the OPEC Plus meeting, which is on 6th of July, with an expectation that this would be a fifth straight month for the month of August that we will see increase in production from OPEC by 411,000 barrels per day. Well, the geopolitical tensions have eased as Iran-Israel holds ceasefire, but there is still a lot of uncertainty over the July 9 deadline for tariffs, and that continues to make the markets choppy. Having said that, we also have seen not just the gains in energy space, but the precious metals overnight also have gained. So you have gold and silver both gaining by more than a percentage point. The US dollar trading at around 4-year lows clearly has been supportive for this one. In the metal space, it is copper which continues to outperform. While we have seen zinc, aluminum, copper, all of these metals gain for the month of June, July as well has started on a positive note, especially for copper, which is trading at a 3-month high. Well, here as well, the weak US dollar, tight supplies, inventories declining, and expectation of a China stimulus measures are some of the supporting factors.
Okay, all right. Thanks a lot, Manisha, for joining in and filling us in with all of those cues. For the time being, we slip into a short break. On the other side, the management of MapMy India Maples will be joining in to talk about the recent order win. We'll also get some fundamental stock talk with Deven Choksi or DR Choksi Finserv. Stay with us.
Welcome back. US markets had a mixed finish. The Dow ended higher, but we did see some cuts coming through on the Nasdaq. The Nasdaq ended lower by close to about 0.9%. You know, one of the reasons what led to the AI sell-off yesterday was as a part of the big, bold, beautiful bill, there was an AI regulation. And the Senate voted 99-1 against it. So basically, that AI regulation clause said that individual states in the US can come up with their, it barred individual states to come up with their AI regulation. So basically, the government wanted that at the federal, right on top, the central government or the federal government will be the only ones able to decide on the AI regulation. So that was what was put in the clause. But the Senate voted against it. So now basically what this does is that individual states, Texas can come up, Texas can come up with its own AI regulation. California can come up with its own AI regulation. So it's just going to increase the complexity and uncertainty. And that's the reason. So this happened yesterday when the Senate voted 99-1 against barring
regulation of AI.
Barring states from coming up with their own AI regulation. And that's one of the reasons why the Nasdaq sold off close to about 0.8%. But let's pull up Asia this morning. Hang Seng was shut yesterday. So Hang Seng, I think it's a gain of close to about 0.5% as it begins trade with. But the Japanese markets, where there are a lot of question marks surrounding the deal, whether the Japanese-US trade deal will go through, what happens to rice, etc. Nikkei is the one selling off sharply. That's down nearly 1%. But let's invite the first corporate on our show now. Digital mapping firm CE Info Systems, Map My India, secured a licensing contract worth about 233 crore rupees from a private sector international client. So to talk more about this and the growth outlook, Rakesh Verma, co-founder and CMD at Map My India, is now with us on the show. Mr. Verma, thank you very much for joining in. This is Rima here. Before we get chatting about the order win, just a couple of about 2-3 weeks back, we had a very large transaction in the company where we believe PhonePe sold about 5% stake in the company. Tell us the reason behind, because they've been an early investor in Map My India. They sold a large 5% stake. They still hold 13-14. But what was the reason, and are they planning to sell more?
Well, any investor has a freedom to buy and sell. That's the beauty of listed companies. Coming to PhonePe specific, well, they have been an investor since 2015. We all know that they're going through their IPO process. And for that, they had a need to exercise this option to sell some shares. So we have no company has any control over such issues. There is no issue with them. They are very happy and they have made tons of money.
Sell more? And did the promoters consider buying when PhonePe was selling?
Well, promoters don't have that kind of money to invest in and keep buying. We are happy maintaining a 51% majority stake, and that's what we want to stick to.
Just to close the loop on this, sir, they had close to 18.5% in the company. They sold 5%. Any indications from them that they will be looking to sell the remaining? Because, if there's no conversation, that continues to remain as a bit of an overhang on the stock. So have they communicated anything that they're now done for the time being?
I understand that, and communication is always there with PhonePe. They are very good partners too. They're also our customers, remember. First is they have a 90 days lock-in in any case. They can't sell for 90 days. Beyond 90 days, I think if they have gone through the process of DRHP and all, it's not that they're in a hurry to sell. It's just some of their requirements. But if they sell, I have nothing to comment on it. If they don't sell, still I have nothing to comment on that.
Okay, so you only have an indication.
I understand the overhang.
Okay. So you only have an indication, but you cannot confirm whether there will be no further stakes by PhonePe, right?
They are also part of Walmart. I hope everybody knows.
Yes.
So they cannot go and make a statement of any kind this way or that way. This is what their CEO told me.
Okay. All right. Thanks for sharing what you know on this. It kind of gives us some sense of clarity at least. Now let's come to the order win as well, sir. This 233 crore rupee order. Where is the client from? What industry? Tell us a little more about the margin profiles of this order. I think you have stated your intent of being a 35% EBITDA margin in the past. So, how does it lead into that target?
Well, all the orders that come to us are of different nature. We have given the clarification in the stock exchange that it's a map data licensing. And typically any map data licensing, when it happens, it has a huge margin because it takes full advantage of the operating leverage. So an order of this kind results in, if I can say, approximately 60% margin. I will not be offline.
Okay, and the client, local, global, if you could give us some more color.
Again, we have, in the filing we have said, it's an international customer for India market.
Yeah.
Now, under the contractual obligation, I cannot disclose the name of the customer.
All right. Sir, if you could just confirm a couple of details. What will the revenue recognition of this particular 233 crores be? You know, how much in this year, how much in the next? And just want to reconfirm, what did you see on margins of this particular order?
As I said, 230 crores is over a period of 7 years, starting from year 1. So divided by 7, 33 crores, that's what it comes out for every year. Margin, I just said that for this kind of an order, it's not an order by itself. It's a kind of a business that we are in where we try to fully leverage on our map data, product and platform. And that creates a margin of the nature of 60% or so.
What percentage of your revenues or order book would come in from such kind of deals, licensing deals, where you enjoy margins of 60%?
Well, I think a year back or so, we had talked about the Hyundai Kia 400 crores, right? Now we are talking about this. And there are certain more orders that have happened. Those orders do give us a large margin of the nature I told you just now.
All right. Very quickly, sir, you've highlighted that government business will be one of the growth drivers. Just quick analysis. What is the margin difference between government orders as well as non-government?
Government orders, we, at least at this point of time, but in future it may change with our products becoming more mature for the government also. So at this point of time, I'll say a 20% margin on the government orders is what we look at.
And what will the government contribution stand at as we close this year? Because it's been going up.
Yes, it will go up. But the last year, I think we had around 10% or 12%, something like that.
Okay, got it. Thank you very much, Mr. Verma, for joining in. That's Map My India for you. Devin Choksi is now with us, joining us on the show. Devin, thank you very much for joining in. You know, let's talk about Asian Paints and the CCI order. Just when things appear to be perhaps bottoming out for Asian Paints, analysts had started turning bullish on it, saying valuations are more than 1 times below, the long-term averages. We've got this CCI penalty now, the CCI order. Do you think it's going to be a big negative overhang, and how will this play out?
Yeah, good morning. Well, when you are an industry leader, when you are controlling 1/3 of the total market in the industry, and obviously, I think when the competition is increasing, all kind of situations would arise. I think one which we are probably seeing. But that is not taking away the long-term prospects of this particular business and the company's capabilities as well. They have been in this business for a long period of time. I think out of the total home decor business of about 150,000 crore in the country, if the paint business is commanding about 90,000 crore kind of a total size, and of which I think if Asian Paint is 35,000 crore kind of a company, obviously I believe that I think the kind of challenges would come to them, but I think this company is very integrated to meet these particular challenges. So I don't think that takes away the prospects as we see it today. On the contrary, current year appears to be more promising on 2 counts. On 1 count, I think the raw material, the input cost is remaining under control, so which is giving the promise for better margin for the sector as a whole and companies like Asian Paint in particular with a large capacity that they have. And on the other side, I think the re-rating of business is now started to happen because of the previous fall in stock price. I think again the stock price started becoming slightly more stable and it could have re-rating. Also because of the fact that the business conditions improving on the other side. So we remain cautiously optimistic about the prospect going forward for the company. Maybe a small hurdle at this point of time on the CCI order.
Not sounding too perturbed, Devin. That's interesting. And so CCI order is one aspect. The other is a larger question on, is the worst over for the paints industry? Just comment on that as well. I mean, we've seen how things have played up. The Birlas are there, JSW is there. Akzo Nobel has been snapped up. Too much has been going on. Is it time to start buying paint stocks, or do you think we will probably see a little more of a price war perhaps till things stabilize?
I think initial phase would be of taking some amount of market share is something which one cannot rule it out. And that's where more than the price war, I think they may probably end up giving more amount of incentives to the retailers from the point of view of, I think, cornering some part of the market share. That is understood. Now that hurts the domestic, the newcomers in more than, I think, the existing one. Largely because of the fact, I think, that they would be initially, as first 4 or 5 years, I think they'll be having a situation of bleeding in the business. For JSW, I think the situation will be slightly different because ExxonMobil is already established with around 50 to 55,000 crore distribution, 50 to 55,000 distribution points that they have already established, and the business is profitable. But for Birlas, I think it's going to be a tough situation as we see it. In my viewpoint, I think more than the price pressure today, I think the requirement should be how the market is going, and that's what I think one would keenly observe here. We see in next 10 years' time the size of the market growing from 90,000 crore to somewhere around 150,000 to 170,000 crores. So obviously, I think the kind of overall paint business is growing from current levels to, I think, almost double in next 10 years' time. So we remain relatively more optimistic about the possibilities going forward.
All right. Hi, Deven. Good morning. Dream, folks, that's going to be a stock in focus because certain programs of ICICI Bank and Axis Bank have been discontinued, and they're saying the impact is going to be material now. The stock, as it is on this fear, had pulled back, I think, close to around 15 to 18%. What's your view? In all probability, it starts off in the red. Will you look to buy, or will you say there's too much of skittishness out there, too much of uncertainty? You rather just stay away.
Good morning, Nigel. I think disintermediation in this business, I think, is something which one probably is asking for. I don't think that, I think, the aggregator model on which this company created, I think, a significantly large presence works after a while, because once, I think, the bank partners who are basically also having an equal amount of penetration ability, and through the use of technology, I believe, the fintech platform in particular, I would think that, I think, they are basically going to create their own presence, significant presence on their own. And that's where, I think, even the margin-related question would come, that why should one pay for an aggregator, whereas I think one can use the technology, leverage the technology, and go to the last mile as far as, I think, all the airport and the lounges are concerned. So in my viewpoint, I think that's going to happen. The disintermediation, as we call it, as is happening right now. Not too sure how exactly Team Fox will probably reshape the business model in the current situation. So till the time clarity emerges, maybe not enough confidence to look at this particular business.
Okay, so yeah, Dream folks, let's see what the market reaction is going to be. The thing is that the fear of this happening had been there in the market. So has it already played out in the stock price? Will we see further damage today? Let's see. We've reached out to the company for clarification. Let's see if they're willing to offer one. Auto sales, Deven. I mean, obviously, it's the same picture, right? Very sluggish on passenger vehicles. M&M continues to perform very well. Bajaj Auto has been lagging last couple of months. It's not just the June numbers now. Autos, are you buying any stock? What would be your picks?
Yeah, I guess I think the individually companies have to be looked into. Bajaj Auto's case, fortunately, I think the three-wheelers and the EVs have picked up well. Though the two-wheelers haven't done enough, I think, in the domestic market particularly. So that is a lag as far as I think the business is concerned. Mahindra is a different story altogether because every successive model that they've been launching, they've been collecting bookings in advance for 1.5 to 2 years at least. And that's where probably I think the company is having relatively more clear visibility as far as the business is concerned. As I see it, I think the current year appears to be more promising on the new vehicle segments. I think particularly the buying of new vehicle segments, largely because of the disposable income increasing in the hands of the people, and at the same time cost of fund coming down due to the fall in the interest rates. Given that situation, I would think that somewhere from the second quarter after, once the festive season starts, probably we are likely to see the better numbers coming up from autos. July to September, I think we are not expecting too big a growth as far as numbers are concerned. So can safely say that beyond first half, the second half should remain relatively more stable for most of the good companies in the auto space.
Okay. RBL Bank. That's been a stock on fire. I think 4% up yesterday, 21% in the last 1 month. And since the beginning of the year, 65%. Now there are reports which suggest that Dubai-based lender Emirates NBD is exploring a significant minority stake in RBL Bank via primary capital infusion. Your thoughts if this transaction were to materialize, and even outside of that, Fundamentally, how is RBL Bank positioned at this juncture?
Well, the challenges would continue because I think you are competing with the larger companies who are equally strong with their presence and using technology at the core level. So from that perspective, I think the challenge would continue. But yes, in the banking business, I think the growth would also emerge along with the technology when you strengthen the balance sheet. In this case, I think the balance sheet strengthening activity is appearing to be more promising. And that's where probably I think with the technology front end, they could possibly get some of the lost market share. As such, I think whatever the repairing of the balance sheet had to happen, I think is completed, I believe. And as a result of which, I think the future years may appear relatively more promising. I believe the market is having that kind of optimism at this point of time. That's where I think the stock price is getting reflected into. In my viewpoint, I think selectively one can look at, I think, such kind of opportunities.
Interesting. All right. Deven, I wanted to ask you about Adani Ports. We have got the June update that's come in there. And the growth that they've delivered is around 12%. It just hit the screen, actually. For the first quarter, it's also up by close to 11%. The guidance, remember, they had given was around 505 to 515 MT, which compares with around 450 MT in the previous fiscal year. So it appears that they're on track. What's the view on Adani Ports?
Yeah, Nigel, I guess I think apart from volume, I think the value realization is equally important because I think the cargo handling and the mix of the cargo handling resulting into better yield is something which one is asking for on a per ton of realization. I believe that I think two factors are working in favor of the company. On one side, due to the automation, the cost factor is coming under control, and as a result of which it promises to add into the margin. On the other side, I think the yield is improving, and as a result of which I think on a 10-12% kind of a volume growth, we are talking about a slightly higher yield compared to what one has seen in the previous year because of the mix as well. So in my viewpoint, I think this remains absolutely very promising. This business is a cash-generating business, and obviously I think you are going to see a larger amount of growth also through the inorganic acquisitions. And the ones that they have acquired, I think they are likely to start contributing in coming year and quarters as well. So we remain distinctly optimistic again, I think, for the business per se as a whole. Any corrective price, I think, would be a better opportunity to add into the stock.
Deven, thank you very much for joining us this Wednesday morning. We'll get into a break. On the other side, we'll address the market technicals. Sudarshan Sukhani and Mitesh Thakkar join in with their technical trading ideas. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call. You're on CNBC TV18. Well, let's get straight to our technical experts. Sudarshan Sukhani and Mitesh Thakkar join us this morning. Good morning, gentlemen. Thanks a lot for joining in. Well, Sudarshan, you go first. Last couple of days have been more or less sideways, not moved too much, but the bias appears to be on the positive side. For the time being, the GIFT Nifty is suggesting we have a 25-30 point uptake. What would you do?
Yeah, good morning. See, you're quite right. The bias is on the positive side. We are at a strong uptrend, but within an uptrend, there will be periods and protracted periods when the markets do nothing. That's normal. I mean, the market is not expected to go up day after day, hour after hour. That doesn't happen. All of us know it. So we are now probably in a phase where the markets are entering into a consolidation. Within this consolidation, there is one trade. On any day you see a 150, 200 point dip, go and buy that dip. If that dip doesn't come, if the markets decide to go on the upside, then we miss that trade. Because that is a high risk trade. The low risk trade is to wait for dips and go long.
Okay. Mitesh, what have you made of the consolidation over the last 2 days? Is this just consolidation in an otherwise bullish structure? And how would you approach the index today?
Good morning. I've been calling for some kind of consolidation because one, after the rally, we had the hourly charts and 2 hourly charts in the overbought situation. Also, there was a gap, around this levels of 25,690 to about 25,750. I think that still remains. So maybe in the next few days, you will see the markets being subdued, the index being subdued, but these stocks should do well because the overall trend is on the positive side. Now, on the index, if somebody wants to trade, wait for an intraday dip, get closer to about 25,450 or levels. That's where you want to enter with a 70-80 point benefit stop.
Okay, all right. Let's talk about individual stocks then. Mitesh, you go first.
Yeah. I have all buy calls today. Good morning, Naju. I have buys on Bank of India with a stop at 119 for targets of 127. Couple of names which have joined the F&O series now. That's Blue Star is a buy with a stop at 1675 for targets of 1760. Amber is a buy with a stop at 7020 for targets of 7250 and a buy on Biocon with a stop at 356 for targets of 375.
Okay, all right. Blue Star, that was an interesting one yesterday. Big mover is what we saw. But Sudarshan, coming across to you, what's on your radar?
Well, GMR Airport is a buy with a stop under 84. Gujarat Gas is a buy with stop under 470. Vedant is a buying opportunity with a stop under 457. And finally, APL Apollo is a buy with a stop under 1650. APL Apollo has gone through a very decent correction and is a positional buy.
Thank you, gentlemen. We'll chat with you through the day. For now, it's time for a short break. We'll come back with the pre-opening rates. We'll also be joined by Rishi Vora of Kotak Institutional Equities to discuss the auto sales numbers for the month of June.
Welcome back. About 15 odd minutes left before we start getting our pre-open rates. Let's pull up the Asian indices. Again, the picture has been fairly mixed across Asia this morning. We've been saying that some of the markets like Japan are down. Hong Kong is managing a little bit of a gain for now. actually looking better than before. The implied open was telling us that we'll get about a 40-point pop. Now we'll have the pre-open anyway, but that's not a 50-point open. In a little while from now, we'll start getting in our pre-open rates. And obviously, the pain space is going to be keenly watched once again. Let's see what happens there. By the way, there's news that's coming in on RBL Bank as well. In a bit, we'll have Lata join in. Reports seem to be indicating that there could be a foreign bank suitor in the fray for RBL Bank. But the question is, I mean, how close are we to a deal? Will there be a deal, no deal? And what do the current regulations say? I think Lata will join in. Do we have her? I don't think we have her right now. She'll join in on this in a bit. RBL Bank up 4.5%. That's, of course, yesterday. We'll see if it has any follow through today or not. The other stock to keep an eye out on is, of course, Dreamfolks, and we've been pointing that out because the company has said, now here's the technicality and the interesting aspect. The company said that their contracts with ICICI Bank and with Axis Bank are not over. The contracts are still in place, but the current programs that they were running with these banks, with respect to the cards and the airport access, etc., the lounge access, some of those programs have been wound down. The question is whether that means an end of all association, whether they'll manage to retain big banks like ICICI as clients at all. The company has acknowledged that this will have a material impact. So that's again a watch point. So these are some of the names that we are looking out for very, very specifically this morning. Otherwise, I mean...
the company, I think in the clarification, did say that the contracts with the banks remain active.
Yes.
So it's not a complete exit, but certain programs seem to be deactivated. But that said, the certain programs are going to have material in nature. And the stock itself, I think, is down, what, 40% now from the start of the year. And from its 52-week high, the stock has corrected close to about 55%. The 52-week high was 522, hit in September of last year, and now the stock is down to 230. So that's going to be one stock to watch. And Hero MotoCorp in pre-open is also higher. So that's up nearly about 2% on the back of the sales numbers. But let's talk about RBL Bank. That's in focus because news reports suggest that Emirates NBD Bank is eyeing minority stake in RBL Bank. Lata joins in with the details of on this likely development. Lata?
Well, the report says that NDB Bank will be buying a minority stake in RBL through a preferential offer to which it will subscribe. Now, we already know that NDB's board has permitted the bank to raise 3,000 crore, and NDB on its part has, NBD on its part has a banking license, which it is implementing through a wholly owned subsidiary and has 3 branches. So in a way, its fit and proper has been already done by Reserve Bank. They've got a banking license. Now, it seems to be that the news is brewing for a while because look at RBL Bank's shares. They have moved from 160 rupees in April to 260 as of closing yesterday. And I mean, you can look at the way it has risen. June 5th, it had gone to 206. That's a big jump from the April levels. And from 206 to 260 is also a very big jump in a couple of weeks. Now, RBL Bank's shares, let us look at NBD's position. NBD is known to be looking for a stake in some Indian bank. We know that they are very big, they were interested in IDBI Bank as well. And the whole catch is what will be RBI's position. The RBI's rules are this way. You have to take permission when you get 5% stake, when you get 10% stake, and when you get 15%. 15% is the maximum any foreign entity can have, or any entity can have, in a bank. Over and above that, it is only exceptions, and it has been granted in, I can say, 2.5 occasions. One was when Fairfax got the permission in CSB, Catholic Syrian Bank, 51% stake, but only 26% voting rights. Likewise, LVB got sold to DBS Bank. Again, there it merged completely with DBS, so none of these rules apply. And finally, there is SMBC waiting to take a 20% stake in Yes Bank. We haven't yet got the official nod from RBI, but the way it's going, it looks like they have some kind of an informal nod. And chances are that looking at the SMBC instance, NBD has been emboldened to perhaps start some negotiations with RBL Bank. But RBL doesn't have a single seller. like in the case of Yes Bank, where State Bank was holding that 24%, and it was very awkward for Reserve Bank to give one bank two licenses. SBI operates as SBI operates as a 25% holder or 24% holder in Yes Bank. It always had to come down. So there was a constraint on RBI to give that permission. There is no such constraint in RBL. So will RBI make an exception at a time when, there is no problem with the bank? Why have a rule if you're going to continue to give exceptions? That could be one way of looking at it. RBI governor has said in an interview that they're reviewing the entire ownership structure, but that's nowhere near fruition. It's a thought. So will they wait for that? Or will NBD not get into all this? Will it only apply for 5%, in which case, it can get 4.99 is always available. So we don't know. All options are on the table. The story says 15 to 20% following SMBC. That will require Reserve Bank to make a very big exception for a healthy bank. We will have to wait and see. Okay, by the way, we wrote to Reserve Bank and to RBL. We are still awaiting a reply.
All right. Okay, Lata, got that. Thanks very much for putting the story in context. Let's see which direction it actually moves in. Well, for the time being, we'll shift the spotlight on the auto space. The auto sales that have been coming in for the month of June have been a mixed bag once again. Let's discuss the trends and what we should be doing as investors with Rishi Vora, analyst at Kotak Institutional Equities. Rishi, thank you so much for joining in. So it's more of the same, right? I mean, you have the winners that continue winning, for instance, M&M, and M&M is doing so well on all its fronts, passenger vehicles, even tractors. Aisha's numbers have started looking better over the last couple of months. But the sluggishness in four-wheelers, I mean, there's just no departure from that. Whether you look at Hyundai, you look at Maruti, mostly anemic numbers. Your thoughts? Let's start first with passenger vehicles. Do you see any light at the end of the tunnel? Do you like any PV stocks, barring M&M?
Yeah, good morning. You rightly pointed out that, passenger vehicle volumes, at least the retail trends, have been sluggish for last couple of quarters, and partly to do with base, but we believe that this trends, at least till festive, will continue, where, we might see a low single digit to a flattish growth. Just during the month, obviously, the volumes, the wholesale volume decline was on the larger side. It's predominantly for Maruti, it was driven by plant shutdown, so that had some impact. But yeah, retail sales, I think at least till July, August, we don't see that recovering. And around the festive time, with whatever the central government and RBI has done in terms of income tax cuts, CRR cuts, we do see some recovery. But again, it would be more around the festive period. And also, one of the peculiar behaviors which we have observed, at least lately, is there is like bunching up of demand that happens where, during festive, the demand is much stronger, and in the non-peak or non-festive periods, the demand tends to remain muted. So that's how the trends have been. Consumers do wait for attractive offers, and that's when we see bulk of the demand coming through. So yeah, it's a bit like lumpy in terms of demand coming back and then slowing down. So I think these are the trends we'll see. Hoping for a decent numbers at least during second half. First half might still be overall a low single-digit growth for the sector.
Rishi, but I think in the first quarter, passenger vehicle sales on an average were down 6%. Is that correct, Q1?
No, it would be, let's say, a flat marginal decline, not a mid-single digit, but a low single-digit decline.
A low single digit. So that's for Q1 passenger vehicles, down, say, -2-3%. Yes. And for the full year, though, you're clocking in a growth of?
Let's say the industry expectation is around 1 to 2% growth, and we are around 3% growth at this point in time.
Got that. What about the trends in two-wheelers? And your thoughts on the anti-braking system, if it does get implemented next year? How will it impact? Who will it impact?
Sure. Again, two-wheeler, let's say if I look at first quarter numbers, the retail trends have been, again, mid-single digit to low single digit kind of a growth. So again, over there also, things have slowed down post-festive last year. And part of the reason was the motorcycle segment was not doing well. May was a good month because of a strong wedding season, but again, June has again slowed down a bit. So again, similar to passenger vehicle segment, our expectation is that second half we'll see some bit of growth coming back to mid to high single digit. Over here also, we are working with 6% growth for the industry for full year versus industry guidance of 6 to 8%. ABS norms, if it comes through, obviously it would be a significant impact for the industry. Today, around 16% of the two-wheelers have ABS and 84% of the two-wheelers don't have ABS. So that 84% has to shift towards ABS from 1st January 2026 as of the government staff notification. It's a significant impact. There can be around 3 to 5,000 rupees of cost increase in terms of percentage, anywhere between 5 to 8%. So that's a big impact for the industry. And in terms of OEMs, I think Hero gets the most impacted as 94% of their portfolio will have to shift, followed by TVS, where the impact on the portfolio would be around 65%, and then Bajaj Auto, which is around 35%. Royal Enfield, there will be no impact because all their models are today equipped with ABS.
All right, so two-wheelers could get knocked in, Rishi, but what about who benefits? I think Endurance is a probable candidate. Could you list out the beneficiaries and how big is this for them?
Sure. So roughly, if you look at it, there are three players today in the market, which is Bosch, Continental, and Endurance Technologies. Bosch is the leader with almost more than 60% market share. Again, the business sits in the unlisted arm. So today, the Bosch India listed arm may not get the complete benefit of it at this point in time. Endurance roughly is around 10 to 15% of the market share at this point in time. As I told you, right, 16% of the two-wheelers today has ABS, 84% needs to shift. So almost the industry or ABS industry size will almost increase by 5x. And obviously all the players will get benefited out of it. I know the question is, the problem can be that, in the near term, we might find, or let's say supply can be a constraint, and whoever adds the capacity at a faster pace may benefit out of it. So obviously we need to see the plans of all the ancillaries. But yeah, these are the three major players who will benefit if ABS norm comes in.
Bosch, Continental, and Endurance, though Endurance has a smaller share of the ABS market. Got that? That's really helpful information, Rishi. So finally, quickly, I mean, we're getting into market opening. What stocks to buy from a 12-month perspective? If someone were to ask you your top 3 auto picks, what would they be?
We continue to be selective at this point in time in the space, given the trends which we are seeing and the valuations. But yeah, as first thing you mentioned was M&M. So that continues to be our top pick. Followed by Hyundai Motors and then Maruti. These are the three names we like at this point in time.
Oh, really interesting. So Hyundai and Maruti playing for that turnaround, perhaps,
yes,
maybe around the festive time. Got it, Rishi. Good conversation. Thank you very much for joining, and we look forward to more of these in the coming weeks. Well, with that, let's quickly get back to our technical experts. Look at the 9-10 calls. The pre-open is settled. Nifty up 46 points in the pre-open. So, Darshan, what would your call be?
Well, it will be APL Apollo. Buy APL Apollo with a stop under 1650.
All right. And Mitesh, what about you? 9-10 call?
I'll go with a buy on Amber for targets of 72.50.
Oh, Amber, you said?
Yeah.
Amber Enterprises. Got it. All right, gentlemen, thanks very much for the trades. Let's quickly move on and address the standout brokerage report of the day. Nimesh is here as always with it. Which one is it and which stock, Nimesh?
Hi, sir.
Good morning.
Good morning, sir. So today's standout is on Tata Communications. Macquarie has put out a note. They have initiated coverage on the stock with an outperform rating and a target price of 2,300, a meaningful upside from current levels. But interestingly, they see the stock can double in 3 years in a bull case. Now, what Tatacom does? Tatacom is an enabling digital transformation for enterprises. For the world's largest digital initiatives, or for that matter, digital pipeline network. In fact, they see optionality in the growing digital services space where the company is a market leader. Now, the problem for Tatacom was their ROIC has fallen from an average 16% in FY21-23 to almost 11% in FY25, largely on back of acquisitions. And Macquarie says, assuming there are no further acquisitions, this ROCI can again come back to more than 20% by FY28 and gradually move towards the company's target of 25%. So that's the key thesis on which they've initiated coverage with an outperform rating and a target price of 2,300 on Tata Communications.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's go back to Mitesh and just get a quick view on this particular name. Mitesh?
I think there's really, some big movement happened yesterday. The stock had broken its 200 average and was consolidating. It made some kind of a triangle consolidation on the hourly charts, and yesterday gave a breakout. Now, this breakout suggests a first target of around 1,800, but logically, this could even stretch to about 19, 10, 20 level. So I think that's the minimum target I would look for from a trading point of view.
Okay, all right, Mitesh, got that. Thanks very much. Let's take a look at stocks that are on the move. Let's look at Dreamfolks actually. It's down 3.5% on my screen, showing down 3.5%, and that's exactly what we were discussing. That A, this has been in the market for a while. This buzz that there's some trouble there with their contracts with ICICI Bank and Axis Bank, and B, the company is maintaining that it's not like the relationship is entirely over. The contracts still continue, but the programs that they were running with these two banks for the airport lounge access, those programs are winding down. What that entirely means, we'll have to wait and watch. But the stock's down about 3.5%. It's down 52% in the last 1 year. I mean, pull up a longer term chart of Dreamfolks. It's been a tough one. This year itself, it's destroyed 40% odd in shareholder value. I mean, down 40% so far in 2025. So that's Dreamfolk. Talk about what else is taking the Nifty higher today. TCS, Infosys, so actually some of the Indian IT names are doing pretty okay. There's Hero MotoCorp reacting well to those numbers that came in. Rima, remember, was just telling us that at least in terms of June monthly sales, Hero's fine. They've met the mark. So that stock's also higher.
And they've also launched a new car yesterday. A two-wheeler. It's called Vida VX2.
Okay.
At an introductory ex-showroom price of $59,500. And Nomura says this is one of the most affordable electric scooters to date, at least for Hero MotoCorp. So there is a new launch which is also boosting sentiment for Hero.
Okay, all right. So more in the EV market coming through as well. Counting down, I think just 10 seconds to go as the day opens out. 25,588 as we kickstart the proceedings. Mid-cap index is very, very quiet. Let's see if it manages to build on some gains. There we go. The bell's gone. So the implied open was spot on because we've started 50 points higher. Nifty closing in on 25,600 now. The leaders this morning would include Hero Motor, the stock that we were just discussing. Infosys is actually holding out pretty well. There's a little bit of banks and IT on top, which is actually good news for the Nifty. So you've got Infosys, TCS up and about. There is ICICI Bank, which is about 0.5% higher. Axis Bank, 0.25% higher for the time being. Infosys is the one that really is standing tall with a gain of 1.5%. State Bank of India, again, 0.25% up. So it's not a big move on banks, but small incremental gains are coming through. Even Wipro is flashing some green. So banks and IT, not too bad. On the downside, IndusInd Bank, 2% lower. Asian Paints, now that CCI has confirmed that it is indeed starting a probe in those antitrust investigations. So that's a 1.5% knock on Asian Paints. Sun Pharma, Nestle, Trent, BEL. These are some of the stocks on the lower side. But yeah, I mean, the Nifty is doing pretty well, still holding on to a gain of 50 odd points. And for now, it's fairly steady with some of the large IT stocks and some of the large bank stocks working for the bulls.
Well, that's right. You know, a few stocks actually that deserve special mention from the broader market. Tata Communications, the standard brokerage report, well, that one's reacting positively. Big up move is what we're seeing out there. Right, they won a small order, so that one as well has opened well in the green. The stock of the morning yet again is Gabriel. You know, it's up, I think, another circuit. So effectively, just in a matter of the last 10 sessions, the stock has gone up by more than 60%, you know, even more than that. That's the kind of move you have seen. Remember, they announced that rejig, which is EPS accretive, margin accretive, and also, you know, if you put a number to it, last year they did an EPS of around 15 rupees. They're saying because of this entire, you know, consolidation that they're looking at, the EPS goes up by 7 rupees, which means it goes up by effectively 41%. So that's why the stock is, you know, being bid up. Keystone Realtors, they won a redevelopment project. The street likes that. Quite a large one out there. You know, Baman Rustamji had joined us on the show just a couple of sessions ago, and he was sounding very, very confident. And I think in the last two sessions, if I got that correct, the stock is up close to around 15%. So big move is what we're seeing. Besides that, Ellen Berry listed yesterday with solid gains, 30% up. It's continuing its good form today. Sterlite is one of the top volume gainers on the upside, so that's moved up as well. And Seagull, that's another one that's moved up. So good start, guys. Let's see whether or not we can get past the 25,670 odd mark.
So for Seagull India, there is an order win of 1,199 crore rupees. So that explains the big up move that we're seeing. 4% up, very large volumes to begin trade with. And the other one is Prime Focus. Nimesh was telling us yesterday in D Street Chatter that this company is likely to raise some money via a preferential issue along with Kaya. Prime Focus was active yesterday. It's gained, I think from Monday, Tuesday, Wednesday, every day it's been gaining close to about 5%. So that is another big mover. RBL Bank, that continues to, you know, gather a lot of buying interest. RBL Bank, I think, has gained now for 4-5 continuous sessions, and the stock rally continues. So RBL Bank, another 2% higher on that. And then you've got strength in some more names. So a Kamdhenu pops up on the on the volume charts, 24 lakhs to begin trade with. Inox India is seeing buy-in. Hiranba Industry, Tata Communication, Raymond has gained close to about 20% from the start of this week. On the way down, you've got Global Civil Project, a company that listed yesterday is retreating a tad bit. So you've got cuts on that. And then you've got softness in Dreamfolks, the stock that we were earlier referring to. Hyundai too, numbers were in line, but the stock has corrected close to about 0.5%. And MOIL, a stock that you were referring to, that's gained nearly about 2%. Rahul Arora, Chief Executive Officer at Nirmal Bang Equities, is now with us on this show. Rahul, thank you very much for joining us here in the studio.
Morning. Thank you for having me.
Okay, so how do we, how are you going into the earnings season this time? What should we expect? And is there any mismatch in terms of what you're expecting and what the price or consensus is suggesting, where there could be an opportunity?
So I think it's always good to enter with a little bit of trepidation and hope for positive surprises rather than going in through an overestimation and then coming out with a disappointment. I think, Rima, Q4 was not as bad. I think if you look at the upgrade to downgrade ratios compared to, say, the last 8-quarter average, Q4 was much better. So I think all things considered, there is not a very big disappointment expected from Q1. The only thing that I think people will be watching for is because so much has happened through Trump's tariffs and geopolitically in Q1 is what the IT companies say about the outlook for the next 12 months. I think people were expecting some of that commentary to come in Q4, but I think we'll have a realistic picture. Obviously, it's almost 12% of the index, so you'll have to wait and see how it goes. But I think by and large, for banks, it should be okay. Consumer will be a bit soft. Reliance should be okay. That's 70%, 75% of the Nifty right there. So I don't think you're going to enter into too many disappointments. Cement should be by and large flattish. Durables and electrical should be flattish. Defense should be about okay. So I think on balance, I don't think we're entering in where we're saying, oh my God, there's going to be some, really negative surprises. But then on a company to company basis, anything can happen. Of course, from where we were a few months back at 22,000 on the Nifty. We have rallied about 20%. So it's not like valuations are cheap right now. It's pretty much priced to perfection. So I think any negative surprises will be met very negatively by the market. I don't think room for substantial re-rating is there. And I still maintain my view that I think this will still be a range bound here, where I think going back to the old highs of 27,000 or taking them out this calendar year might be a bit tough on current evidence.
I was coming to that. You've already answered partially my next question, because I remember, Rahul, our conversation on Editors Roundtable, and you were taking things with a pinch of salt and some healthy, perhaps, cynicism at some level, which is really the point that but the market can surprise you, right, at times. When you have cynicism, when you don't see any fresh positives ahead because earnings are where they are, valuations are where they are, I don't know. I mean, is there something that we're missing? Because in the morning, we were discussing this golden cross, right? The technical indicators are saying that things are going higher. You ask most of the techies, are saying the market's charging higher. On fundamentals, we're struggling to find a very solid reason. Your thoughts?
So a sector will emerge. We don't know what it is going into the results season. You know that famous English song that I found love in a hopeless place.
Oh,
so
wow.
You might just find a sector in a hopeless market.
I thought Rahul's telling us more.
No, but I think to your points would be, I don't see, you've had a situation where, as I was saying about IT, you're not sure. I think if you look at the two-wheeler or the auto sales numbers by and large, I think two-wheelers have performed well. I think premium passenger vehicles are still doing well. Tractors are doing well. Premium two-wheelers are doing well. I think look at Aisha's numbers. Yeah. So I think that's a pocket that you can certainly look at. I think EMS players are still doing well. Of course, there is a bit of a slowdown because you did have intermittent rains in the first quarter in different parts of India. But I think by all prognoses, the rainy season is likely to be good. So if that happens and you have a proxy on rural, then two-wheelers obviously comes in. Then you probably look at consumer staples as well. You look at NBFCs, which are basically, ruling the roost in those kind of places. Credit growth to the agricultural sector might pick up. We just had our deputy head of research in Uttar Pradesh recently. I think the crop has been good. we are expecting a good Kharif output as well. So I think the rural part of the economy is something to watch. I think consumer discretionary is still doing well. I think by all, sort of numbers that I have been looking at, United Spirits look like it's going to have a good couple of years ahead of itself. We recently hosted Puneet Chatwal of Indian Hotels in our conference just about a week back. He's seeing no signs of slowdown. Of course, with what happened with Operation Sindoor and the unfortunate incident with the Air India, there'll be a temporary blip, but I think hospitality is one.
Structurally, it's still,
yeah, I think hospitals is another area. So it's not like it's all gloom and doom. There are still, pockets where earnings growth will be good. Now, you can question valuations in those backdrops, but, a lot of these will have a lot of mid and small cap names, but let's look at something like an SBI. Still coming to you at 1.2, 1.3 times price to book. If it manages to grow at 12-13%, the ROAs are at similar level. The ROEs are at about 1.5 or thereabouts for SBI. So that becomes a no-brainer. So it's not like pockets of value are not there. I think PSU banks, consumer discretionary, and a proxy to rural would be three themes that I watch into when I go into results season.
So when I hear you, I think the sum and substance is stop looking at the Nifty and waiting for the Nifty to make a move, do the dance. Look at stocks, find your stocks and stick with them. And you'll find growth.
That's always been my view. You don't buy the Nifty, you buy stocks, you buy businesses. And, I think just one line, I think even when we talk about stocks, right, we should actually address them as businesses. And I think that's a mindset shift that people have, that you're actually buying into a business. So if you're buying into a good quality business and it has 1 or 2 quarters that are, a bit of a down cycle, so to speak, you stay invested. And one classical example of that is the defense sector. I think they're so well priced to perfection. There could be a couple of quarters where numbers don't live up to expectations, but I think structurally it's a great sector to be invested in.
Okay, interesting. Hi, Rahul. Good to have you. And I'm still thinking about finding love in that. Interesting one.
Friday is still 2 days away. Nigel, wait.
All right. So, Rahul, let's focus on the banking name since we just spoke briefly upon that. And SBI is something that valuation-wise obviously has some support. That stake in NSE as well could be a little bit of a booster shot. And the stake in Yes Bank as well. But those are additional ones. What about going down the rug? If you look at it, these smaller banks, suddenly they've come to the party. IndusInd Bank, there was so much of trouble. You made the biggest money out there if you had the guts. You had RBL Bank. People are doubting the book. Now, suddenly everyone's talking about that. The book value is 280 rupees. And that stock has moved very swiftly, 160 to 260. IDBI Bank as well, 80 rupees stock has become 105. Would you look down the rug or would you stick to the larger names?
One name that you missed out is Development Credit Bank, which is DCB.
Again, DCB, yes.
Despite the run, it's still not trading at one-time price to book. And I think if you look at the credit and deposit growth, it's likely to be 15-17% for the next 2 years. So I think it's not a bad place to be, Nigel, because I think if you aggregate the large cap private sector banks, all of them, you're probably looking at an NI and profit growth of between 10 to 13%, compounded for the next 2 years. And most of these, if you look at, say, ICICI, HDFC, of course, some would be at a discount, but the larger consensus ones are all trading at about 2.5 times price to book. So I think Federal Bank looks like an interesting play. And City Union Bank. I think these are two names that I would certainly look at. Both have ROAs of between 13.5 to 4, ROEs of 13.5 to 14.5%, and ROAs of about 1.5% or thereabouts. I think on both there is a lot of work happening on the digital side. So I think cost to income ratios could be coming down. GNPAs and net NPAs are under control, and I don't think both these banks need capital in the foreseeable future. I think we could extend that into NBFCs. I think if you look at something like a PNB Housing Finance or a Canfin Homes, that also looks interesting. I think, this entire segment, which is either operating on collateral or looking at salaried employees, I think could be standing us in good stead. Again, valuations are not too demanding in that front. And if you want to go a little further, I think although some of these stocks have done well, on corrections, I'd even look at something like an AU Small Finance Bank. So I think Federal, City Union, DCB, PNB Housing Finance and AU from the non-large cap space in the BFS I look interesting, and maybe on corrections even insurance names like say an ICICI Pru Life, and if my call on the market goes wrong and it keeps going up, ICICI Pru Life has a very large ULIP book. That could be an interesting one as well.
Lots and lots of ideas there. Rahul, thanks very much for that. Actually, we have more questions, but maybe another time. But you did mention one space, which is hospitals, which is something where you're seeing interest. And I think that's the next big sort of conversation that we have lined up. Maybe you'd want to listen into this one. Apollo Hospitals obviously in focus after approving that scheme of arrangement that will see it combine its pharma, retail and distribution businesses with the digital initiatives under Apollo Health Tech. That's the name of the new entity that's going to be set up. And of course, that entity will then eventually be listed as well. To talk about this, the whole rationale and the creation of more shareholder value, we have Ms. Sunita Reddy, Managing Director at Apollo Hospitals, joining in. Ms. Reddy, thank you so much for being with us. So this is a big restructuring exercise, ma'am. We want to start by understanding the overall rationale. I think what you've said in the call as well is that it kind of simplifies the structure, makes it cleaner, and maybe also reduces the holding company sort of element that was being attached to the listed Apollo Hospitals. Just tell us what is the valuation you're looking at and the targets that you've ascribed. 25,000 crores in revenue over the next 2 years. How have you arrived at that? What makes you optimistic? Which of the businesses will take you there?
So first, in terms of the valuation, we've always felt that the sum of the parts did not do justice to the digital. The rationale behind doing the whole thing is not just to capture the value of the sum of the parts, but to go beyond and create a very strong retail digital business, which is omni-channel. And with this, with the composite scheme of merger, what we're doing is moving Apollo HealthCo as well as the telehealth business into the new company, as well as amalgamating KeyMed, which is the supply chain. And as we move forward, the front-end pharmacies will also get absorbed into this company. So you will have a very strong retail company, which is Indian-owned and Indian-controlled, which is very key. So there's a sum of the parts reason, there's the IOCC reason. The third is really to capture the synergies of the digital business, because currently they have 130 million customers. They are doing about 900,000 transactions a day. They have 40 million downloads. The sheer volume of that business and the potential to create a large into the hospital business is huge. And this is the way forward. This is the way that we're thinking about it.
Ma'am, just for clarity, so that we understand the projection that you've shared so far, that by FY27, Apollo Health Tech will have revenues of 25,000 crores. Can you give us a rough tentative breakup so we understand what will the scale and size be of the individual businesses by the time you get to that target?
Yes, so as you look at currently, they're at 16,237 crores. They are growing very fast, around 20% growth. As you look at forward, I think the offline pharmacy growth is around 20%, and the EBITDA generated from that is 1,000 crores in 2027. KeyMed is growing at about 18-19%, and with the introduction of private label, there is a very strong opportunity to also improve the EBITDA margin and the EBITDA coming from that, which will be 700 crores. Digital, we are quite sure that we'll get at least 60 to 100 crores of revenue. So total, the breakup of I've given you the breakup of the EBITDA, because in the end, that's what counts. You will get 25,000 as you look at the 17 and the 20% growth coming from the three different, the digital, the offline, as well as KeyMed. So the 20% growth results in 25,000 crores of turnover.
Just one quick word, Ms. Reddy. Congratulations on this big announcement. You're guiding for a 7% margin, which effectively means at 25,000 crores, you do 1,750 crores. Almost all brokerages believe that this is too aggressive. You don't think so?
Not at all. Not at all, because as you can see, I've given you offline. Offline is already generating 7% growth and growing at 20%. KeyMed, we know for sure. We've got experience. We're very sure that those 700 crores will come from there. And the digital, as you can see, is, we've been very conservative about growth, even though we're adding new revenue stream, which is the insurance.
Okay. Ms. Reddy, thank you very much for joining in. This is Ekta. Just wanted a sense in terms of the valuations that you all are now working with when it comes to NewCo. In September of 2024, the enterprise value which was subscribed during the Advent deal was around $2.4 billion or $2.7 billion. The street is working with probably a range of around $3 to $3.4 billion now. Is that a fair assumption?
Yes, I think the street is being very conservative because if you look at the potential of this company, it is let me say, very good. And I think that more than anything else, the whole valuation has been done by KPMG and validated by Axis Bank. Relative valuation of AHL to Keymed is at 2.2 times. With that having been said, the transfer of telehealth business, which gives it another 80 crores of revenue, pure revenue, is is an additional benefit. All in all, I think with the current swap ratio of AHEL shareholders getting 1.95 shares for every one share they hold in the new company is also reflects this valuation.
Okay. For Apollo 24/7, that's still making EBITDA losses. Can you just tell us whether you're on track to achieve a break-even by when in FY26? Is it going to be in the mid of FY26 or by the end of FY26? And your GMV target as well.
Break-even will happen in the fourth quarter. GMV target around 4,000 crores, but really I think GMV is not important. Here's an omni-channel company delivering and potential to deliver 25,000 crores of revenue. So in terms of an engine for growth of revenue and profitability, I must say that this is very strong. And therefore there will be no losses.
Okay. How is incremental capex going to be funded in NewCo? Because the reason I ask is that, earlier it was a part of Apollo Hospitals, and hence the cash utilization was across all of the businesses from hospital to digital. Hospital is really your cash cow, but that's now going to be a separate entity. So give us a sense in terms of where exactly are you going to be generating cash? How much is going to go into capex?
There's very little going into capex because the way that the pharmacies are set up, it's only 10 lakhs per pharmacy, and the ROC on that is on the whole company is 20%. Having said that, they have 1,931 crores working capital. So I think use of working capital for the business is all that is required, since the Advent funding of 2,430 crores has enabled the company to be fully funded for growth.
Okay. Apollo Hospitals is now going to hold a 15% stake in NewCo going forward.
Yes.
How did you arrive at that 15% stake?
15 plus 2% coming from another company, so totally 17% stake in the new company. How did we arrive at this? I think we did a fair value discounted cash flow method. In this discounted cash flow method, the Apollo Hospitals will own 42% plus what comes from the 17% that we're currently holding. The 42% plus the 17 equals 59.6%. In this, the 42% will get distributed to all of the shareholders. So that's close to 17,000 crores of revenue being distributed to all of the shareholders. Balance Keymed holds 25. Keymed and its shareholders holds 25% stake. Advent will hold 12.1%.
Okay, and any plans on monetizing this stake at all, or would you be a long-term shareholder?
I think, we should see how we take this forward. First is to see that we get the synergies of the company in this stake, and a director seat on the board of AHL will help us make sure that these synergies appear. Going forward, there is an opportunity to monetize. As you know, a company with the size and scale that we have now created will definitely be valued. The value will keep increasing over a period of time. So when required for the Apollo Hospitals growth, especially in the hospital business, there is an opportunity to monetize some of this.
All right, Ms. Reddy, in terms of royalty, the new company will pay some royalty, right? I think it's approximately 10 crores is what you're talking about, but that will gradually increase. Could you tell us how do you see this increase going about? I mean, what could be the ballpark number?
So 10 crores will be the beginning, and then there's a 5% reset that will happen every year.
5% increase every year, right?
Yeah.
All right. And also, a private label on the digital side, I think it's still very, very small, but you have plans to scale it up. Could you tell us where is that number headed?
So currently it's 17.6% of the offline. We are moving to making sure that it's 17% of the online as well. And we're also using the KeyMed channel to push the private label. So there is an opportunity to supply the 75,000 pharmacies and the 3,000 hospitals that KeyMed is currently supplying to.
Okay. Just a quick word with regards to the synergy between the two businesses. The reason I ask is how much are you actually going to benefit from, say, the funneling of patients between the two businesses? And what is the plan in terms of synergies going forward?
So if you look at just one part of it, which is quite huge, the diagnostics, 20% of the customers come from Apollo. They come from Apollo Healthco, which will again become Apollo Tele-Technologies. So definitely, we are seeing that happening in the diagnostic business. In the insurance business, there is potential of 80 crores revenue, but beyond the potential, for customers who now see that they can pay for their healthcare needs using the insurance policy offered by 24/7, again, another funnel. The third funnel is that we will together work with corporates, and the retail presence that Apollo Healthco has is tremendous, with 40 million downloads. So there is, again, we are working on synergies that will make sure that there are conversions that happen with some of the pharmacy consumers, both online and offline, moving into the Apollo hospitals.
Okay. So big restructuring done. I'm just wondering, I mean, in any case, you had gotten funding from PE giants just a couple of years ago when the Advent deal, etc. From infusing capital perspective, whether it is in listed Apollo hospitals, I mean, or even in the new entity that's being created, is there anything on the horizon? I mean, there's enough cash being generated in the business as well. So just from that perspective, how do the next 2 to 3 years look?
Well, I think that all of our businesses is about being self-sustaining, generating cash for growth. Clearly, I think that given the numbers, if you look at the 25,000 crores that we're projecting, growth of 20% from 16,000 crores currently, the EBITDA that's being generated from the offline business is 1,000 crores. And we're quite sure we have a line of sight of this. KeyMed by itself will generate 700 crores of EBITDA. And we're being very conservative about the digital and saying with profitability, they will generate 50 crores. So 1,750 crores of EBITDA coming from these three lines of business in the digital space. As you know, Apollo Hospitals is already generating 1,200 free cash flow. So there is more than sufficient headroom for growth. I mean, liquidity for growth. Beyond that, I think if you look at the debt levels in both companies, at Apollo Hospitals it's 0.2. Here it is 0.6, with only working capital being used for day-to-day activities.
Sure. All right. Ma'am, we'll leave it on that note. Thank you very much. Offers us a good perspective and clarity on the new structure that has emerged. Good luck with all the plans. Thank you for joining in today.
Thank you.
Thank you. We'll take a break on that note. Coming back on the other side, we'll be in conversation with the management of Aarti Industries to talk about the company's FY26 outlook.
Welcome back. Well, the markets are holding on to mild gains, but a lot of stocks actually are doing a thing of their own. So let's talk about the chemical space now. The sector has performed, amid the geopolitical uncertainty. We'll also get a sense about what's the impact on supply chain and how is demand shaping up for the remainder of this fiscal. To help us out with that, we're joined by Suyog Kotecha, the Executive Director and CEO of Aarti Industries. Hi, Suyog. Thanks a lot for joining in. Well, you had a brokerage note that came in earlier this week, and they said, that's MK, they say that the US tariff situation may create new opportunities for a company like yours. Would you agree? If yes, in which sectors are you observing this?
Yeah, I think let's take a step back. I think we're just coming out of unprecedented quarter, and given you started by saying sort of understanding impact on supply chain, I think it's very rare that within a quarter we have seen multiple significant geopolitical events. Starting with US tariff announcements on first week of April, followed by India's counter to terrorist attack in Kashmir, then flare up of Iran-Israel, and then pause, and then renegotiation of US tariffs to the multiple countries in the world. So I think with that kind of movements, supply chain shocks are quite real. Right. I think we have seen raw material volatility where, going down by 20%, going up by 15% in same quarter, which is quite unprecedented. Even from a physical supply chain point of view, right? For example, Kandla port, from where we export significant quantity of our products, was shut during the mid part of this quarter, and till date, the congestions are quite severe. So a lot of shipments getting delayed, having impact on freight cost. Even the June Middle East flare-up saw a lot of shipments going from Middle East to India to US getting significantly delayed. So I think all of that, I think the industry, especially the export-oriented sort of companies, continue to manage this volatility. As we look forward, I think many of these aspects are settling down. There is one major event that we are yet to see, which is what you referred to in terms of what happens to US-India trade deal, and in general what US does with sort of reciprocal duties beyond 9th of July. And if that settles in favor of sort of India versus rest of the world, we will definitely see demand pick up. But at this point in time, I think customers are waiting to get full clarity. And sort of, we expect that clarity to emerge in the next couple of weeks time frame.
Yeah.
But today is difficult to make that judgment call.
Yeah. So, Suyog, obviously the freight situation is very, very difficult. But do you think it's creating a bit of an opportunity for some of your products? More tariffs come about from other parts of the globe as well. The tariffs could be relatively higher. Do you see it creating an opportunity in an adverse situation?
In a mid to long term, yes. Right. I think in a mid to long term, we had described this in our. There are some chains where we compete head on with China. I think in those chains we saw pickup in demand in US, and as I said, if it gets settled in favor of India versus China, we will definitely see pickup in demand. But at the same time, in near term, we do see this volatility impacting in terms of customer taking decisions, because I think businesses like certain environment, right, to make business calls. And when that certainty is missing, when that clarity is missing, we also do see people holding off from making decisions from a large, year-related volumes or multi-year contract kind of situations.
Suyog, hi, Rima here. Some of the MNC agrochemical companies are still cautious when we chat with them about calendar year 25, calendar year 26. And considering a big chunk of your revenues coming from this sector, give us an indication. I know you've got an EBITDA guidance of about, I think, 18,000 to 22,000 by FY28. Tie in your, aggression, what you see versus what we're hearing from your MNC counterparts.
No, so I think even our outlook is quite consistent. I think everyone has been talking about sort of volume-led demand growth, but I don't think any one of us is budgeting for margin increase at this point in time. And that's what we also hear from our agrochemical clients. I think a lot of stories around inventory buildup, and in that context, correction in the overall pipeline is kind of done for most of the value chains. And in that context, we see volume-linked growth coming, but it is coming at a relatively significantly lower margins compared to where it was, let's say, 2-3 years back, given kind of demand-supply imbalances we have globally. And that's the story we continue to hear. That's the story we continue to observe. So we continue to see demand growth, but at a relatively stressed margins.
I think your FY26 capex was about 1,000 crore, and the second half of the year will see the staggered commercialization of Zone 4. So which products will be available first? How would the revenue accretion? And I think after that, you're going to be focusing a little bit more on the balance sheet because a chunk of your capex would be done by the end of this fiscal year.
Yes, so I think that's right. I think this year we will spend around 1,000 crore of capex. And part of that greenfield site will get commissioned this year. Most of these products will go into agrochemical, pharma, and coating sector. But the real benefit of that site will start coming in sort of subsequent financial year, right? When we commission the full site and we ramp it up also to decent utilization levels. At this point in time, I think during this year, the capacities that we commissioned last year, our expanded ethylation capacity, our expanded nitrotoluene capacity, and our expanded MMA capacity, I think we remain focused on sort of utilizing those capacity to the full extent possible. The new Greenfield Zone 4 will start kicking in towards the end part of this financial year, but the real benefits, we should be able to start seeing it in the next financial year.
Suyog, thank you very much for joining in. Short conversation today, but we'll chat when the numbers are also out. Thank you once again for joining in. Let's talk about M&M. M&M sales numbers beat street expectation in the month of June, and the company continues to see strong demand for the SUV segment. My colleague Mangalam spoke with Nalinkant Golagunta, the CEO of the automotive division, and began by asking him about the models that led to this growth.
Strong performance in June, 18%, like you said. Really, what has given us a lot of impetus over the last few months has been the 4 major launches we did last year. And as you know, we had the 3XO launch on the Thar Rocks, both on the ICE side. And we had 2 very strong EV launches, the 9E and the E6 as well. So that has given us the impetus, that has given us some of the growth coming in as well. But the bedrock of the volumes for us, of course, continues to be our Scorpio platform, our HCV 700 and the Bolero as well. So that continues to be a strong foundation. On top of it, the growth has come from these 4 major models.
So, the first quarter so far, your SUV sales have been 22%. What we want to understand is how sustainable is this? And are you likely to up your guidance of mid to high teens growth in FY26 basis this 22% performance in the first quarter?
Yeah, so we called out mid to high teens and we stick to that performance outlook at this point in time. We are not upping it. It's very early in the quarter, and very early in the year for us to look at it, but we're confident that we'll be able to do the mid to high teens growth.
All right. And what about the EV numbers? What's the monthly run rate out there? What about the utilization and the capacity that you're operating at?
Yeah. So when we launched, we said that we have operational as about 5,000 capacity per month. As you know, we launched 3 packs, pack 1, pack 2, pack 3. And but right now, what we are retailing out there to customers is only pack 3, the top end variant. And there's been strong demand for that. And we are at about 4,000 production and 4,000 billing and retail at this point in time, and just on that 1 pack. As we go into festive, we'll be launching the other variants as well, pack 1 and pack 2. So as we get ramp up on those, we should be able to see a little bit of a higher volume coming in from there. But what we have operationalized, we're confident we'll be using most of it.
And when you say higher, it would be 5,000 or would it be more than that? Are you increasing your capacity?
No, at this point in time, what we called out is 5,000 as an operational capacity. So that's what we'll be operating on.
And what about the rare earth issue? Because, the industry is facing that. Are you facing that as well? What's the kind of inventory that you're sitting on for the rare earths? And what's your plan after that?
Yeah, so currently we have inventory of all the affected parts. We have done a full analysis on all the affected parts. And as you know, there's end user certification which has to be put in place. So that's something we're working very closely with the suppliers to get it done as well. We're working closely with the government as well as SIAM to get there. But we're also looking at alternate sources. We're looking at alternate designs as well. So overall, currently we have the inventory for the production that we want at this point in time, but we're actively working to de-risk.
How many months are you covered for?
No, it's hard to say at this point in time where we are because the suppliers are also finding opportunities to find alternate supplies for us. So it's very hard to say, but currently we're well placed.
All right. And inflation. Tata Motors did speak about considering price hikes. What is the kind of inflation that you've faced so far, and will you be considering price hikes too?
Yeah, so price hikes is part of the regular running of the business for us. So we had projected in our own yearly planning what that looked like. And so we continue to see similar benign trends on inflation. So we'll stick to that. Yes, there is a price hike which will come up, but it's not something which is immediate.
What would the quantum of that be?
It'll be what we have done regularly on a quarterly basis. It's hard to say at this point in time because we are still a month or two away from that, and we'll have to see what the inflationary trends are. So hard to say at this point.
Right. While SUVs did well, the commercial vehicles were largely flat, and in that there was specific weakness in the sub 2 tons vehicle. What exactly is driving this, and are you seeing any sort of change, any turning of sentiment there?
Yeah, so sub 2 ton has on the load side, if I may call it, not on the passenger side. On the load side, we have seen weakness, and it's a weakness we have seen over the last few quarters. The hypothesis we have is a lot of the volume is starting to head towards higher tonnage, and so we're seeing some growth coming from there as well. And there's also the unorganized sector, which is underneath that, below that as well. So bit of pressure from both sides to some extent, and but the beneficiary for us obviously is the 2 to 3.5 ton, which is where we have a very strong portfolio. So while the industry has been muted growth, we've actually given consistent growth, and the market share gains that we have shown over the last few quarters and the market share gains we will see in Q1 as well when the final industry data comes in, tells us that we're on track.
That's the one that is driving your CV sales growth itself. For the first quarter, it's up 4%. Here too, your guidance is high single digit for the full year. So on the one hand, where your SUV, you've outpaced your guidance so far in the first quarter, in CVs, you are fairly away from there. Do you still maintain the high single digit growth guidance for CVs?
Yeah, like I said, very early in the year for us to do any changes in numbers at this point in time. We have a festive season coming as well. We are starting to see some momentum in the rural segment on Bolero and other products as well. So we are hoping that that will translate into some growth coming on the CV side as we head into the festive season. So again, very early to say, so we are sticking with our high single digits.
What about three-wheelers? That was a big 37% jump in June. How much of that was led by electric vehicles? Do you have a target contribution coming in? I mean, what's the prognosis here?
Yeah, so I don't have the exact numbers. It's a separate business unit, but overall consistent growth there. But a lot of that was also coming on the passenger segment side within the three-wheeler EV segment. So that's where a lot of the growth was coming from.
Why is there so much volatility in exports? All of 36% growth in the first quarter, but June was just 1%.
Yeah, so it's hard to say. On an export business, it's hard to look at it month on month. We also have major launches coming up. So we have some stocking that we do in certain markets at a certain point in time versus others. So it's better to do it at a quarterly level and probably even at a yearly level. So overall, we're confident with what we have. We just launched the 3XO a couple of quarters ago in South Africa. It won the Car of the Year award in South Africa. We're just about to launch 3XO in Australia this week. So we are very confident with what we have as products, and we look forward to taking our EVs as well globally in the next few years to come as well. So quite gung-ho on that front, but hard to take a trend out of monthly volumes at this point.
So what's the annual target that you have for exports in terms of volumes?
Again, we don't put out numbers on IO at this point in time, but it should be strong double-digit growth.
Strong double-digit growth. And finally, you called out a lot of new launches in the international markets. What's the kind of facelifts and launches that we can expect in the second half of this year for India?
Yeah, we have quite a bit in store. The most important thing is we are putting out an event in August as well, where we'll be talking about our new platform. That will anchor all our new vision SUVs going forward. So we're super excited to share our vision there and hope the customers will respond with the same excitement as they have done over the last 5 years.
Could you give us a peek into what you are going to talk about there?
Well, the teasers give some clues there, so I'll let the guessing game go on, but we'll be talking about platform and a few vehicles which will be anchored on the platform, which will be showcasing there.
Okay, that's the word coming in on M&M. By the way, the market at the index level is absolutely flat, but ITs are rocking today. The Nifty IT index is a gain of 1.5%. And in fact, the top 4 Nifty gainers today are all the IT heavyweights. So Infosys right on top, 2.5% gain. TCS 1.5%, Wipro 1.3%. Tech Mahindra too is moving up with a gain in excess of close to about 1%. Banks are a bit on the back foot, and the top Nifty loser today is IndusInd Bank. That's down more than 3%. Goldman Sachs today has downgraded IndusInd Bank to a sell, and they've put a target price at 722, so much lower than the current market price of 850. Mitesh is now with us for a few calls, 10 a.m. calls. Mitesh?
So good morning. I think, you were rightly pointing out IT as the space to watch out for. In fact, a lot of IT names have given breakouts in the hourly to hourly chart. So I have a buy on Infosys with a stop below 1620 for a target of around 1685 to begin with. Maybe then we'll look at high levels. And a sell on ABB, which is turning slightly negative. So keep a stop of about 59.80 here. Look for targets of 57.50.
Okay. The stock to watch just moments from now will be HDB Financial Services as it makes its debut on Dalal Street. The issue price was 740, but it's seen very strong subscription. It was a large issue of 12,500 crore rupees, and it saw a subscription of 16.7. And it's open with again a 12-13% higher, now 835 rupees on HDB Financial Services. Valuations for it are cheaper than some of its peers like a Bajaj Finance, for instance. So it's a good debut for HDB Financial Services, 13% up on that. The bell has gone now at, okay, 5 seconds to go for HDB Financial Services. Mitesh, what about some of these private sector banks? They've had a good run, but they've retraced a bit now. You've got even a Bajaj Finance. Some of these financial names are under pressure. Okay, that's the debut of HDB Financial Services. It's open with a gain of close to about 13 times. The valuations, as I said, were seen cheaper than some of the Bajaj Finances of the world. I think analysts had pointed it at close to about 2 to 3 times. So lower than a Bajaj Finance, which trades at say 4.5 to 5 times. So it's a good debut on day one. 740 was the issue price. The stock is open at close to about 840 crore. 840 rupees. We'll get into a break on that note. On the other side, Manisha Gupta will come back and chat about commodities. Stay tuned. Welcome back. Let's now turn our attention to the commodity markets. Manisha Gupta, as always, is joining in. Manisha, morning. What are you looking at?
Well, thank you for that. I'm looking at soft commodities right now because these are the ones which have seen big losses when you look at the first half of this year until now. Well, on my radar is sugar because we've seen sugar prices decline quite sharply. There is weak interest from the buyers at the Intercontinental Exchange, and the sugar prices, with the kind of decline that we've seen trading below 16, are now at a 2021 low. So it's a multi-year lows that we've seen come in for the sugar prices there. Also, when you look at the overall supplies, those have been increasing as well. We have high production in Brazil. It also has to do with abundant rains that we have seen in Asia. That is leading to a higher production coming in from India and Thailand as well. So that is not very supportive for the prices. Also going forward, because the crude prices have continued to decline, the ethanol prices have declined. So there is more that you've seen as cane go in for sugar rather than ethanol, increasing inventories yet again. The other one on my screen is cotton, where the prices are now trading at a 2020 lows. The US production is expected 6% year on year. The other major producer is India. Here as well, because we're looking at very strong monsoons for the month of June, 109%. July is expected at 106%. So sowing here also has gained quite strongly. The markets also are looking at weaker demand coming in from China, and that clearly seems to be weighing on prices. The other one is Arabica coffee. Here as well, we've seen prices decline to a 6-month lows. Higher crop supplies in Brazil, higher global inventories, not so strong demand coming in from Europe has been weighing onto the space here as well. And the last one is soybean. The prices here are trading at around 12-week lows. There is higher production in the origin countries like Brazil, Argentina, Australia, US, including India as well. For India, we are trading below MSP now for 8 to 9 months, and the Chinese buying is not so strong because of the tariffs that they have in the international markets, especially from US, and that continues to weigh on as well. I want to take you through on what we've done in this year until now in sense of prices then, and I'll start with edible oil as a space. Barring soybeans, which is up by nearly 3%, you have sunflower, which is down 3%, and palm oil prices down by 9% in this year until now. Take a look at the grains then, and wheat is down 3%, and you have corn prices trading 9% on the weaker side for the year 2025 till time. Good production, especially when it comes to wheat, whether it has been about Russia, Ukraine, India for that matter, continues to weigh on prices. And then you have agriculture, industrial commodities like rubber used in gloves and automotives, etc., and cotton for textile and polyester, etc. As you can see, double-digit percentage decline here as well. Cotton is down by nearly 15% and rubber down 17% in this year until now. And this is the final plate which shows you sugar, cocoa, coffee. And as you can see, we've seen sugar prices decline by 18%. Cocoa is down 24%, coffee down 8% as well. So overall inflation when it comes to food commodities is definitely does not seem to be a concern because the first half of 2025 has seen very sharp declines coming in for most of them.
Thank you very much for that. Now let's talk about Keystone Realtors, where the company has won a cluster redevelopment in Andheri. Vinny joins in with the numbers. Vinny?
Hi, good morning. So yes, Keystone Realtor Developers has actually won an 8 housing society redevelopment project. This is in Andheri West. The gross development value for that is around 3,000 crores, cumulative area of around 4.57 acres of land, and saleable value area is around 10.6 lakh square feet. Now in this, as of now, development agreement is signed with 5 of the societies, and letter of intent is received from 3 of the societies, where obviously they'll be signing the development agreement, and they're very confident on that front. So 8 societies where they've signed, and do not forget that just yesterday also we'd seen that they'd won one more redevelopment project of around 4,500 crores in Science. So back-to-back 2 days of redevelopment project.
Thank you very much for that. Inox Wind is the other one that we are tracking right now, where Motilal Oswal has initiated coverage with a buy. Stock is excited. Vivek joins in with the details.
Well, that's right. So interesting note coming in from Motilal Oswal Financial on Inox Wind. So they've initiated coverage on the stock. They have a buy rating. They have a target price of 210 rupees a share. What they're saying is that the company is one of the leading vertically integrated player as far as the wind energy sector is concerned, and they like the stock after the recent correction that it has seen. Remember, they're talking about the company's capabilities, where it delivers end-to-end solutions right from concept to commissioning, as well as operation, as well as maintenance of the entire wind power project. So the entire life cycle is taken care of by the group. What do? They, number one, manufacture both 2 megawatt as well as 3 megawatt wind turbine generators, and they had an order book of almost 3.2 gigawatt at the end of FY25. Along with that, there are 2 listed subsidiaries. Remember, Inox Green Energy manages
5.1 gigawatt O&M portfolio. This includes both own as well as third-party portfolio. And as far as financials are concerned, they expect the company to deliver a consolidated EBITDA CAGR of 38% from FY25 to FY28. They see a ramp up in WTG execution from 705 megawatt in FY25 to close to 1.8 gigawatt in FY28. And the target price multiple that they have is at almost 25 times FY27 earnings per share.
Thank you very much for that. Once again, let's put the spotlight on HDB financials. Day one today on Dalal Street, strong opening, 13% higher on listing day. MK has initiated coverage on HDB Financial with a target price of 900 rupees. They've got a buy rating. That's about a 22% upside compared to the issue price. And it values it at 3 times FY27 price to book. Their positive view stems from its diversified, granular and large-scale lending franchise. So HDB Financial Services higher. Another one is SBI Cards we should look at, because today Goldman Sachs has downgraded SBI Cards to a neutral with a target price of 1,006, and Goldman Sachs has also downgraded IndusInd Bank to a sell with a target price of 722. So these are some stocks in the financial space which are under pressure. By the way, for the Nifty as well, it's flat, but now it's got a red tick going for itself. So the Nifty is moving towards 25,500 at the low point of the day. Get into a break. On the other side is our special segment. It's the economy. Lata will be in conversation with Ajay Srivastava of Global Trade Research Initiative and S. Ganapati of Gokuldas Exports on the likely options for exporters from 9th of July.
Welcome to It's the Economy. India and the United States are racing against time to conclude an interim trade agreement before July 9th, when the full reciprocal tariffs are supposed to kick in. President Donald Trump recently told reporters that India and US will soon strike a deal with much less tariffs. Now just listen to that bit.
I think we're going to have a deal with India, possibly. And that's going to be a different kind of a deal. It's going to be a deal where we're able to go in and compete. Right now, India doesn't accept anybody in. I think India is going to do that. And if they do that, we're going to have a deal for much less tariffs.
Okay, now just note the word, last 3 words, much less tariffs, indicate there could also be a deal with something more than 10% tariffs, but less than the 26 plus 10, 36% tariffs. So how will the various combinations of tariffs impact India? I have with me Mr. Shivaramakrishnan Ganapathy, the Vice Chairman and Managing Director of Gokaldas Exports, and Ajay Srivastava, the founder and head of Global Trade Research Initiative, a trade expert. Gentlemen, thank you very much indeed for your time. If I can start with you, Mr. Srivastava, what have you made of this first statement itself, that there could be a deal? Are you reading this as a likelihood of a tariff between 10 and 36? By the way, I believe it is 36. It would be 10 plus 26.
So it's 26. It's not 10 plus 26. It's 26 or 10. So basically, they want 10% as their base tariff. That's a new zero for the US. And they say their MFN tariff, the normal tariff which US or India charges on the imports, they will remain there. And 26%, they will be kind enough to cut 26%, not charge 26% and charge only 10%. So Indian goods going to the US, if FTA is concluded, then they will be paying MFN tariffs, existing MFN tariffs, plus 10%. For example, for many of the garments, say tariffs range between 8% to 20%. So those tariffs will continue. In addition, 10% more will be there from the US side. In return, India will be cutting all MFN tariffs except on agriculture and dairy, maybe.
Okay. Okay. Mr. Shivaramakrishnan, good morning, and thank you very much for, agreeing to speak on this. I know it's speculative, but assuming we strike a deal and it is 10%, what exactly will be the tariff on your products on apparels, and how competitive will they be?
So currently we have the tariff, which, as Ajay Srivastava said, ranging, approximating about 15 to 18% on an average for the goods that we send. And then there is a 10% tariff on top of it. I think if that status quo remains, what is relevant for India is what's the relative tariff. So there is a bunch of countries which are exporting to United States, ranging from China, Vietnam, Bangladesh, India, to several more countries. So it all depends on relative tariff as to how our competitive landscape will be. We also need to know whether it's 10% or even higher, the incremental tariff. So that also needs to be seen. So if I look at the markets, I feel that the US market with tariff will have some stress in terms of rise in prices. And we could, we will have to see how that impacts demand. But having said that, if India does have a differential tariff which is advantageous for us, then that will be great from a sourcing standpoint. We will see much more sourcing shift to India. So we'll have to wait and see, what happens to us, as well as what happens to other countries.
Yeah, so we will just in a minute run the rival countries. Am I right in guessing that Vietnam gets 46? Am I right in guessing that our major competitors are Vietnam, Sri Lanka, Bangladesh, Philippines and China? Would that be the main competitors, Mr. Shivaramakrishnan, in your area?
By and large, apart from China, of course. But
apart from China. And they also are in for much higher tariffs, even as a base case. And all these other countries, comparable countries that you spoke about, Vietnam, Sri Lanka, Bangladesh, are, going to face higher tariffs. So do you think Indian apparel exporters, at least, are going to face stress, maybe because consumers will buy less at a higher price, but you're not losing the market to competition?
You could say that by and large. But we also need to know, the 46% that you mentioned about Vietnam, that may or may not be the final tariff for them. They are also negotiating with the United States, and there is a likelihood that that may come down for them. But then again, no one knows. So we have to wait and see where that one lands as well. So as long as I maintain that, as long as India has a relative tariff advantage, we will be better off as far as the United States market is concerned.
The chatter, Mr. Srivastava, appears to be more with Britain, EU, India and Japan. I have not heard too many statements from Donald Trump or his secretaries on any other country. So should we expect, as Mr. Shivaramakrishnan fears, that something positive can come even with Bangladesh, Vietnam, etc., especially Vietnam?
So US is currently negotiating with more than 20 countries. And we have to be very clear, these are not the normal FTA negotiations. In an FTA negotiations, both the sides, they cut their MFN tariffs. In this case, US doesn't want to touch their MFN tariffs. So, for example, they already have an FTA with Vietnam in which they have agreed to zero tariffs on garments from Vietnam. But now they are threatening them with higher tariffs and renegotiating. So these are some other kind of negotiations in which US is calling shots. We have to be very cautious. But I am discussing with my friends in 3-4 countries. So things are not moving ahead. For example, Japan, US doesn't want to cut tariffs on Japanese cars. So Japanese is not moving ahead. Europe also is not moving ahead. Vietnam is trying. They have offered many things despite having an FTA in which US already agreed zero tariffs, but still things are in limbo. So apart from India, I don't see anybody has got at the advanced stage where we can say next few days we may have a deal or no deal. All others are in between. That means these negotiations may have to go beyond July 8 deadlines.
Okay. What are you expecting as a base case on July 9th? Never mind if it is speculative, Mr. Srivastava. We are all working with speculations.
Yeah, thanks. So there is nothing from the official side. We are hearing from various sources, India and US, is that India has shown red lines for agriculture, dairy and GMO foods. And in return, India says that give us something. For example, at least lower MFN tariffs on our labor-intensive goods like garments, textiles, leather, handicrafts, etc., so that we have something to show to our domestic audience that we got something else. The deal will be one-sided. So I think US will understand this. If India-US deal doesn't go through, the US whole bogey of this Liberation Day tariff will fall flat. They could not get any other country to sign on the deal except for the UK. We don't have the full details about the UK deal also. So if India deal doesn't happen, US position will be weakened. I think they will understand they are intelligent people and there may be a deal with India.
Okay. Yeah, we are working with the baseline that they are intelligent people and will not shoot themselves in the leg. But, they've been bigger bullies than we thought. Mr. Shivaramakrishnan, what is the base case you are working with? Again, very speculative, but we have to work with something.
Base case is status quo. So underlying tariff remains and 10% continues. Because I don't think it's practical to see conclusion of trade deal by July 8th. There are several countries to be, deals with several countries to be closed. So there could be a possibility that this will just get extended. So we are working with that as a base case at the moment.
They will extend the deal. I mean, there is already the taco trade happening. Trump always chickens out trade, and the administration is aware of it. So a lock, stock and barrel repetition of the April 9th postponement to July 9th and from July 9th to another date may be not politically acceptable to the US presidency, to the, to his committee. So what do you think, Mr. Srivastava? You think he will be able to announce an India deal and then status quo on others? Or will it be more? Because it very much matters to people like Mr. Shivaramakrishnan what understanding happens with the other countries.
If deal happens, what Mr. Shivaramakrishnan tells, that position will continue. If this deal doesn't happen, then 10% will become 26% plus MFN of 18, 20, 25, whatever we say. That's the thing. So I think US realizes all these things. It should be important for them to get India on board for the deal. Else they will look very weak before the world.
Okay. What is your sense about which of our products could be in danger? I mean, I don't think we are hurt by Harley Davidson or the various alcohols, the tariffs coming down. But I would assume that some products, like for instance, corn, cotton, soybeans, are what, some agricultural experts believe are vulnerable. What is your sense about where are India's vulnerabilities if we open the door?
So only 5% of US exports to India are agriculture and dairy products. I mean, less than 5%. 95% plus are industrial products. So we have no threat from the US if we open those 95%, which are industrial goods. But agriculture goods, agriculture is not a trade subject for us. Our productivity is low and it's a livelihood issue for half the population. So we cannot fiddle with agriculture. So I think agriculture and dairy remains India's red line. Everything else, we need not be scared of US. US is not present in most of the industrial goods space, unlike China. They are into very high-tech products, semiconductors and all those things. But rest, their exports are very weak and we need not afraid. There is no threat if we if we protect our agriculture and dairy. Then nothing else to be afraid of US.
Okay, well, they are fighting with Japan to open rice imports into that country. So I'm not sure how much how much we will be able to wrangle. Actually, the Indian position is also difficult because rice and wheat are procured by the government. I mean, farmers in a way are protected because anyway the government comes in and buys. How does that work? Will procurement have to stop? I mean, I guess it cannot.
So they are not only targeting tariff cuts, they are also targeting our MSP, our public stock.
Yeah, what they call non-tariff barriers.
I'll give you one example. If tariff protection is not there, like their rice and wheat are highly subsidized, and the farming is mechanized, and they overproduce many years, and the international prices they go down very low. So this happened with Africa. Africa, on the advice of some of the countries, they cut their MFN tariffs, and there was imports in Africa, and import were at such a lower price that African farmers could not sell. Next year, they stopped growing wheat and rice there, and there was nothing next year for African population to eat, and there was a famine. We don't want that to happen in India. So we say agriculture, we should keep in our mind very clearly, it's a red line. It's not a trade issue for us.
No, I agree with you, sir. I mean, for about 6 months, the Prime Minister tried to dare and stare down the farmers on just, the farm bills. Yes. And he couldn't. So it is politically impossible for India to sacrifice on agricultural tariffs. And I guess the US would know that. That is really a no-go area. Removing procurement is, I mean, it's a revolution on our hands, and that I don't think we are going in that direction. Just a final word, Mr. Ganapathy, Mr. Shriram Krishnan, what's the current status? Are you able to sell at 10% plus 18%?
We are able to sell, that 18% or whatever, that underlying tariff is always there. This 10% is incremental. We, of course, saw a degree of slowdown in order placement initially. And at the moment, brands who are buying from us are also unclear as to what would be the tariff post-July, from July 9th onwards. So they're also waiting to, take a final call on further order placements. But, we're still seeing a reasonable order flow. So I don't think that's slowing down at the moment.
Okay, I thought there would be extra order flow because, you want to buy ahead of a likely higher. No such trend.
We haven't seen that trend at the moment.
Either. Okay, all right. Well, we'll have to wait and see. It's only a week away, but it could be a very, very important week ahead. Mr. Shriram Krishnan and Mr. Ajay Srivastava, thank you very much for bringing whatever clarity we can get at a time like this. These are times when things change with a tweet. And therefore, we are just prepared with the numbers at this point in time to make a decision. We have to wrap up on Bazaar. On that note, Chartbusters after the break.
Benchmark indices continue to consolidate just below the flat line for the frontline indices. We have financials and realty being the big draggers, whereas IT is an outperformer. The mid-caps underperform a tad.
A steady debut on bourses for HDFC Bank, backed HDB Financial. The shares list at a premium of 13% to its issue price. We'll be joined by the management in just a few minutes from now.
IndusInd Bank is among the top Nifty losers in today's trading session. There is a note that is coming from Goldman Sachs. They've downgraded the stock to sell rating, target of 722 rupees. They're saying the bank is structurally weaker now, with return on assets to reset lower.
Dreamfolk trades lower after the company informs exchanges of certain program closures, which could have material impact on its financials.
Inox Wind trades higher after Motilal Oswal initiates coverage on the stock with a buy rating, target of 210 rupees a piece. They expect the company to deliver strong EBITDA compounding of over 38% for the next 3 years.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me is Mangalam, and the market's a little bit off color. But we've got a couple of, IPOs that listed today. HDB Financial made its debut on the Dalal Street today, listing at a premium of around 13% to its issue price. To discuss the company's plans, the outlook, we're joined by Mr. G. Ramesh, the MD and the CEO of HDB Financial. Hi, sir. Good morning. Congratulations. A big event, a lot of hard work gone in there, and those that got the share in the IPO, they'll be happy because the stock is listed at a sharp premium. That said, this time around now, you can give us some kind of an outlook. So what kind of a growth, AUM growth are you looking at for this year? If you could help us out with that. And what kind of rough NIMs should we work with? Please go ahead, sir.
So thank you first of all for inviting me to your studio. It's a day for our listing. Thank you very much for inviting me. As you know, this is the largest NBFC IPO in the history of India, 12,500 crores. We also have the largest applications for a $1 billion plus IPO in the last 4 years. So first of all, thank you to all the people and all the investors who have shown active interest in our stock. We had over 22 lakh retail applications. So thank you very, very much. Now, in terms of our growth, we are a 17-year-old company, been through cycles. We understand the cycles and we understand India. And our whole focus has been on targeting aspirational India through our products and services. In the last 3 years, we grew at a CAGR of about 20%. And I think that's a number that we are quite comfortable with.
All right, 20% and HDFC go hand in hand, and HDB Financials, we don't expect any different for them as well. But, I'd like for you to throw some color on what would lead this growth, because I'm looking at your book. About 40% is enterprise, about 37% is asset-backed, and consumer finance, which a lot of people are eyeing, is just about 20 to 23% of your book. So going forward, what is the ideal mix that you would have, and which of these will outperform?
We are a customer company, not a product company. We have had a long journey of introducing new products, and it's part of our DNA. We launched enterprise lending in 2008, and we launched asset finance in 2011, consumer finance in 2016. So consumer finance is our newest business. It was about 13% about 5 years ago. It's 23%. We believe that all our businesses that we are in have an opportunity for growth as India grows over the next few years and decades. And what we're really trying to do is to make sure that we have adequate capital allocation in all the aspects of our customer, whether it's the business or personal needs, and that's how we think about growth.
What, according to you, would be the ideal mix? Would it be 1/3, 1/3, 1/3?
So we don't have really a target. I mean, so what we would like to have is a very diversified book so that we can manage business cycles. So there'll be businesses that have a certain low and a business that have an opportunity. So what we're really trying to do is to have a well-balanced portfolio. Don't have a target in terms of mix, but in terms of opportunity, I think a 1/3 mix would really make sense.
All right. And, borrowing from banks, I think, is approximately 1/3 of your total borrowing mix?
That's right.
All right. And, we have a couple of rate cuts that have come about. How does that tie into things, and what should the rough margin band we should work with?
So, a rate cut cycle is obviously beneficial for a company like ours. About 70% of our book, more than 70% of our book is on fixed rate, given that the customers that we work with and our retail book, as you may know, our top 20 borrowers is less than 0.34% of our AUM. So that's the level of granularity. So a lot of small borrowers that we lend to are extremely comfortable with a fixed rate kind of asset scenario. And so that's what we work with. And a rate cut cycle obviously benefits both the lender and the customer. So that's something that we look forward to as a company. Historically, our gross NIMs have been in the region of 7.6 to 8%, depending on the cycles. And again, our focus is on diversifying our product, and within the products are micro segments so that we can deliver a reasonable risk-adjusted return.
And this band that you've been speaking about historically is likely to continue irrespective of what the cycles are.
That's right.
Perfect. What about your return on assets? I'm looking at your return on assets. So the last few years, 3 years in particular, they've been contained between 2 to 3%, while the same for your peers have been a lot higher. What is your plan to increase or improve your return on assets, sweat your assets a little better from here on?
So our plan to improve that would primarily focus on the product portfolio that we work with, the customers that we work with, and within the customer segment that we work with, the product customer segments that we can work with so that we can generate a reasonable risk-adjusted return. That would be our strategy.
And would you have a target on how much you would like to improve this to, any sort of band that you're targeting from here on?
So our focus is on making sure that we deliver a good stakeholder value over a long period of time. Our fundamentals are very strong. We have a strong business model. Many of the businesses that we are in, we have a large market share in terms of how much we originate on a monthly basis. And that's something that we'll continue to work with.
All right, a word on asset quality then. There is that fear that keeps creeping up, that things are slowing down, maybe people are borrowing a little too much, punching over their weight. What are your observations, sir, in terms of customer behavior? And any worries, or you think, whatever we are seeing are just knee-jerk and it's par for the course?
So we are the business of risk management, and it's a fundamental business that we do is manage risks. As I said, a 17-year-old company manage risks through cycles. We're very conscious of how we manage our risk and our cycles. So it's something that we have done over the years and quite confident of continuing to do so.
How would you maintain your yields from here on? Because I'm looking at your secured and unsecured mix. Secured is close to around 71%, unsecured about 29%. Where do you see this mix going, and how would that impact your yields?
So again, our yield is really a function of the product mix that we generate. And the way we think about our products is that we will typically have a annual tactical plan for capital allocation for each of the businesses we are in. So every business that we have will have a certain amount of cycles, and we make sure that we are allocating capital to the businesses that we think are the best from a risk-adjusted return perspective for this year. And that's how we allocate capital. In terms of our March 31st number, our secured was about 73% of the book, and unsecured was 27% of the book. It changed marginally from the prior year, again, primarily because we focused our business on businesses that we believe have a better asset cycle at that point of time.
So as of what we speak, for this year's annual tactical plan, what is your capital allocation veered more towards?
So we'll broadly be, as I said, about 75% to 70% secured, and 25 to 30% unsecured. So that principle will broadly stay.
All right, take that point for now. Congratulations on a listing once again, and wish you good luck. Hope to speak to you every quarter, and perhaps hope to speak to you at a time when you consistently grow over 20% as well, with your NIMs in that 7.4 to 8% band, and the asset mix changing as per the asset cycle that you deem is fit, which improves your return on capital employed from here on as well. With that, we'll shift into our special segment. We get you a few ideas for profit. Our colleagues from Money Control Pro join in. Anubhav Sahu has a stock that he's been tracking.
Well, the chemical sector has gained a lot of attention in recent times. Now, this sector has been dragged by elevated channel inventories, soft demand in the end markets, and dumping from key countries like China, Russia, and Korea. Now, few of these factors have rectified. Channel inventory has normalized in some of the product value chains. Raw material prices are likely to moderate, which in turn has helped the sector in fueling gains recently. Now, while prospect to anti-dumping duty for the array of chemicals are positive for the sector, we believe execution ability for the chemical companies in the dynamic new world order would be a key differentiator. So we have a switch idea when we are advising investors to trim their position in Bajaj Amines after a sharp run up of 60% since April 25, and instead take exposure in Nosil. Now, Bajaj Amines have an execution approval challenges for new products like electronic grade dimethyl carbonate and dimethyl ether. Nosil, on the other hand, is executing well on the export side, which make up about 35% of sales. Domestic market is sluggish due to dumping. That said, here companies seeking anti-dumping duties on product basket, which account about 40% of sales. And lastly, valuation has sobered down materially, and that's why we are constructive on this space.
All right, Anubhav, thanks a lot for that. Meanwhile, we have taken a slight downtick on the market. It's because of the IT index. The IT index, which supported the index earlier, the frontline index, is now coming off the highs. We have the Nifty IT. The index comes up for you on the screen, currently at the lower end of today's trading range so far. Still higher by about 0.2%, but fairly off the highs by about percent or so. At one point, it was up by almost 1.5%. Take a short break, come back. On the other side, we have the management of Allied Blenders joining us in the studio. Stay with us. Welcome back. You're talking to us on a Wednesday morning, a little too early in the week, but we have an important discussion lined up for you. The management of Allied Blenders and Distillers joins us to discuss a whole host of things. One of them, the Maharashtra excise duty hike as well, but more importantly, the business outlook of the company. The Managing Director, Alok Gupta, joins us in the studio. Thanks a lot, Alok, for joining in.
Thank you very much.
Let's address the Maharashtra excise duty first, because that was something that was discussed by everyone by and large. You as a player could give us two basic numbers. One, what proportion of your revenues comes in from Maharashtra? And because of the excise duty hike so far, what would be the increase in end user prices?
So our share of volume is sub 10%. The way we are reading the excise policy for now, it will definitely have an impact on volume. We could see about 20 to 30% reduction in volume. But there is also an opportunity on MML. And I think we are well positioned to take advantage of it because we have capacities to be able to do that. However, there is a bit of a volume margin balance. That is the tightrope that we are currently walking on. As the policy contours are not fully known, I think it's difficult to figure out if there will be any margin impact. And therefore, we are at an Excel stage. We believe there could be a solution, but the market will definitely go through a significant change in terms of the product mix.
So how much will the price increase by because of this excise duty?
Well, if we were to take current EDPs and just pass it through with new excise duty and distributor and retail margin, the increase should be north of 50% in many segments.
Got that. Hi, Alok. Good to see you in the studio, and congratulations to you as well as the team in terms of the listing. I was just doing some rough math on the Officer's Choice, which is your key brand. You know, if someone bought 2 bottles a year or so ago, then good for them. They had a good couple of months. But if someone bought the stock instead of that, the 3rd bottle would be free today.
That is true.
That's on a lighter note. Yeah. Let's get a couple of numbers out of the way then. You know, in terms of volumes, how many cases are you looking at to sell this year? Your realization as well per case is roughly in the vicinity of around 1,000 rupees. So how do you see both these 2 numbers headed? And obviously, premium and above is going to play a bigger role. And you'll have said in the past as well, you're looking to increase this share.
That is what? So essentially, the way we have looked at our legacy portfolio, which we call as a power portfolio, and the new brands that we are launching, on Officer's Choice, which is our flagship brand, the focus is really on getting the gross margins right. We are north of 40%, and we want to maintain those margins. So the guidance is a single-digit growth. Okay. On the P&A whiskey side, we've got 3 beautiful brands. We've got Officer's Choice Blue, Iconic, and Sterling. Iconic, as we know, has been a blockbuster. It's been, in 2 years in a row now, the fastest growing spirits brand in the world. We did 5.7 million cases last year. The brand continues to grow, and we will see over the next few years high rates of growth. So we expect market share consolidation in what we call as P&A whiskey. We've also launched a brand called Golden Mist, which is a deluxe brandy in the southern state. So overall, what we are looking at, volume to grow in double digits, but value to grow mid double digits.
All right. So
and Iconic, as you said, 5.7 cases, if I got that correct.
5.7 million cases.
Million cases. So if that's going to grow at a faster clip, where do you see that number headed? And you know, we just have the total, the entire volumes last year was around 33 million cases. So where's that headed?
So if you ask me, mid to long term, this brand has enough legs to be a market leader. So we are currently at sub 6 million. So there is enough and more juice left in terms of what market share this brand can get.
I want to talk about your product share in general, because India, yes, it's a brown drinking country. We have almost 80-85% of the revenues for the country coming in from whiskeys as against the others. But the others are also growing fast. In your case, your revenue from whiskey is 95-96%. You have the Russian standard vodka. You're talking about gin. You're talking about other players as well. So what would the product mix of the company look like, and what's your aspiration here?
First, a quick data point. About 95% consumption in India is dark, which is brandy, rum and whiskey.
Got it. Okay.
Of which whiskey is 65, and roughly 5% is others, all whites put together. And these ratios have not changed over the last 30-40 years.
Got it.
So pretty much, I mean, plus minus 1%. So I think our love for dark spirits has been there for the last 50 years. We love whiskey. Now we love whiskeys of all kind, not just Scottish kind, but we're also drinking a Taiwanese and a Japanese and a Thai whiskey and a German whiskey. So I think we just love whiskeys. So that's really the broad construct. What we're trying to do here is that we have a powerful portfolio up to, let's say, 1,000 rupee price point. Then between 2,000 to 5,000 rupees price point, which we call as super premium and luxury, about 3% volume of the 420 million cases last year is there, but that's really where the bulk of money is. So all the brands that we're talking about, whether it is Russian Standard, whether it is Woodburns, whether it is Zoya, whether it is Art House, whether it is Pomori, they're all operating at a price point of 2,000 to 5,000. And roughly 98% of the luxury volume is between this price point.
Got it.
So going forward, the focus is on what we call as the luxury segment. And just a little trivia. For every 1% volume gain in luxury for us means 9% value gain.
Got it.
So the impact is just disproportionate.
So make it simple. You are at around 31 million cases as of last year. You had given us a roadmap to 50 million cases. By when do you reach there? And once you reach there, how much higher will your realizations be versus last year?
So we are 33 million cases last year.
Yes.
We had said that we will go to 50% P&A. There was no guidance of 50 million cases.
Yes.
The idea was that we'll go to 50%. And I think we will hit the 50% P&A in the next 3 years.
Okay. And what will your overall realization look like that time?
So we should see overall realization, let's say on an annualized basis, it should be improving by at least 2.5-3% year on year.
Okay, all right. Let's talk about market share then. Officer's Choice, I think it's holding on to a mid 30% market share, if I got that correct. Right. Can you hold on to that? Point number one. And point number two, debt reduction as well. What is the updated net debt in books? I'm looking at the finance cost. I think that's come down a little bit. RBI's cut rates as well, so that gives you further legs. But what kind of a debt number should we be looking at by the end of this year? And interest cost as well, I think, should come down. Yes.
So Officer's Choice has about 38% share. We are quite focused on maintaining a gross margin. So what we'll see is a profitable growth. And the brand will hold on to its market share, but importantly, keep delivering on the margins. On the interest cost, pre-IPO to now, our interest cost down about 25 crores a quarter.
Yes.
We expect this to come down even further. As far as this financial year is concerned, we went from last year H2, we were already positive cash flow. This full year, we are positive cash flow. So now we are generating enough cash flow to be able to sustain our growth capital need.
Yes.
Right? If at all there will be borrowing required, that will be for any capex and M&A that will come along. But the business is now going to generate enough cash to meet its own needs.
Is there any M&A on the cards?
Well, I think is there anything that will announce in the next couple of months? The answer is no, but I think we will stay on active lookout if something comes across.
Okay, and if you want to guide us in terms of which part of which segment are you looking at if there is going to be some M&A?
So on the front end of the business, it's clearly going to be in the luxury space if something comes along. And on the backward integration, if a interesting raw material asset comes along in a large market for us.
You know, one thing that we've noticed you've done ever since you've listed is you've used your listed company clout to negotiate better deals with some of your suppliers and vendors. How much has that impacted your working capital, your margins positively? And how much more are we seeing in terms of margin improvement from here on?
So FY24 to FY25, we have seen a 6% improvement in our gross margins.
Yes.
50% of this has come on back of what we call as a rate reset. I mean, our vendors were very, very helpful during our pre-IPO phase where we had a bit of a working capital crunch. And essentially, we renegotiated our rates with our vendors. And we have been able to improve our gross margin by about 3% purely on rate reset. About 2% has come from internal efficiencies, which is in terms of where we are buying, how we are buying, what we are stocking. And about 1% has come on back of better commodity cycles. So of this 5 and 6%, I think 5% is sustainable, and we'll see it, in the years to come by. We don't see any change from a working capital point of view. I mean, from number of days payable, it's sub 30 days, and we're quite comfortable where we are.
All right. I'm looking at FY26 revenues basis, all the things that you're saying so far. A little over 4,000 crores is a possibility.
Yeah, I think it's a reasonable guidance that we should be in and around that.
With around 13-14% margins?
Well, I hope so.
And earlier, I recall you'll have gone, most of your guidance has been achieved, but the bulls on the stock will want to know whether you maintain that guidance of close to 5,500 crores of revenues, say in the next 3 years, as well as margins in mid-teens. Holding on to that looks like a possibility.
Well, we exited at about, let's say, 3,600 crore last year.
Yeah.
Our guidance is that we should grow our revenue about 15% year on year.
So then mathematically,
we'll get to a number.
All right, take that point. Thank you so much for joining in, Alok. Wish you good luck. And as they say in the alcohol industry, cheers. I would know that, but I do definitely.
I can only say drink responsibly.
Absolutely. And the bulls and the bears, that's about the market, right? Some drink in celebration, some in, yeah. So, but anyways, thanks a lot for joining in.
Thank you very much for your time.
Well, time to slip into a short break. On the other side, we'll focus on some stock-specific action. We'll also track the markets for you. Don't go anywhere. Welcome back. Keep an eye out on the broader markets. A couple of stocks are moving well. Welspun Corp has moved to the high point of the day, so good going on that. On the flip side, you have Keystone Realtors. The stock has seen a good run in the last few days. It was up 7%. Now it's up only around 3%. So I think you should keep an eye out on that name as well. Venus Pipes is the other one that was up close to around 8%. I think now it's up close to around 5.5%. So some kind of profit taking from the top is what we're seeing on that one. And I think Vimta Labs, we don't talk about it very often, but that as well is showing some traction. Add to the list, and Apollo Tyres as well. Mangalam.
Consumption stocks, Nigel. That's what I'm watching out for right now. Britannia has moved to the high point of trade. We're seeing some traction in Titan ahead of its first quarter update. Brokerages have expected, this quarter to be a good one. But importantly, keep an eye out on Asian Paints. This morning, we had, pointed out that there is that Competition Commission related issue that may keep the stock slightly under pressure, but that dip has been quickly bought into. The stocks moved back into the green. So we'll keep an eye out on this entire pack. With that, we are out of time on this edition of Chartbusters, but you stay tuned to CNBC-TV18. The team of Trading Hour comes up next.
Good morning, it's a trading hour. We are into midweek and we are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormus Fatakia, with me Sonal Butra. We are grinding slightly lower. Sonal, we're heading into the weekly expiry tomorrow, but this potential trade deal between India and the US is proving out to be a bit of a sore point right now. We're awaiting more clarity, and the mid-cap index too is now grinding low. But as was the trend yesterday, the bulls would be hoping that the second half turns out to be better.
We'll have to see which way things go, because there's this uncertainty uncertainty, as you said, about the US-India trade deal. That continues to be the big trigger point going forward. For now, Nifty is closer to the day's low. It has come up sharply from the highs. Mid-cap index is the one that continues to be an underperformer. So that index is down 0.4%. You know, for larger part of the day so far, it's the Nifty IT which had been supporting the Nifty, but that too has come off from the highs of the day. So look at that. It has come off and it is at the day's low. So all these stocks which will be in focus, Nifty IT especially, we will kickstart the earnings season soon as well. So all eyes on the IT names as well. Nifty Auto is the other one. For now, that is the top gainer, but that too is up just 0.1%. It has recovered from the day's low so far. But you know, while we're talking about action in the secondary space, there's a lot of action in the primary space as well. Let's kickstart trading hour by focusing on the primary market. 860 crore rupee IPO of Crizac has hit the street today and will close on July 4th. The company is a B2B education platform for agents and global higher education institutions. Following the IPO, the promoter share in the company is expected to reduce to 60.42% from the existing 8.48%. To discuss more on this, Vikas Agrawal, the CMD of Crizac, and Christopher Nagel, the CEO of Crizac UK, join us now to take the conversation forward. Gentlemen, good morning. Thank you so much for joining in. Vikas, let me come to you first up. For the benefit of our viewers, can you simply explain what your revenue model is, who are your clients, and what does the business entail?
Sure. As a company, we connect various counselors and agents across the globe via our platform to universities in various destination countries like UK, USA, Ireland, New Zealand. These counselors get students, they counsel the students, help them select the universities and courses where they want to apply. These agents will then put the application to our platform. We coordinate with universities and get them the offer, which in turn pass it to the agent who help the students to apply for the visa. So we are a link between, let's say, agent and the university.
Okay. So your clients are majorly the universities across the globe?
Yes. You can say so.
And which is the biggest geography for you, Vikas?
At the moment, from a source perspective, India would be our biggest geography, where we have 60% of our students coming from. And in terms of destination market, UK would be our biggest destination market, where 90% of our students would go to.
Gentlemen, good morning. Thank you for joining in. To Vikas, before I get to Christopher, you know, your issue is a complete offer for sale, which means that you would not be receiving any proceeds from this. So with no proceeds coming in from the IPO process, how do you plan on funding your potential expansion plans, and are there expansion plans that are lined up for you?
Sure. The company at the moment is sitting with 400 CR plus cash in the books. So company does not need any additional capital for expansion. It's a very asset-light model. And we decided to go for IPO because it will bring trust and visibility. In terms of expansion and future plans are concerned, company has sufficient cash to do that.
Okay. Christopher, let us get you in the conversation as well. This is the basic platform which connects agents with universities, is what Vikas explained to us. What about value-added services? Is that something that you will be looking at expanding into, be it student loans, forex, visa, accommodation support? If yes, how much is it as a percentage of revenues currently? If not, how do you plan to scale it?
Nice to see everybody today. It's true that at the moment, our major source of revenue is our services to universities. We have plans to add on other services in future. Some of those you mentioned just now, like student loans, accommodation, or forex services, which all students need. Our plan is not to, manufacture these products ourselves, but to distribute them from other suppliers. Because we are a platform, currently, we help students gain admission to universities, but there's no reason that our same platform can't be used to distribute these other services as well. These are not currently in our revenue, but we hope that we'll be able to roll them out very soon.
How soon would that be? Any timeline? And if yes, would that require additional investment? Just trying to understand the future course of the business.
So we're hoping it'll be in the coming year. that we'll add these services on, and they'll start to, contribute to our business. And because we are a platform business, there's negligible capital investment required to add additional products and distribute them through our platform.
Two-part question, Vikas. You mentioned most of your revenue also comes from the UK geography, almost 95% of it. What steps are you taking to diversify your geographic base to reduce this revenue concentration worry? And part two of my question is, since you have close to around about 4,000 agents in around 40 countries, what are the steps that you're taking to expand into other areas, be it the likes of Latin America, other parts of Asia, excluding India, of course, and say for the likes of Africa?
In terms of bringing down the risk, as you said, 95% of our business is for UK. We are looking at expanding into different destination countries, which is USA, Ireland, and Dubai to start with. We're also looking at expanding into Australia if possible. At the same time, we are expanding into various source market, again, which would help us diversify and de-risk the business. As of today, we receive application from almost 75 different nationalities. So that would help, even if one particular corridor, say for example, India, Canada, last year got choked or had diplomatic issues, expanding into a different source market would kind of eliminate those risks. To answer to your next question, yes, the company has a desire to expand into new geographies for source market. For example, Southeast Asia, where we have a negligible presence, we would like to expand into that one possibly in a year or year and a half. Likewise, you rightly said Latin America again is a good source market, especially for US and Canada, and would love to expand into those ones as well.
Okay, because while we're talking about expansion, let's quickly take a look at the financials as well. While revenues have grown well, even profits have grown well. However, margins have been quite volatile for you. You've seen 25% margins in FY25, that was 13.5% in FY24 and 38% in FY23. What explains this volatility? And while you're talking about expansion into markets like the US, the policies that are coming by the government as well, do you think it'll be difficult to penetrate such markets?
Sure. With reference to variation in volatility of margin, our margins was stable last year as well. It's just that last year we had a extraordinary expense of acquisition and termination fees, which had showed a dip. But if you look at the absolute number, it was same in line with roughly 25%. We expect almost plus minus similar range in future as well as the business goes. With reference to your questions to US, yes, there is a bit of a turbulence at the moment, but our US base is quite small. US is by and large the biggest destination, not only for Indians, but across the globe. So we still believe that irrespective of these headwinds and news, US will still continue to grow decent numbers.
But in case there are any adverse student-related policies that come out from there, Vikas, because there is a lot of policy uncertainty over there, whether we like it or not. It's a fact. And if there is a case of any adverse policies, and you mentioned US is a very large market, but since it's a very small size of your product base, would you look to diversify or pivot from there and move on to other geographies? And since I'm getting into this, your top three, dependence on your top three global institutions has come down from almost 63 to 53. Does that number come down further as well?
Yeah, you're right. Just to move out of US as well, though we expect to grow in US, Dubai, for example, is offering a golden visa to students. So they are welcoming students. And the best part is, if you had gone to the news of late, India itself is becoming a big destination market. Last month, government of Maharashtra signed up 6 or 7 tie-up with foreign institutions to set up campus outside Navi Mumbai. There's already 2 or 3 running in GIFT City in Gujarat. There are a few coming up in Delhi, NCR. So India itself will become a big destination market. Since we have a very big network of agents in Africa, South Asia. We believe we will be able to contribute and bring students from those countries to India. And that would also help us kind of de-risk the company from any kind of volatility in terms of policies.
Okay. Vikas, a lot more questions, but I think you'll be able to answer a lot more of them after listing itself. So thank you so much for joining in today with all those details, explaining the business to us, the future plans, and what kind of new areas you're looking at in terms of new business prospects as well. Thank you so much, Vikas and Christopher, for joining us today and answering all those questions. With that, we'll do one thing. We'll slip into a break. When we come back, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. 70 points lower on the index. The Sensex is also down 200 as of now at the lowest point of the day as we speak. We're shifting focus to commodities now. Manisha is here with us to talk about the crude oil prices ahead of the all-important OPEC meeting over the weekend, Manisha.
Oh, well, absolutely, yes. You know, and interestingly, we've started the month of July on a positive note after posting strong May and a stronger month of June as well. May was up 8% and June prices gained up by nearly 10%. And July started on a firmer note, as you can see on your screens. Well, yes, it's the OPEC Plus meeting. It's on 6th of July. And while the markets have pretty much factored in, and there's a lot of conversation already that we've had on how for a fifth straight month in the month of August, you could be looking at 411,000 barrels per day of an increase in sense of output from OPEC. With this, it will become 1.7 million barrels per day by the time we're reaching the month of August. So it has been a very steady pace that OPEC has been wanting to come into the market to regain its market share. And this is something that the street really has seen baked in case of prices. The other thing is about geopolitical tensions, which seem to be easing right now, especially with Israel and Iran ceasefire holding. So that tells you that there are no supply concerns. And on the other side, the demand also continues to be on the stronger side. There's uncertainty, of course, because of the July 9th deadline when it comes to tariff agreements as well. If it doesn't happen, some of the countries could be going back to higher tariffs as well. So that's an uncertainty or a choppiness that the markets are looking at right now. The weakness in US dollar index trading at around 4-year lows also seems to be supporting buying in case of crude prices as of now. So the last couple of sessions, the first 2 days of July, clearly seemingly positive there. And the street now will watch out for the US non-farm payroll data that comes in tomorrow. So ahead of that, again, some jitteriness, some choppiness, but stronger gains continuing.
Okay, so that's what's happening in the commodity space. The commodity markets, equity markets, all of them watching out for the big geopolitical development and what's happening with tariffs as well. But you do remember to tune into all new CNBC TV18 Prime. We'll be bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. The Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour. Well, there's some further pressure that we're seeing on the Nifty. It's down 70 points. The mid-caps continue to be under pressure as well. And Bank Nifty, that's a big underperformer today. That one is down around 0.5% as we speak. So it's a good time to get a technical check on the markets. Mitesh Thakkar is joining us for just that. Mitesh, good morning. Thank you for joining in. Well, do you see further pressure, or second half could be something different? We have the weekly options expiry tomorrow. What are the charts suggesting?
I think, one, the market was already showing signs of supply and tiredness about 25, 650, 25, 700 zones. With the overbought readings, I think there was a chance of a pullback happening, and I think that is playing in. My sense is that 25, 400 is the first intraday pivot, and the larger level is at about 25, 200, 250. So maybe we'll see 25, 400, and then we'll take a call from there. But the overall bias and direction remains on the upside, so trading with long bias.
Still trading with a long bias, looking to buy the dips towards 25,400. Mitesh, what about specific stocks?
I have a buy on Dalmia Bharat. The cement dips are doing well, so buy here with the stop at 21.80 or just below it, and a target of 22.60 can be looked at. And the other stock which I like, that's Dabur, that's a buy with a stop below 480, 479 and a target of 500 is what I'm looking at.
Okay. Amitesh, what about the IT space? That has been once one index which has been doing well, but even that came off from the highs of the day. What is the indication? Some of these names like Infosys, TCS.
Yeah, right there. I think, Infosys, though, I think was giving a breakout about 1640. It's come below that. Similarly, TCS also turned negative after opening. But the overall setup was quite positive, and these stocks have also underperformed. So they will play catch up. From the timing, I think the stock which I like the most will be HCL Tech. I would recommend, buying that around the 200 average area, which is around 1690, 1700 zone, and then keep a stop below 1670 for targets of 1750 to begin with.
All right, Mitesh, thank you so much for sparing time joining us today. Views on the index and on specific stocks as well. We'll have you back later in the day as well. On to some stock-specific movers then. Just before we go to Vivek, just pull up Mobi quick. That has seen a bit of a fall towards the lows of the day, continuing to grind lower from its IPO price, and its post-listing high was 700 rupees, and since then the stock now at 240 is Mobi quick, 12.5% lower in the last 1 month. But as we were talking about Inox Wind, Motilal Oswal has initiated coverage on that stock, doing fairly well for itself. Vivek is here with more on this, Vivek.
Well, that's right. An interesting note coming from Motilal Oswal today morning on Inox Wind. They've initiated coverage on the stock. They have a buy rating and a target price of 210 rupees a share. What is it that they're saying? Number one, they call Inox a leading vertically integrated player in India's wind energy sector. Remember, the company delivers end-to-end solutions. So they have concept, they have commissioning of wind power projects. Along with that, they also supply O&M, operational and maintenance of the entire value chain. Along with that, remember, the company produces both 2 megawatt as well as 3 megawatt wind turbine generators with a robust order book of over 3 gigawatt at the end of FY25. Along with that, there is a listed company as well, which is a subsidiary, Inox Green Energy, which manages a significant 5.1 gigawatt O&M portfolio. So in terms of earnings, they estimate that Inox Wind should be able to deliver a strong consolidated EBITDA CAGR of 38% from FY25 to FY28. And along with that, they also see ramp up as far as WTG execution is concerned from 705 megawatt in FY25 to close to 1.8 gigawatt in FY28. So the target price to earnings multiple that Motilal has assigned is 25 times FY27 earnings per share.
Okay, that's Inox Wind in focus. The stock is up 2% as we speak. That's about Inox Wind. Thank you, Vivek, for joining in. Let's take a short break. Management of Dreamfolk Services will join us next to discuss the potential impact of its program closure from Axis Bank and ICICI Bank. Do stay tuned. It's an important conversation coming up.
Welcome back. On to an important conversation then. Dreamfolk Services, that stock is under pressure after it informed the exchanges that certain programs that it operated for Axis Bank and ICICI Bank were closed, even as contracts with both these clients remain active. Now, Librita Peter Kalath, who is the CMD at Dreamfolk Services, is joining in for this conversation. Librita, good morning. Thank you for joining in. You could tell us firstly as to what was the reason as to why these programs were cancelled? What part of the contract is affected and what does that do to the overall contract? Because Axis and ICICI being two major banks, how much of your top line comes from these two clients?
Sure. Good morning. So the thing is that, what led to this is, I think we all are aware that what happened couple of days back, or I would say weeks, right? There was a press release which stated that, these contracts are out of Dreamfolk's program. Now, the thing is that, these were the facts. I mean, at that point, yes, all the contracts were in place, everything. There was nothing as such. But the thing was that it was a pressure which was getting built up to the clients. Okay, it was a pressure tactics which were done. So to be very upfront, it is mainly done by these two major airport operators who have now started getting into the similar business. Now, if the competition is, in terms of the services or the technology or trying to build something different, that's where the competition should be. But I think the pressure which has been built up is to, tell the clients that, in case if they do not sign up with them or do business with them directly, they would actually stop their cardholder access to their airports. So this is a pressure which has been built up. And these are the reasons that, why these clients had to move. But let me tell you that our contracts are still in place. It is not that we were just managing the lounge program. Just the airport lounges. There are other services also which Dreamfolks provides to these clients. Secondly, also to mention that, there are around 70 plus lounges in India. However, these operators, the airport operators who are trying to get into this business are holding around 35 to 40% of the lounges only. And the other lounges are still operational, and these programs are still live on Dreamfolks platform.
Okay, Liberta, I'll ask you more about which are these programs which are still active, how much of your revenues are impacted. When you talk about these pressure tactics which are coming on the clients, is it only on the clients or on Dreamfolks as well? Maybe to acquire Dreamfolks or that service business, or to give away a part of their business to these airport operators as you're mentioning?
So I'm sure, and I think you are more smart enough to understand, the way the market works here, right? Obviously, the innovation or the innovative companies are always under pressure. And yes, there is a pressure built up, not just on the clients, but the pressure is also built up on Dreamfolks as well. I do not want to specify clearly on, the way it is. But yes, if you actually look at it, the negative PR which has been built up from past few weeks was for only reason, to ensure that it impacts our stock price, because we are a listed company and obviously any negative PR is going to impact the stock. So I would say that yes, it is not just a pressure tactics to the clients, but yes, of course, it is much more to Dreamfolks.
So, Librita, to get this straight, were you or Dreamfolks were sent feelers from competition that there is an intention to acquire the company? What was your response to that, if there was any?
Indirectly, yes, we were getting these fillers, but see, it is not the business what Dreamfolks has created. I mean, I'm very proud to talk about that. It is the industry what we have built, right? So when you have built an industry and you are the number one in the market, right? And the intention of Dreamfolks are, we do not want to stop ourselves just to be a market leader in India, but the vision is to be globally present. And yes, that was one of the reasons that, we did not want to be acquired or get associated with any of such acquisition. And we wanted to be an independent company.
So in that case, what have you done to mitigate the pressure? Have you approached any authorities? There's CCI. Are you looking at any official action in that case?
Well, we are very small, okay, and I do not want to also talk about many things, but we are a very small player in this market, and I do not want to get into something which will further damage because it has already created a lot of damage to our business in terms of the way things are happening. So yes, I don't feel that any of the authority would be supportive for us for obvious reasons, and that's why we have actually not been to anyone and we have not asked for any support. But yes, as a company, we are not trying to go back in terms of trying to stop. But yes, we have already built a lot of other services. We are doing a lot of other things in terms of the technology as well. And I would say that, in this 13 years, the way we have actually built our relationship with all our clients and the trust what we have built. And I think that, yes, everyone understands that and they all want to continue work with us. Okay. And I would say that airport is not just one of the area where we are trying to focus. There are other areas which we have already built. In last interview also, I very clearly said that we are now into a lifestyle as well. And apart from sports, we are into railway, highway. And when I say lifestyle, we are into golf and there are new services like social.
So, Liberta, what my question here is from the shareholders' angle. What assurance do you have for them? Because while you're saying airport is not the only business, it is one of the major businesses that you have. What assurance are you giving to the shareholders? How can you just submit to the fact that there is competition pressure? What if somebody comes into your other vertical and starts pressurizing you there as well? What should shareholders do in this case? You're a listed company.
So I completely agree. So, in other areas for that matter, when I talk about outside airport industry, obviously there is no monopolistic player right now. Obviously at the airport, there are monopolistic players. I mean, there are two large operators who are sitting and want to actually dictate their terms. So of course, that is one area where I would say that, yes, I could see a risk coming in. But other industries where we are going, it is not going to be managed by one single player. So I don't see that there's going to be a risk there. And as a listed company, yes, I have to assure all my, stakeholders who are having that trust in me to believe in me that, yes, we are going to build the way we have built the lounge industry. And you will see that, what are the other things, because let me tell you one thing, that even after these things which have started happening from yesterday, all these clients are still in touch with us and we are trying to build. The same clients are actually going to move from the lounge, giving the lounge benefit, give some different benefits. So I would say that, yes, we are completely working on those and you will see changes coming in these areas as well.
Okay. Liberta, we spoke to you on 20th June when you said the press release came out in public as well. But you denied back then. What has changed from then till now? What made you come out and actually talk about it that, there is pressure on the business, authorities won't be supporting? What changed in last 14 days?
So, of course, that press release which was given, it was very anonymous. It was never clear that who is the one who has actually given that statement. Because if you actually see that it was none of our clients who had actually given these statements. And whoever has given was not even, I would say that, did not even have the to actually use the words that, they did not have those guts to even talk about that, yeah, they are the one who are actually giving the press release. And I would say that, from past 2 years, this pressure has been happening and we are trying to maintain that relationship. We thought that, okay, we have to work together and it is a business thing. So I always try to be diplomatic and try to cover it up. But I thought it was high time for me to now come out and tell the facts to everybody that what is actually happening. So, before more press releases come out, because I'm sure, this is how the market works or this is how people work, that, they would come out and tell that, what are the changes they have been driving it. But let me tell you that I do not see this as a competition. I do not see it has to be a fair competition. When we say competition, I think it has to be in a professional way, talking about technology, talking about services, but not about pressurizing or threatening somebody to do the business. So and that is one of the reasons that why today I had to come out and actually talk that, what is exactly happening.
Liberta, let's get a few things straight here. There are multiple uncertainties at this point. Part one, are there any more cancellations that are likely to take place? What are your clients telling you in terms of the relationships that you had? You've mentioned you've built a lot of relationships over these last many years, but what are your clients telling you currently as to what happens next? Part two, you are saying that you're diversifying into other areas beyond airports, but airports is your biggest business. And even if you diversify into other areas, the scaling up in those areas will take time. That's two. What happens to all of these things? The bigger part is, are there any more cancellations that are on the anvil?
So presently, if you'll actually ask me, there are no such cancellations, because even these cancellations which actually happened, I just got few hours notice. It was never that, there was a proper notice of a week or something, because I just got few hours notice that there is going to be a migration. Okay. Secondly, till date, till now, I have not got any news or any information from any of our clients on migrating from our platform. So the program is going on. Okay, but yes, we are getting information or messages from our clients that there is a lot of pressure from these two operators who are trying to pressurize them. Okay. Secondly, when you tell me, you're asking that, yes, lounge is one of our biggest revenue driver, and the new services, what you're talking about, would take time. But let me tell you something that, lounge also 13 years back when we actually launched it, it was not something that, was immediately we started seeing volumes coming in. But today, I think, the card holder or the consumer is very well aware. The awareness 13 years back was actually very less in terms of, what are the benefits on the card. But today, I think the card holder is aware in terms of what are the benefits. They know that, what kind of card would give what kind of benefits. So I don't see that it would take long time for us to actually drive more numbers in new services, because we have also seen, and we are closely working with all our clients, because none of the clients are also appreciating what is happening in the industry, and they are also looking at an alternative to immediately build up. So I would say that all these things are I don't see it would take a lot of time. I would say that you will see changes very soon.
A couple of follow-ups to that, Liberta. You mentioned that the cancellations, even the migration bit, you were given a few hours notice from these players, from your clients. Is there a general timeline as to when for a cancellation to take place, say a week, say 15 days? That's one. And two, if today a proposal comes to you for a potential acquisition from anybody from that matter, be it competition or be it any other player who wants to get into the space, what would your answer be?
Well, I've not thought about it. As I told, that the vision for the company is to grow global, okay? And we have a lot of things to do in terms of, getting in this industry. As a listed company, I think it is more important for me to build the trust and confidence what I have built within the market. So I want to continue that. And I have not thought about, if someone is coming and talking about the acquisition at this moment, because that is not, right now in my agenda. I would say that right now the things what I'm focusing on is completely on what needs to be built, and we are actually working on building it. And you will very soon see it is a silent period, and I actually can't talk about it, but because it was just yesterday we have created a new product, and very soon you will see that is out in the market as well.
Okay. Liberta, you're talking about confidence, you're talking about focus on the business, but the fact is you're a listed company, right? So the big question is, why did you deny it earlier and now there's a U-turn? And since you're in silent period, you won't be able to tell us what's happening next. But do you think because of whatever events have happened, there's been a huge wealth destruction for individual shareholders, big shareholders as well? Do you think SEBI should look into it? And if it's such a big problem, you can't just come to media and talk about it, right? It's not a battle of narratives anymore. It's a bigger issue than that, because lounge is the biggest business for you. So what do you have to say to the shareholders to gain that confidence back? Because they really don't know what to do about it now.
Firstly, I just want to tell you that I am not taking a U-turn or, trying to cover up. Okay, let me tell you that when I came last and when I spoke about this, obviously the contracts were in place and there was no change in the contracts. Everything was intact. We never got any such communication in terms of clients moving out. As I told you that it was just on 30th late evening wherein we got this information that yes, there's going to be a migration, and that's the only reason. So I think we are following the compliances, and I'm very clear that, I would not want to give a wrong narrative to the market. I've always been very upfront and I've always given the right messages. And this time also, I have not taken time to come out and talk about it. Last time when I said it was the fact. And even right now, what I'm talking about is I'm not trying to, come to media to talk about this. You will see that what we are actually building it up, and the way would, Dream Folks is right now, doing the business. So I just want to clear that I'm not using this platform just to make myself, right. I am actually trying to use this platform to give the right narrative, what exactly is happening with this business.
We take that point. So how did these contracts reach, say, others before the company then? And on what grounds were you asked to shut down these contracts? You must have had those conversations with your clients as well, right?
As I told you, the contracts are not shut. The contracts are still on. Okay. Today also, if you actually look at it, the ICICI program is still live on our platform. There is...
So let me put it this way. What clauses were invoked? What are removed? What part of this contract is removed? What still stays?
Okay, so if you actually look at it that, there are different set of cards which actually get these benefits. Okay, so it is only the few cards which have been migrated on the other operators platform. And there are still few cards which are running on our platform. So that is the change which has happened. So 100% cards which were there on DreamFolks platform are not there. There is a migration in terms of the card distribution.
So finally, Liberta, just to sum up, you mentioned that, okay, if there is a proposal for an acquisition that comes up, it is not on your agenda. It's a yes or no answer.
It is not in our agenda right now.
Okay. All right, Liberta, thank you so much for sparing time and joining us today. Of course, the reason to ask you that question, it was not the fact that you mentioned it came out on the 30th, but then since you mentioned that it's been going on for the last couple of years and you've chosen this time to talk about it is the reason why those questions were put to you. But thank you for clarifying on a lot of these aspects. Wish you good luck for the road ahead as well. That was the management of DreamFolks Services on a whole host of issues coming by. Stock currently 4% lower, still well below its IPO price of around 326. Take a short break. The market still, well, where it was, 60 points lower on the index. Continuing that conversation on the markets with Ashi Anand of IME Capital. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Ashi Anand from IME Capital joins us to discuss market fundamentals. Ashi, good morning. Thank you so much for joining in. Well, the big event, the US-India trade deal, that is something which is expected. It is keeping the markets in a wait-and-watch mode as well. There are earnings as well which are coming up, so a lot to watch out for. What's your idea of the markets? What do you think could be the important sectors we'll be watching out for?
Hi, firstly, thank you for having me on the show. So I think the markets are very interestingly poised. You are just kind of off the kind of all-time highs. And I think the two key elements that are preventing a more bullish sentiment from actually forming is one, very, very clearly, we do need to have clarity about the Indo-US trade deal. I would actually argue that you also need clarity about US and other economy trade deals, because that is going to ultimately drive the state of the global economy, and we are still dependent on global demand across multiple sectors. So Trump and the trade deals to be implemented by the US, I think you are going to need to wait to see clarity around some of this before you can get into a bit more of a runaway bullish market sentiment. Because without that, you still have the sword that could kind of really impact the global economy quite significantly. The other core element is that we are entering the corporate results season. Our expectations continue to be that across most sectors, we expect earnings to be largely muted. We've seen kind of low single-digit earnings growth over the last couple of quarters. We broadly expect something similar in the current quarter. We don't really expect to see a large growth rebound. But what is going to be very important to understand is how corporates are really looking at the kind of growth recovery. Across different segments, there are certain pressures, and I think by and large, people are expecting some of this to kind of ease up as we go into the second half. And you see a larger growth recovery going into the second half. But until you aren't seeing clearer signs of this, I think markets kind of crossing and going significantly above the previous all-time highs is going to be slightly difficult.
Ashi, good morning. Thank you for joining in. Since you mentioned the results season, would green shoots be enough to soothe market sentiments that, okay, growth is on the anvil, even though you don't see it this quarter? But even would green shoots be enough, or would you want to see a finer, more proper growth for, as you mentioned, in the second half for the markets to move higher?
So the reason we kind of believe green shoots may actually be enough, right? You have a very, very important thing which is played out in the markets over the last year, which is 100 basis points cut in the repo rates. You have seen the 10-year bond yields also fall off. As interest rates kind of start to come down, there are various kind of positive multiplier effects across the economy. It should help boost consumption demand. It should help certain on-the-margin capex. Real estate is again another segment which should get boosted by kind of interest rates falling off. So you do have a clear indication of what can lead to some form of a growth recovery. Consumption, which has been weak quite sustainably over the last kind of 12 to 18 months. If you just see the kind of impact on household consumption that a fall in EMIs can actually have, and the kind of spending power that that can release. So I think you do have the fundamental framework for a growth recovery, which is the kind of sharp fall in interest rates that you've seen. However, it just across kind of sectors, you have different challenges, right? So I think consumer has had the larger consumption slowdown. We see interest rate reduction as being some kind of a solve for that. IT has uncertainty around US Trump, right? And Trump and tariffs, and accordingly companies aren't spending. You need some clarity around that. Pharma has its own challenges. Across, if you go sector by sector, there are specific issues. A lot of the sectors that were driving growth in previous years, if you're looking at capital goods, capital markets, real estate, a lot of these have grown quite significantly off their lows over the last 2 or 3 years, and the base has now actually caught up. So, yes, we kind of believe that. So when we are talking about green shoots, I think you need green shoots that are clear enough to point towards the second half recovery. But as the second half recovery does kind of start becoming a bit more visible, I think in the context of the fact that interest rates are falling, we believe that the positive market sentiment could sustain.
Right. Ashi, very quickly, running out of time, which is the one sector that you'd be watching out for this time around in the earnings season, on the positive or maybe on the negative side as well?
So the one sector that we really clearly have the biggest focus on is listed digital platforms. We expect these to continue to do very well. There is strong kind of growth. There's underlying profitability improvement. That is the one sector that kind of remains top of our mind. But I think the other big sector is really what are the trends in financiers, because that is a space where valuations and growth and quality, all three of those line up quite well.
All right, Ashi, running out of time, so thank you for sparing time and joining us today. Take this conversation forward on another day. Take a short break here on Trading Hour, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is, of course, CNBC TV18's all-new app, where you get breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen to download the app. We take a short break. Back on the other side. Stay tuned. Welcome back. Still 50 points lower on the index, and some flashes coming on your screen. The unfortunate incident that took place at the Telangana unit of Sigachi, and the company has issued a statement saying that the accident has resulted in a loss of over 40 of their team members, and over 33 people have been injured in this incident. That's the official word coming in from Sigachi. The stock is down around about 7%, but they mentioned the fact that they are coordinating with the emergency response and the family support as well. And they've also mentioned in their earlier release about what they are trying to do with the operations at the plant. But as of now, the word from Sigachi is that 40 team members have been lost and over 33 have been injured in that unfortunate incident. happen. But the markets, the Nifty is down around 50 points, some recovery from the lows that we are seeing. A couple of movers then. Gabriel India is one of them, a 20% circuit yesterday, 20% circuit today as well, so crossing the 1,000 rupee mark, so a record high for Gabriel India. TVS Sri Chakra is another one, 9.5% higher on that stock as well, so doing fairly well for itself. Bajaj Consumer is doing well, 8.5% higher on that stock, and RITES among the railway names is doing well for itself, 6.5% higher on that stock as well. So a lot of movers in the broader market, Sonal, but the index continues to consolidate, some recovery from the low.
Oh yes, that's the big point, right? There is some recovery from the low, especially on the mid-cap index. It was in the red for the larger part of trading day today, but there is some green on the screen. With that, we'll take your leave on this edition of Trading Hour. Stay tuned. Halftime report is up next.
Stocks see cautious trade as India and US continue to engage in a possible trade deal. IT and consumer durables show some green while realty and industrials largely sulk.
Competition Commission of India has ordered a probe into the anti-competitive practices by Asian Paints following a complaint by Grasim, the promoter of paint maker Birla Opus. The paint leader says it will review the order and take legal recourse.
HDFC Bank arm HDB Financial debuts on the stock exchanges at a 13% premium to the IPO price and a positive listing. The MD and CEO Ramesh Ganeshan tells CNBC-TV18 fund infusion will help drive growth, which he believes will sustain at 20%.
Apollo Hospitals MD Sunita Reddy tells CNBC-TV18 the company may trim its 17% stake in Apollo New Co. sometime in the future. She expects the pharma and digital business to notch revenues of 25,000 crores by FY27.
JSW Paints MD Parth Jindal responds to CNBC-TV18's query on aiming for the number 3 spot in paints with the popular jingle Dulux, Dulux, Dulux. Clearly, there's much riding on the Akzo Nobel brand and team for Challenger.
Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Manglam Malu. Well, today is definitely a day of trade where we are seeing some amount of caution. We're just about buying time to see what could probably come out from the US-India trade negotiations. So currently we have the Bank Nifty, which is down around 0.5%, the mid-cap index, which is absolutely flat, and we have the advanced decline ratio, which is currently on the declining side. So let's see where we go from here. But nonetheless, we do have a lot of stocks in focus in today's trading session. So that continues to, be top of mind rather. So Asian Paints, Apollo Hospitals, HDB Financial, and even Dream Folks, where we did have some important comments coming from the management. We'll get to that in just a bit.
Hi, Ekta. It is consolidating on, lower consolidation is what one can say for the overall market right now. Though over the last few minutes or so, we've seen a big spike in a couple of these metal names. So JSW Steel, Tata Steel, both of them come up for you on the screen. This, even as trade talks world over are currently underway. We had the flashes of, Japan, the Japanese Prime Minister at the bottom of your screen too. We have some pockets which are doing a lot better. Metals over the last few minutes, but right now through the day we've seen some of these low-ticket consumption items. Britannia, for instance, has moved higher. Remember, the management had told us that they're not too far away from the double-digit growth. We are seeing some traction in names like Godrej Consumer, also Kalyan Jewellers and Titan ahead of their first quarter update. So we'll watch out for how this performs. But there has been this shift to defensives where some of these pharmaceutical stocks and a couple of the IT names, along with some FMCG names, are doing a lot better today. Amidst all the stocks which are advancing versus declining, we have Inox Wind that is buzzing. There has been a bullish note that has come in from Motilal Oswal this morning. The brokerage has initiated coverage on the stock, a buy rating. What is the rationale? What is the target price? Vivek joins in to tell us more. Vivek.
Well, that's right. Bullish note, and that's precisely the reason why Inox Wind is doing quite well in the session today. So Motilal Oswal initiated coverage. They have a buy rating on the stock and a target price of 210 rupees a share. Now, what does the company do? Remember, the company delivers end-to-end solutions as far as the wind power value chain is concerned. They manage conception, they manage the commercialization and the commissioning of a wind solar project, and along with that also provide O&M, which is operation as well as maintenance services for the entire power project in the wind sector. Along with that, the company also produces 2 megawatt as well as 3 megawatt wind turbine generators. And at the end of FY25, the company had an order book almost 3.2 gigawatt. Now, the company also has a listed subsidiary, Inox Green Energy, managing a 5.1 gigawatt O&M portfolio. So with all this, Motilal expects that the company should be able to deliver a strong consolidated EBITDA CAGR of 38% over FY25 to FY28. They see ramp up in the wind turbine generation execution from 705 megawatt in FY25 to close to 1.8 gigawatt in FY28. The target PE multiple that Motilal Oswal has set is at 25 times FY25 and FY27 EPS.
Okay, all right. So that's on Inox Wind. Vivek, thanks very much for that. That stock is up around 2.3%. The other stock in focus is Keystone Developers, which is gaining in trade after the company is selected by 8 housing societies as a developer of a large-scale cluster development. Sonal is here with more details in this. Over to you, Sonal.
Thank you for that. Well, yes, the company is in focus. They have won an order for cluster development where there will be 8 societies that they will be redeveloping. The development agreement has been executed with 5 societies and letter of intent has been done with 3 societies. They say the execution with the 5 societies will happen very soon. The cumulative developable area is 4.75 acres and the saleable area is 10.6 lakh square feet. They say the total gross development value is around 3,000 crore rupees, and that is something that the street seems to like, and the stock is higher in trade.
All right, that's about Keystone Realtors. That stock higher by about 3.5% in today's trading session. Also, we have Hindalco, which is joining the metal stocks, which are doing well over the last 15 minutes or so. But let's talk about CNBC TV18 Prime, which is our latest offering. It brings you insights from policymakers, business leaders, economists, and all of them who are shaping both the India and the world's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, gives you unparalleled insights. You can tune into CNBC TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C, which focuses on commodities and crypto, and Global Lens at 8:30 p.m. on weekdays. Well, a lot is happening in the paint space. JSW Paints is ready to challenge the top two players, says the company's managing director Parth Jindal, after the acquisition of AkzoNobel's India assets. He expects more synergies from an iconic brand like Dulux. I caught up with him and, the global CEO of AkzoNobel to talk in detail on the outlook on this deal and, more importantly, the synergies. Here are excerpts from that conversation.
It's one of the most iconic companies globally, and we've always been we've deeply respected everything that the business has done in India. So when this opportunity came, we felt that it's the right opportunity for JSW Paints, and there are a lot of synergies between the two. So, once we, hopefully, if we get all the approvals, the Competition Commission of India approval, as well as complete the open offer, and we get into the business, we will become the fourth largest player in the Indian paint industry. With looking at FY25 numbers combined, we'd have a top line of about 6,000 crores. And we would be in striking distance of the third largest player in the market. And our aim would obviously be, to understand the culture of AkzoNobel India, integrate the families of AkzoNobel India and JSW, make it one big, paint company. Look at the synergies in the market, because there are a tremendous amount of synergies both in the decorative side of things as well as on the industrial coating side of things, and then leverage the technology partnership that we will continue to have with AkzoNobel. So our goal is that we would like to come into the top three in decorative, and like to be the #1 player in industrial coatings. So, like I said, we have to first get into the business. We have to understand everything, and then we have to start unlocking the synergies. So it's a bit premature to put a time frame to it, but I would like to say that we would like to do it at the earliest.
Was that a tough negotiation that you had, because there were many suitors for AkzoNobel India?
It was, but it was a very positive discussion because at the end of the day, it's about the proceeds, certainly, getting value out of the business, but it's also about finding the right partner because we believe in India, we're staying committed and invested in India. And as much as we're convinced that JSW will do a better job than we can to capitalize on the strength of Dulux in the deco market to grow faster, on the coating side, we remain the technology provider under a royalty agreement, and therefore it's a long-term partnership, and we wanted to make sure that we had the best partner, which we believe we do.
You enter this business with some debt on your books. How much more elbow room would you have for any further capex deployment towards marketing spends, deployment towards distribution, and how much of that would be arising from the synergies?
Yeah, in terms of capacity, now when you look at the 5 facilities that we would be acquiring from AkzoNobel India and the 2 facilities, soon to be 3 facilities of JSW Paints, combined we would have enough capacity to double the revenue from where we are today.
Got it.
So from 6,000 crores, we can take this business to 12,000 crores without adding any new facilities. So in the near term, apart from certain debottleneckings and certain backward integrations in resin, there is no plan for either company to embark upon any serious capex. In terms of the branding, like I said, we have to establish the brand architecture, but yes, we will double down on our advertising spends. We have to we need both JSW Paints as well as Dulux. We will want to, amp up the spends over there. So we want to definitely get the spends up in.
To what percentage have you?
No, the benefit for us is AkzoNobel India is acquiring the IP from AkzoNobel Global. So the 3.5% royalty that was being paid to AkzoNobel Europe on the decorative side goes away.
Right.
So that elbow room is available to the company to amp up spends on the advertising front, plus what JSW Paints has been spending, plus what Dulux itself has been spending. So overall, this becomes significant.
And what about distribution? You guys combined have about 28,000 touch points. Compare that to the leader at 90,000. The disruptor, Birla, they've reached around 55,000 as well. Have you put yourself a target here?
So I think touch points is not the right way of looking at it. I think let's look at machines, tinting machines, which is the main main metric we at least follow. And between AkzoNobel and JSW Paints, we would have 28,000 now, which would be a very significant number. And last year, AkzoNobel India added about 3,000 machines. JSW Paints added about 2,000 machines. So that engine is also working, and that engine is also bringing in new network also. We know Dulux is one of the leaders in the premium end, and we know JSW Paints is growing very fast in the value and mass premium end. So now how do we combine the two is going to be the thing. Obviously, the first port of call and the first synergy is getting the 28,000 retailers that we have combined to start selling each other's products. Right? That's the first synergy that will play out. Our 9,000 guys will get Dulux. Dulux's 19,000 guys will get our product. Our tinting machines will tint their product. Their tinting machine will tint.
So that is an immediate revenue synergy of how much?
That is at least you can call it about between 700 crores to 1,000 crores of synergy can be unlocked there.
Got it.
And then you look at the synergies from the new network that is going to get attracted to this new proposition of JSW.
Which will be growing at what pace?
Let's see. Like I said, 3,000 and 2,000, 5,000 got added last year. So we would hope that people see value in our proposition. But like I said, first we need to unlock the value in the 28,000. Then there are synergies on the cost side, whether it's logistics cost, whether it's procurement cost, whether
a couple of 100 basis points at least.
Yeah, it all play out. We have to get in and figure all of this out. But we believe outside in there's a couple of 100 basis points possible.
Everyone we spoke to after this deal was announced. They said that, okay, this is a consolidation in the industry. They are well aware of the strategy that AkzoNobel India has been deploying so far in the market, as is JSW. What is going to be different in terms of an offering and in terms of a strategy to the market once again, the aggression, as a combined entity? What would you imagine that to be?
Like I mentioned, the decorative, I think we get heft with this coming together. Industrial, we become the number 2 player in liquid coatings in the country. So the aim would be how to become number 1, how to leverage the deep R&D know-how that AkzoNobel Global has, being one of the leading players in the world, and leverage all their know-how in bringing in newer products into the market, as well as double downing on their leadership position in auto refinish, in marine and in protective. And JSW Paints is the leader in coil. So when you put all of this together, we have a very significant industrial business. And over the last few years, at least the last 2 years, industrial has been growing faster than decorative. So we want to definitely make sure that we continue on that path. So that will be the strategy, is, really derive synergies.
So what sort of operational targets have you set yourself when it comes to, say, a 10,000 crore revenue that we're looking at a combined entity in the next couple of years? What would the margins then be?
So, we have to, I think it's again a bit premature to disclose any of that information. The aim is obviously on the decorative side is to continuously spend on the brand and build market share. On the industrial side,
Do you have a target in mind?
No, I don't have a particular target. We want to be the 3rd largest player for sure in the decorative side of things, and then we'll start thinking of second. But first, go step by step. And industrial, we want to be number 1. But I haven't given it a thought of what is the kind of overall margins that we're looking at. But we would obviously benchmark ourselves to the listed players, and we would like to be in that ballpark.
What about the reverse merger of JSW Paints into AkzoNobel once this deal is completed?
Yeah, I think again a bit premature. We haven't taken a view on that as of now. We believe that there are advantages of having one private company and one listed company. We also need to understand the synergies. We also want to complete the integration. Once all of that is done, then we will look at the opportune time to disclose.
Because I do remember you said that you would look at a couple of IPOs from the JSW group in the next few years.
Yeah.
One of them was Cement and the other one was Paints. So you still continue to maintain that, or maybe you will list Paints via this way?
I think now there is no need for JSW Paints to look at doing a separate IPO. This is a vehicle that we will have available to us. It's only the timing that will be decided.
And what about the leadership of this business? How much of it will be run by the Akzo team? How much of it will be run by the JSW team? And how many people will be holding on to their jobs?
No, every single one of them. We are, AkzoNobel India family is, joining hands with JSW. We are extremely proud and honored to welcome them to our family. What Rajiv and the team have built at AkzoNobel India has been truly phenomenal. And Rajiv will continue to run the listed entity. That is my intent. I hope he also wants to do that. And JSW Paints leadership team will continue to drive JSW Paints, and then at the time of the merger, then we will decide what is to be done.
Is there a one-line message that you'd like to give to all the incumbents and the recent disruptor in the paints industry?
Dulux, Dulux, Dulux.
You want to sing that as well?
I can do it better than Parth.
Right. Dulux, Dulux, Dulux.
Yeah,
That's exactly what he's
singing
saying.
all the way to the bank post the acquisition.
Yeah, the AkzoNobel guys will be singing all the way to the bank, and Dulux, Dulux, Dulux is what is on Parth Jindal's mind right now. What we'll do is, we have the markets on our mind. We'll take a short break. On the other side, Pritesh Mehta, Executive Vice President at Yes Securities, joins in with some trading strategies. Welcome back. The Nifty is down about 50 odd points. We've seen a slight bit of recovery from the day's low. The mid-cap index is marginally in the green as well. Perfect time to get you up to speed with what the FNO setup for the market looks like right now. If you look at it, there is consolidation at the lower level. So we have Nifty, Nifty Bank, Nifty IT, all of them in focus. The IT index, while it is in the green, has moved off the highs, and as a result of which we have the overall Nifty lower by 50 points. If you look at the advanced decline ratio, that tells you that more stocks are declining than the number of stocks which are advancing. So notwithstanding the outperformance of the mid-cap index, the broader markets still have more stocks in the red. If you look at the Nifty day's low today, it's pretty much contained to what we've seen over the last few trading sessions. So 25,450 to 25,500 is where we've seen some sort of reversal for the frontline index. And the Nifty Bank as well. Today's low is 57,139. The low yesterday was 57,151. And the low previous day was 57,193. Again, between 57,150 to 57,200, we are seeing some support come by for the frontline index as well. So there is consolidation at the lower levels, but nothing really that worries, the larger trend on the market. Defensives, they are outperforming today. So we've seen Britannia do well, Biocon, Autopharma. So from the FMCG and pharmaceutical pack, there is some, stocks being well bid. But on the way up, there is some supply. 25,500 call and the 25,600 calls. Both of them active ahead of expiry tomorrow. So we have close to 25,600 to 25,650, which is again the previous few days highs on the Nifty, where some can see some supply. But for the market to reverse its consolidation trend, it has to break above day before yesterday's high. And fresh longs, I'm seeing on Amber End. That's the one stock that I'm looking at, because even yesterday that stock outperformed and a lot of open interest built up out there. So just keep an eye out on Amber End. For the last couple of days, there has been some long positions which are being added to Amber End prices.
Okay, all right. So those are a couple of FNO updates. We do have Pritesh Mehta joining in to discuss the markets now. Pritesh, hi, welcome to the show. Well, let's start with the Bank Nifty, which is under pressure today. It's underperforming. It's down around 0.5%. We have IndusInd, which is down around 1.8%. There was a Goldman Sachs note on that. But separately, even something like an HDFC Bank is under pressure. How would you approach these stocks today?
See, I'd like to start with Nifty, then move on to Bank Nifty. First of all, Nifty is in a good spot right now. Despite a sharp rally that we had from second week of June, market is consuming time at top rather than giving away, which is a good sign. And when we talk about Bank Nifty, I think so. The structure is improving. Despite that weakness, or we can say, I won't term it as a weakness, but a bit of consolidation in the private banking space. PSU banks are shaping up quite well. In fact, when we look at the ratio, PSU banks versus Nifty or even Bank Nifty, they are coming out to a base. So I think private banks are taking a bit of break, but nothing wrong with that. They were the early movers. I think they are going through a bit of time-wise correction, nothing more than that. But the strength of Bank Nifty and Nifty is still there from the broader perspective.
All right, and individual stocks, are you going long or short?
I think we have several pockets of strength right now in market, whether it's metals, whether it's cement. So I think we have created one customized cement index, and that is breaking out on the upside after months of consolidation. So one stock that caught our attention, that is Dalmia Bharat. Now this stock was consolidating for almost a year. It created a base, now it's breaking out. We can see series of bullish anchor columns. So buy for a target of 2500. The stop would be around 2150. The second one is buy on JSW Steel. Now see, Nifty metals are shaping up quite well on standalone chart as well as ratio also. With dollar weakening likely to continue, I think this space is going to be active for a quite long period of time. So buy JSW Steel for a target of 1170. The stop would be around 1020.
All right, Pritesh, thank you so much for joining in and giving us your views on individual stocks. Let's talk about IndusInd Bank. That's the one which is under pressure. It has been recovering from its lows earlier. Nomura had a positive note on the stock. We are awaiting leadership changes out there, but today there's a Goldman Sachs note which is downgrading the stock. Vamakshi joins in to tell us more about this downgrade. Vamakshi.
Well, Mangalam, it's a downgrade coming in from Goldman Sachs for IndusInd Bank. They've downgraded the counter to sell, target price of 722 rupees per share. They say that the company is now in a very structurally weak position. ROAs are expected to reset lower. They believe the bank is likely to have a weaker growth trajectory going forward, as well as return profile, even post normalization of its trajectory in the second half of FY26 as well as FY27. 1.7. Given that, they've gone ahead and cut their EPS estimates by 25% for FY26 and 17% for FY27. This in turn reflects likely persistent margin pressure amid a weaker yield trajectory as well as elevated funding costs. Now, valuations, as far as those are concerned, are likely to stay below book on poor visibility of turnaround. So, therefore, they've gone ahead and have issued a downgrade on IndusInd Bank. Resultantly, the counter is under pressure today.
Okay, all right, Vamakshi, but stay with us because you're watching HDB Financial Services also, which made its D Street debut. Tell us more.
Well, Ekta, you know, the company has listed at 835 rupees per share. This is coming in at a premium of almost 13% to the issue price. Now, keep in mind that the company has an AUM of 1.06 lakh crores in FY25. They managed to grow their book at a 20% CAGR over the last 4 years. As far as the NIMs are concerned, in FY25, they were under a tad bit of pressure, coming in at 7.6% as compared to 7.9%. And the asset quality is quite robust for the company. It is at 2.26%. This is one of the lowest asset qualities that we've seen among some of its peers. Now, in FY25, they did note high credit cost, which was at around 2%. Resultantly, the ROA is declined to 2.2%, and it is tad lower as compared to peers such as Cholamandalam as well as Bajaj Finance. Now, let's talk about valuations as well. Now, it listed at 835 rupees per share, which puts the company's 1 year forward price to book at 3.4 times. When we compare it to Chola Investments as well as Bajaj Finance, it is slightly lower, but it is higher than the 2 times that Shriram Finance trades at. We were also, in fact, joined in by the management, and they said that they are ensuring that they have adequate capital to meet all of their aspirations. They're attempting to have a well-balanced portfolio, and they believe that the rate cut cycle will be quite beneficial for them. They also highlight that they are very conscious on how they're managing their risk through the cycles. Currently, they have a 73% secured book and 27% unsecured book, and they believe roughly the ratio will remain the same. They're expecting 70% secured and 25 to 30% unsecured book going forward. The company did have a good listing. The stock continues to do well in trade, up almost 14%.
All right, Vamakshi, thanks a lot for that. You alluded to what the management had to say to CNBC-TV18. Let's listen into what they had to say.
Consumer finance is our newest business. It was about 13% about 5 years ago. It's 23%. We believe that all our businesses that we are in have an opportunity for growth as India grows over the next few years and decades. So what we would like to have is a very diversified book so that we can manage business cycles. So there'll be businesses that have a certain low and a business that have an opportunity. So what we're really trying to do is to have a well-balanced portfolio. Our focus is on making sure that we deliver a good stakeholder value over a long period of time. Our fundamentals are very strong. We have a strong business model. As I said, a 17-year-old company manage risk through cycles. We're very conscious of how we manage our risk and our cycles. 75% to 70% secured, and 25 to 30% unsecured. So that principle will broadly stay.
Okay, so that is HDB Financial up around 14% good debut coming in there. We'll take a short break, but on the other side, Manisha Gupta will join in to talk about the commodity space. Stay tuned.
Well, we pointed out that there is buying in the defensives. Just pull up something like a Colgate. That stock too has surged to the high point of trade right now. We also have Varun Beverages, which has spiked from the lows. So it's recovered about 1.5% from the lows, currently sitting with a gain of almost 1%. So Colgate, Varun Beverages doing well. And alongside that, on the other hand, we have Tata Communications. That's one which has also moved higher by about 5%. That stock is sitting with a price of almost 1,814 rupees on the counter right now. But let's talk about the commodities arena. Manisha Gupta joins in. Manisha.
Thank you so much for that, Mangalam. And I'm joined with a special guest as well. Dilip Narayanan is Head Bullion and Treasury at Malabar Group. Dilip, hi, thank you so much for joining in. And the first half of this year has seen big amount of volatility. We've done an all-time high at $3,500 an ounce as well. And we've closed the first half with nearly 27% of gains. Take a step back and tell us on how have you seen the first half of this year to begin with?
Thank you, Manisha, for a quick call. And yes, you're absolutely right. The price has been, very volatile. I would say not even in the first half, even in the last quarter of previous year also. From there, I mean, it's been almost 1 year now. The rally has been bullish, and this first quarter has been real challenge for the retailers also because there's been days when the price moved up pretty high, and the buyers have been waiting for a small dip where they can seasonal buyers can buy it. So definitely for this first half, the percentage of business which we normally see has definitely dipped down.
Dilip, how would you look at the price and volatility continuing into the second half of now? I mean, how are you planning? How are you calculating the rest of this year?
Well, I foresee the prices to be volatile. With yes, there has been a little bit of relief as far as the global tensions are concerned, but you never know, Manisha. I mean, there are surprises every day. But people, but gold seems to be bullish, and I mean, maybe here and there, $100-200 volatility is which is very common on a daily basis. But the second half again would be a little challenging. But having said that, in India per se, the rupee is performing well. I mean, rupees would definitely start performing well with various various agreements to be signed with the US and things like that. So and also main thing is that we have festival seasons coming in, Diwali and things like that. So there are the festival seasons now start in the second half. So India could see a good rise, good buy of gold in the second half, no matter where the price is.
Oh, sure. Dilip, also, so what is your outlook when it comes to prices for the second half of 2025? Also, how would you look at the demand performing as well?
Well, my price, it would average be around 3,400 to 3,200. I mean, I don't see anything below or above. That's my personal quote. I mean, based on how the market is behaving as of now, and demand per se, as far as jewelry is concerned, I'm very positive about it. Even at these levels, we have seen good purchases happening in various dips. Like even a $50 dip, we find customer rushing towards buying gold because there is much, as I mentioned earlier, there is too much of buying pending within the customers levels, because of the price. And I'm sure that all this festive seasons will convert all the purchases of gold into a positive note.
Dilip, also comment on what people are really buying. Is it more about investment or is it jewelry buying, one? And second, there seems to be that push towards 18 carats, but there are some jewelers telling us that the wealth creators perhaps are continuing with 22, some even asking for 24 as an investment. What is it that you're reading on the ground?
Predominantly, Manisha, India is more of jewelry purchase and as compared to what investment buying is. Yes, there is a rush towards investment buying. At spikes, you see more of investors coming into the market for buying investment bars. But the percentage wise, if you compare it with international, because we do have international, stores also. So as compared to that, in India, the purchase of jewelry is definitely the first choice. But investment bars are also coming up because of the price move.
Since you mentioned about the global stores as well, what has been your reaction on the stores there? Because while, of course, India has been slightly choppy and, as you said, price sensitive as well, what about the international markets?
International market has also seen a dip because of the global tensions. I would not be able to quote the exact figure of our international business because I have not seen the real figure. But I can mention that overall we see a decline of sale internationally also. But again, when India moves in towards buying spree, all the markets converts accordingly, be it Middle East or Far East or any other country.
Okay, all right, Manisha. Thanks very much for that. Well, that's on the entire commodity space. We need to take a short break with the news that we have the markets just about flat at this point in time. The mid-cap index flat, and we have the Nifty just about lower by around 50 odd points. Consolidating, you would have to say, with a little bit of a negative bias. Take a short break. We'll get you more on the markets. Lots of stocks in focus. All of that on the other side.
Pull up the intraday chart of Bajaj Consumer. What a big mover this stock has been. It's up 11% right now in a market which is consolidating lower. Bajaj Consumer is one of the stocks which has been a big outperformer, up around 10% In the last month or so, it's up around 30%. And the biggest reason for that is a change of guard, where Jaideep Nandi has decided to step down. And the company in the earlier part of June itself announced that, there would be Neeraj Pandey who would be taking over as the MD of the company, who has experience in Marico, Bangladesh, Asian Paints and a couple of other FMCG companies as well. Before this, he was at Unibic. From that announcement day itself to now, the stock has returned about 38%. So the street definitely liking the change of guard in Bajaj Consumer. Otherwise, the business has been very, very meek over the last few quarters, and the stock has been an underperformer in the past as well. Can they move forward from here on or not is the big question. But speaking about moving forward, in our Insight Edge segment today, we're focusing on Apollo Hospitals. Ekta, we spoke with the management earlier today on the scheme of arrangement. What is it that you took away from the conversation that we had and what they had to say?
Well, interesting details coming in from Sunita Reddy as always. So the reason for the particular deal that she undertook is, or the composite scheme of arrangement, is to basically, they always felt that the sum of parts didn't really do justice to the valuations of their digital business. Now, remember that the new company as well as the existing hospitals business will now get a valuation based on what these existing businesses have. For example, shareholders also were quite unhappy that, if you just want to buy into a traditional hospital business which generates cash and you put that money back into hospital expansion, you can't do so simply because the digital business is with that particular company. So that gets separated so that sum of part value, parts didn't really do justice to the valuations according to them. Now, separately, they do see the company reaching 25,000 crores in terms of revenue and 7% EBITDA margin. They do believe it's achievable. They've done around 16,000 crores in FY25. They do believe that, there are segments such as insurance as well as the pharmacy business, which will be key drivers going forward. Offline pharmacy business is growing at 20% according to them. KMed, which is their distribution business, is growing at around 18 to 19%. And KMed can probably grow at a faster clip with the introduction of private labels as well. But overall, for Apollo 24/7, when does it break even? That's an important part because the street is watching out for that. They've reiterated that it will probably break even by Q4 of FY26 on the EBITDA level. And an interesting part is that, Apollo Hospitals is going to hold 17% stake in this new company. So that means that there's a possibility that they could even use that stake eventually to monetize it, to put it back into Apollo Hospitals in terms of cash, but nothing near term. Is just something to keep on your radar. The royalty, which will be paid by Apollo Health Tech or, the new company to Apollo Hospitals, will begin at around 10 crores per year and then will rise by around 5% every year. We did, in fact, speak to Sunita Reddy earlier this morning. Listen in to excerpts of what she had to say.
First, in terms of the valuation, we've always felt that the sum of the parts did not do justice to the digital. The rationale behind doing the whole thing is not just to capture the value of the sum of the parts, but to go beyond and create a very strong retail digital business, which is omni-channel. As you look at forward, I think the offline pharmacy growth is around 20%. And the EBITDA generated from that is 1,000 crores in 2027. KMed is growing at about 18-19%. And with the introduction of private label, there is a very strong opportunity to also improve the EBITDA margin and the EBITDA coming from that, which will be 700 crores. Digital, we are quite sure that we'll get at least 60 to 100 crores of revenue. So total, the breakup of I've given you the breakup of the EBITDA because in the end, that's what counts. You will get 25,000 as you look at the 17 and the 20% growth coming from the three different, the digital, the offline, as well as KMed. So the 20% growth results in 25,000 crores of turnover.
All right, so that's the management of Apollo Hospital, Sunita Reddy out there. But let's talk about V-Mart. That stock is under pressure right now, down about 2.5%. And this after they've reported their first quarter update for FY26. And the update says that their revenues, while they grew about 12.5%, closer to 13%, it was led by a very meager same-store sales growth. Same-store sales for the company this quarter grew by just 1%. On its part, the company says that because the base quarter had Eid, which was preponed in the fourth quarter this year, if you adjust for that, the same-store sales growth is up 5%. But even if you take all of those things into account, the sales per square feet for the company have grown just 1%, and that's what brokerages aren't particularly happy with. Yes, they've added around 15 stores during this quarter, close about 2. The important part is going forward, will they see an improvement or a pickup in same-store sales growth from here on is the big question. The stock has seen a recovery from the lows earlier, so maybe some bit of profit taking after what was just slightly muted street performance versus street expectations. With that, we'll slip into a short break, but as we do that, let's give you some good news. India's business news leader, which is CNBC-TV18, is now just a click away. That's the CNBC-TV18 app, which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. You can download this app from either the Apple Store or the Google Play Store, or just scan the QR code which comes up for you on the screen.
Welcome back. Well, it is showing an incremental amount of pressure for the bank Nifty now. So we are down around 0.7% at the low point of the day. Just watch out for IndusInd Bank, which is down around 2%. It's lost around 10% this year. Obviously, it's going through, lots of news pieces over the year. But nonetheless, besides that, it is Bajaj Finserv and Bajaj Finance, both the twins, which are under pressure today, so down around 1.7 to 2% respectively. And moving away from the financial stocks, we have Larsen and Toubro, which is showing a little bit of a decline now, so down around 1.3% currently for L&T. And on the upside, however, JSW Steel and Tata Steel managing to hold their head above the water, top gainers on the Nifty. But we need to wrap up the show. As we do that, we'll leave you with some views on Trump's sleeping tax bill and tariff uncertainties from Ben Powell, the chief strategist for Asia, Pacific and Middle East, from when he spoke on CNBC earlier today. Listen in.
after a lot of toing and froing, and that is, I suppose, a victory for the administration. So over the last couple of weeks, I think it's fair to say that President Trump and the US administration will feel that they've had kind of multiple wins domestically, foreign policy and otherwise. So I think that will feed through into confidence that they are on the right track. So again, as investors, I think we should very much expect to see a continuation of the, how can I say, more dynamic approach from this US administration where comments can turn around kind of very quickly. Again, that's going to continue. So waiting for clarity, I think, is not an option. We're going to have to learn to accept that, deal with it, act and invest accordingly. There are really constraints, actually. So we believe, President Trump, we at BlackRock believe that the US are serious about trying to rewire global trading. That seems to be a real thing. However, they have to live in the real world, and there are something like laws of physics in the economic sense. You can't just click your fingers. Not even the mighty America can just click their fingers and kind of unpick 50 years of trade globalization and so forth. So it's going to take an awful long time, even if we believe, as I think we do at BlackRock, that there is a sincerity around changing the trading system. So these constraints slow the pace of change and mean that the US administration have to kind of deal with the world as it is. And that is somewhat reassuring.
Nifty Sensex fall further to trade near the day's low. Banks continue to be under pressure. Mid-caps also in the red but are relative outperformers. Realty and industrial sulk, while metals and consumer durables show some green. HDFC Bank's arm HDB Financial debuts on the stock exchanges at a 13% premium to its IPO price in a positive listing. MD and CEO Ramesh Ganesan tells CNBC-TV18 that the fund infusion will help drive growth. Apollo Hospitals MD Sunita Reddy tells CNBC-TV18 the company may trim its 17% stake in Apollo HealthTech sometime in the future. She expects the pharma and digital business to notch revenues of 25,000 crores by FY27. Greenfolk Services CMD Librata Kalat speaks out, saying pressure from airport operators caused ICICI and Axis Bank to pull the plug on key programs. The provider of airport lounge services hopes to build other verticals to offset the pressure on its core business. SBI classifies Reliance Communications as a fraud account, saying sufficient reasons were not provided to explain the irregularities. The bank will report the account and name of Anil Ambani, director of the company, at the material time to RBI. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. With me is Vamakshi Dhoria. Vamakshi, good afternoon. Yet another day of consolidation, still grinding towards the downside, and that is what has been the case over the last couple of days as well. Well, absolutely, Hormaz. Nothing has changed over the last 3 days. It continues to remain a lackluster trading session yet again today. And in fact, when we look at the broader markets as well, you know, the mid-cap index is performing relatively better as compared to the benchmark indices. The advanced decline ratio will also come up for you on the screen. It will show that the declines are far outpacing the advances. In fact, let's also look at some specific stocks then. There are some stocks that have managed to climb to an all-time high amid the kind of muted moves that we're seeing today. Take a look at SRF. That stock is up almost 2%, 3,270 thereabouts is where the stock is at. Apart from that, take a look at UltraTech Cement, Dalmia Bharat, some cement stocks also notching some gains in today's trading session. But apart from that, let's also focus in on the metal index. That too is doing quite well. Tata Steel, MotoCorp, JSW Steel are some other metal counters that are flying high in trade today, and the Nifty Realty Pack continues to languish in trade, down almost 1.5%. But moving on then, HDB Financial Services, India's largest IPO so far, made its debut on Dalal Street today, listing at 835 rupees, a premium of almost 13% to its issue price of 740 rupees. The listing price of 835 rupees gives it a one-year forward price to book multiple of 3.4 times, which is lower than its peers like Bajaj Finance and Chola Investment. We also spoke to the management of the company about their listed business. Let's listen in to what they had to say.
Our focus is on making sure that we deliver a good stakeholder value over a long period of time. Our fundamentals are very strong. We have a strong business model. As I said, a 17-year-old company manage risk through cycles. We're very conscious of how we manage our risk and our cycles. 75% to 70% secured, and 25 to 30% unsecured. So that principle will broadly stay.
The stock that has been in the news over the last couple of days has been Apollo Hospitals, and that is because they're planning to create a new listed entity by consolidating its pharmacy, digital health and pharma distribution business into one platform. Now, earlier today, we spoke to Sunita Reddy, who is the managing director of the company. Here's what she had to say.
First, in terms of the valuation, we've always felt that the sum of the parts did not do justice to the digital. The rationale behind doing the whole thing is not just to capture the value of the sum of the parts, but to go beyond and create a very strong retail digital business, which is omni-channel. As you look at forward, I think the offline pharmacy growth is around 20%, and the EBITDA generated from that is 1,000 crores in 2027. Keymed is growing at about 18-19%. And with the introduction of private label, there is a very strong opportunity to also improve the EBITDA margin and the EBITDA coming from that, which will be 700 crores. Digital we are quite sure that, we'll get at least 60 to 100 crores of revenue. So total, the breakup I've given you the breakup of the EBITDA because in the end, that's what counts. You will get 25,000 as you look at the 17 and the 20% growth coming from the three different, the digital, the offline, as well as He-Man. So the 20% growth results in 25,000 crores of turnover.
25,000 crores of turnover for the new company is what Apollo Hospitals is expecting. But moving on then, let's focus in on Dream Folks as well. The stock is under pressure after certain programs for Axis Bank and ICICI Bank were closed. Vinny joins us with more details on this. Vinny?
Absolutely. So what we understand, and this came in as a notification on BSE, was that certain programs for Axis Bank, ICICI Bank have been closed with effect from 1st of July 2025. Now, what they're highlighting that the contracts with both these clients overall are still active, other than the lounge services where there are some issues. So some of them have been closed, is what the word came in. Now, do not forget the 93% of the revenue for the company comes in from lounge services, and 7% approximately comes in from non-lounge services. The management spoke to us today on CNBC-TV18, and what they are highlighting that, the notification for this cancellation of the services from Axis and ICICI Bank just came in few hours before the cancellation of the program. That was yesterday when the announcement came in. They said there was no information from the clients on the migration of the program before, and there are certain migrations that will happen. Some of the cards will still be with DreamWorks, some of them will be migrated. The company also said that there were two major air operators who have entered the business and which is putting pressure on the company in terms of their business. They also mentioned that the airport operators putting pressure on clients like ICICI Bank and Axis Bank, which has led to some of these cancellations coming in. The client also highlighted that they had to move from company's lounge program due to the airport operator pressure. Because of all these pressures coming in from two other operators, there was pressure on the clients as well, and that's why the shift that has come in. Company highlighted that obviously there are 70 plus airports or lounges where they're working on, but around currently 35 to 40% of the lounges are operated by these two major operators, so there could be some impact on this front. The lounge is one of the biggest business and revenue growth drivers for the company. They're focusing on new ones, but 93% of the revenue comes in from lounge services, and Axis Bank and ICICI Bank are one of those big clients, and they just got a notification few hours before that cancellation that happened yesterday. That's the word from the management.
Vinny, thanks a lot for summarizing that, and let's also listen into what the management had to say when they spoke to us just a few hours earlier.
It was a pressure which was getting built up to the clients. Okay, it was a pressure tactics which were done. So to be very upfront, it is mainly done by these two major airport operators who have now started getting into the similar business. The pressure which has been built up is to, tell the clients that, in case if they do not sign up with them or do business with them directly, they would actually stop their cardholder access to their airports. So this is a pressure which has been built up, and these are the reasons that why these clients had to move. But let me tell you that our contracts are still in place. It is not that we were just managing the lounge program. Just the airport lounges. There are other services also which Dream Folks provides to these clients. Secondly, also to mention that, there are around 70 plus lounges in India. However, these operators, the airport operators who are trying to get into this business are holding around 35 to 40% of the lounges only. It was just on 30th late evening wherein we got this information that yes, there's going to be a migration, and that's the only reason. So I think we are following the compliances, and I'm very clear that I would not want to give a wrong narrative to the market. Contracts are not shut. The contracts are still on. Okay. Today also, if you actually look at it, the ICICI program is still live on our platform.
Well, that was the management of Dream Folks. The stock continues to languish in trade today. But moving on to the next big story today, India's largest lender, State Bank of India, has classified the loan account of Anil Ambani's Reliance Communications as fraud. SBI concluded the company could not explain non-adherence to terms and conditions of the loan. Ritu brings us more of the details. Ritu?
That's right. State Bank of India has classified the loan account of Anil Ambani's group company, Reliance Communications, as fraud. And in its letter, which is dated the 23rd of June, SBI said it did issue multiple show-cause notices to the company in the last year. And after reviewing their responses, it found that the company failed to explain their non-adherence to the terms of the loan. And they also couldn't justify the irregularities in the conduct of the account. And therefore, SBI tagged them as fraud. And it is now going to report both the company and its erstwhile director, Anil Ambani's names to the Reserve Bank of India. But remember, this is not the first time that the company's account has been tagged as fraud. Canara Bank did it in November last year, but of course later the Bombay High Court did stay the move, citing the lack of borrower hearing as per RBI directions. Now, Reliance Communication, interestingly on its part, says that it has been under the corporate insolvency process since 2019, and the loans that SBI is talking about were taken before the process began. A resolution plan is already in place and it is awaiting the final note from NCLT, and therefore under Section 32A of the Insolvency Code, it should be immune from prosecution for any past actions once the resolution plan is approved, and therefore it is seeking legal advice on the next steps. But if you look at SBI's reason for this fraud classification, they're quite stark. For instance, they find loans worth 6,200 crores were used by Reliance Communication to repay other bank loans. Almost 5,500 crores went to related party repayments. Another 1,880 crores was invested and quickly liquidated. That suggested that the funds were not used for genuine purposes, and so on. So there are clear red flags. There are instances of fund diversion, breach of trust, and manipulation of account, all under the watch of the company's management and promoters.
Indeed. Ritu, thanks a lot for bringing us that update. As we take a short break, remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes the global shifts and their impact on Indian businesses, giving you unparalleled insights. You can tune in to CNBC TV18 Prime at noon for the Global Reset, 1 p.m. for the Big C, and the Global Lens at 8:30 this evening.
Welcome back. You're watching Business Lunch on CNBC TV 18. Let's get you the latest from Trump On the tariff front, the president says the US could reach a trade deal with India while casting a doubt on a possible deal with Japan. Remember, India and the US have been negotiating a trade deal before the July 9 deadline. Trump's assertion that it will be a different kind of deal has set the stage for the final round of negotiations. Listen in to what the president had to say on this.
I think we're going to have a deal with India, possibly. And that's going to be a different kind of a deal. It's going to be a deal where we're able to go in and compete. Right now, India doesn't accept anybody in. I think India is going to do that. And if they do that, we're going to have a deal for much less tariffs. We have a great relationship, great reliance, and really a great sort of a partnership in a way. But on trade, they've been very unfair. And those days are gone. So what I'm going to do is I'll write them a letter, say we thank you very much. And we know you can't do the kind of things that we need. And therefore, you'll pay a 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know. And it's very unfair to the American people.
US President on the whole host of issues on a trade deal with India, also on a potential deal with Japan. Now, we also spoke to Mukesh Aghi, who is the president of the US-India Strategic Partnership Forum. Listening to what he had to say on these ongoing negotiations.
I think the discussion in Washington, D.C. is all about closing a big deal, and the big deal would be India. It's going to be an interim deal. It's not going to be a final deal, because some of the bigger issues, such as agriculture, such as dairy, such as GMO, they will come in part 2. But part 1 is let's close the deal, get the business moving forward, and bring in more certainty rather than having an uncertain environment between the two countries. Well, when you say reciprocal, that means if the US is going to put 10%, then India should put 10%. You can't have one country at 0, other country at 10 itself. The whole objective of renegotiating a trade deal was early on, where India's weighted average tariff was in double digit and US was in single digit. And the whole objective is to bring parity here. So I think if US insists on 10%, then India will also insist on 10%. And we are seeing that US is putting major tariff on Canadian, European, and Japanese steel. So it'll be an exception if India gets it down to 10%, but let's wait and watch.
Well, we also spoke to 2 industry leaders on the possibility of a trade deal with the US and what that could mean for their businesses. Let's listen in.
In terms of what happens to US-India trade deal, and in general what US does with sort of reciprocal duties beyond 9th of July. And if that settles in favor of sort of India versus rest of the world, we will definitely see demand pick up. But at this point in time, I think customers are waiting to get full clarity. And sort of, we expect that clarity to emerge in the next couple of weeks time frame.
Approximating about 15 to 18% on an average for the goods that we send. And then there is a 10% tariff on top of it. I think if that status quo remains, what is relevant for India is what's the relative tariff. So there is a bunch of countries which are exporting to United States, ranging from China, Vietnam, Bangladesh, India, to several more countries. So it all depends on relative tariff as to how our competitive landscape will be. We also need to know whether it's 10% or even higher, the incremental tariff. So that also needs to be seen.
Well, the other big news from overnight is the US Senate voting in favor of Donald Trump's big, beautiful bill. The $3.3 trillion tax and spending cut bill passed the Senate following a dramatic 51-50 vote. In the end, it was Vice President J.D. Vance who cast the tie-breaking vote. The bill includes $4.5 trillion in tax cuts and $1.2 trillion in spending reductions. It now moves back to the House before it moves to Donald Trump for final approval.
Well, in more news, US President Donald Trump and Elon Musk have reignited their bitter feud. Speaking to reporters on Tuesday, President Trump threatened to deport Musk and strip his businesses of federal funding following Musk's public criticism of the president's flagship spending bill. When asked directly if he would consider deporting the Tesla and SpaceX CEO, who has held US citizenship since 2002, Trump said, and I quote, "We'll have to take a look." Later that night, he also posted on Truth Social that the Department of Government Efficiency, which is DOGE, may need to take a good hard look at Musk companies. Let's listen in.
I think what's going to happen is Doge is going to look at Musk. And if Doge looks at Musk, we're going to save a fortune. Thank you very much, everybody. I don't think you should be playing that game with me.
Meanwhile, amidst the war of words between the two, Elon Musk has praised the president for resolving several conflicts in his second term.
Moving on to some developments in Gaza then, US President Donald Trump has urged Hamas to accept a 60-day ceasefire with Israel. More on this in this report.
U.S. President Donald Trump urged Hamas militants on Tuesday to agree to what he called a final proposal for a 60-day ceasefire with Israel and Gaza. Trump on Truth Social said Israel had agreed to the conditions to finalize a 60-day ceasefire, quote, during which time we will work with all parties to end the war. He also said representatives for Qatar and Egypt would deliver what he called this final proposal to Hamas. And were the Iran-backed group not to accept this deal, Trump said the situation in the Middle East would, quote, only get worse. The president told reporters earlier in the day that he is hopeful that a ceasefire for hostages deal can be achieved next week between the two sides. He is set to meet Israeli Prime Minister Benjamin Netanyahu at the White House on Monday.
We're also going to talk about Gaza. We want to get the rest. We got a lot of hostages back, but we're going to talk about Gaza.
The war in Gaza was triggered when Hamas-led militants attacked Israel on October 7, 2023, killing 1,200 people and taking 251 hostages, according to Israeli tallies. Gaza's health ministry says Israel's subsequent military assault on the coastal enclave has killed over 56,000 Palestinians. Hamas has said it is willing to free remaining hostages in Gaza under any deal to end the war, while Israel says it can only end if Hamas is disarmed and dismantled. Hamas refuses to lay down its arms. Throughout the conflict, the two sides have shown little sign of a readiness to budge from their entrenched positions. Trump and his aides appear to be seeking to use any momentum from U.S. and Israeli strikes on Iran nuclear sites, as well as a ceasefire that took hold last week in that conflict, to secure a lasting truce in the war in Gaza.
Take a short break. There's some more selling pressure now for the markets. The Nifty now at the lowest point of the day, 100 points lower. We continue that on the other side. Stay tuned. Welcome back. Now, amidst a spate of sudden unexplained deaths, particularly in young adults, a new study by the government agency ICMR and the All India Institute of Medical Sciences has conclusively established no link between the COVID-19 vaccines and the sudden deaths. The study shows lifestyle and pre-existing conditions such as the key factors behind these deaths. The study sees no major change in the patterns of causes compared with previous years. Now, in most unexplained deaths, genetic mutations have been identified as a possible cause. The final results will be shared once the study is complete.
Well, Prime Minister Narendra Modi embarks on his week-long visit to 5 countries: Ghana, Trinidad and Tobago, Argentina, Brazil and Namibia. This 8th-day tour is his longest foreign trip in a decade. This will also be his first ever bilateral visit to Ghana. The tour is aimed at expanding India's ties with several key nations of the global south. He will also participate in the crucial BRICS summit in Brazil.
With that, we call time on this edition of Business Lunch. We leave you with the markets at the day's low. As you can see on the top of our heads, the mid-cap index is now down 300 points. The Nifty too at the day's low. From Amakshimi and the team that put this show together, thank you so much for watching. Mid-cap radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vivek Iyer. Well, red-looking screen. The cuts have actually extended. Bank Nifty is the one which is putting a lot of pressure. Midcap, which briefly came in the green, is back in the red again.
That's right. Good afternoon, Sonal. And what's actually transpired is, especially in the last 15 minutes of the session, we've seen the fall extend quite significantly, especially in the broader end of the markets. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks slipped to the day's lowest point as India and US continue to engage on a possible trade deal. Metal and consumer durables show some green, while realty and financial services sulk. Midcaps fall in line.
Inox Wind trades higher after Motilal Oswal initiated on the stock with a buy rating with a target of 210 rupees. The brokerage expects company to deliver strong EBITDA CAGR of 38% over FY25 to FY28.
Dream Folk Services CMD Liberata Khalat speaks out, saying pressure from airport operators caused ICICI Bank and Axis Bank to pull back on key programs. The provider of airport lounge services hopes to build other verticals to offset the pressures on its core business.
Keystone Realtors gains after the company selected by 8 housing societies as developer of a large-scale cluster development. Total gross development value at 3,000 crore rupees from this.
HDFC Bank arm, HDB Financial, debuts on stock exchanges at an 13% premium to the IPO price in a positive listing. The MD and CEO Ramesh Ganeshan tells CNBC TV18 the fund infusion will help drive growth.
Okay, those are the top headlines. We'll discuss some of this in greater detail as well. For the markets, a 140-point cut is what we are witnessing on the Nifty currently, and that has come in on the back of that pressure that we are seeing on the Bank Nifty at the day's low. In last 10 minutes, the fall has been sharper. So the Bank Nifty is down around 1% right now, and most of the sectoral indices are in the red right now, barring metal and auto. The IT index, which was supporting Nifty in the morning, has also turned red. Do remember, all these stocks will be in focus because we are entering the earnings season as well. So that space continues to be in focus. Mid-cap seeing a bigger cut. That one is down around 0.6% as we speak.
That's right. And, like you mentioned, it's some of the NBFCs and banks that are taking a bigger knock today. Have a look at a name like Cholafin, have a look at a name like Shriram Fin. Two large NBFCs today are seeing significant selling pressure and near the day's lowest point. But a whole host of other stocks is what Hormaz has. This is our special segment, Midcap Movers. Hormaz is standing by the wall to take us through the midcaps that are buzzing in the session.
Well, after the kind of outperformance that we have had in the recent times, a screen like this does not look pretty at this juncture, with the midcap index down almost at the lowest point of the day. Start off with the losers then in the broader markets. Profit booking continuing in Narayana Health. Another 5% knocked off in this stock today. Reddington is down 5% as well. And Hyundai Motors, after its sales numbers yesterday, is at the lowest point of the day. NCC2 is trading at the day's low, almost with cuts of around 4%. It's some of the other movers in today's trading session, and they are the metals. They are the ones that are bucking the trend as of now. Welspun Corp is up 3%. SAIL, JSPL, names like Vedanta also doing fairly well for themselves in today's session. If you take a look at some of the other movers, the names that are doing well on the volumes front, you look at RITES after an order win, 5.5% higher. Kajaria, Sagility and RBL Bank has had very choppy moves today. It opened higher, it fell to the lows of the day, then it recovered those losses, and now it's back down to the lowest point of the day, 3% lower on that stock as well. The tire stocks that are doing well for themselves in today's trade. But before we get to that, you look at Sigachi, the newsmakers in today's session. Keystone, second straight project in 2 days. Ola Electric, a block deal took place in the stock earlier in the day, and Tata Communications after that positive note coming in from Macquarie, and as a result of which the stock trades with gains of around 5%. Back to you guys.
Okay, all right. Thank you so much, Hormaz, for joining us with that list. A lot of stocks on our radar. But with that, we'll take a break. But remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists, shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. It's time to talk about some fundraise. Marathon NextGen has successfully raised 900 crore rupees via the QIP route. To discuss this fundraise in detail and the business outlook going forward, let's get in Mayur Shah, who is the Vice Chairman at the company. Mr. Shah, good afternoon. Thank you so much for joining in. Well, 900 crore rupees, that's a big amount. What are the plans to use this money for? And if you can detail the plans going forward as well with this fundraise.
Yeah, good afternoon, Sonal. We have raised 900 crore and out of this, 300 crore is for the reduction of the debt. And the balance is the growth capital. We want to acquire more projects and going forward from our upcoming projects, investments. So Marathon has been able to do two big corporate action in last 3 months. One more thing which Marathon has done is a scheme of amalgamation was announced and approved by the board, whereby almost 418 acres of the group land has been merged into the Marathon.
Understood.
The merger will take around 9 to 12 months, but the board has already approved and it is right now in the process of a merger. So that way, these are the two major corporate actions like raising 900 crore and as well as merging all the group land bank into the Marathon.
Understood that. So the rationale for the merger was to amalgamate the group land bank into the listed entity. Give us a sense of the rationale for the QIP as well in terms of the shareholding. What was the promoter shareholding, number one, in the listed entity pre-merger? In the unlisted entity, we are assuming you held a complete stake over there. Post the QIP, almost a 30% equity dilution was done. Post the QIP, what will be the promoter shareholding? Does it fall below the prescribed SEBI limit of 75%? And also, is there any tax angle? Would you be bearing a higher tax burden post this particular amalgamation?
No, the rationale was, to have efficiency coming in from all the group land bank into the listed entity. What we have seen, we are targeting is the post-merger. Right now, the dilution is of approximately 17% when we are raising 900 crore. But the post-merger after nine months or so, we are coming back at 74.5% because of 3,200 crore worth of the land and the assets which are getting merged into the Marathon.
Can you repeat that number again? You said post amalgamation, the promoter holding would be around 74.8%, if I got that number correct.
Yes, 74.5.
74.5%. Okay. So a follow-up on the promoter holding itself, Mr. Shah, the BSE website shows there is a major pledge on promoter holding. Can you explain the impact now? How much of it will go away?
Frankly speaking, there is no pledging of a Marathon shares. Basically, there is one NDU, not to reduce our percentage holding in a group company was actually registered and it has been misreported, and we have already returned to the SEBI and the stock exchanges to correct the effect, because there is absolutely zero percentage of pledging of shares of Marathon NextGen as it stands. And I think they are going through a correction.
Okay, so what is the final pledge? What will be the pledge post the correction?
There is no pledge.
There is no pledge. Okay.
Absolutely zero pledge. Actually, we have registered one NDU which has been misinterpreted as a pledging of a shares.
Understood. Mr. Shah, one question. Pre-merger with the group entities, what was the total debt on books? Post-merger, are you assuming any debt from the promoter entity? What is the cost of finance? And post-merger, do you expect to see that reducing?
Yeah. So Marathon NextGen has been having a robust 2024, and whereby we have reduced our debt of the listed entity by almost 200 crore, and highest ever PAT of 190 crore was reported in March 25. In the merge scenario, we have another 550 crore debt coming in. However, so altogether, let's say, as it stands, around 1100 crore of total debt in the merge entity, out of which, again, during this year, we intend to repay through our cash flow almost 50%, and we are also repaying through the QIP funds approximately 300 crore.
Okay, so you will be left with around 200 crores of debt by the end of this year.
Yeah, we are targeting around that.
Okay, so that's about the balance sheet. Let's talk about your operational update. In terms of sales, what are you targeting in FY26? You did around 600 crore rupees. What are the launches looking like? And will you continue to focus on Mumbai micro markets?
Yeah, basically we have clocked almost 873 crores of a pre-sale in last year, and we are looking at almost 20% growth in that number. And for the launches, like we already have 65 lakh square feet of construction development is going on in Mumbai MMR, Panvel, Bhaikala, Bhandup, and Dombivli. These are the micro markets which we are focusing on. And from the acquired land bank of Marathon Next Gen, we will be launching, we have another 50 lakh square feet of launch capacity, out of which we intend to launch around 2.2 million square feet, 22 lakh square feet during this year.
So, Mr. Shah, 22 lakh square feet this year. Out of that, what will be through Marathon route, what will be through the JDA route, or any other JD or JV route, and what will be the support that you get in from your partner?
Yeah, so basically when I say 22 lakh square feet is already acquired land bank of Marathon, but out of this growth capital of another 600 crore which we are targeting is an asset-light model, JDA and JV in Mumbai MMR region. Particularly, we are looking at society redevelopment, cluster redevelopment in the central and south Mumbai. And we already have tied up a couple of those schemes. At appropriate time, we will announce the JDA for the same schemes.
All right, so we'll come back to you again and have that conversation about the new updates with respect to business. Thank you so much, Mr. Shah, for joining us today with those updates about the fundraise and most importantly, the amalgamation that has been ongoing for a while now. With that, we'll slip into a short break, but as we do that, here's some good news for our viewers. India's business news leader is now click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back to Mid-Cap Radar. Well, what's actually transpired, especially in the last 20-25 minutes of the session, has been the fact that the sell-off has intensified quite a bit. Some of the names, especially some of the NBFCs, we highlighted Cholafin. That particular stock has seen further selling pressure emerge, and Cholafin down almost 4% in the session. Along with that, some of the gold NBFCs today have seen quite a bit of selling pressure emerge, especially throughout the course of the day. In fact, look at a name like Muthoot Finance. That particular stock down almost 1.5%. Manappuram Finance too also falling in tandem with Muthoot. But yesterday you did see a pretty significant development coming in as far as Apollo Hospitals was concerned. The company went ahead and announced a corporate action where they, planning to demerge the healthco and the diagnostic business into a separate entity. To talk on this and a lot more, Kunal Damesha, who's the pharma and healthcare research analyst at Macquarie Capital, joins us. Thank you so much, Kunal, for joining us. First up, what do you make of this particular deal? How does it impact the valuations of Apollo Hospitals? So far, analysts were concerned that it was not getting the valuation it deserved compared to other hospital stocks. Does this now free up space?
So, this separation of the pharmacy business from the hospital business, I would look at it from, two angles. One is from the existing investors angle. I think nothing changes, much from the existing investors angle, because they were already part of the journey on both of these businesses. But let's say when this new business gets listed, that changes any new investors who just want to take part in whether hospital business or in the pharmacy business. It makes their life much easier to choose which secular growth tailwind they want to be part of. Apart from that, on the valuation front, there is a belief that Apollo Hospital used to get a discount versus the other hospitals.
Right.
As far as I am concerned, I value Apollo Hospital based on SOTP, and within that I value their healthcare business EBITDA at par with the other Indian listed hospital peers. So for me, there was no holdco discount, etc., that I was implying within the overall Apollo Hospital valuation.
Kunal, the company has a target of around 25,000 crores and margins of 7% by FY27. Do you think that is quite aggressive? What do you make of different entities and the entity altogether as well right now?
So I would highlight that the target in my view is aggressive, and I think they also kind of understood that it's an aggressive target. This target was first put out when the Advent deal happened sometime last year, when Advent infused $300 million in the business. At that point in time, the company had suggested that this combined pharmacy business would do revenue of 25,000 crore by FY27. And they had suggested it would do 7% EBITDA margin on pre-Ind AS 116 basis. Now, when I look at the current announcement, what has changed is the revenue target of 25,000 crore is now being put out as the exit run rate on FY27. So FY27 is expected to be lower than that. So I think the top line guidance has been lowered to that extent what we had got last year for the same business. And then the pre-Ind AS 7% EBITDA margin target, which was shared last year, has now been changed to post-Ind AS EBITDA margin target of 7%. Now, important thing here is, because of the fundamentals of the business, there is a difference between the pre-Ind AS EBITDA margin, which would kind of take out the rent expense from the EBITDA, versus post-Ind AS, the rent expense moves to depreciation and interest expense because of the lease accounting. And hence, I would say effectively, this now post-Ind AS guidance of 7% EBITDA margin is a downgrade from earlier pre-Ind AS EBITDA margin guidance of 7%.
Understood that, Kunal. Thank you for explaining that very clearly. Kunal, also one thing which you want to understand is just stepping out a little bit from Apollo Hospital. You called FY26 as the year of capex as far as hospital chains were concerned, and you said that there was a good chance that return ratios could be compromised. Most of the companies, wherever they've spoken in conferences, have actually said that capex expansion will be done along with maintenance of return ratios. Your view, and what are your top picks in this particular space?
So I would say if I look at the top 8 listed hospital within Indian market, the management of these hospitals have guided to add almost around 15 to 16,000 beds over the next 3 years, right? And this expansion is roughly 4 times of what these same companies have done in last 5 years. So last 5 years, they've added 3,400 beds. Now they are guiding to add 16,000 beds. So one, the next 3-year expansion is very large. Secondly, the ARPOB growth, which used to be very high between FY19 to FY24, the CAGR has been almost around 11%. That has now moderated in FY25 for most hospitals to its historical range of 6 to 8 percentage points. So my sense is that the margin expansion which happened during the last cycle because of strong ARPOB growth, etc., is not going to sustain going forward, and hence the profitability in the existing hospital might not improve as much as we have seen in the last 5-6 years. And then new hospitals being high fixed cost business will initially put some drag on the profitability, because any new hospital typically breaks even at around 45 to 50% occupancy level. And before that, it causes EBITDA drag. So my sense is there will be profitability compression, and that would translate to ROC compression while these new hospitals ramp up.
All right. Thank you, Kunal, for joining us and giving us your take on the hospital space and in particular Apollo Hospitals. With that, we'll take your leave on this edition of Midcap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala and thank you so much for tuning in as always. This week seems like it's a bit of a consolidation that we're seeing coming in after the run-up during the last week. Now, Monday, we saw a fall. Yesterday, a muted day. And today, again, a fall coming in for the Nifty 50. Even as of now, Nifty 50 is below 23,400 levels as of now. 25,400 levels, I beg your pardon. So 25,300 mark, and around that level is what? Okay, it's again back to that 400, but yes, it's flip-flopping around those levels. So keep an eye out on that. It opened up in the green and then we saw the fall coming in. Let's look at what the broader end of the market is doing as well, because that doesn't seem to be outperforming too much versus the benchmark indices. So mid-cap also down with the benchmark indices 0.4%. Small cap is also trading with cuts in today's trading session. So yes, that's down 0.6%. So nothing interesting that's happening here. The only run-up that we're seeing coming in today's trading session is from the metals pack. So keep an eye out on Nifty Metal and the metal names over there. That's managing to hold on to some bit of a green. And autos, mild green today. Mild green coming in for the Nifty Auto as well. Among the top sectoral losers, we have Realty, PSU banks that are down and out in the trading session today. But this is a show where we solve all your stock-related queries, and that's what we'll be doing. To solve all of that, we have Richard Jain, Head of Equities, Technical Research, Wealth Management at Motilal Oswal Financial Services, and Parthiv Shah, Director at Tracom Stockbrokers, to answer all your stock-related queries. Good afternoon, gentlemen, and thank you so much for joining in with us. Richard, after the run-up that we saw last week, now, what are the levels that we should keep an eye out on? Because 25,400, it slipped below that mark today as well. How important are the levels? Which levels should we keep an eye out on now for the Nifty?
Yes, very good afternoon, Vinny. Well, overall, we think that we should see some sort of consolidation in the short term, primarily because of the negative market breadth since last couple of trading sessions. And also, if you look at the RSI setup along with the price up move in the mid cap and the small cap space, along with even the bank Nifty space, there has been some negative divergences over there too. So although the broader trend remains intact, but usually we see such corrections which are known more of a time-wise correction within an uptrend. And major support for Nifty should come in around 25,300 to 25,250 zone. So I think that in the short term, we would see some time-wise correction or consolidation, and there would be more of a sector rotation which could go on, such as we can see that banking, financials witnessing some profit booking. Cement is one space where fresh breakouts have been seen today. So I think index would stay within a range, but sector rotations would be seen in the next few days.
Okay, important to watch out for there. But let's move on and get started with those stock-related queries. And the first query for today is coming in from Narasimha, who's writing to us from Hyderabad, holding 250 shares of KPIT Tech. Price is 1,558 rupees per share. So they're making a loss on this one. Wants to know whether he should hold or look to sell at the current levels. Parthiv, afternoon, and what are we watching out for in terms of KPIT Tech, mid-cap IT? What is the view coming in here as well? And also, does it merit maybe averaging, given that the stock price has seen a fall from their buy price?
A very good afternoon to you, to Vinny and Richard and our viewers. I do believe that it does make sense to add on to this position. I think the key reasons being that if you see the revenue growth, I think this is one of the mid-cap IT companies which has delivered stellar revenue growth of almost 15% year on year on a constant currency basis. More importantly, the EBITDA margins have held up very well. When we saw a lot of other peers were struggling with their margins because of attrition issues and the billing issues, I think this company has delivered almost 21.1% margins, which are growth as compared to year on year when they used to deliver somewhere around 18.5%. Also, very importantly, I think if you look at the total contract value, the deal closures, they've closed Q4 with almost $280 million worth of deal. I think this is one of the highest quarterly TCVs that this company has ended with. Plus, I think inorganically also this company has been pretty active. And our sense is that, for FY26, I think there is very good possibility that this company can grow to the tune of anywhere between 15 to 18%. And that is the key reason why, despite the slightly elevated valuations of around 34 trade multiple, I believe that, one can add on to this position and the run rate for this company looks really good.
Okay, run rate for the company looks very good. Maybe can add on to this position is what's the word coming in on the fundamental front. But on the technicals, Richard, KPIT Tech, what are we watching out for? Because last 6 months also it's seen those ups and downs, but overall a 16% decline. So on the technicals also, would you suggest the viewer hold or maybe add on to some position instead of selling?
It seems that the stock is going through some sort of time-wise corrective phase where 1150, 1200 is a good support at the lower side. But frankly, if I look at the technical structure of KPIT versus some of the other IT names which have done well in last few weeks, I think there has been some relative underperformance, at least in the short term, over the other names. Technically, I think Tech Mahindra looks much better poised in case of a run-up move or any kind of uptrend is there in the IT names. Then I think a relative outperformance could be seen in Tech Mahindra within this space. So KPIT Tech does not look much negative, but maybe it would continue to consolidate. So I won't recommend adding new positions to it. If he, in case he wants to make a switch, then Tech Mahindra could be a better option.
Okay, Tech Mahindra will be a better option is what you are highlighting. Let's move on to the next query for today, coming in on two pharma names. This is from Radha Krishnan, who's writing to us from Bangalore. She's holding 500 shares of Piramal Pharma. This is at a price of 240 rupees per share, and 1,000 shares of Morpin Labs, and this is at a price of 81 rupees per share. So for Piramal Pharma, she's making a loss. Morpin Labs also, she's making a loss. She's saying her investment horizon is just 6 more months and wants to know whether she should hold, continue to stay invested in this one, or maybe book her losses. Parthiv, what's your view coming in? Piramal Pharma had come out with their annual report as well recently. They've given that vision FY30 for them as well. 3x in terms of EBITDA growth is what they're expecting to see. 2x in terms of overall revenue growth in the next 5 years. So what are we watching out for here? Piramal Pharma and Morpin Labs.
First on Piramal Pharma, if you look into the run rate of the company, I think they delivered $1 billion worth of revenue in FY25. And I think the management has given a very realistic target of touching almost $2 billion over the next 5 years. I think we believe that the way they've set up their capacities, the way they've done a lot of inorganic acquisitions, especially in the CDMO space, and based on the commentary that a lot of customers from UK, US, are giving a lot of inquiries in terms of newer pipeline of orders. And I think the management has delivered exceptionally well since the last 2 quarters in the CDMO side of the business, where I think the margins have also held up pretty well. So our sense is, I think it could be lumpy 1 or 2 quarters going ahead. But more importantly, I think if you look into a 2 or 3 year horizon, I think Piramal Pharma is looking very attractive. Even the other businesses, especially the hospital generic business, and more importantly, I think the consumer side of the business, all of them, I think, are doing reasonably well. And they are also, I think, expected to grow at the rate of 12 to 14% over the next 5 years. So I think the management has its act together and they are building in facilities and going ahead, looking at the trend of the CDMO business. I think it's looking interestingly poised and one should hold on to this for the next 2 to 3 years.
Okay, hold. And Morpin Labs?
I'm sorry, I don't track Morpin Labs.
Okay. And Ruchit, your view coming in on both the stocks, Piramal Pharma as well as Morpin Labs. Piramal Pharma last 6 months around a 21% decline. Morpin Labs also has been quite muted and seen a 21% decline as well. What should we do with both these pharma companies? What should the viewer do? Hold or book their losses?
I think Piramal Pharma has seen a price-wise correction since the month of November 24, but these are not the levels where one should look to exit. Finally, because after the price-wise correction till the month of February, I think the stock is going through some consolidation phase, but this entire consolidation is above its weekly 100 EMS support. So price-wise downside, I think, seems to be very limited from here on. Maybe some more consolidation and the stock should see a move over next 6 months if towards 240, 250 kind of range. So these are not the levels where one should look to book losses, but rather continue to hold on your existing positions. You should get levels around 240, 250 where you can take a review again for the stock. I think I have similar view for Morpin Labs as well. All the corrections that we have seen have been more of a time-wise correction rather than significant price-wise corrections over last 2 or 3 months. And 58, 57 seems to be a good support for the stock for now. But yes, for Morpin, I would recommend keeping a strict stop loss below 58 rupees. And if that gets breached, then that could change the trend for the stock.
Okay, so keep an eye out on those levels over there and a strict stop loss for Morpin Labs specifically. So keep an eye out on that 58 mark for the stock there. Let's move on to the next query for today. We have Venkateshwar writing to us from Tamil Nadu, holding 200 shares of Zen Technologies. Price is 600 rupees per share. He's asking whether to hold or look to sell at the current level. So he's been holding it for a while. Zen Technologies as such has also seen a very good run up. Parthiv, your view coming in for Zen Technologies?
Extremely well placed, and defense sector is buzzing and they deliver a lot of simulators in the drone segment. And we know globally, I think it's going to be like drone warfare. And if you look at the order book of the company, I think their standalone order book was sitting at around 700 crores. And the management is expecting, orders of around, order inflow of around 800 crores by H1, which is, I think, definitely a very good pipeline. And the management has talked about, long-term CAGR growth guidance of around 50% over the next 3 years, which is, I think, stupendous. And from the current base, it seems also achievable. So we believe that I think it's a very good long-term hold. No doubt, I think on a trail basis, the valuations will look very, very elevated. But if the management is able to kind of deliver the growth numbers that they have just guided for, and also more importantly, if they're able to maintain the operational margins at around 30-35%, I think it does tend to justify the current valuation. So certainly hold on to this for a long term. It's a very good proxy defense play.
Okay, very good proxy defense play coming in on the fundamental front, and continue to hold on is the view on the fundamentals. On the technicals also, is hold the view coming in, or should the viewer maybe book out some bit of a profit right now?
The overall trend for the stock still seems positive. Price up move supported by good volumes. Recent small dips that we have got, we have not seen any kind of volume-based selling happening on dips. So I think this is a good structure. As once this small corrections get over, then the stock should resume its broader uptrend. So downside seems to be very limited from here on. 1800 to 1815 is a good support zone. So I would also recommend to hold on to the stock.
Okay, hold on to the stock right now, Zen Technologies, from both the fundamental and the technical point of view. Next query for today is also again a defense name that we have. Giri is writing to us from Bangalore, holding 800 shares, I beg your pardon, of Bharat Electronics. And this is at a price of 310 rupees per share. Wants to know if he can hold his shares for one more year or maybe just get out of the stock. So he's bought it at 310, making a profit on this one. Parthiv, your view, given that it's a defense story, similar story, should BEL also be a hold?
Yes, absolutely. And I think I would rate Bharat Electronics as one of the finest PSU defense plays in terms of how well they've executed, how well I think they've diversified their order book. It's not that here in this company, they are overly kind of dependent on one segment of defense spending. In fact, I think this is one company where, though currently 81% of the revenue and the order book is coming from the defense segment, but they are also looking at aerospace as a segment. They are also very eagerly looking at exports, because currently the exports is only 4% of the revenue. But going ahead, looking at the inquiries that they've got and what they've messaged to the market, I think definitely export as a share will go up. And when I think India is talking about increasing its defense export from 25,000 crore to levels of 50,000 crore, players like Bharat Electronics, I think, will play a major role. So we are very upbeat on this company. No doubt, I think recently post Operation Sindoor, this company has also run up a lot. But I think on any correction looks very attractive. And as we talk, this company is sitting at an order book of almost 80,000 crore plus with a lot of other inquiries. So certainly the execution track record has been good and the long-term output looks also interesting.
Okay, that's the view coming in there for BEL. And your view, Ruchit, for BEL as well. Would you suggest a hold for this one as well?
Yeah, so it has been one of the strongest stocks within the defense space also. Even when we have seen small bit of corrections, recently in some of the defense name, we've not seen any such correction in BEL. So any minor corrections even towards the 20-day exponential moving average support are getting bought into. So overall remains an outperformer within the sector, and that it should continue that move over next few quarters, I think. So continue to hold on to BEL. Any kind of dips if we get, then there should be used as an opportunity to add more.
Okay, that's the view coming in there on BEL, and can use it as an opportunity to add more. That's the word coming in on the technical front. But on that note, we're going to actually step into a very short break. And as we step into the break, remember to tune into all new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
investing.
Welcome back to Your Stocks on CNBC TV18. We still have with us Richard Jain as well as Partha Shah to solve all your stock-related queries today. Now, let's move on to the next query for today. We have Srinivasan, who's writing to us from Bangalore, holding 200 shares of JK Lakshmi Cement. This is at a price of 830 rupees per share. They're making a profit on this one right now. The stock is trading at 986 rupees. Wants to know if he should continue to hold or look to sell and book out his profits. Partha, your view coming in on JK Lakshmi Cement?
Last quarterly results, and the company delivered EBITDA per ton of almost 1250 per ton, and that was, I think, one of the highest in the industry. No doubt, I think this has also come with lot many years that they've put in terms of improving the operational excellence and adding a lot of cost effective synergies like waste heat recovery, renewable sources of power, things like that. And I think if you look at the long-term target, how the company is placed, I think currently they're sitting at around 16 million tons of cement capacity. And over FY30, I think FY29, they're looking to up that to around almost 30 million tons. And I think they've given a very good roadmap, and they also have a subsidiary company called Udaipur Cement, where they hold almost 75% stake, where also they have some expansion plans in the grinding unit. So overall, I think this is the year where we feel that the cement company should deliver a lot better numbers in terms of profitability and volume growth. And as against the industry volume growth of 5 to 6%, this company is targeting to grow volume by around 10%. So we believe, I think this is a good year to hold this company, and certainly don't book out early.
Okay, that's the view coming in there for JK Lakshmi Cement on the fundamental front. But on the technicals, Richard, what's your view?
Technically, I think cement as a space is poised to deliver good returns over next 2 or 3 months. The kind of breakout that we have seen in many of the cement names such as UltraTech Cement, Remco Cement, or even JK Lakshmi Cement, last 3-4 trading sessions, the price of moves have been supported by very good volumes. I think this momentum should continue over next more 2 to 3 months. So we are quite bullish on the entire space, cement space as a whole. And JK Lakshmi Cement definitely can do well from current levels also towards 1150 to 1200 in the near term.
Okay, that's a view coming in there on JK Lakshmi Cement on the technical front. Next query for today, we have Moni Dey writing to us from Kolkata. She's holding 150 shares of Zaggle Prepaid Services. Price is 450 rupees per share. Wants to know if she should continue to hold or exit the stock. Zaggle Prepaid, what are we watching out for here, Parthiv? And does it merit continuing to hold the stock or maybe sell and look at some other name?
It's an interesting name, no doubt. And I think the company has been growing pretty well. And if you look at also the guidance that they've given, I think it is pretty aggressive. They're talking of growths of around 35 to 40% and standalone EBITDA margins of around 9 to 10%. So I think they are looking to inch up the margins as well with better operating leverage and go to the tune of 12 to 13% over the next 2 to 3 years. Our sense is that after the recent correction from the peak valuation levels, I think this company is looking a lot more interesting now. And I think the management has executed reasonably well. They have very good active customer share across the corporate industry, which are growing well. And the churn rate has stayed below 1.5%, which is always a good thing. So currently they're sitting on 3.28 million active users, which is inching up and growing up. So I think certainly suggests this is a good hold for the next 2 to 3 years.
Okay, good hold coming in for the next 2 to 3 years on the fundamental front. On the technical front as well, Zaggle Prepaid, what are we watching out for in terms of levels now, Ruchit?
The stock is consolidating in a range, but the good thing is that this entire consolidation of last few weeks is above its 200-day moving average, which is in the range of 400 to 390. So can continue to hold in this consolidation, but if it's a trading positions or a short-term positions, then I would recommend to keep a stop loss below 390 on existing positions.
Okay, so keep an eye out over there for Zaggle Prepaid and the levels over there. Next query for today is coming from KS Rao, who's writing to us from Andhra Pradesh, holding 100 shares of All Cargo Logistics. 73 rupees is the buy price. They're making a loss on this one. Long-term investor. So he's saying he's ready to hold it for 2 more years as well, but wants to know if it actually merits holding this stock for 2 more years. All Cargo Logistics, what's the view here, Parthiv?
We are not very upbeat on this particular logistic player because one, I think the valuations seem to be very, very elevated. And I think they've faced a lot of challenges on the geopolitical front and the tariffs and the global trade, which has impacted their business and the volumes. And I think overall the environment is still looking dicey, and that is what the management has also concurred with. And we are not expecting FY26 to be a very blockbuster growth year. And because it's quoting at a trade multiple of around 70 in terms of price to earning multiple, I think it is looking very expensive. I think we are better off focusing more on the domestic players, ones like Delivery, who have started turning around. And we believe it's better that the investor switches his position from all cargo into names like Delivery.
Okay, and all cargo logistics, what's your view coming in on this one? Richard, does it merit just getting out of the stock now?
Yes, mainly because of the relative underperformance when the broader markets had done well over last few months. We have seen most of the names where the broader markets have seen a rally. We have not seen any kind of price up move supported by good volumes in all cargo logistics. So this underperformance could continue. There could be some better opportunities in the markets. Delivery, maybe the technical is also looking positive, which Parthiv just told. So making a shift seems to be a logical idea.
Okay, making a shift seems to be a logical idea both on the fundamental and the technical front. But that was the last query for today, gentlemen. So Parthiv as well as Richard, thank you so much for joining in with us and always helping us solve our viewers' stock-related queries. And viewers, thank you so much for always sending us your queries. Remember, you can always email us your queries on the email address that is flashing at the top of your screens. But with that, we'll wind down today's edition of Your Stocks on CNBC TV18. Thank you so much for tuning in. Don't go anywhere. Up next, you have Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
A decline of around 0.3%. We're seeing the Hang Seng that's opened up in trade today with a gain of 0.5%.
I have a deal with India, possibly, and that's going to be a different kind of a deal.
The stock that I'm going to be looking at is Vedanta. You know, it's been holding and protecting that 20 DMA for the last many trading sessions.
So the implied open was spot on because we've started 50 points higher. Nifty closing in on 25,600 now.
Moving Apollo Healthcare as well as the telehealth business into the new company.
We have a festive season coming as well. We are starting to see some momentum in the rural segment.
Are grinding slightly lower. Sonal, we're heading into the weekly expiry tomorrow, but this potential trade deal between India and the US is proving out to be a bit of a sore point.
There is a pressure built up not just on the clients, but the pressure is also built up on dream folks as well.
140-point cut is what is we are witnessing on the Nifty currently.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. For the markets, we've given up all our early gains. So the Nifty is now slipped to levels of 25,400. After opening flat this morning, markets have headed down through the course of the day. Pressures visible across sectors, but it's the Nifty Bank which is underperforming quite sharply. The Nifty PSU Bank has also snapped its 6-day winning streak. So looking at some of the top Nifty losers, we're tracking sharp cuts across Shriram Finance, IndusInd Bank, and we'll talk more about the Goldman Sachs downgrade on that. But a Bajaj Finserv, Bajaj Finance, all dragging the financial space lower. On the flip side, metals are bucking the trend. The Nifty Metal Index is up close to about 1%, so that's going strong. Look at a Tata Steel, a JSW Steel leading the charge. The Nifty IT Index has cooled off. There was an intraday gain of close to about 1.5% on Nifty IT earlier in the session, but now that index is absolutely flat. And, you know, there appears to be some rotation in stocks where, you know, there is some bad news. The stocks have underperformed. Pull up something like in Asian Paints. Now, Asian Paints is now up close to about 1.5%. From the intraday low, it's recovered nearly 3%. So despite the negative news about the CCI probe on anti-competitive practices, Asian Paints has completely shrugged off that negative news. The other one is Maruti Suzuki. Maruti Suzuki is also higher by more than about 1%. Earlier, there was the news about, I mean, in the morning we were talking about how the auto sales numbers for Maruti Suzuki had disappointed the street. But on the flip side, there was also that production data that has come through. So Maruti Suzuki is up close to about 1%. So that's tracking at least the large cap action. We'll talk more about the mid caps, individual stocks like Tata Communication, Dream Folks. But how should you position yourself in the last hour of trade? Mitesh is now with us with a few closing strategies. Mitesh, you were calling for consolidation. It's slipped a bit. Is it still within the consolidation band, or are you starting to get worried? And are there any fresh positions one can take on the Nifty now?
Yeah, I think, you know, we are still in that band. I think now we are heading towards the lower range of the band. I actually talked about 25,400 as the first target. We are practically there. And in case we break below that, a good chance that we might see 25,200 being tested. Yet, I think, you know, the rally which started from sub 24,700 will still be in flows. So, one, I think getting to 25,400 means that we'll wait for some reversal on the half-an-hour chart. In case we get it, then I think, you know, we'll take this as the short-term low. And on the upside, we might retest 25,700. So the overall bias is positive. But in the near term, I think the immediate move is on the negative side.
Okay, Nifty can head to levels of 25,400. What about the Nifty Bank? You know, it did well last week, but now it's retracing a bit.
See, same with Nifty Bank. I think both the indices have a very similar kind of chart pattern. For the Nifty Bank, the corresponding support level is slightly lower. 56,600 to about 56,550. So as long as you're above that, I think it should be okay.
What about your stock calls for the last hour?
Yeah. So on the stock side also, what we've done is that we've taken some short position because we've been trading with mainly long buys. So on the stock side, I have one buy and one sell. On the buying side is GMR Airport, which is a buy with a stop bid of 86 for targets of around 92 to about 93 on the upside. And on the negative side, I have a sell on Hindustan Zinc. We'll keep a very tight stop over here, about 454, and look for a target of around 435.
Got that. Thank you very much for that. Moving on to Dreamfolk Services. That is under pressure after certain programs for Axis Bank and ICICI Bank were closed. The management did call out that this is going to have a material impact on the financials. We had a chat with the management. Vinny joins in to tell us the news and what the key takeaways were from the management interaction. Vinny?
Yes, so yeah, absolutely. There's an important news that is coming for the company. Now, obviously, certain programs, that is for Axis Bank and ICICI Bank, have been closed with effect from 1st July 2025. Now, banks accounts for a lot of a portion of the loan services that they have in tie-up with other clients, and banks are a large amount of their clients. So, big banks like this surely will impact them. The company had said that there is going to be some material impact of this, certain programs closing down by these two banks on the company's financials. The exact amount is not something that they have mentioned so far. But what the company highlighted, and what we should note also, that 93% of the services actually comes from lounge services. So it's a huge portion of the revenue actually is driven by lounge services. Now the management said that, this cancellation that actually came in for Axis Bank and ICICI Bank from both these clients was just a few hours before this cancellation actually took effect, that they were informed about this, and then they informed the stock exchanges. Other than that, they had no information that this was going to be actually happening. They highlighted the major reason for this is that two major airport operators are there who have entered into the business in the last couple of years, and they have been causing a lot of pressure on this. So airport operators are putting pressure on the clients as well, is what the management was saying, and especially ICICI Bank, Axis Bank, like these big clients is where the pressure is coming in from these other two operators, is what the company is highlighting. They also said that the client had to move from the company's lounge program to other operator program because of this pressure that came in. And currently, do not forget, 70 plus lounge services that are there across the country. 35 to 40% of these lounge services are operated by these two major operators. So that's a big concern that comes in, and we could see some bit of an impact of that financial impact on Dreamfolks. And revenue driver mainly for the company's lounge services, though they spoke about diversification to other segments as well, but right now it only accounts for 7% of their revenue contribution. So will be important to see in terms of diversification, but concerns and pressure coming in from competition was the key highlight that we picked up today.
Okay, in fact, a good time then to listen into what the management had to say in an exclusive interaction with CNBC TV18.
It was a pressure which was getting built up to the clients. Okay, it was a pressure tactics which were done. So to be very upfront, it is mainly done by these two major airport operators who have now started getting into the similar business. The pressure which has been built up is to, tell the clients that, in case if they do not sign up with them or do business with them directly, they would actually stop their cardholder access to their airports. So this is a pressure which has been built up, and these are the reasons that why these clients had to move. But let me tell you that our contracts are still in place. It is not that we were just managing the lounge program. Just the airport lounges. There are other services also which Dreamfolks provides to these clients. Secondly, also to mention that, there are around 70 plus lounges in India. However, these operators, the airport operators who are trying to get into this business, are holding around 35 to 40% of the lounges only. It was just on 30th late evening wherein we got this information that yes, there's going to be a migration, and that's the only reason. So I think we are following the compliances, and I'm very clear that I would not want to give a wrong narrative to the market. Contracts are not shut. The contracts are still on. Okay. Today also, if you actually look at it, the ICICI program is still live on our platform.
Okay, that is a big story. Ashish Chaturmutha, MD Fund Manager, PMS at JM Financial, is now with us. Ashish, by any chance, have you been following the development in the stock price action at Dream Folks, and what would your thoughts be?
Good afternoon, Rima. So, as far as Dream Fox is concerned, we don't have this stock in our portfolio, but definitely we have been tracking this space closely, and we believe that there's a huge amount of competition and kind of pressure, obviously because of the private authorities which are now running the airports, and now we are seeing a new IPO which is also going to come in next couple of days, and it is also running a lot of restaurants and lounges in the airport. So we need to see, we need to closely watch this development, but definitely from a shorter term perspective, it's a little negative. And those holding the stock, I think there's going to be a lot more pressure in the stock in coming few days and months.
Okay, got that. What about what about the entire automotive space and the kind of June data that we've got for the monthly sales? Things are still very tepid, especially on the passenger vehicle side. And considering that the base was favorable last year, same time was also the central election. So things had slowed down last year. So despite that, year on year things are weakening. What if things don't pick up in the festive season? Now all hopes are being baked in the second half of the year that things will improve in the festive season. But what if that doesn't play out?
No, definitely. So, as you rightly pointed out, there's a lot of pressure on the auto numbers, and particularly into the PV segment. We believe that the more pressure is going to be seen in the entry level, vehicles. Now, only silver lining is that if we are going to see better monsoon, so obviously the rural demand might start pick up, and if that happens, then I think within the tractor segment can do really well, and that's where we feel that Mahindra has good exposure. So I think that this is one stock which could be big beneficiary of the rural economy recovery which is going to be witnessed. Along with that, we think that whatever tax incentives which we got into the budget, that's also going to get reflected into coming few quarters, and this will lead to some amount of spending power in the hands of consumers. So this will be this data need to be watched very closely. But my sense is that whatever downside we had seen in the last couple of months in the auto numbers, it looks like we are in the process of bottoming out. But one has to be very careful about which stock and which segment one need to focus. So we are very positive on the little high-end segment. For example, companies like Eicher Motors would be beneficiary of the broader trend which we are witnessing in the urban economy. But from a rural economy perspective, I think tractor is a segment which looks promising, and from that perspective, Mahindra should do very well.
M&M's both automotive and the tractor segment did very well in the month of June. Tractor especially surpassing expectations. The stock today is on the flatter side, just down close to about 0.5%. But then it's had a great run up over the last 2 or 3 years. IndusInd Bank is the other one that we're tracking. Shares are under pressure. This is after a Goldman Sachs downgrade. So what is it that makes Goldman Sachs cautious on IndusInd Bank at these levels? Vamakshi joins in with the details.
Well, Rima, Goldman Sachs has downgraded the stock to a sell. They've got a target price of 722 rupees per share, and they say that this is because the franchise overall looks structurally weaker. The ROAs are also expected to reset lower. Now, what they also highlight is that the bank is likely to have a very weak growth trajectory as well as return trajectory going forward, even post normalization of most of the issues by the second half of FY26 as well as 27, and resultantly they've gone ahead and cut their EPS estimates by 25% for FY26 and 17% for FY27. They believe that this cut reflects likely persistent pressure on the margin profile amid a weaker yield trajectory as well as elevated funding cost for the bank. Now, what they've also said on valuations is that they are likely to stay below book on poor visibility of the turnaround. So therefore, they've gone ahead, downgraded their rating. The stock resultantly under pressure today.
Okay, thank you very much for that. Surbi and Nigel are also here with us, with me for the last 50 minutes of trade.
We were hoping, Rima single-handedly would pull the market higher back into green territory, but I think it's a bit of a tough order.
It's tough now. Yeah.
But yeah, it's slightly disappointing. I mean, considering
to come back to the studio.
The bank Nifty playing spoil sport down 1%. So yeah, for the Bulls, slightly disappointing afternoon.
Well, that's right. I believe both the batsmen are at the crease. I'm just the runner. But anyway, let's focus on a couple of stocks then. And let's focus on the index, that's holding one end up. And Ashish, I would like your view on the metals pack. Now, that index is actually doing a relative outperformance in today's trading session. During, after an hour of trade, you suddenly saw it spurt to the high point of the day. There are a few factors that are playing out. Now, there is a hope that, in fact, we'll see some kind of a stimulus that will come in China. That's going to be interesting because the official manufacturing PMI data, though it continues to remain in contraction mode, which means that it's sub 50, it improved actually from the month of May. But there are some hopes that there could be some stimulus in China. Point number one. Point number two is there are some unconfirmed reports, as has been the case in the last many months, that there'll be further production cuts. We'll have to see how that comes about, quantum and various other details on that front, because year to date, as it is, Chinese production actually is down. The problem is that demand has been even weaker and the exports continue to remain elevated, which is putting pressure on global pricing. But a production cut in China will be great news because that's what will result in a shortage of supply in the market, which in turn will support prices, which have corrected quite a large extent to sub $500 on a per ton basis. There's another factor that's playing out. There's some optimism that President Trump comes to the table, gets some deals going with various countries. That in turn will help, because it removes any kind of uncertainty with regard to demand, with regard to, how things will pan out from here on. And also in addition to that, you have the dollar that's weakened, which is good news as well. And talking about the dollar weakness, when the dollar weakens, it's normally good news for base metals. So you have copper as well as aluminum prices. They're at the highest levels we have seen in the last 2 to around 3 months. So 4 factors playing out: stimulus, there could be some production cuts in China. Hopefully, Trump gets some deals going. And finally, base metal prices reacting to favorable dollar index. Ashish, what do you like from here? Ferrous, non-ferrous, and if you could name a stock, will be absolutely great.
Hi, Nigel. So yes, definitely, you have rightly mentioned some of the points. Apart from that, we believe that the fall in dollar index from 109 to almost 96, 97 zone is clearly, seeing a shift towards the entire commodity cycle. We are seeing both copper, aluminum, and not only this, we are seeing iron ore prices also going up significantly in the last couple of days, and we are seeing a very, very serious buying interest coming into it. There's an anti-dumping duty on steels, so which is also supportive for Indian, steel manufacturers, because there's a good amount of demand, and with the new anti-dumping duty, we are going to see some kind of, demand, the supply softening, and which will lead to some kind of price stability coming into steel prices, and this is ultimately going to benefit players like Tata Steel and Jindal Steel. But what we like is into the mid-cap space, which is stocks like Lloyd Metals. Lloyd Metals, because here if you look at, they've got a new environmental clearance, and because of that, their current capacity, which is close to 10 million tons, is going to almost 25-26 million tons production. So I think and with the steel prices also going up, this is going to be a big beneficiary for a stock like Lloyd Metal, which is more integrated player. So I think this is one stock. This is the only one stock which we are holding in our portfolios at this point of time, and we believe structurally, with this kind of production which we are going to witness, we can expect 30 to 40% kind of PAT growth for next 3 years time frame in the stock.
Okay, so that's a take on some of the metal names that are actually shining really bright in today's trading action. Tata Steel, JSW Steel, all of those stocks are right up on top. There is also some buying still evident in Maruti Suzuki, in Asian Paints, in Lever. Some, consumers plays, not necessarily pure FMCG, but other names as well, looking okay. Ashish, hi, good to have you on the show today. Paints, such a big, wide debate raging out there, whether after several bad years, finally should one start accumulating large paint stocks, or is there more pain ahead for paints? What do you think? Is the color green or red?
Good afternoon, Surbi. So I think, the kind of, kind of competition we are going to witness in the space, it looks like, one should clearly avoid the names like, Asian Paints or maybe Bajaj Paints. The reason being, Grasim, the kind of capex they have done, almost 10,000 crore kind of capex, which they are going to do, and which is almost completed. And if you look at one-time sales is what one can expect out of this capex number. So clearly, Grasim is going to see almost 9,500 to 10,000 crore kind of top line, which will make them number 3 player in the entire segment. So there's a huge, I would say, competitive intensity which is there, and for a space where we are not going to witness more than 15% kind of top line growth, and if the stocks are trading at 60 PE multiple, you will see a lot of pressure or consolidation which will continue in the space. So my sense is, if one has to really take a bet, I think Grasim is one stock which looks very promising. But as far as Asian Paints Bajaj is concerned, I think they would trade more into a consolidation phase if there's no further downside. But I think in terms of upside also, it looks very, very restricted at this point of time.
Okay, all right, Ashish, appreciate you joining in. Thanks a lot for discussing all those stocks. We look forward to having a chat with you in the time to come. Well, by the way, keep an eye out on the Nifty. From the lows, actually, we have bounced a little bit. So that's pretty good news. I think a couple of stocks are fighting for the bulls. One such stock is Asian Paints, as we just pointed out. Wipro as well has cut its losses. So that's good news. And I think we have Maruti Suzuki that's now up 1.5%. So that as well is fighting in there for the bulls. So pretty good, looking screen in terms of those stocks. Just to highlight a few more names that are moving up. Flair Writing, that one is up close to around 5.5%. Volumes as well fairly decent. Sai Silk, we don't talk about the stock very often. I'm not sure whether there's a large trade, but that's one of the top gainers. And Bajaj Consumer, one of the biggest underperformers in the last few years. I'll tell you what, if you pull up a 1-month chart, you'll see that stock has given massive returns. There's a rejig at the top, 30% in a single month. So there are hopes pinned on the new person at the helm. But remember to tune into the all-new CNBC TV18 Prime. We bring you insights from policymakers, business leaders, economists, shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the global reset, at 1 p.m. for the Big C, currencies, commodities, and currencies. In fact, cryptos, and in the global lens at 8:30 p.m.
Welcome back. Looking at the market as we get into the last half hour of today's trading session, and the color continues to be red. 1% lower on the bank Nifty. Nifty itself is down by about 0.5%. Nikhil Ranka is joining in this afternoon. He's from Nuvama Asset Management. Nikhil, good to have you on. So it's interesting, the market seems to be now figuring out what the next trigger is going to be, and I think soon enough it's going to be about earnings. Are you expecting any pockets of, upward surprises in Q1?
So good afternoon, Surbi, and thanks for having me on the show. Honestly, if you look at it, this quarter could be a watershed quarter in that sense, because if you look at the key sectors in that sense, IT and banking put together will be 55-60% of the total Nifty earnings. In the case of IT, because there was tariff uncertainty in the month of April, a lot of decision making got delayed in that sense. And therefore, if you look at the initial consensus estimates, people are expecting 1.5-2% constant currency growth for Infosys. But if you look for other large cap names like HCL Tech, TCS, TechM, people are expecting constant currency decline. So there will be subdued earnings from IT. And also, if you look at banking, we had almost 75 bips of repo rate cut in the last 3-4 months. And almost 40% of the book is linked to repo rate for most of the large banks in that sense. So, we will see a 15 to 25 bips NIM decline over the next 2 quarters for most of the banking names. And given the fact that loan growth has also slowed down, the system loan growth to close to 10%, the pre-provisioning profit growth will be very, very subdued for banking names. So what we are therefore looking at, the combination of the two put together, is single-digit earnings growth continuing for the next 2 quarters for Nifty names. And the consensus estimates, if you look at it, we ended FY25 at close to 1,010 rupees of EPS, and we are building in closer to 1140, 1150 rupees of EPS for FY26. So if the first 2 quarters are single-digit growth, then the asking rate for the next second half will become more like 16 to 20%, which looks very, very challenging. So my sense is the risk is more on the downgrade side for markets right now, and therefore the best case is that the markets consolidate at these levels. In our view, the upside is probably single-digit from these levels in Nifty over the next 6 to 9 months.
Okay, so best case is markets consolidate and see a single-digit kind of an up move. But what is the base case then, Nikhil? If we do see those earnings downgrades in the second half of the year, because consensus is still running a little high, what could be the extent of downgrades and even the extent of downside, say, on the index? Because some of the factors that you spoke about, say for banks, the NIM compression in H1, or the fact that system loan growth has slowed down is well documented. We've been talking about it. So isn't that not already in the price?
So Rima, if you look at it, we are right now at a number of closer to 1,300 rupees of FY27. And if you look at the last 8-10 year trading band of index, 19 to 20 times is the medium trading range of markets. So, even if we take 0 downgrades to earnings at 1,300 rupees of EPS, 26,200 becomes the upper end of the trading range. Now, if I'm building a 2-3% earnings downgrade to the 1,300 rupees of EPS that we are currently factoring in, and if we end up close to 1,250 rupees of EPS, then given the fact that you will have earnings downgrade, so, there could be lower multiples that could get assigned to market. You could probably have some sort of sell-off till 24,700, 24,800 levels. And then, probably we start building in FY28, 6-9 months down the line, and then the next leg of up move will come in. But right now, my sense is closer to 26,000 odd levels, a lot of positives start getting built in for the markets.
Okay, all right. Hi, Nikhil. Good to see you in. What about the pharma pack? It appeared to be a bit of making a comeback, but you're saying the second half of the year will be challenging. Tell us more.
So Nigel, if you look at it, for most of the large cap pharma names where there was a US exposure, combined put together, Indian pharma companies would have done close to $1 billion of revenue from one single drug, which is Revlimid. Now Revlimid goes off patent in Jan 2026, and a lot of the supply chain over there will start doing destocking from Q3 onwards. So whatever is the number that has to come will come in Q1, Q2, and then for the second half, there will be a very big void if you look at names like Dr. Reddy or Cadila, because they had very chunky contribution from Revlimid in their US earnings. So therefore, my sense is till the time we have some visibility of any other blockbuster drug from these companies, it's going to see earnings decline in FY26 and 27 for these names. At best, it could be a flattish EPS. And therefore, these stocks could have significant time correction from these levels. And therefore, I don't think, you can have even double-digit upside in these names from the current levels.
Nikhil, so given your cautious stance on the market, and of course, we're all awaiting to see if there's indeed that earnings recovery, what is it that you would advise taking exposure to right now? What would be, say, your top 2-3 themes or ideas?
So if you look at it, telecom is one of the most defensive bets right now. If you look at it, we had a tariff hike 6-9 months back. A large part of that has got absorbed in the numbers. And my sense is, before we have a Jio IPO somewhere in second half of this financial year, there could be one more round of tariff hikes that might get contemplated. So if you have another tariff hike of say 15 to 20%, and if you look at the flow through to EBITDA, it's almost 70% that flows from revenue to EBITDA for telecom names, the incremental part of it in that sense. And IT is in that sense insulated from growth from a lot of the global turmoil in that sense. We don't know what will happen on 9th July when the tariffs finally get announced. But telecom is one sector which will be completely insulated even if there is some volatility around 9th of July in that sense. So, that is one space where I think there could still be double-digit returns that can be made over the next 12 months. So we are positive on telecom from the current levels.
IT in particular, Nikhil, I know you look at it very closely, which is why we ask you every time. But any stocks we should watch going into the earnings season where there is a mismatch versus expectations and what the company might deliver? From an earnings point of view, the stocks which are on your watch list from the tech SPAC.
So, Rima, I think Coforge is something that could prove out to be very interesting. If you look at the commentary of Q4 also, the management was extremely confident that in spite of the uncertainty that they are seeing in Q4, they will continue to see very strong growth. And given the fact that they have sold one of the loss-making subsidiaries, margin expansion should also come through for Coforge. If you look at the initial estimates with some of the brokers have put through, people are expecting close to 7% CC growth for Coforge this quarter. So if you juxtapose that with rest of the pack where, you are either seeing a decline or 1.5% growth, and you have something which will probably grow at 7%, then obviously multiples will start getting re-rated for those things. So I think that is one of the interesting names which should be looked for in the current earnings season.
Okay. All right, Nikhil, we'll wind it up on that note for today. Thank you very much for joining in. Good to get that perspective on the market with you. Thanks for that. Thank you. Well, let's move on to a corporate conversation now, and it's an interesting one. We're putting the spotlight on PVR INOX. The company has been, of course, talking to us about its plans of expanding in the south of India in a big way. It's looking at expanding its base in Telangana, for instance. More screens are coming up over there. Sanjeev Kumar Bijli, who's the executive director at PVR INOX, is joining in to talk about this look south strategy, so to speak, at PVR INOX. So, Sanjeev, great to have you on. Thank you so much for joining in. So, we've been discussing this over several quarters with Ajay. I remember those conversations where clearly South is emerging as a big market. That's where you're going. You're also trying to keep it asset light with the FOCO model, right? The franchise-owned, company-operated model. So just tell us once again, the numbers, how they're stacking up for South. What justifies the Go South approach? I mean, in the last 1 year, have you seen average occupancies higher in your southern screens? Why are you looking at South India? Is content better? What's driving you there?
No, clearly, I think the occupancies are much higher there. I think people go to the movies a lot more often. The culture to go and entertain yourself at the cinemas is much stronger. So that's why we've been focusing on the South a lot. In Karnataka, Tamil Nadu, Kerala, and also Telangana, we're actually focusing a lot, not just on the main cities, the big cities, but also the smaller cities.
numbers to that effect, Sanjeev? I mean, what would say, I mean, average occupancies, I think most quarters that we talk are ranging between the early 20s to mid 20s. But what are occupancies like in the South? And I'm not asking, I mean, as of this month per se, the latest numbers or Q4 numbers, just so that we understand the difference.
Average occupancies are hovering around 30%. So that's what it is in all these southern states. And, you know, the number of movies that come out also in South are very prolific. The quality of films is actually getting better and better. So that is what driving the people to the cinemas in South India, and our focus on South India, amongst the rest of India as well, of course, but on South India always remains very strong.
So 30% plus occupancy in South versus an average of 23-25% pan-India. That would be correct?
That's right. That's
Okay.
right. Yeah.
So Sanjeev, how many screens do you have in South of India today versus your overall screen count? And how will that change going ahead with this targeted expansion down South?
Well, we have around 1,761 screens now, all India. 40% of that is in the South. And going forward, every year we're adding about 100 screens. This year we've opened about 20 screens so far, and we're going to be opening another 82 screens till the end of the financial year. Out of the 100 screens, again, about 40% will be in South India.
So as a percentage, 40% exposure to South remains, simply put?
Yes.
That number is not going to change.
Absolutely, yeah. There's a lot of potential there. There's a lot of, places where new malls are coming up, new opportunities are coming up for us, and some great developments are coming up. So our focus and our growth strategy in South, of course, remains very robust.
Okay, Sanjeev, so just come in on the CapEx and the funding, because again, the whole approach has been asset light.
Yes.
So as you go about opening these 100 screens, how much money will PVR Inox have to put in? And how much, I mean, I don't know how the franchise model works. How much do you need to put in? How much comes in from the franchisee?
Actually, there are two kinds of models that we're pursuing. One is asset light, where about 50% of the capex, up to 50% of the capex is actually contributed by the developer. And then we also have a FOCO model where 100% of the capex is contributed by the developer. So roughly on 100 screens, if our capex without this model, if we were supposed to invest entirely in the fit outs of the cinema, which we used to do, the capex would be anything from 300 to 350 crores. But now it's actually half. It stands at around 175 to 200 crores.
Hi, Sanjeev. Good to see you in. This is Nigel on this side. It's been a while since we spoke.
Hi.
I just want to ask you, what's the margin difference between the two?
The margin difference, when it comes to FOCO, actually is purely on revenue share.
Okay.
But as far as asset light is concerned, asset light is actually also taken on lease, but a very low MG. So we still basically retain the revenues, the total revenues, and do a revenue share with the developer. This is a fairly new model, and we're obviously yet to see the proof as we go along.
Yeah, so what's the profitability though? Profitability difference between the two?
Obviously, the FOCO model will be much higher because it's only purely on revenue share. And as far as, we have zero investment and purely on revenue share only. But as far as the asset light is concerned, we can expect, EBITDA margin, depending upon the location also. It's not just one sort of like margin that we're looking at, but anything between 18 to 20% could be the margin.
And you gave us a number as well in terms of the investment that would be required from PVR side. Can you just repeat that number?
As I said, the total investment for 100 screens would take about 300 to 350 crores.
Got it.
Since this is a combination of FOCO and asset light, we'd be looking at 175 to 200 crores.
Got it.
How has this quarter been, Sanjeev, since we have you? We've had a few good movies, which has got people back to the theatres, whether it's Mission Impossible, Sitare Zameen Par. How has Q1 been?
Much better than Q1 last year and much better than Q4 also. I think we'll probably end up clocking about 33.5 million people this quarter. We're very happy with the numbers we've reported. Managed to get a good number of footfalls at a decent ticket price. and a very decent F&B number as well.
And how would this 33.5 million number in terms of footfalls for Q1 just compare with Q1 of last year or Q4, just to get an idea of the improvement?
I think Q1 last year was just about 30 million. So it's
okay. So that's about a 10% increase.
10% increase, yes.
In terms of, you've given us the occupancy level. In terms of what we can expect from the F&B spends, the entertainment side of it, right, which is also simultaneously, I mean, apart from cinema exhibition, that's also something that you've been pushing. What are early trends suggesting for Q1?
Again, much better. The F&B spend is measured by SPH, which is the spend per head. We've gone above on our spend per head from the last quarter. And even the same quarter from previous year. So there seems to be a 10 to 12% increase in spending as well on F&B.
Okay, so F&B spends also going up. Just overall, Sanjeev, leave us with the updated levels in terms of cash and debt. I mean, you've already told us that in this CapEx rollout, your share is only up to about 175 crores.
Yeah.
What is the plan for the rest of the year in terms of any other investments? And just an update on the cash levels and the debt position.
No, I think maximum it'll be about 200 crores towards these new projects, maybe about 50, 60 crores towards renovations and repair and maintenance of the existing circuit, because, there are some properties which are very old now and need some kind of rejuvenation capex, about 50, 60 crores. So we're obviously keeping an eye on the debt, and we'll be able to pare down our debt further, hopefully by another 200 crores this year.
Okay, all right, Sanjeev, thanks a lot for joining in and giving us your take. There have been a few big hits in the past quarter, and you're sounding confident about things going ahead. But let's cut across to Parikshit, who's in conversation with the Union Telecom Minister, Jyotiraditya Scindia.
With us right now is Union Telecom Minister Jyotiraditya Scindia. Mr. Scindia, thank you so much for joining us here on CNBC TV18. In the last few days, you've also spoken about how the government does not want a duopoly in the telecom sector. Now, when it comes to the revival plans for Vodafone, what is on the government's agenda right now?
So first of all, I would like to correct your statement. I do not think a duopoly is healthy in any sector. And also within telecom, Parikshit, you'll understand that there are multiple verticals. My comment was at the Wi-Fi broadband International Wi-Fi Day. And my comment was in context with any vertical within the telecom sector. Be that as it may, as you have chosen the mobile vertical within the telecom sector, let me say this, that there are very few countries in the world that have 4 players within a particular market. And India happens to be one of those very few outliers in the world which has 4 players in the market. Each one of our players have upwards of 90 million subscribers or 100 million subscribers, be it from BSNL at 91 million subscribers to Jio at 390 million subscribers. So across the whole range. I do believe that the amount of capex that has been put in the telecom sector in India stands out as a paragon across the world. Today, the telecom sector across the world is going through huge amounts of rationalization, and the return on capital employed across the sector in the world the numbers have been dipping very, very quickly. It's only in India that you're seeing a robust return on capital employed, which is why our telcos have deployed almost close to about 4.5 lakh crores, putting in place the 5G network in India. So whether it's the government-owned BSNL or any private sector company, It is for the management in these companies to decide on their strategy and their path to profitability. As far as BSNL is concerned, the department can only give them guidance, vision, strategy inputs. Ultimately, it is the management of that particular company that delivers. And in our case, BSNL has seen a huge turnaround story, one that we are seeing today occurring after 18 years. To answer your question directly, as far as Vodafone is concerned, that is for the management and Vodafone to decide, and not for me as government to decide.
Right. But when it comes to further equity conversion, I think you've said earlier also that it's not as possible.
There cannot be. There possibly cannot be further equity conversion unless the government share gets diluted to lower than 49% to enable us to increase it back to 49%. Because we can't increase it beyond 49%, because the minute you do that, then it becomes a PSU, which is not our intent.
But are there other options being considered?
At this point of time, the equity option, increasing the equity option is not an option. As far as other options are concerned, there's not much discussion happening at this point. If there is, we will let you know.
Analysts have said that 2-year deferment of Vodafone AGR dues is the most possible thing that the government could do.
That is, as I said to you again, that is not for us to decide. That is for the management of the company to decide.
Right. Now, also,
I do not happen to be the CEO of Vodafone, and neither do I happen to be the CEO of BSNL.
Okay. My final question on Vodafone before we move on to other issues. It is also being said that if Vodafone collapses as a going entity, then you'll not be able to recover the dues. Will the government allow that situation to happen?
So I see that you're trying every angle to get an answer from me. I do not answer hypothetical questions.
Okay. Let me also ask you about Bharti Airtel. Now, Bharti Airtel has also applied and made an application to you for equity conversion. The government seems to be considering this. What's your view right now? Has a call been taken?
The Department of Telecommunications is evaluating it. Once they evaluate it and they bring it up to me, then I shall exercise a view based on the analysis that has been done.
Right.
At this point of time, they have not brought it up to me.
Right. But your view, basically whatever you do, whether it's for Bharti or Vodafone, will have to be done on a broad-based basis for everyone. So for the larger health of the sector, what would be your message?
So I will have a view once there is an analysis that has been done within the DoT. Every telecom operator within the ambit of that prescriptive nature of the rule has a right to ask us for conversion of their dues into equity of the company. That's the right that Bharti has exercised. And now that they have submitted their application, it's being examined by the department.
All right. Speaking about satellite...
That being said, it will have to be examined not only by DoT, but it will also have to be examined by Ministry of Finance.
Right. Speaking about satellite communications, the DoT is yet to take approval or yet to approve TRAI's recommendations on spectrum for satellite communications. By when do we expect?
So TRAI has submitted their recommendations to us only in early May. And the DoT is now examining those recommendations. And we are in dialogue with TRAI. It's important for DoT and TRAI to have that conversation and that dialogue. Normally, the process on a reference does take a couple of months. Hopefully, in a couple of months, that should be through.
That should be through. Some industry bodies have also raised concern about the pricing of spectrum for satellite communication companies. How would you respond to those concerns?
Concerns with regard to what?
Or low pricing.
Well, please remember that I am quite confident that TRAI has taken into account, and they've had multiple stakeholder meetings. You cannot price spectrum in the same manner for satellite as you do for telecom, for mobile. And the reason for that is very clear. Satellite spectrum is a shared asset. And therefore, a shared asset spectrum cannot be priced in the same manner as a dedicated spectrum. The laws of physics combined with the laws of economics are very clear on that principle. Ultimately, it is TRAI, because that is the regulatory body that decides the pricing of spectrum, which is mandated, and they have taken into account everyone's considerations, and they'll come out with a ruling on that.
Right. Speaking about Starlink, you've met representatives of Starlink over the last few months. They've got one approval from the government. InSpace is waiting for them to respond to their draft, and they may give an approval soon. But finally, how long would it take to clear the decks for them to operate in India?
Well, I think that the process is on. They have to get permission for their satellite Earth gateways to be located in India. They've got to get in-space permission. They've got to get security clearance. And then they have to get spectrum. These are the major 4 milestones, if you will, to be able to operate in India. I am of the opinion that the sooner my SATCOM companies operate, and by that reference I mean not only Starlink, whether it's OneWeb or it is Reliance Jio, I'd like them to offer services as soon as possible in as many areas as possible, so that there is a fair degree of competition for those that are not connected. And I see that happening, as I said, in the next couple of months. This process should get ironed out.
So by the end of this year, it should be well on track?
Hopefully, but that depends. Please understand that depends on each one of these companies as well, because the quicker they respond to issues with different regulatory authorities, the quicker the permission will be given. It's not something that's dependent on government alone.
Right. Is that the reason why the Tech Adoption Fund, which was launched by InSpace recently, that becomes all the more important?
Absolutely. TDDF is very important for us from a satellite perspective, from a 6G perspective, from an AI perspective, from an IoT perspective. And version 1.0 has already financed almost about 100 or greater proposals, over about 200 crores. We've also got multiple other proposals that we've looked at. And so therefore the Technology Development Fund is a very important piece of that puzzle.
Right. Speaking about the MTNL default and a possible relief package, MTNL has defaulted on loans to the tune of over 8,000 crores. We believe the Cabinet Secretary also took a meeting recently to look at various options to revive it. What's the path to revival?
No, there's no question of path of revival, because as of 1st January 2025, all operations of MTNL have been transferred to BSNL. So BSNL is now the operator for MTNL's customers. So what there is in MTNL is the bank debt and the government equity. So the bank debt needs to be renegotiated with the banks. The process is being done by the Ministry of Finance. And then there are assets within the MTNL balance sheet which need to be divested. And once that is done, then pari passu, a squaring up exercise will happen.
Right. I would also like to ask you about BSNL. Now, you've been focusing on BSNL's growth and profitability. What would be your outlook on the financial health of BSNL going forward?
So that's a good question, Parikshit. After 18 years, we've been able to turn BSNL around. And I think that is a huge move in itself. And let me give you a little bit of a picture of what we've been able to achieve over the last calendar year, the last 12 months. We have increased revenue from financial year 23-24 to 24-25 by roughly about 8%, from roughly about 20,000 crores to about 21,900 crores. Our EBITDA numbers have been extremely promising and extremely healthy. from an EBITDA of close to 2,146 crores in FY 23-24. Our EBITDA this fiscal FY 24-25, historical earnings, has grown to 5,395 crores. So there's been a 150% increase in operating profit.
Welcome back. A few minutes to go. The Nifty has climbed well above 25,400 in the dying minute. In fact, closer to 25,450, but still down, nursing a cut of about 100 points. Sudeep is now joining in. Sudeep, wanted to get your thoughts on two stocks, if you've looked at it. One of them is Gabriel Industries, which has had a one-way up move. And the other one is Dreamforks, where there is negative news and the stock has gotten beaten down.
I think, Gabriel, the verdict of the market is very clear, and I completely agree with it. I think it's a very good thing for the Anand Group to have consolidated all their automobile-related operations, auto component operations in Gabriel. This is a fantastic step from Gabriel India standalone point of view as well. I think it was a one product company with 90% of revenue coming from single product. The diversification was a need of the hour, and they achieved it through, without going out and acquiring external businesses or trying to set up greenfield. The group companies which were in multiple other verticals got consolidated. So the diversification of product objective got achieved in a seamless manner, in a very, very peaceful manner, I would say. The opportunity, of course, in the auto component space is significant, and Gabriel is a well-known player. I think it's a win-win for the promoters as well as the minority shareholders. And from a business point of view, also, I think it's a good exercise to have been carried out by the group. So yes, Gabriel India definitely, and the market is giving a thumbs up already in a big way. I think price started moving even before the announcement, and the pace has only increased post the announcement. As far as Dreamfolks is concerned, of course, it's a very unfortunate development, and there are a lot of uncertainty. I heard the interaction which you guys had with the management today earlier. Of course, they're trying to put up a brave face, and of course they're trying, but I think there are a lot of uncertainties. Future business, international business, one doesn't know what's going to happen. Those are in the realm of future. As things stand today, it's in a crisis mode, and we have to be very, very careful. I won't definitely recommend anybody buying. Price have corrected significantly, but still it's not the time to buy Dreamfolks.
All right, Sudeep, request you to stay with us. For the time being, I think we'll wind down the markets. And then, in fact, we'll get back to a chat on stocks. But the markets go home with a cut of around 100 points. The good news is we came off considerably from the low point of the day. So we're off close to around 60 points from the day's low. What didn't do well? Some of these financials came in for selling. So you had Shriram Finance, HDFC Life, IndusInd Bank, Bajaj Finance as well. All of them down between 2 to around 3% in today's trading session. What did well? Metals. There is hope that, in fact, China will do something with regard to stimulus. Hopefully, China doesn't produce as much as well, which in fact will support pricing. And there is a glimmer of hope that President Trump will be more rational, sign some deals that will remove some kind of uncertainty with regard to demand. So explain that one was higher. Asian Paints, that's had a good run actually. Talk about a stock that's been an underperformer for the last 3 years. Well, today it was one of the top gainers, up 2.5%. What else was moving around in trade today? RBL Bank, there was some news, media reports that suggested there could be a deal. The street looks like they've sold into the stock, because after seeing a big run from around 170 rupees to around 260 rupees, the stock actually goes home at the low point of the day. Hutco as well was down close to around 3.5%. NCC goes home with a bit of a cut. What else did well? You had Tata Communications, spurred up by a nice brokerage note out there. Mankind, that goes home with a gain of around 4.5%. And ABFRL as well, solid gains out there. From the broader markets, you had SAIL that participated on the upside, and Dixon Technologies, it seems to be one downtick and then two upticks, because the stock has recovered all the losses that we've seen in the last few days. Stock now holding above that 15,000 rupee mark. The good news today was the mid-cap index did a relative outperformance, ending with a mild cut of around 0.1%. However, the number of stocks that were advancing were lower than the number of stocks that were declining. Well, we'll wrap up on this edition of Closing Bell, but you don't go anywhere. Markets Forward comes up next.
The Lal Street trims early gains. Nifty and the Sensex fall 0.25%. The mid-caps do slightly better, but the banking stocks underperform, with the index falling nearly 1%.
The Nifty Metal Index surges over 1% in a weak market over positive global cues. Tata Steel, Welspun, JSW Steel and SAIL, all of them the top gainers. There are hopes that in fact China will stimulate its economy, which in turn will be good news for the metal counters.
HDFC Bank's arm, HDB Financial, debuts on the stock exchanges at a 13% premium to its IPO price in a positive listing. The management believes that the fund infusion will help drive growth. Meanwhile, Tata Communications perks up in trade after a rating upgrade by brokerage firm Macquarie, believes that the stock could potentially double over the next 3 years in a bull case scenario.
Hello and welcome to Markets Forward, your go-to show where we get you up to speed with regard to what went on today. I'm Nigel. With me is Harmas. Harmas, a bit of a down day, but I think still par for the course. I'm not too worried.
On the uncertainties with regards to the trade deal is that's keeping the markets a little bit on the edge. But yes, we are respecting that 25,500 level, at least on the downside for the last couple of days. Today was not the case. But yes, still a downtick, nothing alarming as of now. The broader markets too did fairly well after recovering from the lows of the day. But we've got you covered over the next 20 minutes with all the big news and the key developments on the Lal Street, the top corporate voices and the events to track ahead of tomorrow's trade. Let's kick off the day by the market action. Nigel, you know, still a bit of consolidation that continues on the index, but the broader market's recovery was the highlight.
Well, that's right. I think, the broader markets, the mid-cap index actually went to more or less flattish. However, the number of stocks that were declining were more than the number of stocks that were advancing. So a bit of a mixed bag coming in from the broader markets. However, if we look at the Nifty as well as the Nifty Bank, what was good is they managed to defend the lows of the day. At the start of trade today, I'd spotted that, in fact, 25,440 odd mark. That's going to be a crucial level you want to defend on a closing basis. And we did defend that mark. So that'll be some kind of, support at least for the bulls. They'll want to go home with that particular data point. But let's run you through what all we have on the show for you. We start off with all the top movers and shakers of the day. Vivek is standing by. We'll have shares of SBI Cards as well as IndusInd Bank. Both of them slipped in trade post ratings downgrades. Also in focus is the Apollo Hospitals, which was under pressure over revenue projections of the firm's new entity. Last but not the least, we'll delve into all the key market events you need to watch for tomorrow's trading session. But as promised, let's go to our opening batsman. Vivek is standing by to tell us about all the top movers and shakers of the day. Vivek.
Well, that's right, and wishing the best to the Indian team given the fact that the second test match has just started. But, in terms of stocks, very volatile trading session, and especially in the second half, you did see quite a bit of volatility kick in, especially in the broader end of the market. Well, in terms of stocks that did well, the first stock that stands out is actually Asian Paints. It started off the session on a very weak note, but managed to end it on a very strong note. And this is despite the concerns of, likely CCI probe over, anti-competitive practices. The stock ended higher by almost 2.5% today. The other stock that did very well was one from the telecom pack, one we don't discuss too often, but that was Tata Communication. Macquarie initiated coverage on the stock. They have a positive stance. Stock ended higher by almost 5%. The one set of stocks, especially in the second half, that did very well was the entire metal pack. So all of the metal names today managed to end the day with significant gains. Tata Steel among the top gainers, almost 4% higher for a large name like Tata Steel. Well, another stock from the broader end of the market, Sagility, this stock on good volumes, one of the top gainers as far as the NSE 500 was concerned. And within the mid-cap pack, Apollo Tyres, after a while, did see a sharp rally today. And that particular stock too managed to end the day with decent gains. So Apollo Tyres today, almost 4.5% uptick over there. On the other hand, what didn't do too well? Well, SBI Cards, a Goldman Sachs downgrade coming in on this particular name. They see a pause to the rally, which is precisely what happened in the session today. IndusInd Bank, again, this particular stock had seen a significant up move, but again, Goldman Sachs downgraded this particular name. So two stocks from the BFSI space saw a bit of downtick today. And the entire realty pack, especially if you look at some of those larger names, they did see significant selling pressure, and this has been continuing for quite some time. So Phoenix, Brigade, Anantraj, all of these stocks ended the day lower in the session.
Vic, thanks a lot for that comprehensive wrap of stocks that did well and not so well in today's session. Let's go across to our guests now. Sudeep Bandyopadhyay, the Group Chairman at IndiTrade Capital, and Shrikant Chauhan of Kotak Securities is joining in. Gentlemen, good afternoon. Thank you for joining in. Shrikant, to you first. Some key levels that you are tracking on the index. We managed to defend that 25,400 level at least on the downside and also closed above that 25,440 mark. What are the levels you're watching out for going into expiry tomorrow?
Good evening, Hormas. Good evening, Nigel and everyone. Well, for Nifty, 25,400 is certainly going to act as major support for the market. But if we consider the overall option statistics, then based on that, there is good amount of call writing at 25,600 and resistance has shifted from the levels of 25,600 to 25,500. So now 25,500 is going to act as major resistance for the market, or we can say that 25,500 and 600 is the area of resistance. And on the downside, 25,400 is the important support level. In case if we see the market is closing below the same, then in that case, we could see the levels of 25,200 where the market is having next leg of support. So sustaining above 25,400 is crucial for the market. And for the Bank Nifty, there also we saw a good amount of sell-off. 57,000 is the crucial mark. Below that, again, the chances of hitting 56,500 would turn bright.
Right. Sudeep, to you then, what about HDB Financials? Made its debut today, a 13% premium to its listing price. It's still the valuations in comparison to a lot of its other peers, say Chola or even Bajaj Finance, are slightly still on the lower side. Would you still be betting on the stock after its listing?
Well, I think yes, because look at the way the issue got subscribed. I think there is definitely significant demand for this stock. And the listing was not, they didn't keep up with the kind of oversubscription that we did see. That was probably because market was a bit subdued today overall because of the trade deal related uncertainties. But I think it's definitely a good stock. And from a long-term perspective, one can consider buying it and keeping it in their portfolio. Look, they are not yet Bajaj Finance. They are not yet, let's say, even a Sundaram. But I think they have the potential and they have a very strong parentage.
Let's in fact go across to Vamakshi to tell us more about HDB Financial and about its listing in today's session. Vamakshi.
Well, Hormas, HDB Financial is listed at a premium of almost 13% to its issue price. The AUM stood at 1.06 lakh crores, growing at a CAGR of almost 20% over the last 4 years. The NIMs have taken a bit of a knock, coming in at 7.6% for FY25. The gross NPA ratios, though, is one of the lowest among peers at 2.26%. In fact, during FY25, the credit cost was high at almost 2%, and resultantly, the ROAs declined to 2.2%, and in fact came in a tad lower than its peers like Chola as well as Bajaj. Now, given the valuation at which the stock has listed, it listed at 835 rupees per share, trades at 3.4 times 1 year forward price to book, but this is lower as compared to Chola as well as Bajaj Finance, but higher as compared to Shriram Finance. Now, we were also joined in by the management, and they said that they do have adequate, they want to ensure that they have adequate capital to meet their aspirations. They're attempting to having a well-balanced portfolio. The rate cut cycle could be beneficial to them, and they also see nearly 70% secured book and 25 to 30% unsecured book going forward, which is very similar to what they have currently.
Consumer finance is our newest business. It was about 13% about 5 years ago. It's 23%. We believe that all our businesses that we are in have an opportunity for growth as India grows over the next few years and decades. So what we would like to have is a very diversified book so that we can manage business cycles. So there'll be businesses that have a certain low and a business that have an opportunity. So what we're really trying to do is to have a well-balanced portfolio.
All right, that's about HDB, but we can't let Vamakshi go at just that. She's here to tell us about a couple of more stocks at Goldman Sachs Note and IndusInd Bank, as well as SBI Cards. Vama, tell us, why did both these two slip in trade?
Well, IndusInd Bank was down and out in trade on back of a downgrade from Goldman Sachs. They've downgraded the counter to sell, target price of 722 rupees per share. They say that it is a structurally weak franchise now. ROAs are expected to reset even lower. they believe the bank is likely to have a weaker growth as well as return profile even post normalization in the second half of FY26 as well as 27. They've cut their EPS estimates by 20% for FY26 and 15%, rather 17% for FY27. They say that valuations are expected to stay below book on poor visibility of turnaround. The next counter on our radar is SBI Cards. Again, another downgrade coming in from Goldman Sachs. They downgraded the stock to neutral, target price of 1,006 rupees per share. They say that there has been very strong price performance so far, and therefore it has resulted in very sharp re-rating in the company's valuation multiple. In fact, valuation multiple has now gone above the above one standard deviation of its historical average, and this in turn has raised several investor debates, which includes loan growth revival, because the industry's credit card loan growth still remains quite tepid at 8.5% year-on-year as of May. Quantum of improvement in credit costs this cycle is also something that investors are debating on, and they still believe that the company is well positioned to deliver strong returns in the medium term. However, they have highlighted that because of the sharp re-rating that they have seen, the risk reward has now become balanced. Therefore, they've gone ahead and downgraded their rating on this counter.
Vamakshi, thanks a lot for that. Sudeep, IndusInd Bank, so much chatter around it. There were notes that came in saying that the bank is now looking to start FY26 on a clean slate by getting in a new management. Now comes a downgrade. Is this too risky a bet to play in the private banking space even after the turnaround if it happens, because there are better bets in the sector?
Well, I think it was definitely a bit aggressive bet, if somebody wants to take. The bank has gone through enough and more problems. We assuming that problems have ended. And I will harp on the word assume, because we still don't know. The new management is expected to take over. The announcement post RBI approval should come, and that will be a good beginning. But there are a lot of uncertainties, and the bank will have to do a lot of back-end work. So rather than aggression in the market, they will probably have to clean up the back end first. So the new management, the new MD CEO will have to take care of these back end issues for some time. Our guess is it will take about a couple of years for the bank to really come back and start demonstrating performance in terms of P&L and business numbers. So if somebody is willing to wait for 2 years, yes, these are opportunities for them to pick up. But if you don't have that kind of time horizon, it is better to look for other opportunities.
Okay, all right. Sudeep, got that thought on that particular one. But let's focus on the broader markets then. And there was one such stock that was under pressure in today's trading session because it faced a major setback. That's Dreamfolks. Axis Bank and ICICI Bank ended their key launch access programs, impacting the business where 93% of their revenue comes from. That's the lounge services. The move comes amid mounting pressure from two dominant airport operators who now run nearly 40% of India's airport lounges and are reportedly urging banks to switch away from Dreamfolks. Let's listen in to what the management had to tell us.
It was a pressure which was getting built up to the clients. Okay, it was a pressure tactics which were done. So to be very upfront, it is mainly done by these two major airport operators who have now started getting into the similar business. The pressure which has been built up is to, tell the clients that, in case if they do not sign up with them or do business with them directly, they would actually stop their cardholder access to their airports. So this is a pressure which has been built up, and these are the reasons that why these clients had to move. But let me tell you that our contracts are still in place. It is not that we were just managing the lounge program. Just the airport lounges. There are other services also which Dreamfolks provides to these clients. Secondly, also to mention that, there are around 70 plus lounges in India. However, these operators, the airport operators who are trying to get into this business, are holding around 35 to 40% of the lounges only. It was just on 30th late evening wherein we got this information that yes, there's going to be a migration, and that's the only reason. So I think we are following the compliances, and I'm very clear that I would not want to give a wrong narrative to the market. Contracts are not shut. The contracts are still on. Okay. Today also, if you actually look at it, the ICICI program is still live on our platform.
The management of Dreamfolks there in a conversation with CNBC TV18. Shrikant, on the charts, Dreamfolks, well, it's been trading well below its IPO price of 326. Now with this latest fall that you've seen, is there any support that lies at lower levels?
So Armaz, this stock was around 209, 210 for a couple of months. But from there, we saw some mild recovery, or we can say just relief rally sort of trend in the in last few months. But again, based on its technical formation, one thing is very clear, that the stock is under severe selling pressure. And on the dismissal of 210, I'm expecting this stock to fall to the next important support level, which is around 180 and maybe 160 in the worst case scenario. So based on extensions, we can draw these supports. But broadly, I'm of the view that 210 is the level below which one should look for exiting out of this particular stock.
Okay, all right. Well, let's listen in to what Apollo Hospitals MD, Ms. Reddy, had to say on the newly listed entity, NewCo, which merges the pharmacy, digital and distribution businesses. And it's projected to generate revenues of around 25,000 crores by FY27 with margins of around 7%. Let's hear her out.
First, in terms of valuation, we've always felt that the sum of the parts did not do justice to the digital. The rationale behind doing the whole thing is not just to capture the value of the sum of the parts, but to go beyond and create a very strong retail digital business, which is omni-channel. As you look at forward, I think the offline pharmacy growth is around 20%. And the EBITDA generated from that is 1,000 crores in 2027. KeyMed is growing at about 18-19%. And with the introduction of private label, there is a very strong opportunity to also improve the EBITDA margin and the EBITDA coming from that, which will be 700 crores. Digital, we are quite sure that we'll get at least 60 to 100 crores of revenue. So total, the breakup of I've given you the breakup of the EBITDA because in the end, that's what counts. You will get 25,000 as you look at the 17 and the 20% growth coming from the three different, the digital, the offline, as well as KeyMed. So the 20% growth results in 25,000 crores of turnover.
All right, and JSW Paints is aimed to challenge the top two players in the industry after the acquisition of AkzoNobel India assets. The company has acquired a majority stake of 74% stake in the maker of deluxe paints. Let's listen in to what JSW's Parjindal had to say on the deal.
If we get all the approvals, the Competition Commission of India approval, as well as complete the open offer, and we get into the business, we will become the fourth largest player in the Indian paint industry. With looking at FY25 numbers combined, we'd have a top line of about 6,000 crores. And we would be in striking distance of the third largest player in the market. And our aim would obviously be, to understand the culture of AkzoNobel India, integrate the families of AkzoNobel India and JSW, make it one big, paint company. Look at the synergies in the market, because there are a tremendous amount of synergies both in the decorative side of things as well as on the industrial coating side of things, and then leverage the technology partnership that we will continue to have with AkzoNobel. So our goal is that we would like to come into the top three in decorative and like to be the #1 player in industrial coatings.
More competition in the paints sector. But gentlemen, Sudeep, Shrikant, thank you so much for sparing time and joining us on the show today with your views on the stocks that were discussed. Now, in an exclusive conversation with CNBC TV18, Telecom Minister Jyotiraditya Scindia has ruled out any increase in the government stake in Vodafone Idea. He also confirmed that the Telecom Department was evaluating Bharti Airtel's proposal to convert spectrum dues into equity, a move similar to Vodafone Idea. Listen in.
When it comes to further equity conversion, I think you've said earlier also that it's not as possible.
There cannot be. There possibly cannot be further equity conversion unless the government share gets diluted to lower than 49% to enable us to increase it back to 49%. Because we can't increase it beyond 49%, because the minute you do that, then it becomes a PSU, which is not our intent.
But are there other options being considered?
At this point of time, the equity option, increasing the equity option is not an option. As far as other options are concerned, there's not much discussion happening at this point. If there is, we will let you know.
Analysts have said that 2-year deferment of Vodafone AGR dues is the most possible thing that the government could do.
That is, as I said to you again, that is not for us to decide. That is for the management of the company to decide.
Right. Now, also,
I do not happen to be the CEO of Vodafone, and neither do I happen to be the CEO of BSNL.
Let me also ask you about Bharti Airtel. Now, Bharti Airtel has also applied and made an application to you for equity conversion. The government seems to be considering this. What's your view right now? Has a call been taken?
The Department of Telecommunications is evaluating it. Once they evaluate it and they bring it up to me, then I shall exercise a view based on the analysis that has been done. At this point of time, they have not brought it up to me.
Time to slip into a short break. On the other side, we'll focus on all the big corporate voices. We'll also get you set up for tomorrow's trading action with all the events to watch. Welcome back. You're tuned into Markets Forward. As promised, let's get to all the top corporate voices that joined us during the course of the day. First up, Mahindra & Mahindra. Management says that the new launches have done well for the company. They add that its growth momentum is steady in the SUV segment and hopes to maintain a mid to high teen volume growth for SUVs in FY26. Further, the management is optimistic on the export front, projecting high double-digit growth in the overseas markets for the current fiscal year. On the rare earth magnets, the management says it's exploring alternate sources and designs for rare earth magnets. That's not all. The company is also mulling over a price hike in the next 2 to 3 months.
Next up is Allied Blenders. The management says that the excise duty hike on Indian-made foreign liquor in Maharashtra will impact volumes by 25 to 30%. He adds that the company is walking on the tightrope of balance between volumes and margins. Maharashtra accounts for less than 10% of the volumes for Allied Blenders. The management also said that the hike in duty will make Indian-made foreign liquor costly by 50%. And that's not all. The management is now actively looking out for acquiring luxury segment companies.
Vedanta Industries' Suyog Kotecha acknowledged that the supply chain shocks from multiple geopolitical events in the last quarter have been significant. He, however, noted that the sector is seeing volume-led growth. Margins remain under pressure due to supply-demand mismatch in agrochemicals. Kotecha also said that the company plans to invest 1,000 crores of capex in FY26.
And before we wrap on the show, gearing you up for tomorrow's trade with some of the key events to watch out for. And who better than Vamakshi to take us through that?
Hormaz, tomorrow being the expiry day, we'll be keeping an eye out on any sort of volatility as far as the frontline indices are concerned. But getting to the economic cues then, we'll be watching out for the US initial jobless claims. Keep in mind that US financial markets will also be closing early ahead of the Independence Day. But nevertheless, we'll be keeping an eye out on the non-farm rolls payroll data as well. The US S&P Global Services PMI is also expected to come out tomorrow. And from the domestic market, we'll be watching out for the services PMI data. Moving on then to the stocks, VST Industries will be in focus. The stock goes ex-dividend tomorrow, and a couple of board meetings also lined up in tomorrow's trading session, which includes Patel Engineering. They will be considering proposal for issuance of debt securities. Prime Focus also on our radar. They will be considering fundraising proposal, and so will PN Gadgil Jewelers. So roughly, those are some of the important cues to watch out for.
All right, Vamakshi, thank you for that. With that, we call time on this edition of Markets Forward. Nigel and I take your leave. For more news and updates, stay tuned. We'll be right back.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. The Sensex and the Nifty end lower as financial stocks drag the markets. Mid-cap index snaps an 8-day winning streak. Metal stocks buck the downtrend.
I think we're going to have a deal with India, possibly, and that's going to be a different kind of a deal.
U.S. President Donald Trump hints at a trade deal with India with much less tariffs if U.S. companies are allowed to compete in the Indian market. India's top trade negotiator extends his stay in Washington as talks continue on the contentious agri and dairy sectors. The U.S. Senate passes President Trump's sweeping spending bill after Vice President Vance cast the tie-breaking vote. The bill now goes back to the House, with Trump setting a Friday deadline to pass the legislation. The bill is set to add $3.3 trillion to U.S. debt. More than 30 people killed in Gaza in the last 24 hours as Israeli attacks continue. President Trump says Israel has agreed to a 60-day ceasefire proposal, urging Hamas to accept it. More than 600 Palestinians killed in the last 5 weeks while waiting in queues for food assistance. State Bank of India classifies the loan account of Reliance Communications as a fraud, initiates action to report the name of Anil Ambani to the Reserve Bank of India. Ambani resigned as a director in the company in 2019.
We can't increase it beyond 49% because the minute you do that, then it becomes a PSU, which is not our intent.
Telecom Minister Scindia rules out any increase in government stake in Vodafone Idea, confirms that the Telecom Department is evaluating Bharti Airtel's proposal to convert spectrum dues to equity similar to Vodafone Idea's. That's an exclusive.
HDB Financial lists with a premium of 13% over its IPO price, delivers the biggest listing gain among public issues of over 10,000 crore rupees since the pandemic. Zigachi Industries says 40 people are dead at its Hyderabad factory after an explosion on Monday. The company's shares are down over 20% in the last 3 sessions. Airport services provider Dreamfolk speaks out after ICICI Bank and Axis Bank pull back on key credit card programs. The company blames 2 major airport operators for pressuring banks without naming them. Majority tax victory for global cloud-based software firm Salesforce. The Supreme Court dismisses the tax department's petition seeking to tax subscription revenue from India as royalty. Let's head straight to the day's market action. The Indian market ended with cuts today, with the Nifty slipping below the 25,500 mark. Nifty PSU Bank snapped its 6-day winning streak as well, ending about 1% lower. That's the Nifty Bank for you. The Nifty closing about 90 points lower, 280 points gone there on the Sensex today. And the mid-cap index also closing lower today, down by about 80 points. Surbi joins us now to wrap up the day's trading action. Surbi, what was weighing on the markets today?
Well, it was a midweek breather for the bulls as the market has continued to consolidate so far. 3 sessions. The Nifty is now a little over 200 points off the high that it hit on Monday, which was over 25,660 thereabouts. So today we're talking about that weakness happening not just at the large cap index level, but even mid caps. Mid caps were subdued throughout, though the mid cap index did not fall as much as the Nifty. The advance decline ratio was still bad, and I'll come to the individual moves and shakers in just a bit. But leading the declines today was the financial part of the market. Financials and Bank Nifty in particular, it was down 1%. So let's start with the losers on the financial side. Shriram Finance, IndusInd Bank, Bajaj Finserv, HDFC Life, SBI and HDFC Bank themselves, all of these stocks, banks and non-banks, losing anywhere between 1 to 3%. So very clear weakness out here. But you can't just pin the blame on the financials of the banks, because even outside that list, look at L&T, look at RIL, look at some of the PSUs like BEL or ONGC. These stocks were down. Even some of the consumer names like Nestle, no real great shakes there, and a cool-off continued. Metals, however, were on the upper side. Now, when we're talking about the green side of the screen, so metals, perhaps it has something to do with the optimism on some sort of a trade agreement between China and the US, and also some talk about maybe production cuts happening in China supporting prices. But the ferrous stocks did really well. So Tata Steel and JSW Steel, they were the Nifty winners for the day, gains between 2 and 3% in most cases. Other gainers included Asian Paints. Even as the Competition Commission of India launches its probe, Asian Paints saw some buying at the low, so almost 2% higher. UltraTech Cement had a good day. Maruti and Bharti Airtel were the other stocks on the green side of the screen. Now let's come to the mid-cap movers. Very, very different hues over here. So if you talk about the upside, then RITES was reacting very well to a contract that it won. On Tata Communications, there was a favorable brokerage note. That's why that stock was up about 5%. Sagility managed a fair amount of green as well. But then you also had stocks that were losing ground. Case in point would be Hyundai Motors. Numbers not very great for the month of June. Hyundai was down about 5-6%. Swiggy and RBL Bank, 2 more stocks on the lower side. A lot of buzz around whether there's a deal brewing with RBL Bank. Anyway, the stock ended about 4% lower. Going forward, the progress of the India-US trade deal, of course, is something that the markets will eye very, very carefully and keenly. And then we're waiting for the US jobs report. The ADP employment report numbers will come out on Wednesday evening. But the big report, the non-farm payrolls report, comes out on Thursday this time, because Friday is a US market holiday. So that's where the markets will take their next cue from.
All right. Many thanks, Urbi, for joining us. And staying with the U.S., President Trump has hinted at reaching a deal with India, claiming it's going to be a different kind of a deal. Addressing reporters on board Air Force One, President Trump said that the proposed trade pact will entail much less tariffs if U.S. companies are allowed to compete in the Indian market. This comes amidst hectic negotiations between India and the U.S., with India's top negotiator extending his stay in Washington. Now, both sides are at a stalemate on the contours around agri and dairy sectors, including several others. Remember, a failure to strike a deal by the 9th of July deadline will attract 26% tariffs on Indian goods. So the hope is that we will get at least one installment, part 1 of a larger deal done with the US ahead of that deadline. Here's President Trump.
I think we're going to have a deal with India, possibly, and that's going to be a different kind of a deal. It's going to be a deal where we're able to go in and compete. Right now, India doesn't accept anybody in. I think India is going to do that, and if they do that, we're going to have a deal for much less tariffs.
Well, that's President Trump on the India-US trade deal. And Mukesh Aghi, President and CEO of the US-India Strategic Partnership Forum, says that the interim trade deal between the two nations is likely to cover at least 6,000 product lines, but Aghi believes the deal is unlikely to cover agri and dairy sectors, which are, of course, the big bone of contention. Take a look.
India, under the law, cannot allow GMO. So I think the government hands are tied. And we are trying to explain to the US government that let's not push hard on that area. Our feeling is that US will focus on getting first interim deal going and then focus on ag, dairy, and others in the latter part of the discussion itself. Our estimate shows slightly over 6,000 product lines, which both sides have agreed to move forward.
Well, that's Mukesh Aghi there. Now, President Trump has warned of imposing a 30 to 35% tariff on Japan if a trade deal is not reached between both countries before the 9th of July. Japan and the US are gridlocked over the treatment of the agri-industry. Japan's top trade negotiator said the country will not sacrifice its agriculture sector to seal a trade deal.
We have a great relationship, great reliance, and really a great sort of a partnership in a way. But on trade, they've been very unfair. And those days are gone. So what I'm going to do is I'll write them a letter, say we thank you very much. And we know you can't do the kind of things that we need. And therefore, you'll pay a 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know. And it's very unfair to the American people.
Well, that's President Trump on imposing tariffs on Japan if a trade deal is not inked. Now, the U.S. Senate has passed President Trump's one big, beautiful bill by a razor-thin margin. After days of heated debate and an all-night session, Vice President J.D. Vance cast the breaking tie. The bill includes deep tax cuts, reductions to social programs, and major increases in defense and immigration enforcement spending. The bill could increase national debt by over $3 trillion in 10 years. The Senate bill removed a proposed tax on solar and wind energy projects, but will end tax credit for clean energy sooner than its previous version. It also imposes a 1% tax on remittances. The legislation is likely to face challenges in the U.S. House, where Republicans cling to a thin majority and some GOP lawmakers already voicing concerns against the bill. The big corporate story back home, State Bank of India has classified the loan account of Reliance Communications as, and I quote, a fraud. In a letter dated the 23rd of June, the bank said 3 show-cause notices have been issued to the company and that the name of Anil Ambani has been sent to the Reserve Bank of India. Anil Ambani resigned as a director of Reliance Communications in 2019. Ritu joins us now with more details. Ritu, take us through the reasons as to why SBI has arrived at a fraud classification for Reliance Communications.
That's right. State Bank of India has classified the loan account of Anil Ambani Group's Reliance Communication as fraud, and in a letter dated the 23rd of June, SBI explained it issued multiple show-cause notices to the company in the last year, and after reviewing their responses, its Fraud Identification Committee concluded that they had failed to explain the non-adherence to the terms of the loan, and they couldn't really justify the irregularities in the conduct of their account, resulting in the company's account being tagged as fraud. Now, SBI says it is now going to report both Reliance Communications and its erstwhile director Anil Ambani's names to the Reserve Bank of India. But remember, this is not the first time that the company's account has been classified as fraud. Canara Bank had done it in November last year, but then later the Bombay High Court stayed the move, citing the lack of borrower hearing according to RBI guidelines. Now, Reliance Communications on its part says that the company has been under the corporate insolvency resolution process since 2019, and the loans that SBI is referring to were taken before the process began. A resolution plan is in place and it is pending the final approval from NCLT, and that under Section 32A of the Insolvency Code, it is immune from prosecution for any past actions once the resolution plan is approved, and therefore it is seeking legal advice on the next steps. But SBI's reasons for fraud classification are quite stark. For instance, it found loans worth about 6,200 crores were used to repay other bank loans, almost 5,500 crores went to related party payments, another 1,880 crores was invested and quickly liquidated, suggesting the funds were not used for genuine business purposes, and so on. So there were clear red flags, and SBI said these transactions suggest fund diversion, breach of trust and manipulation of accounts, all of which happened under the watch of the company's management and its promoters.
All right, Ritu, many thanks for joining us. The big newsmaker this evening, Telecom Minister Jyotiraditya Scindia has ruled out any increase in the government stake in Vodafone Idea. Remember, the government stake currently stands at 49%. Speaking to Parikshit Luthra, Scindia made it clear that government has no intention to make Vodafone Idea a public sector company. The minister also confirmed that the telecom department was evaluating Bharti Airtel's proposal to convert spectrum dues to equity, similar to what has been done for Vodafone Idea. But of course, in the case of Bharti Airtel, it would amount to a very small amount that gets converted. Take a look.
When it comes to further equity conversion, I think you've said earlier also that it's not as possible.
There cannot be. There possibly cannot be further equity conversion unless the government share gets diluted to lower than 49% to enable us to increase it back to 49%. Because we can't increase it beyond 49%, because the minute you do that, then it becomes a PSU, which is not our intent.
But are there other options being considered?
At this point of time, the equity option, increasing the equity option is not an option. As far as other options are concerned, there's not much discussion happening at this point. If there is, we will let you know.
Analysts have said that 2-year deferment of Vodafone AGR dues is the most possible thing that the government could do.
That is, as I said to you again, that is not for us to decide. That is for the management of the company to decide.
Right. Now, also,
I do not happen to be the CEO of Vodafone, and neither do I happen to be the CEO of BSNL.
Let me also ask you about Bharti Airtel. Now, Bharti Airtel has also applied and made an application to you for equity conversion. The government seems to be considering this. What's your view right now? Has a call been taken?
The Department of Telecommunications is evaluating it. Once they evaluate it and they bring it up to me, then I shall exercise a view based on the analysis that has been done. At this point of time, they have not brought it up to me.
You've met representatives of Starlinks over the last few months. They've got one approval from the government. InSpace is waiting for them to respond to their draft, and they may give an approval soon. But finally, how long would it take to clear the decks for them to operate in India?
Well, I think that the process is on. They have to get permission for their satellite Earth gateways to be located in India. They've got to get InSpace permission. They've got to get security clearance. And then they have to get spectrum. These are the major 4 milestones, if you will, to be able to operate in India. I am of the opinion that the sooner my SATCOM companies operate, and by that reference I mean not only Starlink, whether it's OneWeb or it is Reliance Jio, I'd like them to offer services as soon as possible in as many areas as possible, so that there is a fair degree of competition for those that are not connected. And I see that happening, as I said, in the next couple of months. This process should get ironed out.
Well, you can catch that entire conversation with the telecom minister at 7:30 p.m. right here on CNBC-TV18. India's largest IPO of 2025, HDB Financial Services, made its stock market debut today. The stock listing at a premium of 13% to its IPO price of 740 rupees a share. The IPO witnessed strong investor interest, with the issue being subscribed nearly 17 times on the final day of bidding. HDB Financial's MD and CEO G. Ramesh said the company is ensuring it has adequate capital to meet all aspirations. Airport services provider Dreamfolks has spoken out after ICICI Bank and Axis Bank pulled back their key credit card programs. Speaking to CNBC-TV18, the company blames 2 major airport operators for pressurizing banks, but doesn't name the operators. Adani Airports, GMR and GVK are the top private airport operators in India. Shares of Dreamfolks declined today. The company provides lounge access and other premium services for travellers at airports and is present in more than 100 countries. Vinny Motiwala joins us now with more details. Vinny, what exactly is the issue here?
Absolutely. So what we understand, and this came in as a notification on BSE, was that certain programs for Axis Bank, ICICI Bank have been closed with effect from 1st of July 2025. Now, what they're highlighting that the contracts with both these clients overall are still active, other than the lounge services where there are some issues. So some of them have been closed is what the word came in. Now, do not forget the 93% of the revenue for the company comes in from lounge services, and 7% approximately currently comes in from non-lounge services. The management spoke to us today on CNBC TV18, and what they are highlighting that, the notification for this cancellation of the services from Axis and ICICI Bank just came in few hours before the cancellation of the program. That was yesterday when the announcement came in. They said there was no information from the clients on the migration of the program before, and there are certain migrations that will happen. Some of the cards will still be with DreamFox, some of them will be migrated. The company also said that there were two major air operators who have entered the business and which is putting pressure on the company in terms of their business. They also mentioned that the airport operators putting pressure on clients like ICICI Bank and Axis Bank, which has led to some of these cancellations coming in. The client also highlighted that they had to move from company's lounge program due to the airport operator pressure. Because of all these pressures coming in from two other operators, there was pressure on the clients as well, and that's why the shift that has come in. Company highlighted that obviously there are 70 plus airports or lounges where they're working on, but around currently 35 to 40% of the lounges are operated by these two major operators, so there could be some impact on this front. The lounge is one of the biggest business and revenue growth drivers for the company. They're focusing on new ones, but 93% of the revenue comes in from lounge services, and Axis Bank and ICICI Bank are one of those big clients, and they just got a notification few hours before that cancellation that happened yesterday. That's the word from the management.
It was a pressure which was getting built up to the clients. Okay, it was a pressure tactics which were done. So to be very upfront, it is mainly done by these two major airport operators who have now started getting into the similar business. The pressure which has been built up is to, tell the clients that, in case if they do not sign up with them or do business with them directly, they would actually stop their cardholder access to their airports. So this is a pressure which has been built up, and these are the reasons that why these clients had to move.
DreamFox, the lounge services company, accusing private airport operators of pressurizing them and getting banks to discontinue services. Up next, major victory for global cloud-based software firm Salesforce. The Supreme Court dismisses the tax department's petition seeking to tax subscription revenue from India as royalty. That and more when we return. A major tax victory for global cloud-based software firm Salesforce. The Supreme Court has dismissed the tax department's petition seeking to tax subscription revenue from India as royalty. Ashmit joins us now with more. Ashmit, take us through the contours of the case. This has, of course, been ruled on by the Delhi High Court, by the ITAT as well, and today the Supreme Court upholding the previous verdicts.
Well, indeed, Salesforce was under the IT department's scrutiny. The IT department was construing their income that they make here, subscription income that they make out of India, and was construing that to be a case of royalty, and then subsequently had sought to tax that. That was the argument that was first raised before the ITAT, then before the Delhi High Court, and then finally before the Apex Court is here as well. And constantly, what Salesforce has been arguing is that, look, they don't have a presence here. They have protection under the India-Singapore DTAA. Going on to say that this is not, there is no case made out for royalty, as there is no transfer of copyright, that the users here in India are only provided a web-based access to the services that are provided by them, and therefore there is no case that has been made out as far as royalty is concerned or fees for technical use, and that is something that was upheld by the ITAT, next upheld by the Delhi High Court, and now Salesforce's contentions has now been upheld by the Apex Court as well. The Supreme Court saying that this is clearly not a fit case as far as royalty taxation is concerned, and therefore on that count dismissing the application that had been filed by the Income Tax Department. So a big reprieve coming in. The Income Tax Department was looking at a number of 7 to 8 assessment years it was looking at, and this could have translated into a big tax demand, but the Supreme Court coming to the rescue, saying that not a case of royalty and therefore not a fit case for taxation for royalty that was made out by the Income Tax Department. Back to you.
All right, Ashmit, appreciate you joining us. That's the latest there on the tax department's case against Salesforce. With that, it is time for us to wrap up this edition of Business 360. But we leave you with a sneak peek of the third episode of our show, Leadership Language, with the veteran of the finance industry, Keki Mistry. The full episode airs tonight at 5:30 p.m. Take a look.
My advice to a CFO is always be very cautious. It's not your P&L that is important, it's your balance sheet that's more important. And keep your balance sheet as safe, as secure as you can. See, I told you I joined HDFC
because it was a happy place.
It looked like a happy place to me, and it remained a happy place all through. The most important thing is keep politics out of the organization.
What was the compass that guided you?
Don't chase market share for the sake of chasing market share, because by chasing market share and having these short-term goals, you will do something which will go wrong. Never do anything which would make you feel even slightly nervous or slightly unhappy if it was reported in the newspapers the next morning. That was a mantra that we had followed at HDFC.
What excites you the most about the India growth story?
The growth that you will see in India, you do not see that in China or in any other part of the world. Forget the West.
I don't know how many people know this, but you actually did box a little bit in your youth.
In my college days, I lost my tooth here.
You did, and was that why you stopped?
That's why I stopped.
So what do you think that you took from those experiences and brought to the boardroom with you?
I think learn to lose also. It's not that every time in life you will win.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. 6 months of the year are already over, and we've spent the last 6 months, the last many years, of course, talking about the mutual funds that you should have, the trends that you should be wary of, the insurance that's really, really critical for your portfolio and your well-being. Well, today's show is slightly different because it's not about stock tips or even mutual fund or insurance-specific product tips. It's more holistic in nature. Today's show is about how we need to look at our wealth creation journey perhaps differently, sometimes take a step back, look at whether we are doing things right, fix whatever we are doing wrong, and take a wider view of our overall financial journey. And helping us do that is someone who's got several decades of experience in the financial landscape, in the investing landscape, and she's an author also, and she's watched stock picking, money, personal finance up close and personal. Yes, let me welcome on the show Devina Mehra, founder, chairperson and MD at First Global. Devina, thank you very much for taking out the time. I know this is your first Let's Talk Money. We always grill Devina on whether this sector is good or not. What do you do with, stock A versus stock B? But I promised you a different conversation. Thank you so much for joining in for it.
Thank you for having me, Surabhi. Pleasure to be here.
So, let's look at things a little more holistically in your own journey, because you're someone who was working in the big bad world of finance with, I think, a US bank. And then you decided to go your own way to look at, whether it's portfolio management, wealth management separately. So why don't I start with an open floor kind of a question to understand what you have learned along the way?
Oh, that's far too many things, because it was an evolution. When I started this business in 1993, even stock research did not exist as a career. I mean, no company had an investor relations department. Such a thing did not exist. So right from there, and we did not have, you have a course in IIM Ahmedabad on securities research, because that option did not exist as a career. So it has been a journey, and of course you learn many things which are there in the textbooks. Also, you really understand only when you live through it. For example, asset allocation accounts for 85% of your return is there on page 1 of every investment book. But
you're still looking for the stock.
Yeah, you're still looking, you start with looking for the multi-baggers till you come full circle and find out that yes, what was being said made sense.
Yeah, so let me ask you, Abhin, and in your decades of observing the market, observing different types of investors, big, medium, small, how has the Indian investor changed? And I mean not so much from the point of view of the wealthiest, bulge bracket, family offices, but more from, say, the mass affluent. What are the changes you've noticed?
So in the beginning, of course, not that many people invested in the markets to start with. So that has become, you can say, democratized over time, and especially after COVID, which has both pluses and minuses. And people, and very often when people get into the market, they think there is some magic wand which will make them rich quickly, or they will have something where they can get the multi-baggers, or for that matter, which is even worse, that they will become these traders who make money. So that's how all these courses get sold off. And I recently wrote that anybody who has this magic wand where they know for certain what will be a multi-bagger, or for that matter, a good trading strategy, why would they share it with you? If they can make 1% every day, that means they can have their money grow 7 times in a year. So they're not going to share it with you. And you can just do the calculation that 1 crore can become 20,000 crores in 5 years, and so on. And
I think that's already the first lesson that we have from this conversation, that don't fall prey to stuff that seems absolutely gold-plated. It probably isn't, right? That's probably lesson number 1 from this conversation. But on that, that's also perhaps a reflection of the essential need to grow wealth in a better way, in a faster way than what we've seen our grandparents do, or even our parents do. That time, I mean, there was less investing, it was more saving. It was all about a bank fixed deposit or the odd LIC policy, right? So now I think it's well understood that mutual funds are one of your very good friends. If you were to advise anyone to look at very holistic sort of portfolio management or wealth creation, what's the starting point?
So the starting point is your asset allocation. And just as in Google Maps, you don't just put in your destination, you have to put the starting point. So first understand where your investments are. And investments, people, as soon as you say investments, they think it means stocks and mutual funds. But no, I mean, all those tax saving schemes that you invested in, so those are also investments. Some land you inherited from your grandparents, or apartment that you have booked, gold, if you hold some crypto or anything like that, everything is investment. So first look at all where you are invested, and against that you might have loans, housing loan, car loan. So look at the whole picture and then decide where do you want to be. So do a deliberate asset allocation, and if you do that sensibly, that is 80% of the way through. So sometimes people just freeze, saying only if I understand everything well, I don't know enough about stock markets, then I will start investing. So you don't have to wait for the then. You start with the basics, you get the broad allocation right, and start as quickly as possible. We've all seen those calculations that if you start saving at 25 versus 30, how much more you would have to save, or 35, 40. So start quickly. And one other thing, don't be at extreme ends of the risk spectrum. You spoke about savings. Yes, saving alone is not enough. So if you save a lakh a year and put it in a bank fixed deposit, you will have 75 lakhs after 30 years. If you are
that's scary.
Yeah, if you are in a multi-asset portfolio which gives you maybe 9.5% compounded, you will get to 1.7 crores. If you're a slightly more aggressive with more equity, maybe 12-13% compounding, you will be at 3 crores. So 75 lakhs and 3 crores. So that's the range. So even without taking excess risk. So be sensible about it. Don't be in a hurry to get rich quick. So that I will repeat. So there is no magic formula. Nobody has a magic formula for multi-baggers. Sometimes people ask me that you found HDFC Bank in 1996 or Amazon in 2001. So tell us what is the next Amazon or HDFC Bank that I can buy for my child and forget for 20 years. So nobody has a crystal ball for 20 years. Nobody has ever had a crystal ball for 20 years. I mean, Warren Buffett says that in 75 years, maybe 10 of my decisions have made me all the money. So if he knew which 10 they were to start with, he would have put all his money there. Same with Rakesh Jhunjhunwala, same with anybody. So no one knows in advance what the trajectory would be. So no one knows which company will be a multi-bagger. So you have to take a sensible approach, and you have to manage risk very tightly, because investing is a loser's game. So that's
yeah, that's also a heavy headline, right? Investing is a loser's game. You just have to ensure that your winners are bigger than your losers.
You have to ensure that you play not to lose. So winners games and losers games, the difference is that and games change. So aviation once upon a time was a winner's game. When JRD Tata was flying that Karachi-London flight, it was a complete adventure sport, that some part didn't work. He wound a wire into something and made it fly. Now, I mean, it's not a very great example to go presently, but the point is that the only way to fly an aircraft today is to go by the checklist and make no mistakes. So investing maybe, 50 years ago, when even getting an annual report, even 30 years ago, was not easy, and you could unearth gems which no one had heard of. But now that is not the case. Now if information is available, you have to play that not to lose. Not to lose doesn't mean that you don't book losses. In fact, you have to book the small losses so that you don't take a big hit on your capital. That has to be the mantra. So if you don't lose, then you win, because then the compounding will take care of you. But if you are refusing to admit mistakes, and I mean, I say the best thing you can do for your portfolio if you're investing in stocks is when you invest, tell yourself, I may be making a mistake, because I can guarantee you a significant portion of your investments, things will not go as you envisaged.
So be humble about it. Devina saying starting point is that you could be making a mistake. Just admit that, and then cut the losses in
so that you don't take a big hit, because percentages are not symmetrical. If you lose 1/3 of your capital, then your capital has to go up 50% for you to go to zero. If you halve it, then you have to double it. So it like down 50% means you have to be up 100%. That's how it goes.
Mistakes are costly. Make sure you cut your losses and cut those mistakes in time. But Devina, I want to take a step back. Actually, we're talking stocks and investing. I want to ask you about the difference in the DIY approach and the difference in letting it run through a professional fund manager, and then the headache is to pick the right fund manager as well. It's not easy, right?
Right.
Since COVID, because like you're saying, information has been widely available, and we have all these fintech apps. I mean, you can buy a stock perhaps as quickly as you swipe on your Instagram profile, right? It's become that easy in terms of the technicality, the access. Yeah, whatever you're browsing. I mean, in that same microsecond, you can be buying or selling a stock as well.
Right.
I mean, what's the advice you give to people when they ask you, what do you think, personally, should full-time working people be managing their own stock portfolios?
Do a thought experiment. That's what I tell people. That let's say you want to invest yourself directly in the stock market, and then you are considering, let us say, half a dozen other funds or PMSs or whatever. So consider yourself also a fund manager. So you have these 5 or 6 fund managers, and you are fund manager number 7.
Wow, and you're competing with the best of the best in the country.
So you look at your entire track record. Don't pick and choose, and don't say that last year I found this multi-bagger. No, I mean, now with your DP account, look at everything that happened and look at what were your returns, what was the volatility, and then compare it with all the other 6 fund managers, and then see whether you are the very best. If you are not the very best, then you definitely should not be investing 100% of your investments directly. So that's of even your equity allocation directly. But I mean, this is an interesting thing to do. You want to do it, you want to learn it. So I mean, the only way to learn it is by doing. So if that is the case, allocate a small percentage to yourself, almost like play money, that okay, I will play with 10 or 20% of my corpus, and the rest I will give to professionals. Because it's difficult, as you said, that people have a day job, they cannot do this full time, and therefore their results are unlikely to be as good as the professionals. And so, and always look at returns and risk volatility, both sides.
Yeah. Okay, fair enough. I think that gives us a good starting point. What we'll do is we'll take a quick break, come back after the break, and we'll get Devina's help to design the rough framework for a medium risk portfolio. We'll take some examples, we'll put certain thoughts in place in terms of the financial goals as well. Back with that in just a bit.
Let's talk money. Talk Money.
Welcome back. You're with us on Let's Talk Money, and this week Devina Mehra is helping us put some rules in place to that whole quest for creating long-term wealth. Devina, so now it's time to ask you for some advice. So I'm going to take an example. Say someone who's in their mid-30s, earning, will perhaps continue to earn for another 20 years and is looking at a holistic approach to portfolio creation. So what is the kind of looking at the market environment today, what is the kind of asset allocation, which markets, which asset classes, what's the proportion? What would you advise this medium risk mid-30s investor?
Okay. So first of all, of course, everybody's life circumstances are different, that how many kids you have, whether your parents are dependent on you, many of those factors come into play.
Absolutely.
But one thing when you're planning for 20, 25 years, which we haven't spoken about till now, is that look at global diversification. That is so important. I give the statistic all the time that when I started working, the dollar was 12 rupees. So it's been
I cannot. What? When you started working, $1 fetched 12 Indian rupees.
12 Indian rupees. So in the
86 something today.
Yeah, so in the course of less than a career, there's been a 90% depreciation. So when you are planning for 20, 25, 30 years hence, this is not something you can forget. So because that your rupee loses value over time. And very often, if anything, hard currency expenses have gone up since then. People study abroad, people's children study abroad. And often settle there. So I hear many times people say that after retirement we'll spend half the year there. So basically your hard currency expenses have been rising, and Indians still do too little global diversification because when we were growing up there was no option to it. India did not have capital account convertibility. You could not invest in global markets. Now you can. So our grandmothers were right to buy gold because at that time that was the only currency hedge. But now you have the whole world. Again, people think global diversification means that you buy a NASDAQ index or you buy the 5 stocks you know the names of, or another 3 Chinese stocks you know the names of. That is not global diversification. Global means global because one golden thing in investing is that themes change. So no asset class, no geography, no sector does well forever. So US has done well last 12 years, but there was also, for example, 2003-04 to about 2007, US, and it wasn't coming off a high. It was already in the doldrums after the tech crash. Still, it continued to lag, and that was a golden period for emerging markets. India went up 6 times. Whole emerging market index went up 3.5, 4 times. So you have to have the whole globe as the so that's why, for me, it's a cause. So that's why, we have a whole, all investing across all geographies, all asset product that starts at $10,000, at just 8.5 lakh rupees, which you normally won't get for less than $1 million. So coming back to your question.
So right now, when you want to achieve adequate global diversification in your portfolio, and people, sometimes equated that I'm invested in the NASDAQ, ETF, or I have some fund which is dovetailing on the Dow. I don't know, is that enough?
No, that's not enough. That's what I was saying. US is not the world. So in 2021, if you remember, is when all these NASDAQ ETFs and fund of funds, etc., were launched in India. And not in hindsight, but at that time, I had come on your channel also and said that, 3 years NASDAQ has done brilliantly. Don't assume that this will last. And 2022, NASDAQ was about the worst performing index in the world. It went 40% down from the levels at which those ETFs were launched. And people came to me and said, should I sell now? I said, now that, don't compound a bad buy with a bad sell. Because a stock down 40% can still be a sell. But a major index down 40% is almost never a sell. And so, of course, it bounced back from there. But that's the whole problem with buying very narrow, focused indices or funds, and often it's just a layer of cost getting added at the India end.
So then which are the markets, or where else
so
would
you
look?
have to see that changes. Again, I can't say today that you buy this combination and that will last for 10 years. So that's why we do that. We have a fund and we have portfolio accounts which do that, because that changes, and we look at it every quarter. For example, this year, now we've gone underweight US, even though it's still large, but we've gone underweight US, we've increased Europe, Okay. In China, we've been a little overweight from last year itself. India, we are slightly overweight. So that would be, so, but that changes.
Okay. Okay, so that's global diversification, which is extremely important.
Right. So over time, you should have 30–40% globally diversified.
Wow.
Yeah. So at least, I mean, logically it should be even higher, but because as it is, you are exposed to India. Your career is here. Your real estate is here. So and people say if India is growing so well, why invest?
Why look at other equity markets?
Yes. But in the 90s, which were the highest growing economies, they were the Asian tigers.
Correct.
And then there was a crisis.
Correct.
And in 1 year, those markets fell between 50 and 90%. And that was a wake-up call for me that if I was an Indonesian, my net worth would have been wiped out by 90%. So that was the sort of one of the triggers why we went global as far back as 1999. We were not just the first Indian, we were the first Asian firm to become a member of the London Stock Exchange, other than the Japanese. So because I realized that putting all your eggs in one basket is not a good idea.
It's not a good idea. Okay. On gold, I mean, you briefly mentioned a hedge against obviously currency risk, etc. But you know, gold is an interesting debate right now. Yes, households probably have enough of it, and there's one school of thought saying don't take overexposure because from your grandmother to your mother, I mean, there's enough gold in the households. But the other school of thought is that gold is rarely sold for emotional reasons or whatever. So, you know, many people say that do you really want to include that traditional old jewelry as part of your gold allocation? Because it's not a sensibly well thought out, balanced financial way of investing in gold. What are your thoughts on it?
So whether it was thought out or not, you hold it. So that you have that investment there. So I mean, there's no reason
but
to
you won't
say
sell
that.
it. That's the point. That people say that it's just notional holding. You won't sell your grandmother's jewelry.
Indians do. I mean, every time gold and silver reaches a peak, Indians are out there selling.
Actually,
I mean, even now the jewelers are saying that buying is not happening in gold jewelry. So. So I think you should definitely add it in your asset allocation. And many times the grandmother's jewelry, the daughter or daughter-in-law no longer wants to wear in any case.
Could be. But you know, on a steady state basis, obviously it will vary in different market conditions. But roughly speaking, I mean, do you give it 5%, 10% in a portfolio?
Yes, in that range. It should not be 25% of your portfolio because gold is an extremely volatile asset. People think it is, it is some sort of a stable asset, but the dollar price of gold in 1980 was not breached till 2007. It took 27 years. In between, it came down more than 60%. 19 years later, it was down 60% from the 1980 level. So this is what people forget. It looks good relatively okay in rupee terms because it's really a rupee depreciation chart. In dollar terms, it has been more volatile than the S&P.
Wow. That's something to think about. But, finally coming down to some closing thoughts, Devina, and beyond, of course, we've discussed the asset allocation and some portfolio advice. I want to understand from you, when you've observed people over the years, what do maybe the rich do differently, which keeps their wealth growing? Or, should I put it the other way? What do perhaps some middle-income Indians also do differently to break through, to move to the affluent side? What have you observed and what would you like to share with us at a more behavioral or maybe personal aspect?
So one thing is that don't start that so-and-so became so rich and what was the way they went. Because, for example, if you follow a very high-risk strategy where bulk of the people go bankrupt, but whoever survives, let us say, makes their money 10 times in a year. So if you start with 100 people, at the end of 5 years, there might be only one person left, but that person would have really made it out like a bandit. So you think that, but that's not good strategy.
Okay.
So never think like that. So as I said, do the basics right, that save sensibly, invest sensibly, start early, manage your risk, which means don't have too much. I mean, if you're talking of the stock market, don't be too concentrated in certain themes or certain sectors. Always have a stop loss on wherever you are investing yourself. So do all the sensible things. Don't think you will suddenly make it rich. I mean, somebody asked Rakesh Jhunjhunwala also that you made your money from trading, so why do you tell people not to trade? And he says that, I may be smoking, but I tell my children not to smoke. So because it's not a good idea, statistically speaking, to do that. So do the sensible, I mean, good investing can be boring. So it just doesn't sound very exciting that, do asset allocation and do global diversification, manage your risk. and manage your mind. That's the, lot of what I've read in the last few years has been on how many biases and randomness we have as human decision makers, and why those are all very hardwired within us. So you have to
give an example of,
for example, this is loss aversion bias, that we hate to book losses. And 1 lakh of a loss gives us more pain than 2 lakhs of profit. So don't try to make it up in the same stock or the same strategy. That's another thing which people end up doing, that when the stock comes back to my purchase price, I will get out, because the market has zero interest in your purchase price. So, you should be just agnostic where you make your money.
Okay. Manage your mind, and the money and the wealth will perhaps follow. All right, Devina, it's been a great conversation. Thank you so much for laying out some of the basic rules that we often tend to, overlook or forget. This is a good conversation. Thanks so much for joining us today.
Thank you, Surabhi. Pleasure.
All right. Well, we hope you enjoyed this show, this particular episode of Let's Talk Money. Do give us your feedback, your reviews, and of course, send us your comments, queries, anything else you would want us to talk about. We'll pick it up in the coming weeks. Thank you for watching.
Let's Talk Money.
बेहतरीन फैसला है जी। इससे क्या होगा, ट्रैफिक भी कम हो रहा है, ये भी देखो आप, और जितनी पुरानी गाड़ी जितनी रोड पे कम होंगी उतना बढ़िया।
इमीडिएट बेसिस पे कोई भी बंदा ऑफिस जा रहा है, कोई जॉब वाला है, तो फाइनेंशियली इतनी हर किसी की कैपेबिलिटी नहीं होती कि एकदम गाड़ी खरीद ले। आप उन्हें थोड़ा सा टाइम दीजिए ताकि वो अपना व्हीकल चेंज कर ले जो भी है।
Hello and welcome to News Centre. I'm Parikshit Luthra. The Delhi government's decision to ban the sale of fuel to old petrol and diesel vehicles has sparked chaos and outrage. In an effort to curb air pollution, the Delhi government has officially banned all fuel sales to diesel vehicles that are more than 10 years old and petrol vehicles over 15 years old. Multiple teams of government officials and police were deployed at different petrol pumps across the city to enforce the ban. A total of 350 petrol stations have been identified for policy enforcement and potential vehicle seizure as well. The rule has been implemented with the help of automated number plate recognition cameras at petrol pumps to detect and restrict the use of these vehicles. More than 80 vehicles were impounded on the first day of the ban. The ban took effect yesterday, and according to the government's Vahan database, Delhi has 62 lakh end-of-life vehicles. Out of this, 41 lakh vehicles are two-wheelers and 18 lakh vehicles are four-wheelers. Addressing the media, Delhi's Transport Minister said and defended the fuel ban and attacked the Aam Aadmi Party, accusing it of failure to curb air pollution.
हम दिल्ली के अंदर किस तरह हर जो कंस्ट्रक्शंस हैं उनको मॉनिटरिंग करने के लिए डीपीसीसी अपना मॉनिटरिंग के लिए वहां के लोकल जो इक्विपमेंट्स है वो लगाकर उनकी कंस्ट्रक्शन पे 2.5 PM 2.5 की सीमा में रखा जा सके, इस पे काम कर रही है। दिल्ली की सारी कंस्ट्रक्शन को मॉनिटर कर रहे हैं। हम ये सारी जानकारियां बताएंगे, लेकिन हमें एक दुख और खेद है कि अरविंद केजरीवाल जैसा बेईमान आदमी दिल्ली को ऐसी बीमारियों के साथ उलझाकर चले गया है, दिल्ली को ऐसे कानूनी जंजाल में फंसाकर चले गया है, और बार बार सुप्रीम कोर्ट के कहने के बावजूद, एनजीटी के कहने के बावजूद, एजेंसियों के कहने के बावजूद उन्होंने कोई काम नहीं किया।
To take this discussion forward, I'm now joined by Advocate Sanjay Ghosh and auto industry expert Arun Malhotra. Let me go across to Arun Malhotra first. Mr. Malhotra, what do you feel about the Delhi government's decision to not allow fuel for 10-year-old diesel vehicles, 15-year-old petrol vehicles? You know, the fact is, and there is a lot of outrage on social media, many people are saying that in a place like Delhi, when you have so much of traffic, you're often not even able to utilize your vehicle up to 70,000 or 80,000 kilometers in 10 years or 15 years. Why should you be forced to sell your vehicle, or why should you be denied fuel in this manner? What do you feel about these arguments? All right, we've lost that link with Arun Malhotra. Let me go across to Sanjay Ghosh at this point. Sanjay, a lot of anger there on social media with this new rule. Do you feel that this is going to be challenged in court?
Well, I'm sure it's going to be challenged, Parikshit. First of all, thank you for having me on your show, and thank you for such a balanced coverage. As I saw in your initial audiovisual, you showed both perspectives. Someone being very happy that the roads are better, less traffic. And there was another person who was saying that, you know, we are middle class or poor and we need time to transition. So it's a hard one. It's a hard decision. It's between the right to life and the right to livelihood, if I may put it that way.
Right. But do you feel that people should be denied fuel in this manner? And what adds to the complication is the fact that there is a NGT ruling which has been upheld by the court that you cannot ply 10-year-old diesel, 15-year-old petrol vehicles in Delhi NCR. So that rule is there. So do you feel the Delhi government is on a strong footing here?
See, interestingly, there is also, this issue started, as you rightly said. If you just give me just 1 minute to explain the legal, field over here. There was an NGT ruling in 2015, which said all diesel vehicles over 10 and petrol over 15 cannot ply in NCR region, right? Now, there was also, this was upheld in the Supreme Court in the MC Mehta's case. Now, there is also the third issue. In 2021, the government has enacted a special law which has set up an air quality commission. That air quality commission has now passed an order in April directing this particular fuel ban, which is being implemented from 1st of July in Delhi, and then after in November in Haryana, and thereafter next year in Ghaziabad and Faridabad and all the other areas. Now in Delhi, there is another issue because the Delhi government earlier was even impounding all vehicles which were on the roads. And there were several people who went to the High Court saying that, look, I have a vintage car or I have an old car with a sentimental value, and I am not plying it on the road, and I'm keeping it in my house. So therefore, the High Court directed and the Delhi government on the directions then made rules of how to allow end-use vehicles which are not plying. So now the selling of petrol to these kind of vehicles or diesel to these kind of vehicles only for routine management is an issue which now God knows what will happen, because now there's a blanket ban on selling. But the greater issue over here is that there can be no dispute behind the good motive behind doing this, which is to address vehicular pollution. But the problem is, the elephant in the room is that there are around 6 lakh people who are plying two-wheelers and autos, who will be covered by this, who will, and it's not only the livelihoods of those people, it is, for example, people who can't afford anything else but autos because of their pockets. Now they are going to be stranded and they're going to have great difficulty in commuting in Delhi. So the problem is, and this, I'm not making a political argument here. All politicians, I feel, are the same. All political parties are the same. And actually, it's the bureaucrats who rule. The problem is no one actually does a macro analysis of what ails our cities. And no one does that transition. Now, this is a transition which should have been done. There should have been an awareness created. And ability should have been made available to all these auto drivers to transition from these 10-year-old vehicles to a compliant vehicle. Now, you have not done that. All of a sudden, you have toppled this order on the populace. And then there is going to be a backlash. And then there is going to be a social unrest and tension. And this is how, Indian urban policy goes from one crisis to the other.
Right. Sanjay, stay with us. Let me also get in Arun Malhotra, who's joining us on the phone right now. Mr. Malhotra, the way out of this is to go for retrofitting of your car. That could take anywhere between 3 to 6 lakhs. And who knows, that's not even a safe option. You're literally trying to convert your ICE vehicle into EV, and the resale value of your car may just be about 1 or 2 lakhs. Why would you spend 3 to 6 lakhs on retrofitting it? Do you feel there should be some middle ground?
Parishit, you're absolutely right. I don't think retrofitment is the route which will help us at all. If you look at it, there has been enough intimation by the government. The NGT, for diesel vehicles, it's been more than 10 years, petrol vehicles, 5 years. So obviously there is a sufficient time given. But I agree with what the previous speaker said. Are we making it easier for people to upgrade to a new vehicle? In most abroad countries, foreign countries, there are 3 ways that you make it. You give a good scrappage value, you give a good discount from the manufacturer, and you give also a discount from the GST. Frankly speaking, not much has been done on that count. Regarding vintage vehicles and other things, they hardly contribute 0.01%, so it's just hiding behind a fig leaf. Basically, it has to come in. The problem I'm seeing more is that you have made it for Delhi. Delhi is porous borders of Faridabad, Noida, Ghaziabad, Gurgaon. All these places, people will just go to the neighboring places and fill and come. So, I don't think it serves a purpose. If you have to do something, it has to be more broad-based NCR and also make it easy for people to upgrade if they want to change their vehicle. Ultimately, we have to go for the scrappage. It can't continue going on. Their vehicles are 20, 25 years running. It might have to become national after some time. Why limit it to Delhi only? Because the emission is not a Delhi problem. Just because the NGT says it has to be more national. There are cities like Agra, Kanpur, Varanasi, which are as polluted as Delhi. So we need to take a very macro view and also make it reasonable for customers to upgrade.
This is, when it comes to taxi unions, this is such a big political issue. Other states don't implement such rules. And we see older vehicles plying in those cities as well. Do you think we need to now take a nationwide approach rather than just looking at Delhi NCR? And currently, we're also seeing a lot of stress in buying sentiment. When it comes to passenger cars, especially in the small car sales, we're seeing the market share of small cars declining year on year. That entry-level buyer is not coming in.
Absolutely, Parikshit, you're right. Clearly, it has to be more national. All laws of safety and emission which relate to are national. So there is no reason why on this law we only focus on Delhi. Because you had enough cars of they go to Punjab, go to Muxar, Sangrur or other places, any parts of the country. I don't think they're solving the problem. We're shifting vehicles from one place to another. So clearly the signal message has been given. Nobody can say the government has not informed. A lot of intimation has been given. Sometimes you have to take a strong view, but you have to make it more palatable by giving certain benefits, incentives that people can exchange their vehicle. That's the approach I see. And I think the manufacturers and the government both have a role to play in this. And not just by lip service, but some monetary service also.
Right. Sanjay Ghosh, my final question to you. And very good remarks by both our panelists, very balanced as well. But Sanjay, one thing that I would like to ask you, the Delhi government can say that the National Green Tribunal, the courts have always said that end-of-life vehicles are not allowed on the roads of Delhi. So how can you give them fuel? But what can an average Delhiite go to court and say? What is the kind of argument they can take in the present situation? Because the court will also follow the precedent of its own orders.
Well, that is true. And that will be a problem because obviously if a a vehicle can't ply, then where's the question of it being fueled? But there will be all these issues of livelihood, and you have seen, this is not the first illegality we have found. You had these demolitions in the early 2000s onwards, and Delhi has this unique gift that the parliament had to hear the voice of the people and come up with a special law to actually exempt the demolition activities of illegal buildings. Because if the court orders of demolition of illegal buildings had to be carried out in Delhi, then 90% of Delhi would stand demolished. Now, the fact of the matter is that you have allowed a culture of illegality or legal infraction to continue for 70 years, right? Now, all of a sudden, instantly, you can't have instant solutions, which is why this required a wiser solution, which, as the learned colleague said, and very true, you had to have a holistic approach. Where is the GST concession being given? Where is the loan being made facilitated that public sector banks will give loans to buy these vehicles, new vehicles?
Okay, we're running out of time.
Nothing has been done. So, that is the courts, so far as the courts are concerned, they may take a compassionate view and they may delay the timeline and give some more time to convert or transition.
Right. And we're right about the scrapping value as well. You might just get only about 40 or 50,000 from scrapping your vehicle. But if you sell it, in fact, if you sell your vehicle in Noida right now through any used car app, it will go possibly to some interior place in Uttar Pradesh, like Moradabad, Muzaffarpur. It can go wherever in the northern part of the country. So you really don't get it out of the cycle. It continues in the cycle as well. And it's still more lucrative for a person to sell rather than scrap his vehicle. But thank you very much, Mr. Malhotra and Sanjoy Ghosh, for joining us. We're taking a break, but on the other side, Telecom Minister Jyotiraditya Scindia rules out any increase in government stake in Vodafone Idea. A special interview when we return.
With us right now is Union Telecom Minister Jyotiraditya Scindia. Mr. Scindia, thank you so much for joining us here on CNBC TV18. In the last few days, you've also spoken about how the government does not want a duopoly in the telecom sector. Now, when it comes to the revival plans for Vodafone, what is on the government's agenda right now?
So first of all, I would like to correct your statement. I do not think a duopoly is healthy in any sector. And also within telecom, Parikshit, you'll understand that there are multiple verticals. My comment was at the Wi-Fi broadband International Wi-Fi Day. And my comment was in context with any vertical within the telecom sector. Be that as it may, as you have chosen the mobile vertical within the telecom sector, let me say this, that there are very few countries in the world that have 4 players within a particular market. And India happens to be one of those very few outliers in the world which has 4 players in the market. Each one of our players have upwards of 90 million subscribers or 100 million subscribers, be it from BSNL at 91 million subscribers to Jio at 390 million subscribers. So across the whole range. I do believe that the amount of capex that has been put in the telecom sector in India stands out as a paragon across the world. Today, the telecom sector across the world is going through huge amounts of rationalization, and the return on capital employed across the sector in the world the numbers have been dipping very, very quickly. It's only in India that you're seeing a robust return on capital employed, which is why our telcos have deployed almost close to about 4.5 lakh crores, putting in place the 5G network in India. Right. So whether it's the government-owned BSNL or any private sector company, it is for the management in these companies to decide on their strategy and their path to profitability. As far as BSNL is concerned, the department can only give them guidance, vision, strategy inputs. Ultimately, it is the management of that particular company that delivers. And in our case, BSNL has seen a huge turnaround story, one that we are seeing today occurring after 18 years. Okay. To answer your question directly, as far as Vodafone is concerned, that is for the management and Vodafone to decide, and not for me as government to decide.
Right. But when it comes to further equity conversion, I think you've said earlier also that it's not as possible.
There cannot be. There possibly cannot be further equity conversion unless the government's share gets diluted to lower than 49% to enable us to increase it back to 49%. Because we can't increase it beyond 49%, because the minute you do that, then it becomes a PSU, right, which is not our intent.
But are there other options being considered?
At this point of time, the equity option, increasing the equity option is not an option. As far as other options are concerned, there's not much discussion happening at this point. If there is, we will let you know.
Analysts have said that 2-year deferment of Vodafone AGR dues is the most possible thing that the government could do.
That is, as I said to you again, that is not for us to decide. That is for the management of the company to decide.
Right. Now, also,
I do not happen to be the CEO of Vodafone, and neither do I happen to be the CEO of BSNL.
Okay. My final question on Vodafone before we move on to other issues. It is also being said that if Vodafone collapses as a going entity, then you'll not be able to recover the dues. Will the government allow that situation to happen?
So I see that you're trying every angle to get an answer from me. I do not answer hypothetical questions.
Okay. Let me also ask you about Bharti Airtel. Now, Bharti Airtel has also applied and made an application to you for equity conversion.
The government seems to be considering this. What's your view right now? Has a call been taken?
The Department of Telecommunications is evaluating it. Once they evaluate it and they bring it up to me, then I shall exercise a view based on the analysis that has been done.
Right.
At this point of time, they have not brought it up to me.
Right. But your view, basically whatever you do, whether it's for Bharti or Vodafone, will have to be done on a broad-based basis for everyone. So for the larger health of the sector, what would be your message?
So I will have a view once there is an analysis that has been done within the DoT. Every telecom operator within that, the ambit of that prescriptive nature of the rule has a right to ask us for conversion of their dues into equity of the company. That's the right that Bharti has exercised. And now that they have submitted their application, it's being examined by the department.
All right. Speaking about satellite...
That being said, it will have to be examined not only by DoT, but it will also have to be examined by Ministry of Finance.
Right. Speaking about satellite communications, the DoT is yet to take approval or yet to approve TRAI's recommendations on spectrum for satellite communications. By when do we expect a decision?
So TRAI has submitted their recommendations to us only in early May. And the DoT is now examining those recommendations. And we are in dialogue with TRAI. It's important for DoT and TRAI to have that conversation and that dialogue. Normally, the process on a reference does take a couple of months. Hopefully, in a couple of months, that should be through.
That should be through. Some industry bodies have also raised concern about the pricing of spectrum for satellite communication companies. How would you respond to those concerns?
Concerns with regard to what?
About low pricing.
Well, please remember that I am quite confident that TRAI has taken into account, and they've had multiple stakeholder meetings. You cannot price spectrum in the same manner for satellite as you do for telecom, for mobile. And the reason for that is very clear. Satellite spectrum is a shared asset. And therefore, a shared asset spectrum cannot be priced in the same manner as a dedicated spectrum. The laws of physics combined with the laws of economics are very clear on that principle. Ultimately, it is TRAI, because that is the regulatory body that decides the pricing of spectrum, which is mandated, and they have taken into account everyone's considerations, and they'll come out with a ruling on that.
Right. Speaking about Starlink, you've met representatives of Starlink over the last few months. They've got one approval from the government. InSpace is waiting for them to respond to their draft, and they may give an approval soon. But finally, how long would it take to clear the decks for them to operate in India?
Well, I think that the process is on. They have to get permission for their satellite Earth gateways to be located in India. They've got to get InSpace permission. They've got to get security clearance. And then they have to get spectrum. These are the major 4 milestones, if you will, to be able to operate in India. I am of the opinion that the sooner my SATCOM companies operate, and by that reference I mean not only Starlink, whether it's OneWeb or it is Reliance Jio, I'd like them to offer services as soon as possible in as many areas as possible, so that there is a fair degree of competition for those that are not connected. And I see that happening, as I said, in the next couple of months. This process should get ironed out.
So by the end of this year, it should be well on track?
Hopefully, but that depends, please understand that depends on each one of these companies as well, because the quicker they respond to issues with different regulatory authorities, the quicker the permission will be given. It's not something that's dependent on government alone.
Right.
Is that the reason why the Tech Adoption Fund, which was launched by InSpace recently, that becomes all the more important?
Absolutely. TDDF is very important for us from a satellite perspective, from a 6G perspective, from an AI perspective, from an IoT perspective. And version 1.0 has already financed almost about 100 or greater proposals, over about 200 crores. We've also got multiple other proposals that we've looked at. And so therefore the Technology Development Fund is a very important piece of that puzzle.
The man who has no imagination has no wings. The great Olympian Muhammad Ali immortalized those words, and my guest today embodies the thought. For over 4 decades, he decided to join an institution that was a fledgling startup founded by H.T. Parekh when Parekh himself was 65. Keki Mistry spent his career following Parekh Sr.'s mantra of learning by doing. He took over as Vice Chairman and CEO in 2010, and under his watch, over a 12-year period, profit after tax grew from 3,535 crores to over 16,200 crores. Income grew to over 60,000 crores from over 12,000 crores, and loans under management grew from a little over 1 lakh crores to over 7 lakh crores. He was also instrumental in HDFC's foray into banking and other allied areas. People who've observed his innings say if Deepak Parekh was the ideas man, Mistry was the man who got the job done. Today, he sits on boards of companies that command a market cap of a whopping 30 trillion rupees at last count.
My advice to a CFO is always be very cautious. It's not your P&L that is important, it's your balance sheet that's more important. And keep your balance sheet as safe, as secure as you can. See, I told you I joined HDFC because I saw it looked like a happy place to me, and it remained a happy place all through. The most important thing is keep politics out of the organization.
What was the compass that guided you?
Don't chase market share for the sake of chasing market share, because by chasing market share and having these short-term goals, you will do something which will go wrong. Never do anything which would make you feel even slightly nervous or slightly unhappy if it was reported in the newspapers the next morning. That was a mantra that we had followed in HDFC.
What excites you the most about the India growth story?
The growth that you will see in India, you do not see that in China or in any other part of the world. Forget the West.
I don't know how many people know this, but you actually did box a little bit in your youth.
In my college days, I lost my tooth here.
You did, and was that why you stopped?
That's why I stopped.
So what do you think that you took from those experiences and brought to the boardroom with you?
I think learn to lose also. It's not that every time in life you will win. I keep this diary, it's old diary, 2019 diary. This will show you how many minutes I've cycled, calories burned, the distance traveled, distance I've cycled.
It's all handwritten like
everything. I feel more comfortable than
So do I.
But then it gets punched into an Excel sheet.
Oh, really?
And then
so that's an Excel sheet.
And then there are calculations done on average per day, stuff like that.
Nice. 2009, that was a pretty personal experience that you had to go through dealing with cancer.
You know what happened was that in 2009, I was going to London on a flight. And then I noticed a small red dot of blood when, on the tissue. It recurred after 2 or 3 months. So I went through a colonoscopy process. They found 2 polyps. One had cancer, one did not have cancer. But fortunately for me, the cancer had not touched the wall of the colon. But there was no way to be sure. So I had to go through a 7 or 8 hour surgery where they removed 18 centimeters of the colon. And then they tested that, and fortunately that did not have any malignancy. So the point I'm making is that life is so uncertain. I mean, I had no health issues till that moment, and then suddenly out of the blue this comes up. So it makes you realize that
the fragility of it.
The fragility of life.
But did it
and therefore
change?
It changed me. Till 2009, I never took holidays. You know, when I got married, as a Parsi, our marriage happened in a fire temple, early morning. And after marriage, I went home, changed, and went to work. I'm not.
Are you serious?
I'm serious.
And you're still married?
No, I'm still married. And then I went in the evening back home and changed all that. And the other turning point was when my daughter was born.
Which was why Tuesday is very important to you.
Which is why, see, what happened was again as a Parsi, we are hardcore non-vegetarians, but she was born on a Tuesday, and the doctor came out of the operation theatre and they had to do a cesarean, and he said, we need blood. So staying outside the operation theatre, I said, if all goes well, I'll become a vegetarian. Fortunately, I said on that day, which meant on Tuesdays. So ever since then, all these years, I remain a vegetarian on Tuesdays.
On Tuesdays. What's been the high point of what you wanted to do that you finally got done?
Never used to go on holidays before. Now, post 2009, every year I would go on a holiday, every year. If you ask me what is the only regret I have, one regret I have in life, you know, my mother was always with me and I was very close to my mother. And then the last 1 year, which was 1999, she got a stroke. And I don't think I spent as much time with her as I would have liked to.
How would you like to be remembered?
Simple, straightforward, humble, easy, wanting to help people. Very seriously.
That's Keki Mistry in a nutshell. So cute.
Oh, no. Are you scared of dogs?
No. Lovely to see you. Joining me now on the leadership language is the man himself, Keki Mistry. Mr. Mistry, what an absolute pleasure to have you join us on the leadership language.
Pleasure being with you, sir.
Let me walk you back to 1981, 12th October specifically, when you decided...
12th October 1981.
1981. That's when the HDFC journey began. And you could have gone to Citi. That was a very real option, a very real possibility for you. What made you want to join this fledgling startup?
So, you know, I started working with Indian Hotels. My first job was with Indian Hotels. That was a very short period of time, about a year and a half. And I prepared the accounting manual for Taj, which I believe they used for many years after I left. But then Taj wanted me to go to Goa as a chief accountant. I didn't want to do that, so I was looking for a good job in India, in Mumbai. And then I got 3 offers. So I got an offer from HDFC, which was a very tiny little organization in those days, very small. I got an offer from Citi, and I got an offer from one multinational entity. I chose HDFC because I just loved the culture. I went for an interview. I met Deepak, I met our general manager. In those days, we used to call him general manager, a gentleman named Nagendra. I met a gentleman named Deepak Satwalekar. And I just loved the atmosphere, the informal atmosphere, the very casual, the very, very friendly kind of a work environment which existed. And then I similarly went to Citi and I saw it was a gigantic organization. And I thought I would be just one out of
cog in the wheel.
A cog in the wheel, absolutely. So I decided I would join HDFC. But very honestly, when I joined, I never thought I would work there for 42 years, which is what I did.
Yes, 42 years. And what a journey it has been, not just for you, but for HDFC and for housing finance in the country. I mean, a world of a difference in how we've seen this story evolve. But, going back to the fledgling startup that HDFC was, everyone today talks about the successes. Everyone today talks about, the numbers that tell the story of the growth and the evolution. But let's talk about
what it was actually to create this category in India, the many challenges that you had to contend with to make this category a viable one in India.
So I'll tell you some of the challenges. Obviously there were challenges along the way. You can never get to 100% success without some failures, some challenges, some bumps along the way. So I'll tell you the first and the biggest challenge we faced was we started early. We had a capital of 10 crores and the share value was 10 rupees. The par value was 100 rupees a share. And for a endless number of years, the share was trading at about 70 rupees, 75 rupees, 80 rupees, 90 rupees, always below par for some reason or the other. 70 was the low.
I mean, the IPO struggled as well.
Yeah. So that was the capital. We used up the 10 crores of capital in giving loans. And then obviously we needed funding. I mean, housing loan is all about giving money to people. So how do you give money if you don't have money? So we had to borrow money. And nobody in India wanted to lend us money because the concept of housing finance did not exist in India. In fact, the concept of retail lending was very, very new or hardly ever, was practiced in India. So no banks would lend us money. No institutions were willing to lend us money. Obviously, we couldn't get deposits from the public at that time. So we got our first breakthrough when we got a 10 crore rupee loan from LIC. And that, I think, was a turning point for us. But along with that 10 crore loan, we also got a $4 million loan from IFC, the International Finance Corporation, Washington. That turned out to be the costliest loan we ever got because in those days, there was no way of hedging foreign exchange risk. And when we got the loan, that number is still etched in memory. The exchange rate was $12.56064 for 100 rupees, equivalent to 7 rupees 96 paisa a dollar. The loan, when we paid it back, or we had to pay it back in installments, the last installment was paid when the exchange rate was about 18 rupees to a dollar, 1.8. The loan was very important to us because that loan, along with the loan from LIC, gave confidence to the Indian banking system to start providing us with funding. And frankly, after that, there really wasn't too many challenges we faced. A little bit of challenge in 2008, 2009, global financial crisis. Liquidity had completely sucked out of the system. Funding was very difficult. Interest rates were very high. But 2008, 2009, we started getting wholesale funding at a higher rate, but we were managed to bring it down through a variety of measures and we survived that period. So challenges along the way. Another challenge would have been 91, 92.
Right.
91, 92, India was in a difficult situation. You may remember we had to pledge gold to come out of a foreign exchange risk. Interest rates in India were extremely high. The funding that we would have got from banks would have cost us 17 and 18%. And that is the time we switched to retail deposits. And in those days, today you may find this, unbelievable. But in those days when companies accepted deposits from the public, it would take them 3 months, 4 months to issue a deposit receipt. Now, many of the people who were placing deposits were old people, people who had retired, and they just wanted the confidence of getting that piece of paper. Nothing in those days was automated. So you needed to get that piece of paper confirming the fact that this was a deposit that you had placed with that company. And it would take 3-4 months to get the deposit. So we said we will initiate a system where we will provide deposits across the counter. So you come, you place the money with us, you give us the check or whatever it is, and within 2 minutes or 3 minutes, we would give you a deposit receipt. And then we had control systems in place to ensure that those service standards were met. So that became an instant success. And then we were able to get retail deposits at a significantly lower rate than what wholesale money would have cost us, which enabled us to continue giving housing loans with roughly a spread of around 2%.
One of the opportunities, but also the challenge of a category creator is the fact that there is no template. You've got to create the template. Absolutely. And in many ways, HDFC did that for the housing finance market, building out this category, ensuring that trust was created with the customer to actually avail of a home loan. I mean, what did it take to be able to do that, to deliver on that promise when it didn't exist?
Yeah, I'll tell you something very interesting. In those days, today people borrow money
at the top of the
hat.
Yeah.
So people even borrow money sometimes to go on a holiday or to do anything, any personal stuff. In those days, borrowing was considered not a very good thing to do. There was a little bit of a social stigma, if I may say, associated with borrowing money. So we used to actually sometimes get people coming to our office with a mask on their face and wearing a cap because they didn't want to be seen in HDFC, where obviously they would be
to borrow money.
So we actually had created in those days these little cubicles. So if someone was uncomfortable being seen in the open, then for his meeting with whoever the credit appraiser was, he would be taken into that little cubicle so he would not be seen by people. See how India has changed. The India of 1981 and the India of 2025 is so dramatically different.
Dramatically different, but you talked about the stigma attached to borrowings. And then we swung the other way, where you saw borrowing which was out of control. There was easy money because of low interest rates or zero interest rates, specifically globally, and that led to its own kind of toxic behavior, its own kind of toxic mess, which has taken a fair amount of time to deleverage from balance sheets to clean up. That the pendulum swung from the stigmatization of borrowing to excessive borrowing. I mean, and you watched that journey.
Yeah. No, so Shireen, that is, honestly, even today, people borrow money in India with a lot of ease and are happy to borrow money. But let me tell you one thing. Even today, when someone takes a housing loan, it's the single largest loan that he's taken to buy the single biggest asset of his lifetime. And you will still find that a majority of people will come back before time and start making part of full prepayments of the loan. So it's not that people are prepaying loans because interest rates are high or interest rates are low.
They just want to get it off.
They just want to get that liability off their car. And even today, the average Indian is still very, very conscious about how much money he borrows. So whilst there will be a willingness in the younger generation to borrow money for, doing a whole lot of other things, still you will find that people in their 30s and 40s generally would be a lot more cautious in terms of the amount of money that they borrow. It's not like the Western world. You see, social media, the influence of social media is, I think, one of the factors which has made Indians a lot more bolder in terms of meeting their aspirations, borrowing money to meet those aspirations compared to what they would otherwise have been. But still, there's a far, far greater discipline in an average Indian borrowing money compared to someone in the West.
Yes, and also the savings mentality and the savings mindset is very much for, in the minds of the consumer. You've been one of India's foremost CFOs, awarded several times across different sectors for the contribution that you made as a CFO. What would your advice be to CFOs who are watching this program? And I know you're a numbers man. I mean, you displayed that very effectively at the start of the program. That is your superpower, isn't it?
I love numbers. I mean, I always said from childhood I've had a fondness of numbers.
And you were telling me that your grandmother insisted that you should either join the central bank or the
Tatas. When I'm a Parsi. There are very few Parsis left in this world. There are some 60 or 70,000 Parsis in the whole world. So my grandfather, who came from the old school, when I was young, when I was 6 years, 7 years, 8 years old, said that when you grow up, you must only join Central Bank of India because Central Bank is largely filled with Parsis, or you have to join the Tata Group. So Tata in those days, Tata Group, those days and even today, commands tremendous respect amongst people. So that's what my grandmother had said. But obviously, it didn't happen that way.
It didn't happen, and
But I'm still on the board of TCS.
You still are on the board of
TCS.
So you do have a Tata connection. You do have a Tata connection. But coming back to the point about what your advice would be to CFOs today, it's an uncertain environment. It's also an environment where there is a huge degree of aspiration and ambition, the need to want to grow quickly, scale quickly. What is it that you would caution? What kind of guardrails would you put in place? If they say, claims are claims, but the balance sheet eventually doesn't lie, or hopefully shouldn't lie, what would you tell them?
I would say that when you're a CFO, there are multiple ways in which you can get profits. Multiple ways. If you're a lending institution, for example, you take the example of the period from 2013 to 2018, 2014 to 2018. 2013, interest rates had gone up a lot.
Yeah.
You had the taper tantrum in the US, and then interest rates came down, and 2014 onwards, rates remained by and large low. You would have seen a lot of the NBFCs in those days borrowing short-term money. So you'd borrow 3-month money, 6-month money through an instrument called commercial paper. And people who would borrow money, who would lend money against that commercial paper would typically be the mutual funds, who have a very short-term vision in their, in their scheme of things. So many of these, some of these NBFCs borrowed short and lent long-term. And the interest rate curve was nice and steep. So when you borrowed at the short end of the market, you borrowed at a low cost. When you lend money at the high end, at the longer tenure, your interest rate was high, you so made a very nice spread. And because interest rates remained low for a long period of time, every time you would renew your 3-month, 6-month commercial paper, you would get it at more or less the same rate. So people made a huge sum of money. But when the tide changed and when interest rates started moving up, all these companies which were borrowing short, lending long, ran into huge financial difficulty. So my advice to a CFO is always be very cautious. It's not your P&L that is important, it's your balance sheet that's more important. You have to match your balance sheet. You don't take unnecessary risks on the balance sheet side. You can take risks on you should not take risks on maturity. You should not take risks on currency, and keep your balance sheet as safe, as secure as you can. Shireen, in HDFC, we had a cost income. I don't know if you may not be conversant with the terminology, but we had a concept of cost income ratio. Our cost income ratio in HDFC was under 8%. For a retail financial institution, that would be probably the lowest, not in India, not in Asia, but one of the lowest in the world. So under 8% cost income ratio. To cater to a balance sheet size of over 7 lakh crores, nearly 8 lakh crores, our total number of employees we had in HDFC at the time of merger was only 4,136. So very limited number of employees, catering to a large balance sheet. And we had brought in a lot of efficiency in the way the organization.
So this was by design. This was a very conscious strategic decision.
Yeah, of course. It was done by design. So we cut out bureaucracy. A lot of bureaucracy which you see in many companies, we didn't. We empowered our people. We empowered our people to take decisions. And sometimes decisions would go wrong. It's not that every decision you take would go right, but you have to back up that person. When something goes right, you give him credit, give that person credit publicly.
Yeah.
But if something goes wrong, then you don't call him publicly and tell him, you did a bad thing. If you have to call him, you call him privately and speak to him on a one-on-one basis. So that creates that feeling of happiness. And that feeling of happiness, to my mind, is the single biggest reason, one of the biggest reasons, why we never had attrition in HDFC.
You talked about happiness, Mr. Mistry. And again, when we talk about corporations, when we talk about culture, it's not a word that's used very often. In fact, it's very seldom used. What did it take to create a culture of happiness at HDFC?
I mean, it was just something which was imbibed. I think Deepak started that. It was always there in HDFC. I told you I joined HDFC
because it was a happy place.
It looked like a happy place to me, and it remained a happy place all through. So we created that kind of an environment where we kept, the most important thing is keep politics out of the organization. Very difficult to do it when you have so many branches and so many locations, but I think by and large we succeeded. So keep politics out of the organization.
But how do you keep politics out?
I mean, you keep a very free open door policy where people are free to come in and talk to the seniors. They express their views, they express their thoughts. If there is a problem, they go and say, look, this problem is there, this thing is happening, such and such thing is happening, and you solve that problem. So, and you feel wanted. You have to create that feeling of being wanted. I don't think people leave organizations only because of salary and compensation. I don't believe that at all. Yes, compensation may be important, but I think the single biggest reason why people leave an organization is because they are not happy with the culture. They don't feel happy. They don't feel wanted. So we have to make people feel wanted. Shriram, when I joined HDFC, I decided in the early days that if ever on a Friday evening I say, oh God, thank God it's a Friday and I've got 2 days when I don't have to go to work. And on a Sunday morning, I say, oh God, hell, I have to go to work tomorrow morning. If I ever see that kind of day, I'll leave the company. I never saw that day. We never imposed or asked our employees to work late. We never asked our employees to work on holidays or Saturdays. Never asked them. Maybe once in a way it could have happened, but by and large, no. But voluntarily, you would find that most employees, you would see that on a Saturday, the office would be 50 to 60% full. We had never asked anyone to come, but they come because they like to. I mean, believe me, they actually like to be with the people around, like to work, like to do something. And yes, we rewarded employees through stock options. We had stock option plans and we gave stock options to every employee in the company. I think Infosys was one company which did it multiple years ago, and we always did it whenever we gave stock options. Unlike others, we didn't have thousands of employees. We just 4,136 employees. So we could give stock options to every single employee.
All 4,136 of them.
All 4,136 of them. And because they had stock options, they had an ownership. They had a sense of, that what's good for the organization is good for them.
One of the other issues that I want to talk to you about and also understand from you the lessons and insights through your journey at HDFC. And many would argue that, and perhaps this is a criticism that you heard several times through the course of your career, that HDFC was too conservative, that you could have grown far more than what you did. But the balance between growth and excessive growth, or sometimes irresponsible growth, finding that sweet spot. What was the compass that guided you?
You asked me a question earlier on what you would advise a CFO. So let me tell you one thing. A CFO must have very, very clear, along with the CEO, must have very clear objectives for the company. We had extremely clear objectives. We had 4 main objectives. Our first objective was growth. It's not that we were against growth. We wanted growth. But we wanted growth at a pace that we would set for ourselves depending on the market conditions. If the market conditions were conducive, we could hope for a higher growth, or we would target a higher growth. If the market conditions were not conducive for whatever reason, we would plan a lower growth. Number 2 was asset quality. We said that the most important thing is asset quality. We will not compromise on asset quality or on margins just to get growth. And therefore, we don't care for market share. It became so difficult to convince some of our international investors who are used to the idea of market share, and everywhere they would say, Magan Yolata would come and say, you lost 10 basis points of market share. And I would say on TV, we don't care for market share. Market share is not important in a financial services business because you can get all the market share you want, but it will never give you long-term success. So market share, asset quality, cost control, And the fourth objective was keeping a matched balance sheet. These were our 4 objectives. So you should keep that objective in mind. Don't chase market share for the sake of chasing market share, because by chasing market share and having these short-term goals, you will do something which will go wrong. And the damage will not come now. The damage will come 2 years, 3 years, 5 years later.
You know, speaking of some of the other strategic decisions and choices that you made, the decision to diversify into allied areas, and you were instrumental in
banking, life
insurance, and so on and so forth. Again, the things that one needs to be mindful of, because we've, through this period of excessive money, low interest rates, etc., we've also seen the perils of diversification, too much diversification, too soon, too quickly. What are some of the lessons that you've learned along the road of the way that you diversified into some of these allied areas?
So look, Shriram, we were in a bit of a sweet spot, if I may say. We started housing finance. Housing finance did not exist in India. Then you had all the rules and regulations and all that came in. NHB came in later. In 1992, the Indian economy was opened up. You started seeing banks coming into private sector banks being set up. We applied for a banking license. We got a banking license. We thought there is an automatic synergy between housing finance and banking. Because at the end of the day, it's the same activity.
Yeah.
You are lending money for one, you are lending money for housing. In the other entity, you are lending money for multiple other purposes. So I think diversification is good, but diversify only if you see a clear benefit in terms of the synergy that your existing business has in their new business which you want to get into. If you're, for example, running a cement company, don't start next start a steel company or something like that. That, to my mind, is not diversified.
Or if you're running a liquor company, don't start an airline. Many examples. You talked about synergies and the obvious synergy between HDFC and HDFC Bank, and of course that much anticipated, much awaited merger is finally done. But the wait goes all the way back to 2014 when it was almost done. Why do you think it took as long as it did?
Well, there are multiple factors which would make a merger feasible at one point of time and not feasible at another point of time. So over a period of time, regulations changed. For example, priority sector lending. Earlier, you had to necessarily go and lend that money. Laws changed after that, where you could buy, for example, buy priority sector lending certificates. Interest rates, very important. The interest rates are very important. You have to do the merger at a time when interest rates are low. So there are various ifs and buts which have to fit in the puzzle at that point of time, which fortunately did in 2022 when we announced the merger.
But in many ways, it must have been a bittersweet moment, especially for someone like you who's been part of the HDFC story for over 4 decades, even though you still, of course, are on the board of HDFC Bank. But that moment where finally it got done and HDFC no longer exists.
Shriram, we announced the merger, I think, on 1st April 2022. 1st April 2022. We involved the bankers. 2 bankers were involved from 15 days earlier. Lawyers were involved from a lot earlier. But we involved the other bankers only on that evening, the previous evening, which was a Sunday evening. So Sunday evening, 31st March 2022, if I recall right, was a Sunday. We called up all the bankers at that time and said, look, we are doing this. And merger will be announced tomorrow morning before market hours. Would you all be interested in being part of the deal? So that's why? Because confidentiality. And a merger of this magnitude, of this size, took place without a single murmur in the market. Over the years, there were multiple. But at that time in 2022, there was not one murmur about the merger. And yet, obviously, there was a lot of preparatory work which was done behind the scenes. A lot of preparatory work. It took 3 months at least, or at least 2 months of preparatory work in terms of few close people who were involved who were sort of obviously sworn into secrecy. So I think it was one of the most quietly, most efficiently handled mergers that you would see in corporate life.
Let's talk about where HDFC Bank is today. You talked about the opportunity for growth for India, which also means that HDFC Bank has significant headroom for growth. When you look at the global pecking order, and we keep talking about size and whether size matters, what do you believe HDFC Bank is poised to do over the next decade or so?
Well, look, I think when you're in India, you're an entity, a financial institution in India, whether you're a bank, NBFC, whatever you are, your growth opportunity is phenomenal. It's absolutely phenomenal. And the reason is the underpenetration that you will see for any and every financial service product. We have a young population. 2/3 of our population is below 35 years of age. And coming to housing for a moment, the average age of a first-time home buyer is about 37 to 38 years. So in effect, 2/3 of India's population has not even thought of buying a house. But over the next 1, 3, 5, 10, 15, 20 years, all these younger people will come to the market to buy a house and then to take a car loan or then to take a credit card or whatever. So the growth opportunity that you will see for entities in India is phenomenal. And in that environment, as a bank with this volume and this size, obviously HDFC Bank will also keep growing and keep growing. See, housing is a need. It's a necessity. You need to stay in a house. And this rental housing in India is still not you may still hear the younger generation talking about renting a house and moving from one city to the other. But at the end of the day, for a middle income person, 35 years, 40 years person, he needs stability, he needs a house. Because a house gives him that comfort. There are so many people in Mumbai who would have bought a house in the 90s and 2000s, and then they would have retired, sold that house perhaps, got capital and used that capital to buy a smaller house or buy a house somewhere in wherever, Nasik, Nagpur, wherever, and shipped it to that place.
So your advice is to still own versus rent?
Oh, absolutely. 100%.
Because this debate is raging.
No, 100%. Absolutely own a house. Because a house gives you that mental comfort that you have an asset, a real asset, which will always have a value. Always.
Always.
Always. Not a question of a doubt.
We've got a slew of companies looking at IPOing at this point in time. Many fintechs, from PhonePe to Razorpay and so on and so forth. What do you make of the Indian fintech story? What do you make of the march to the Lal Street for a lot of these companies? And what would your advice be to them as they look at IPOing?
My advice to any company, whether it's a fintech company or it's a brick and mortar company, or a manufacturing company or whatever, is that when you're doing an IPO, leave money on the table for the investor. I really genuinely mean it. When you're selling 20% of your equity, you still hold 80% of the equity. If you price your issue to perfection, the market may absorb it at that point of time, but your post-market performance would be pathetic. And then the value of 80%, which you still hold, will get eroded. So my personal view, and that's what we did with HDFC Life when we did the issue, we did that with a bank, we did that with the asset management company. We really, truly valued it at a rate which was even lower than what the banks were suggesting, in a way.
Is it the over-aggression of the bankers? That typically...
In some sense, yes. In some sense, yes. It's over-ambition of over-aggression of some of the bankers, which could have contributed to some of these companies being over. But there's also the fact that the promoters sometimes want to take the highest price off. which to my mind is not the right thing, because in their own interest, it is not a good thing.
I want to talk about the Jugalbandi, the Deepak Parekh, Keki Mistry Jugalbandi. The two of you have kind of built not just this institution, but built many of the institutions linked to HDFC together. What was it like? Working shoulder to shoulder.
No. So Shriram, there were multiple people. It's not just Deepak and me. I mean, obviously, Deepak and me were there, but we had.
It's a different kind of a Jugalbandi.
But we seriously had some very good people with HDFC. We had Renu, we had Rangan, multiple people. I don't want to miss out anyone, but we had great people. So everyone worked as a team. So it was really teamwork which brought HDFC to what it is. In the branches, we had some great people. So we had people whom we could trust, who worked together, who worked like a family. And people were in HDFC for 30 years, 35 years. All of them were over 25 years in the company. Why 25, 30, 35, 40 years? We never did lateral employment. We hired people fresh from college. And then they went through 18 months of management training with us. During that management training, we would identify what were their strengths, what were the good things that they had, and then we would put them on the job which would suit them best. So we molded the cultural fit was so very important. We didn't want to take people from like say an IIM or an IIT would want to become a general manager in 3 years or 4 years' time. I mean, our business was not rocket science. What we wanted from people was the highest standards of integrity. We could tolerate mistakes, and we would tolerate mistakes. Human beings, people make mistakes. But we would never, ever, ever, ever tolerate even the slightest degree of integrity-related issue. So I think that culture that we set was really what made HDFC successful. That culture brought about trust. Because if you make a happy employee will make a happy customer.
What was the difference in management styles between you and Mr. Parekh?
Not very different, to be honest. I mean, my style would be that you create the systems, you create the platform, you have the technology, you have the products, and then delegate and leave it to that individual to do what he's best suited to do. If there is something majorly going wrong, you intervene. Otherwise, let him do what he has to do, rather than try to control everything. And most importantly, keep politics. And that was a common thing with all of us. Keep politics out of the organization. Don't create. I mean, I have unfortunately seen some organizations from a distance where the CEO would want to create 2 or 3
power centers,
so that all the power centers, that's not the way the organization will ever do well.
Outside of work, you have a couple of things that you're passionate about. There's a reason why I started with Muhammad Ali, and I don't know how many people know this, but you actually did box a little bit in your youth.
In my college days, I lost my tooth here.
You did, and was that why you stopped?
That's why I stopped.
So how long did you do this for?
A couple of years.
A couple of years. What made you want to?
Nothing. It was just something you did in college. First year of college, we had a boxing ring or something in Sydenham College where I studied, and so nothing more.
Was there somebody specific that inspired you?
No. I think Muhammad Ali. In those days, Muhammad Ali was a big name to reckon with. So when you're young, you have these this kind of passion about people. Like I used to always have passion about cricketers.
But cricket continues to be a passion for you.
Cricket continues to be a passion. Not playing anymore.
But you did play.
I did play. I used to play first as a spin bowler as a young boy, and then as you grow older, bowling leg spin, a fellow will come out of the crease and smash you. So I changed to fast bowling. So I used to play cricket, and that's the reason why my left knee got damaged very quickly. Because when you're a fast bowler, your last step is on your left foot, and you put a lot of pressure on the left foot and your right shoulder when you're bowling, if you're a right-arm bowler. So that resulted in my foot getting damaged.
And that resulted in the cricketing aspirations ending there?
No, not cricketing. That happened many years later. Then once I started working, then obviously there was no time to play cricket. I played cricket in my college days, in my school days. A little in school, more in college, but really not thereafter, not much thereafter.
What has, whether it's boxing or cricket, the mentality of a sports person, I don't want to say sportsman, mentality of a sports person. What do you think that you took from those experiences and brought to the boardroom with you?
I think learn to lose also. It's not that every time in life you will win. There will be times when you'll win, there'll be times when you lose, mistakes will happen, failures will happen in life, but you have to have the perseverance to keep continuing. To my mind, that would be the one.
Is there a favorite cricketer or a favorite innings?
Today not so much, but yes, in my younger days, many favorite cricketers. Farooq Engineer, because probably he was a Parsi, so Farooq Engineer. Ajit Wadekar was a big fan of Ajit Wadekar as I was growing up in my early college days. Sachin Tendulkar, massive fan of Sachin Tendulkar for multiple years.
And it's not just cricket, not just boxing, but you have a love affair, running love affair with Hindi movies.
Not movies. No. Old Hindi songs.
Old Hindi songs, not the movies though.
No. I don't watch movies. At all? Now I don't watch movies at all. Actually at all. Maybe one movie or two movies in a year because my wife would force me to go for a movie, and half the time I'd walk out to the theatre and go out. But movies not so much, but old Hindi film songs, yes. That made me improve.
How did that happen? The initiation into the world of old Hindi film music?
No, I don't know. From childhood, we used to hear at the Radio Salon. There used to be something called Radio Salon. And it used to come on one particular day. I think it was a Friday or something. So every day my father, my mother would love it. They'd put it on, and then you just develop that thing.
What's the favorite old Hindi film song that you
Many. I mean, there are many. I would say Kamoshi. There was that song, what is it?
Pukar Lo.
Tum Pukar Lo, Tumhara Intisar Hai. That's a lovely song. There were many such very good songs over time.
Do you sing at all?
No, I don't. I can't pronounce. My Hindi is pathetic.
Well, you did a good job just now.
I hardly speak Hindi.
But, the family office and your daughter's helping you invest through that family office. Beyond financial services, which is, of course, a sector that you believe is poised for an inflection point, what else are you looking at in terms of bets that you would like to make?
I think when you're looking at investing, you have to first diversify your total resources. Supposing you have, I'm throwing a figure, 100. You have to decide of that 100 how much will go into equity, how much you should invest in fixed income, how much you should invest in alternates, and how much you should invest in real estate. So have that broad classification, breaking down your total wealth into these 4 categories. And then depending on that, then you can decide on where to invest and how to invest. Unless you do that, unless you do this basic differentiation, you will go all over the place.
What's the biggest mistake people make when investing?
Go by the spur of the moment. So if someone comes and says, this company is great, go and invest. No, don't invest like that. When you're investing in a share, honestly, my investments are very long term. If I buy a share, it is with the idea that I will never sell that share. I never sell shares, honestly, Shri. If I buy a share, it is for the next 20 years.
What has been your mantra of navigating through uncertainty, volatility, of dealing with things that you have no control over? What's been the mantra to survive uncertainty?
I think the mantra is that you have to do what you can. You can't predict. COVID came out of the blue. But you have to have enough resilience in your system to be able to take care of these kind of setbacks. You can't predict. Nobody could have predicted COVID. And nobody could predict, the warfare or trade war or whatever that we talk about. So you do what you can. Strengthen your balance sheet in a manner in which can absorb any kind of a little shock that comes once in a way. Build the resilience in the company. Get the right people to work for you. Create the right culture. Yes, there will be some setback along the way when you have this sort of uncertain period happening, but you'll come out of it very quickly. I mean, at that time, for example, lowering the stamp duty on real estate transactions was a huge boost because it created a lot of demand for properties, which then meant that construction picked up. If construction picked up, more employment got generated.
Do you think the Indian real estate sector is poised for an inflection point? I mean, it's been a sector that's been perennially plagued with challenges. The last few years have seen a significant recovery. What's the take on India's real estate
So
sector?
I'll tell you, the period between 2016 and 2020 was a difficult period for the real estate sector in cities like Mumbai and Delhi. And that was a period when there were massive regulatory changes which were for the good of the system.
Yeah, with RERA coming in.
Which are now you're seeing the effects or the benefit of that flowing through. But the initial change when RERA came in, for example, the Real Estate Regulatory Act, GST came in on under construction properties, demonetization. In my opinion, demonetization was a great thing. But all these factors temporarily had an impact on the real estate sector. So 2016 to 2020, demand for real estate slowed down. Because demand slowed down and developers historically were used to borrowing a certain amount of money from a bank or an institution, and then the rest of the funding they required for the project would come out of sale of under construction properties. And because under construction properties stopped selling, and the developer couldn't get the money and therefore couldn't complete the project. So that was what caused the stress that you saw in the real estate sector in that period of 3.5, 4 years. But 2020 onwards, things changed. Yes, some projects which suffered in that 16 to 20 period, had a very difficult time. But post 2020, you're seeing that all the new projects that are coming up with far more financial discipline, far more openness, far more transparency in terms of floor area, carpet area, and a variety of other things.
What is the best piece of advice that you have received through the course of your career? What is the piece of advice that you would like to leave people with?
It's the same, which I would say would be that it's integrity, that the world will respect you if for what you are. Remain humble all your life. You have to remain humble. You have to be approachable to everyone. And really, that's the way people will not only like you, but people will like the organization that you stand for. But the single biggest bit of advice would be integrity. Never do anything which would make you feel even slightly nervous or slightly unhappy if it was reported in the newspapers the next morning. That was a mantra that we had followed in HDFC. And the other mantra that we followed was that there is no pillow there is no cushion as soft as a clear conscience.
Yes, and
so I think these were the
so you continue to sleep very well at night.
You continue to sleep well at night. Seriously.
Is there a favorite number that you have since you're a numbers man?
9.
9? Any particular reason,
No reason.
why?
It's just
just that.
Just that.
Are you superstitious
It used
about
to be 7, which was my birth date, but then I found that 9 somehow is a day which always turns out. For some reason, 9 turns out.
So you're superstitious
or anything
about
which
it.
is a multiple of 9.
A multiple of 9.
I'm not very superstitious, not very. But yes, my car would always end up with a 9 number.
Well, Mr. Mistry, it's been an absolute pleasure. Thank you so much for joining us here on The Leadership Language. We appreciate your time and we wish you the very best of luck in your journey from here on. But thank you so much for sharing your insights and your stories with us.
Thank you so much. Thank you, Shriram. Been lovely talking to you. Thank you.
Well, you heard it from the man himself. The softest cushion is a clear conscience. If you enjoyed watching The Leadership Language, for more advice like that, do tune into CNBC TV18. We bring you leaders giving us a very deeply personal account of what has shaped their stories, their journeys. From all of us here on the team for now, thanks very much for watching. welcome to the 12th edition of Voices from the Valley. I'm Shriram Finance. Through the week, you've had plenty of conversation around the magic of AI and what it intends to do for the world. A lot of that conversation is actually happening on social media platforms. But joining me today is a man who's trying to do the anti-social media platform. Akshay Gupta, thanks very much for joining us on CNBC TV18. Says us. Take me through why this decision to do an anti-social media platform.
Thanks, Shireen. It's great to be here. The reason we felt the timing was right is because you've reached this moment where every industry goes through an evolution, and there's a chance for us to really build a healthy digital social media platform with real users, having real conversations without a bot environment, without the addiction and the problems that we've kind of seen with current social media. This time was right, and we felt like Says Us was primed to sort of deliver the next
okay, how does Says Us come about?
So it came about largely with a couple of people thinking about the notion that, you know, social media had gotten pretty toxic. You have all this anonymity and the bots and trolls on the platform. Is it time for something new? And the idea was, can we bring our better selves to the digital world? And last year, prior to the election, the development started, and the alpha version was put out in the market in the fall. So I think we can appeal to our better angels. We believe that we can create an environment where people can actually have a rich, healthy dialogue. And I'm particularly excited because India is, you know, such a massive country with all the opportunity there, with everything that we've experienced in India. So I think Says would be a really, really interesting opportunity for people to experience in a better world.
So who are the investors who are backing the venture?
So we've had some pretty strategic people. One of them is General Wesley Clark. Another is former Minority Leader Dick Gephardt, who ran the Healthy Social Media Council. So they're very interested, highly strategic investors initially that have started. And now we're going through our capital raise process, so we'll see where we go from here.
This is content moderation done very differently.
It is to a degree, but we're not really moderating the content from a Says Us perspective. Right? It is inherently what we're saying is you have freedom of speech, you do not have freedom of reach. And part of the way we've designed the platform is that there's no addictive algorithms. So we're not trying to get that dopamine heat to keep you on there. And there's no way for anything to go viral because we're not putting our thumb on the scale on the content. So it's really the merit of the person with their reputation, their reach, their content, their material that's going to drive whether the material moves forward or not, which is how the real world works. That's how we do things.
So what's been the feedback since you did the beta version?
So it's a very small community right now, and very strategically, we were timing the output, you know, going large. And today is one of the first days we're really actually coming out and talking about it. It's been positive. They like the interactions are very civil. They're not happy. So there's a difference between people being happy and being civil, right? So the discussions on the platform are very civil. You know, you're getting users to interact with the reputation engine, and you're starting to see the basics work.
You know, where do you see it being positioned?
Says Us, think of Says Us as a part of a global ecosystem of social media networks where we are enabling a civil dialogue, and eventually we want to interconnect with other networks. So there is an open protocol that's being developed, a mechanism to actually create a standards committee. It's actually been created, but a standard way of social media to work. So we call it a walled garden. You just gave the example. There's Instagram, there's Facebook, there's LinkedIn, and when you're on them, you're blocked in. The idea, if you look at the way the normal World Wide Web works, is you can go from one website to another. Why can't I or you get on a platform, log in, and be logged in on all my other social media platforms? So there's a protocol called the DSNP. It stands for the Decentralized Networking Protocol.
Okay.
And it's basically built on a blockchain. It's called a frequency blockchain. And you get a single sign-on when you get onto all the participating networks. They all open up to you immediately. And the idea eventually is, as we're thinking down in the future, what happens if my content could propagate? What happens if my users could propagate? My followers? And if I could just, if I don't want to be on this platform, I want to be another one, why can't I just migrate all my material? Why do the platforms own it and own the content? And that's the other key issue we're solving for, is digital self-sovereignty, where you, the user, you own your data, you own your content, you own your followers, not the platform.
The platform's going to let you get away with this, you think?
That's our mission. We're absolutely laser focused on delivering that experience where we want real people, healthy dialogue, and digital self-sovereignty, and I think we can build that world.
So, you know, plans to go commercial, how ready do you feel at this point in time, and when do we see you rolling out?
We're rolling out now. That's why we're talking. India is one of the key markets. That's one other thing. We've put resources on the ground there. So we have dev teams there. We're actually running a internship with a university in southern India. They've got students actually interacting with the platform, working on it with us right now. So I see India as a very critical market. And what I really would love to see is, it's a call out to the creator community to come on to SEZ, join us, interact with the platform, build your community, and help us design the next generation economic model that we're working towards. So our interest right now is to just get people to come on, and particularly the Indian creator community to come on and just start building this with us. We want to give them their digital rights back.
What's going to be your economic model as far as SEZ is concerned?
We're not quite ready to disclose all of it right now, but the main goal is it'll follow that thematic stretch of what we're trying to do, bring the user self-sovereignty back, give you, the user, the ability to experience things like, so the basics will never change. It'll be, the traditional ad models. There'll be certain things that are very common, but the way it's being executed will be very skewed to the digital self-sovereignty side and transparency. Because you can't have an open social network without complete transparency. So we intend to make the economic model very transparent.
So how large is the team working on SEZ today?
It's a tiny little team. We're just, like I said, we're in the transition phase from going from an alpha beta version to a full, to a market base. So we're just starting to build out the team. But we've got dev teams in India. We've got a small dev team here and a senior staff that's, really well poised for this. One of my colleagues who's here with me today has actually been part of Uber. We've got a development, lead of development who's been part of Intel and NVIDIA. We've got a person on our team that's an attorney who's litigated top-end cases and done a lot of startup law. So the team's been assembled. We've got a really solid leadership team, and now it's just building out from here.
So what do you see as the big challenges as you build out from here and roll out commercially? I mean, what are some of the hard, complex issues that you need to deal with?
The first and most foremost is adoption. It's getting people on the platform, getting people to use it, starting to build that community, and really starting to get the notion of the idea to catch hold.
How do you seed it?
We are seeding it, so that's part of what I want to do is start working with some of the Indian influencers to start seeding that piece of it. And then we're reaching out now to vertical groups. So the other thing we've added on the platform is something called groups. So you can actually come in and build a community. So, imagine you've got a book club or you've got a golf group. Here's a way for you to start seeding it, start building your own communities. So we're starting to talk to groups around the world, and I'm particularly interested in India too, is to start building these communities. You can have it private or public, so it's your own private community, and I think that's going to be a key attribute as well.
So India clearly seems to be one of the priority markets for you. What else are you focusing on?
Well, I think the next critical piece is going to be the open social web. So India, obviously, the U.S. presence, we're starting to build that out. And then the global outreach will start. But I think right behind that, getting the open social web working over the next, coming months would be a critical next step for us.
What's been the big learning so far, setting this up and as an entrepreneur?
Patience, determination, and really knowing how to ride the highs and lows of a startup. It's a very different world than a larger company. If, as any of your younger entrepreneurial users get into it, it's like you've got to take the lows and the highs and just know that they're not permanent.
Already got these large platforms that have amassed millions and billions of users around the world. You really think that there is space, there's room for an anti-social media platform? And I keep calling it that because you're everything that social media is not today.
Yeah, so I mean, yes, the reason I say
hoping to be.
Yeah, exactly. I agree with you, Shriram. But, we are up against some formidable players, right? But look at any industry. They've always been incumbent large entities when the moment for change comes. It's the scrappy little ones that sort of change the market, right? And the moment is right because where it's reached this point where they're not solving the problems for the largest sectors of the world's population. And again, it's the definition of success, right? There are 5 billion users of social media worldwide. We don't need all 5 billion to want to have a healthy environment. I don't expect that. But even if we peel off enough people that have got a healthy environment, that's a win. And if we build open social web, that's a win because we're not in it alone. There are other platforms trying to do things and building this idea of hundreds of social media platforms. My hope in India is that when we start building momentum, we create, like potentially would be fantastic if a coup came back and tied, the reputation engine to it and opened up through the DSNP. Like there are opportunities for India to start building its own network.
Well, we wish you the very best of luck, and we hope to hear back more from you as you start to roll this out, and of course, particularly on what takes shape in India, because that's going to be an important market for you. But thanks very much, Akshay, for joining us here on Voices from the Valley. Appreciate your time.
Thank you, Shireen. It's been a pleasure.
Well, with that, it is time for us to wrap up this edition of Voices from the Valley, but we are going to bring you a lot more conversation. Stay tuned to CNBC-TV18. Visit us on CNBC-TV18 Prime, CNBC-TV18 Access, and, of course, join our social media pages and says us as well, as and when they do launch in India. But for now, thanks very much for watching. We'll take a break and be back soon. Now, if you're wondering why I'm in a kitchen while we film Voices from the Valley, here's the interesting story. This machine right next to me is going to do what a lot of people wish or hope or imagine their machines could do, is cook a home-cooked meal. Joining me now on Voices from the Valley is the team behind Posha. It derives its name from portion, and those of you who understand Hindi will know that portion essentially means nutrition. So that's the name origin story as far as Posha is concerned. Let me welcome on to Voices from the Valley the team behind Posha, the actual cooks that have put this machine together. Raghav and Alberto, thanks so much for joining us here on Voices from the Valley. So we've got the relief cook and the sous chef here from Posha joining us. But great to have you guys. Let's start with what made you want to do Posha? What made you want to come up with this guy here?
So I grew up in a household where love was expressed through home-cooked meals, and I've seen enough people in my family who've had to sacrifice their professional aspirations for providing love to their family through food, and enough people who've actually, who've prioritized their careers and missed that part.
Yeah, given up on the home-cooked food. Yeah,
given up on the home-cooked food, and we did not want to be in a situation where we had to choose between the two. And I think there can always be a world where people don't have to choose between the two, and so we started Posha.
And this was 2017.
This was 2017, and we've been at it for 8 years, and we've been.
That's a long time. Yeah.
It's been a long time. It took some patience and persistence to get where we are, but we're finally in homes, in 200 homes, and people are loving Posha now.
So the machine is installed in 200 homes, but largely here in the valley.
That's right.
And what's the order book looking like?
A few thousand pieces. I don't have the exact number on top of my head.
Right.
But a few thousand units all across the US. There's been tons of demand from India, but we aren't shipping to India yet. But hopefully in the next few years, we should have Posha in India.
So Alberto, how did you come to Posha? I mean, what's the story there?
Excellent question. Well, I mean, I've been in like the tech world for 8 years, working on self-driving vehicles. I felt like there was more of a need for people to eat in the Bay Area. Lots of time is lost with working professionals. So I thought this was just the perfect, marriage to have like tech, AI, and cooking all together in one.
So from autonomous cars to autonomous food, but let's get started now, Raghav, and take us through what you're going to be, or what Posha is going to be cooking today, and how all of this works.
Sure. So Posha is a countertop cooking robot that helps you and your family eat freshly cooked meals every single day without having to spend tons of time in the kitchen. All you have to do is choose a recipe on the screen of Posha, put freshly chopped ingredients in the bag.
Okay.
Tap cook and sit back and relax while it cooks a meal for you.
Right.
It's got an induction cooktop here. It's got a pan that's removable.
Right.
It's got this stirrer and 3 different kinds of spatulas that get attached to a stirrer.
Okay, depending on what you're cooking.
That's right.
Yeah.
We have an exhaust in the back that makes sure your kitchen stays clean and does not get smelly.
Right.
We have these containers in the back that I just showed you.
Yeah.
This is where all the ingredients go in.
Yeah.
And
so that part you have to do yourself.
Yes.
The ingredients have to be placed yourself, but you have a spice counter right here.
Yes.
So the spices you don't do any, I mean, you just keep the counter ready and then the machine does the work for you. Yeah.
Okay. That's right.
Okay.
And then what I will do is I will actually make you cook food on it and interact with it.
Yeah.
So you can experience how easy it is to use Posha.
I'm happy to give it a shot. How many recipes does it come preloaded with?
We have more than 500 recipes right now, with new recipes being shipped out as content updates every single day.
Okay. And can I put in my own recipe if I wanted to?
We have a concierge service. Every time you see a recipe that's not on Posha, you reach out to us via this neat little button on top.
Okay.
You request a recipe, and we have our own in-house team of chefs who create that recipe for Posha, train it how to cook it, because it uses vision and cameras and AI to cook, and it's hard for us to allow a human to do.
Right.
And then it gets live.
Okay. Let's start with, what are we cooking today?
So just click on search, and we're cooking like a paneer tikka masala today.
Okay.
So you have that.
There we go. So I can smell the mushrooms as they're being sautéed, and we're waiting for the next steps to happen. But let's talk about how you managed to get investors to bite into Posha. I mean, take me, who's on the cap table?
So our first investor was Shailesh Tulshan. He's the managing partner of Exceed VC. He saw us in 2017 or 2018, I guess. Observed us for about a year and a half. He had run a restaurant himself for some time, so knew about the food tech, knew about how food was cooked and how tech could enable food. He often told us that, most people believe food is art, but I feel there is a whole lot of science into cooking, and I feel you're putting like science into food. So I would.
So he wrote the first check.
He wrote the first check. He was also able to convince Binny Bansal, who's the co-founder of Flipkart. To invest in us. Samay Kohli, who's the co-founder of Grey Orange Robotics, was an early robotics pioneer out of India. He put his name behind us and told us, hey, if you're unable to raise money, go to any investor, tell them Samay is backing us. And if that helps, I'm happy to put my name behind you. So Samay was really helpful. We got Waterbridge Ventures on board. Waterbridge Ventures, we had Manish Khetarpal, who's the managing partner, who sits on our board, and he's been super helpful. In the US, we have Asha Jadeja Motwani, who's the wife of late Rajiv Motwani, who co-wrote the PageRank algorithm. And I told you some time back, but Asha let me stay in her place in Palo Alto for many, many months. So I could bring Porsche to the US and bring it into the houses of all our customers.
Well, talking about Porsche's evolution, it started as a robotic arm and then morphed into this. Take me through why that happened, how that happened.
So we started out with a robotic arm. The problem we wanted to solve was very obvious. People wanted to eat freshly cooked meals every day, but struggled with finding time to do that in the kitchen every single day. We thought the robotic arm would be a natural solution, and who wouldn't? We built the robotic arm, showed it to the customers of Bosch, who happened to be a supporter back in the day, and the customers told us, well, we don't want a robotic arm in the kitchen. A robotic arm
it is kind of weird.
It's super large. It's an eyesore in my beautiful kitchen. It's so hard to clean. And who knows, it might strangle me if you have like the wrong software update.
Yes, you made a bad meal.
You made a bad meal. So clearly people did not want a robotic arm in their kitchen. So we thought, well, we have, we're on a fork now. We could choose to get this robotic arm into the cloud kitchens out there.
Go B2B, but
go B2B. Or we could stay true to the problem we've set out to solve, which is help families eat freshly cooked meals. We decided to do the latter, but that meant we had to change our product completely.
It's a nice looking box, I have to say. So how did that come about, the design? I mean, who worked with you on designing this?
Everything has been done in-house. So we have a team of talented engineers, computer vision scientists, chefs, marketers, product people who have worked very closely with customers, many of whom are top engineers and product people at some of the best tech companies on the planet. And we've taken 2 years of feedback from them, and that has helped shape Porsche today. Porsche sits neatly under your counter, and this is the standard size of any cabinet in the US.
Do you see this as we've seen people transitioning to coffee machines, dishwashers? Do you see that is that the hope, is that the bet that people will make that transition?
So 70% of all US households have a dishwasher installed. 70% of US, and just to compare that to India, it's actually less than 1% in India. Likewise, almost every household has a range. The hope is that very soon Porsche will attain what I call built-in status. Porsche is already very indispensable in consumer homes. People use it about 3 times a week. 3 to 4 times a week. It's more often than how much they use their coffee machine.
What's the ramp-up plan? I mean, you're manufacturing currently in China. You're hoping to be able to move that to India. But, when do you believe that journey may happen?
We're pushing for December of this year. It'll hopefully happen faster. It might take some time. But we're trying to move as fast as we can, to India. To reduce the geopolitical risks we have between US and China.
So what's the expansion plan from here now that you have these 200 households? You're of course working on refining the product. What's the expansion plan from here? I mean, you're currently only selling in a very small area, even within the US.
Correct. So we're only shipping in the Bay Area currently. we're sold out for the entire year. We have a few thousand units worth of pre-orders on our books. That's a few $1 million in revenue. And we're very consciously and deliberately and slowly expanding to other cities now. Some West Coast locations are on the map next, and we're also looking at Texas as a potential location to open up. So we're gradually going from west to east. New Yorkers will have to wait, and Europeans will have to wait even further. But
and Indians are going to. Is that even a market that you want to attempt to enter?
Indians are currently. I think India is currently a niche market, as I mentioned. For an established product category like a dishwasher, the penetration remains to be less than 1% compared to like 70% penetration in the US.
Yeah.
So India remains a smaller market for us.
Yeah, because it's not really that big of a problem in India. I mean, one, culturally as well, but two, also in terms of being able to outsource the job to somebody. So.
Right. So I think the way India is designed, so if you look at the map is divided into two halves. It's 4 billion people in India and China, and there's 4 billion people in the rest of the world. So India and China have a lot of people. So whenever there's a problem, people can throw people at the problem.
Yeah.
In the West, that's not the case, as you rightly pointed out. I think that is also the reason that Silicon Valley has flourished so much. And we're on Voices from the Valley. So I think it's very relevant to why the Valley has flourished.
Are you looking at raising more funds? Do you need more capital at this point in time?
We just announced a raise with Accel.
Okay.
Accel is one of the top 5 VC firms on the planet. We're not raising right away, but if something comes down our line, we would be more than happy to
take me through the investor conversations. How did you get them to bite into spending money on this product?
I think what Accel likes to see in a deal is in a deal at a stage like ours is early signs of product market fit. So do you have customers who can't stop talking about you? Is there high usage? Is there high retention? Are there high referrals? And all those boxes checked for a small base of customers that we had. And so Accel decided they wanted to participate and be part of the story.
Okay, so this is now the key moment of the day. We're going to finally sample what Porsche has made. It is the paneer tikka masala. Thank you, Alberto. And I'm going to dig in. It's good.
You like it?
Okay. It is good. The story of Porsche. They're trying to automate the kitchen with their robot here. I have to say the food does taste good. Whether this is going to take off just as the way that coffee machines and stoves and Instapots and dishwashers did, time will tell. But here's wishing the team at Porsche the very best of luck from all of us here on Voices from the Valley. Bon appetit.
Welcome to a State Bank of India special as the Grand Old Bank celebrates its 70th birthday today. SBI is, of course, mini Indian economy, accounting for 20% of the country's bank credit, 22% of the country's bank deposits. 55 years ago, SBI was born when the Imperial Bank was converted into State Bank of India under the SBI Act. Since then, its deposits have grown, hold your breath, 25,500 times. Its profits in the latest year at 77,561 crores was 52,000 times what it was in 1955. When the nation is in trouble, it looks to SBI. At the height of the balance of payments crisis in 1991, SBI raised $1.6 billion through the India Development Bonds, and it repeated this feat again after a decade during the Pokhran nuclear test in 1998 when India faced sanctions. SBI personnel go on to head many other banks, Yes Bank included, and also staff the RBI and the SBI. You know, there is a deputy governor over there. Most important, SBI has changed with the times. In its 50th year, the bank gave its younger competitor HDFC solid competition in home loans and actually won that competition. Today, with its YONO, it is competing with even fintechs. And on that celebratory note, may I welcome the birthday boy of the day, SBI Chairman, Mr. Challa Srinivasulu Sethi. Mr. Sethi, thank you very much for dropping into our studio on what must be a big day back home at SBI.
Thank you, Lata. It's a great moment for all of us. And I wanted to be in your studio to celebrate this occasion.
We are honored. We are honored.
And, I think the journey of SBI is also synonymous with the journey of India. I think to that extent, it's a great moment to celebrate.
Absolutely, sir.
Thank you.
Actually, when SBI comes, one looks at the future. And so will our viewers. So just give us an idea. What are the immediate targets you have set the bank?
I don't call them targets, but we believe that if you have seen the journey of SBI, it always reimagined its role and stayed relevant.
Yes.
So we believe in SBI that going forward, while we have seen a lot of disruptions in the last 70 years, the disruptions will be much more frequent and much more deeper. So how do you handle these disruptions coming in, particularly in terms of your business models, in terms of the service delivery, in terms of customer protection? I think we all want to focus making SBI ready for another maybe 200 years. Okay. This is what. So the center to this plan is our digital transformation journey. While we have, as you mentioned, the scale and we have the trust of the people, but the scale and trust alone will not make you the best and most preferred bank.
Yes.
So we would like to assure our customers and stakeholders that our investment in technology, digitalization will continue so that the customer engagement with us, which will be much more seamless.
Okay. Well, actually, would you say that in the journey, in the 75 years, the government and the regulators' attitude to SBI and state-owned banks has changed? I mean, first, PSU banks, after nationalization, were part of the fisc. There was financial repression. But in 1991, you all were listed. SBI was listed first. And after that, more recently, I mean, the CRR cut, there is no big danger in front of the country. Still, the CRR cut is given so that I think banks have a fair chance against mutual funds. Would you say the attitude is changing to give you all a fair chance?
See, the public sector banks are having a dominant market share.
Yes.
Some of them would have lost the market share, but I think they're all trying to...
Collectively, 60%.
Collectively, we are the dominant players in the industry, which means that any initiative, either by the government of India or by the regulator, cannot be meaningfully taken to the economy and the general public unless there is a wider participation of the public sector banks. I don't think there is any shift in the attitude. But one thing I can definitely tell you that maybe for the last 2-3 decades, or definitely in the current decade, is that we are getting a absolutely commercial banking approach within the public sector banks, and what I call ownership neutral approach towards serving the customers, and that is getting reflected. Obviously, the CRR cut is not meant for only for
getting a level playing field.
Absolutely.
Okay.
Absolutely.
That has been the tone of the Reserve Bank, but I think the banking sector, that is public sector and private sector, have got a better deal this year with liquidity being thrown in and the CRR cut. How are you looking at this combo affecting your credit growth? I believe the finance minister also met you all. Do you think this year the credit growth will be much better? Last year, I think we are finishing at 9-10%, FY25. What is your sense of this?
Since our silent period started now, I can't...
I'm asking you about the sector.
We can't talk only about SBI, but I think in general, what are the preconditions for any economic growth? I think those things are being ensured fairly well in terms of, ensuring that the system liquidity is adequate. And as you mentioned, CRR cut will add further liquidity to the system. Apart from the benefit of protecting the margins, which the cost of funds are reduced. The other thing is that the upfronting the rate cut, these are all indications, signaling obviously is towards ensuring that the growth is on the higher pedal. I think this is
higher priority.
Higher priority. And the Government of India's initiative of putting some extra money in the hands of the people to encourage the consumption by reducing the rate of taxation.
You give me numbers for the banking sector, sir. I know I don't want to corner you on your silent period issue.
The banks will definitely come back to the credit growth.
So you think we could do 13, 14? I don't know how well you remember the 2002 to 2004 period. Reserve Bank had cut rates from 15 to 8%. After the Pokhran, we had to raise our rates, and then Asian crisis, we brought it down dramatically. But credit growth didn't pick up for another 2 years. It remained at 10%. And then only in 2005, we see this 25% jump in credit. When it slows, takes time to grow.
Absolutely.
But now do you think it can be faster?
I think it is. Stage is set in my view, maybe a couple of quarters from here. One is the corporate credit has been a challenge for the last few quarters. It is mainly because they're all sitting on a
retained profit,
reasonable cash flow, cash availability to them. And I believe that a lot of brownfield expansion, which is undertaken by them, is being taken by their own cash. And that is also getting reflected. If you see the SME growth, we are all witnessing good growth in SME, which means that SMEs are basically B2B businesses, right? If the corporates are not giving the orders, they're not going to perform better. So which shows that the corporates are spending and also giving the orders to SMEs. But the next inflection point for the capital expenditure would have to come. One is most of them are operating at 75 to 76% capacity utilization. And a sustained consumer sentiment and consumption growth. It is not that it's not there, but I think people would like to see the sustained level of that.
You're saying that CapEx has not picked up, but it is looking set to pick up.
All set to.
Okay. What's your sense about margins? Again, for the sector, I'm not cornering you. Because you're going to get this, the rate cut will take away your margins, but the CRR cut will give you back margins, and it comes with a multiplier. Yeah. Every subsequent deposit will give you some gain. So will you come back to your FY25 margins in 4 quarters, 6, or for the banking sector? Does it take 4, 6 quarters to come back?
Most of the banks have indicated that it will be a kind of U curve for the NIMs that you will have. I mean, there is no rocket science in that.
Yes.
There's a lag of deposits getting repriced, whereas...
How much? Is it 2 quarters lag, 4 quarters?
No, I think we'll have to look at Q4 end state.
Okay.
And most of us probably would be sticking to our margins at the Q4 end state. That is what I can tell you now.
I wanted to come to the SBI history itself. As you cast back 70 years, I guess you would have been at least for 1/3 of that.
More than that.
Yeah, more than that. Okay, 35.
37.
Half the history you have seen. Any one memory or any few things that absolutely stand out?
If I have to, of course, there are many things.
Yes.
SBI, there's no dull moment in SBI that I keep telling that. But if 2 things which we have to see from an institutional perspective, not from individual perspective, I think the liberalization has completely given a new paradigm for SBI. See, till that time, you're a dominant player. We still are a dominant player.
The deposit and lending rates were set by RBI.
Absolutely. And then you have new age players. Post-liberalization, you have new private
bank
banks.
licenses.
And many things which have happened. My view, I think the watershed moment for banking as a whole and SBI in particular has been the post-90s.
Okay.
It has given both opportunities and risks. Risk of, we have completely had to remodel our risk management. That the global risk and your own internal economical risk which needed to be relooked at, while the opportunities were aplenty.
Okay.
So I think that is one. And the second important element, I think, for the country, globally, I think, unprecedented COVID was another thing what we really learned many things. It was an extreme business continuity process ensuring, right? You can't have a better testing of your BCP preparedness.
That's right.
I'm very proud that SBI has come out extremely well in terms of our commitment to customers.
Oh yes, not just that. Look at the quality of the balance sheet. In spite of going through a period when people could not go to work.
Absolutely.
I guess you have a historic low in terms of net NPAs now, 0.5% or less than that.
Less than
that. That's quite a record. But since you say 1991, you all got listed in 1990. Right? Now, will you use this 70th year to mark some listings? You already have 2 babies listed. Will more come?
No, the babies will, I think, have to still grow up. It will take some time.
Okay. The market is kind. You're not likely to use
not yet.
All-time highs, very close. And what about SBI itself? You're not looking to use the market's good
we
mood.
did take the enabling resolution for QIP
That is why I'm
of 25,000 crores. I think while the timing is not decided, we have time up to March 26 to launch this QIP.
Okay. So again, let me ask you to cast your mind back. What would you say were the most challenging moments for SBI? When did you all spend sleepless nights?
So, I don't think we spend sleepless nights because of, I think, crisis management inherent to us. Yes, I do agree. COVID was difficult, not because of any business environment. We had to protect the customers who are visiting our branches and, more importantly, protect our staff. I think if you really ask me from a management perspective, that was the most traumatic period which we all have gone through.
Okay.
And probably none of us have taken a day off, except when we ourselves got infected by COVID. Yeah.
Okay. What do you see as the advantages going forward because of digitalization? SBI had to bear the cost of putting a branch in a boat house in Kashmir, in probably an island off the coast of Kochi, or up in the peaks at Kargil. You have, I think in Natula you have a branch. So you'll have had to put these distant branches. Do you think branch costs will come down now because you can reach people digitally? Do you think sizes of branches will come down?
No, first of all, I don't think SBI ever looked at this obligation as a burden.
No, that you didn't.
That also had helped us to have the reach, which is helping us to be a dominant player in deposits. First, that is what I wanted to say. But more importantly, 2 things what we are trying to do is, one is, of course, digitalization is going to help in reducing the costs and turnaround time.
Okay.
Today, we launched one business rule engine data-based SME lending platform.
Okay.
You would be surprised that approval is given in 40 minutes using the data. 40 minutes, which means that my operating people who are processing these loans can process more. So at the branch level, we have simplified the whole customer account opening journey. I keep saying that we open around 60,000 accounts every day. So when you're opening such large number, you have to cut down on our turnaround time. We used to take 3 to 4 hours to open the account, but on average it is now we are able to do it in 15 to 30 minutes.
Okay.
That means you can do more and you liberate your people to do various other activities. But what we are focusing is that how do you simplify the whole internal processes so that the customers can be served better? A lot of customer journeys have been reimagined. Today you can do the fund transfer in 3 seconds, 4 seconds. But why is that at the branch level there are cumbersome processes? we want to completely reimagine the internal processes so that our, we call a project called operational process reengineering, which will completely simplify the high volume business process.
Okay. But in that case, will you go down the path of unsecured loans since you are so confident of your digital data? Actually, the unsecured loans going bad, even in last year, when Reserve Bank blew the whistle, came as a surprise because we thought loans are being given by the entire banking sector on the basis of good digital data. Do you see now a chance of Reserve Bank lowering risk weights or banks themselves making more money on unsecured loans in the coming quarters?
No, I think the unsecured personal loans ecosystem looks better now, obviously. I don't think the risk weights will be reduced because it is only reinstated what was earlier the pre-COVID. But what do we see in the system is that less delinquencies in the personal segment. Okay. I believe the system level, personal level loan growth will come back. Okay. It may not be 25-30% what we witnessed, but I think it will be a double-digit growth rate. But in our case, let me also tell your audience and you is that we are the largest personal loan provider in the country. With in
volume,
you never said. So, which means that our data-based appraisal system has held on very well, and we have the lowest default rate in the personal loans.
Personal loans. Okay, that's good to hear. At the moment, what is the biggest loan growing category? I mean, what would you bet? Your guidance was 13% loan growth. So, which would be the winning horses?
See, in our case, the growth comes from all segments. Okay. That's an advantage for SBI. We have several swim lanes. I keep saying that if one swim lane is not moving faster, we will go to another one. But I think it will be a broad-based credit growth. But for the system, I think home loans will continue to play an important role.
Okay. Despite the fact that we hear real estate is speaking of, despite
in some markets maybe, but I think overall nationwide, I think the home loan segment.
Real estate could be peaking off even because of commercial buildings.
Yes. So. And also because of the luxury segment. I think there will be more focus on the middle level segment and also affordable segment.
Affordable segment. Okay. What's your going ahead? What do you see as the big challenge for SBI?
I did mention in terms of the challenges that how do you stay relevant?
Okay.
And when you are operating at scale, how do you manage your risk? I think this very important. A lot of people keep asking is that, your profitability ratios are low and all. We have the largest number of people who are engaged in the risk and compliance management.
Okay.
When you have a scale of, like, for example, as on 31st March, we were 96 lakh crore business was managed by us, both advances and deposits together. And 23,000 branches, 2,35,000 employees, which means that your aggregate risk can go out of hand if you do not have very robust risk management practices.
Fair point, sir. Fair point. What is your sense of, have you given your team a target for cost to income? Analysts will repeatedly tell you that your cost to income is higher than other banks.
So no, the effort is to reduce and moderate that. But as I mentioned, I think there's only so much we can reduce on the cost to income ratio because we have one of the most compliant organizations in the country, which means that we've spent a lot of resources on the risk and compliance management. But broadly, I think we would like to maintain at the level what we had in 31st March.
Okay. Well, that's a pleasure, sir. Thank you very much indeed for coming to our studios to celebrate your birthday. And please take back a message from all of us, wishing every SBIite very many happy returns and many, many more years of fruitful service to the country. Thank you very much.
Thank you, Lata, for having me here. Thank you.
Well, that's it on this very special edition of Indianomics. Thanks for watching. Welcome to a State Bank of India special as the Grand Old Bank celebrates its 70th birthday today. SBI is, of course, mini Indian economy, accounting for 20% of the country's bank credit, 22% of the country's bank deposits. 55 years ago, SBI was born when the Imperial Bank was converted into State Bank of India under the SBI Act. Since then, its deposits have grown, hold your breath, 25,500 times. Its profits in the latest year at 77,561 crores was 52,000 times what it was in 1955. When the nation is in trouble, it looks to SBI. At the height of the balance of payments crisis in 1991, SBI raised $1.6 billion through the India Development Bonds, and it repeated this feat again after a decade during the Pokhran nuclear test in 1998 when India faced sanctions. SBI personnel go on to head many other banks, Yes Bank included, and also staff the RBI and the SBI. You know, there is a deputy governor over there. Most important, SBI has changed with the times. In its 50th year, the bank gave its younger competitor HDFC solid competition in home loans and actually won that competition. Today, with its YONO, it is competing with even fintechs. And on that celebratory note, may I welcome the birthday boy of the day, SBI Chairman, Mr. Challa Srinivasulu Sethi. Mr. Sethi, thank you very much for dropping into our studio on what must be a big day back home at SBI.
Thank you, Lata. It's a great moment for all of us. And I wanted to be in your studio to celebrate this occasion.
We are honored. We are honored.
And, I think the journey of SBI is also synonymous with the journey of India. I think to that extent, it's a great moment to celebrate.
Absolutely, sir.
Thank you.
Actually, when SBI comes, one looks at the future. And so will our viewers. So just give us an idea. What are the immediate targets you have set the bank?
I don't call them targets, but we believe that if you have seen the journey of SBI, it always reimagined its role and stayed relevant.
Yes.
So we believe in SBI that going forward, while we have seen a lot of disruptions in the last 70 years, the disruptions will be much more frequent and much more deeper. So how do you handle these disruptions coming in, particularly in terms of your business models, in terms of the service delivery, in terms of customer protection? I think we all want to focus making SBI ready for another maybe 200 years. Okay. This is what. So the center to this plan is our digital transformation journey. While we have, as you mentioned, the scale and we have the trust of the people, but the scale and trust alone will not make you the best and most preferred bank.
Yes.
So we would like to assure our customers and stakeholders that our investment in technology, digitalization will continue so that the customer engagement with us, which will be much more seamless.
Okay. Well, actually, would you say that in the journey, in the 75 years, the government and the regulators' attitude to SBI and state-owned banks has changed? I mean, first, PSU banks, after nationalization, were part of the fisc. There was financial repression. But in 1991, you all were listed. SBI was listed first. And after that, more recently, I mean, the CRR cut, there is no big danger in front of the country. Still, the CRR cut is given so that I think banks have a fair chance against mutual funds. Would you say the attitude is changing to give you all a fair chance?
See, the public sector banks are having a dominant market share.
Yes.
Some of them would have lost the market share, but I think they're all trying to...
Collectively, 60%.
Collectively, we are the dominant players in the industry, which means that any initiative, either by the government of India or by the regulator, cannot be meaningfully taken to the economy and the general public unless there is a wider participation of the public sector banks. I don't think there is any shift in the attitude. But one thing I can definitely tell you that maybe for the last 2-3 decades, or definitely in the current decade, is that we are getting a absolutely commercial banking approach within the public sector banks, and what I call ownership neutral approach towards serving the customers, and that is getting reflected. Obviously, the CRR cut is not meant for only.
You're getting a level playing field.
Absolutely.
Okay.
Absolutely.
That has been the tone of the Reserve Bank, but I think the banking sector, that is public sector and private sector, have got a better deal this year with liquidity being thrown in and the CRR cut. How are you looking at, this combo affecting your credit growth? I believe the finance minister also met you all. Do you think this year the credit growth will be much better? Last year, I think we are finishing at 9-10%, FY25. What is your sense of this?
Since our silent period started now, I can't...
I'm asking you about the sector.
We can't talk only about SBI, but I think in general, what are the preconditions for any economic growth? I think those things are being ensured fairly well in terms of, ensuring that the system liquidity is adequate. And as you mentioned, CRR cut will add further liquidity to the system. Apart from the benefit of protecting the margins, which the cost of funds are reduced. The other thing is that the upfronting the rate cut, these are all indications, signaling obviously is towards ensuring that the growth is on the higher pedal. I think this is
higher priority.
Higher priority. And the Government of India's initiative of putting some extra money in the hands of the people to encourage the consumption by reducing the rate of taxation.
You give me numbers for the banking sector, sir. I know I don't want to corner you on your silent period issue.
The banks will definitely come back to the credit growth.
So you think we could do 13, 14? I don't know how well you remember the 2002 to 2004 period. Reserve Bank had cut rates from 15 to 8%. After the Pokhran, we had to raise our rates, and then Asian crisis, we brought it down dramatically. But credit growth didn't pick up for another 2 years. It remained at 10%. And then only in 2005, we see this 25% jump in credit. When it slows, takes time to grow.
Absolutely.
But now do you think it can be faster?
I think it is stage is set in my view, maybe a couple of quarters from here. One is the corporate credit has been a challenge for the last few quarters. It is mainly because they're all sitting on a
retained profit,
reasonable cash flow, cash availability to them. And I believe that a lot of brownfield expansion, which is undertaken by them, is being taken by their own cash. And that is also getting reflected. If you see the SME growth, we are all witnessing good growth in SME, which means that SMEs are basically B2B businesses, right? If the corporates are not giving the orders, they're not going to perform better. So which shows that...